have collateral. The ETFs don't have permanent capital. MicroStrategy, for example, can take our $40 billion of Bitcoin, and I can sell you the senior $4 billion tranche as a security, and I can say, you're going to be 10x over collateralized. So if Bitcoin trades down by a factor of 90%, you're still getting paid back. And that's a very compelling proposition for someone that's risk adverse, that's Bitcoin curious. And so all of those investors are coming to the market right now, and Bitcoin serves some of them. The spot ETF serve some of them. Companies like MicroStrategy serve others that are either very risk averse or they want leverage and performance.
So the debt that you issued is convertible debt. Does that mean that there's no ability for the debt holders to recall the debt? There's no liquidation price, so to speak. Is it all is the conversion in place of any kind of right to recall the debt, specifically if Bitcoin goes down?
People think it's debt. It's convertible debt. It's unsecured, no recourse. What that means, Ron, is that Bitcoin could go from $100,000 to $1,000. The debt's not getting called. There is no recourse. Bitcoin can go to $1. You see, Bitcoin can literally go to 1 penny. The debt doesn't have. There's no call feature, and so it's like basically someone loans you billions of dollars, and you agree that in 5 years you will either pay them back in cash or in stock. But you know what happened is if Bitcoin crashed by 75%, the stock would trade down. We would just pay off the debt with stock. So the risk isn't in the debt so much as it's in the equity. But the point, and the people are like, oh, well, that makes the equity more risky. Well, yeah, that's the point. The point is the people buying the equity want the equity to trade down harder than Bitcoin, and they want the equity to trade up harder than Bitcoin, because some of the people that buy the equity are the convertible arbitrageurs and the options traders. The options trade, like there's a lot of people that want to short the equity. Why do they want to short the equity? Because they're hoping that if Bitcoin trades down, they get a 1.5 boost or a 2 boost. That's what makes it a compelling thing. So if you don't want volatility and leverage, don't buy the equity, right? Buy the bond. And if you want something in the middle, buy Bitcoin if you want to hold a commodity, or buy the ETF if you want to hold the security wrapper of the commodity. And everybody's got different risk profiles. So we're just providing people with the kind of risk and reward and volatility that they want.
I mean, it really sounds like you've engineered the ultimate financial product. Like it just sounds like the more I hear you talk about it, the more I hear you explaining all the different volatilities. It just sounds like you've really spent time engineering the ultimate financial product around the ultimate financial, the ultimate commodity, so to speak.
There's no doubt. This is probably the most exciting opportunity for financial engineering in the world. Certainly in the 21st century. And that's what we're doing. And you need an operating company to do it. And it's definitely engineering. You got to understand volatility and risk and collateral, and performance. You have to understand where the performance is coming from, but you also have to understand the customers. Let me come back to, again, like Standard Oil. I take crude oil. Some people want asphalt. Other people want gasoline. And some people want kerosene, and some people want nylon. I mean, it's definitely engineering. You're like, how does all that stuff come out of crude oil? Well, it does. You're a chemical engineer. You're like, is that a gimmick? Is that a hack? No, it's just engineering. If I give you 60 ARR, 60 vol in crude capital, you can strip 90% of the return out of it, and you could pay someone 6% coupon, 10x over collateralized, and there's a market for that. And yet you would get 90% of the economics, right? You basically get 90% of the return. They get 10% of the return. And believe it or not, there are people that will buy bonds that pay 6% interest, right?
Yeah. I mean, no, I think it's a thing. Mike, do you think, and do you encourage other people to copy the model? Do you think that there are others that can copy the model, or do you think that it can't be copied because most people don't have an operating business? Like, I'm trying to understand. You're very open about your playbook, and you know, is it part of your strategy to get as many people to do what you're doing as possible, or do you believe that people won't be able to replicate the business?
I think every company in the world should recapitalize on Bitcoin. So like that's 400 million companies. So I think all 400 million should. I think every family, every individual should. I think every government should. I think Microsoft should recapitalize on Bitcoin. I think your bakery should. I think all the Bitcoin miners should. So yeah, everybody should recapitalize on it, right? You're talking about capitalizing on an asset that's 60% ARR, 60 vol, instead of an asset, the US dollar, that's 0 ARR, 0 vol. Another way to say it is, I think we ought to put an internal combustion engine in every horseless carriage. I think we ought to put a gasoline-powered engine in every house, every plane, every train, every automobile, every factory, right? I mean, I want to put a fire in every vehicle on the planet. That's what Henry Ford did. That's what John D. Rockefeller did. They put a fire in everything. And I think you could think about this as a crypto reactor fueled by Bitcoin. Bitcoin's the fuel. It's a crypto reactor. We should put one in everything. Now, in terms of the business model, let's think about the generic idea. The generic idea is you have assets. If they're going up 0% a year and the cost of capital is 15% a year, you're losing, it's minus 15% a year. Your capital is being destroyed. So that's the US dollar treasury strategy. The Bitcoin strategy is plus 45% versus the cost of capital. So everybody can do that. Meta, Apple, Microsoft, Disney, everybody can do that. Every Bitcoin miner.
But I mean,
now when you go further,
not everyone can do it to the extent that you've done it, where it's become multiples bigger than your existing business.
My point is, we're not that. We're a treasury company. So there are three different models that are worthwhile to discuss here. Every company on earth, like Disney Corporation, like Apple, if they simply switch their treasury to Bitcoin, they'll probably double their growth rate and double their market cap. Okay, and they will cut their risk in half. Okay, so anybody can do that. That's very simple.
Why do you say they would why do you say they would cut the risk in half? I understand the first part. Explain to me why you believe that the risk would be cut in half.
Let's take Microsoft. Microsoft right now has a market cap that is 95 to 97% valued on forward expectations.
Correct.
And its multiple to NAV is 20. People talk about multiple to NAV, right? Well, multiple to NAV of Microsoft is 20. And that means that for every $20 in market cap, they have $1 in some tangible asset. And so the other $19 are based upon like 144x multiple of quarterly earnings. And so if they were to ever announce that they think their quarterly earnings will be down by 30%, you've got like $1 trillion of market cap that evaporates overnight. So most companies, they don't have any assets. Most operating companies don't. What they have is forward expectations. And that's why you see these stocks crash all the time when the company has an earnings call and they say, we've taken down guidance. When if the CFO says, well, I think the guidance will be like 6% instead of 9%, your $2 trillion company becomes worth $1 trillion in 1 minute. Now, how does that work with institutions and foundations and wealthy people? For example, how much of Jeff Bezos' wealth or Bernard Arnault's wealth or Elon Musk's wealth is based on forward expectations? And the answer is none of it. Actually, their wealth is based on the actual assets they own that are marked to market. Like if you go to Harvard University, Harvard might have a $20 billion endowment. You're like, well, the endowment's worth $20 billion. Well, how much of it is the forward expectations of the profit from the university? None of it.
None of it.
See, none of it. So the wealthy in the world, they're valued based upon assets they own. I know a lot of billionaires, they're like, well, we don't really want to own operating businesses. We want to own property business. Like I give you a choice. You can have a business that makes 100 million a year, valued at 100 times expectations, or you can have $10 billion worth of actual property outright. Which of the two of them do you want to own, right? Of course, the latter, because you don't have to do anything. On January 1st, you get up, you own $10 billion of property, the money printer runs. At the end of the year, you own $11 billion of property. You made $1 billion. What did you do? Nothing. Right?
You remove the volatility. You remove the unknowns. You remove the risk.
So the irony, of course, is people think it's risky to own Bitcoin, and they think that they're stripping the volatility by getting rid of their capital, dividending it out, and buying back their stock. And the truth is, it's the opposite. When you're taking all your capital, investing it in bonds, or buying back your stock, or paying dividends, you're stripping the real productive assets from the balance sheet. You're levering up the company until it's trading 100 to 1 against quarterly earnings, or 200. There are literally companies with no assets that have $4 billion in earnings a year that are worth $200 billion. And they're trading at insane multiples. And if they basically put out a press release saying, we think next year will be half as profitable, the company loses $100 billion overnight. So I don't want to get distracted on this, because I want to make my bigger point. What I'm saying is every company in the world, operating companies, public companies, they're actually running without any assets, without any capital. 90 to 95% of the company's market cap is just forward expectations that are subject to crash anytime. So buying Bitcoin de-risks that. If we come back to the Microsoft example that I laid out in my presentation to the board of Microsoft.
So how was that? Was that really a 3-minute presentation?
You're going to let me finish? Let me finish.
Okay.
You keep interrupting me, and so I can't make my point, and then you're just confusing everybody. And I want to answer the question, because you asked the question. If you don't let me answer the question, people on the stream won't understand why I said what I said. If Microsoft converts to the Bitcoin standard and they start sweeping their cash flows, their dividends, and eliminate their buybacks, over 10 years, you end up with a situation where the company generates $4 to $5 trillion of Bitcoin value, and it might be worth 10 trillion. So 50% of the market cap of the company is based upon digital capital. Right now, 95 to 98% of the company is based on expectations. So you see what you've done is you're acquiring property with your cash flows instead of surrendering your capital. That's why I think that any company in the world should do it. You de-risk the stock and you double the asset value of the company, and you decrease the stress on the management team and on the employees. And that means you don't have to force your customers into 3-year enterprise agreements, bundle all your products in, and sign them to a 3, 4, 5, 10-year lease. And if you look at big companies like Apple and Microsoft, increasingly and all the big software companies, they go to long-term enterprise agreements that look like rental contracts. And those rental contracts put stress on the customer. They put stress on the management team. Eventually, what happens is the customers and the partners complain to the regulators, and they want you to be a regulated monopoly. So if you strip your assets from your balance sheet, you're on a road to serfdom. You're going to end up as a regulated utility company, like a power company or electricity company. That's why I say every company can benefit. Let me go to the next model. The next model isn't MicroStrategy. The next model is any company that has assets like real estate or art or energy that is not that interesting to the market, where it returns less than the S&P index and has less volatility. That's dead money. That's a zombie company. You either can't take it public, or if it's public, everybody loses interest. If you recapitalize that company with Bitcoin, you take 7 vol, 7 ARR art, and you add 60 vol, 60 ARR Bitcoin, and you do 1-for-1, you end up with 35 or 40 ball, 40 ARR digital art. Now you can take the company public. Now you are going to outperform the S&P. Now you can raise billions of dollars of capital. Now people will trade your options. And now you've actually got a very hot stock. So you can fix any zombie, or you can monetize art, real estate, or any other asset class by bolting on Bitcoin instead of gold plating something. Like if I wanted to monetize a lighter or a pen, I would gold plate it in the gold era. I would Bitcoin plate it. I put a crypto reactor behind my art company or behind my real estate company or behind my energy company. And now I outperform the S&P. Now, the third business model is the MicroStrategy model. We're a pure treasury company. So what we're doing is we're creating a Bitcoin reserve, and we're stripping the volatility and the risk to create fixed income, low risk, mid risk, high yield, and then a Bitcoin type performance, and then a 2x, and enabling a 3x, a 10x, a 20x on the options ladder. So we're a pure play. The answer to your question is most companies won't do that. I mean, Metaplanet might. There could be like a company like MicroStrategy in every market. There could be one in Japan. There could be one in the UK. There could be one in Brazil. There might be 2 or 3. So there will be some of them. But that's a special class of crypto treasury company that these other companies, the zombie companies, juice their company. They're going to basically do 2 to 10x by putting Bitcoin on their balance sheet. And then all of the well-run traditional companies like Microsoft, they're going to 2x their market cap, and they're going to cut their risk in half. Those are the 3 business models, and I think that all of those are probably the most interesting thing going on in the world. Now, if you want, ask me the next question.
Okay, so I'm going to go through all 3 of the business models. In terms of the last business model, which is the MicroStrategy business model, you said there's going to be one, there's Metaplanet, and there may be one in every jurisdiction. Do you encourage there to be more than one in the United States, or would that be competitive? And the reason why I say would that be competitive, because on the one hand, the more companies that buy Bitcoin, the more treasury companies that spring up around the world, the better it is for the asset, and therefore the better it is for MicroStrategy. But you seem to say that there's going to be one in everything. So would you encourage a competitor picking up your exact playbook and executing on your exact playbook in your backyard?
I would. I do it with. I tell Metaplanet to do it. But the truth is, nobody seems interested in doing that in the world, other than I think the closest is maybe Metaplanet right now in Japan. As a practical matter, every company that's a public company has an existing business, and they don't want to jettison it, right? For you to do exactly what MicroStrategy is doing, the Bitcoin treasury component needs to be 10x bigger than any other business you're running. So as a practical matter, I mean, the companies that are closest to us would be, say, Mara, but Mara's still got a really big Bitcoin mining and data center business, which is fine for them. I mean, and I think it's kind of a moot point, Ron. You're trying to create controversy for no reason. There's 50,000 public companies that could just recapitalize on Bitcoin and 2x to 10x their market cap, and still, like, I'm not going to tell Disney sell the theme parks and be MicroStrategy, and they're not going to listen to me anyway. So it's a moot point. A company that if Berkshire Hathaway took $100 billion and created Bitcoin Hathaway tomorrow, then they bought all Bitcoin, then they could almost be like MicroStrategy. But who's going to trust Bitcoin Hathaway when they've been in the market for a month? Right? I mean, in order to get trust, you have to have hodled through the crypto winter. And you look at the Sailor tracker, and you can see that we bought Bitcoin in every quarter, like more than 40 times. And so we have credibility. We have a $100 billion market cap. We have $40 billion of capital. I'm not terribly worried that a $1 billion company is going to catch us. And I'm not terribly worried that Google is going to put $200 billion into this, because even if Google bought $200 billion of Bitcoin, they would still have a $2 trillion company valued on the Google business and YouTube, you see. So So I think we're wasting time trying to figure out how some company copies or beats MicroStrategy. Is it a problem? It's totally not. But like, figure out how to create $100 billion business with 40 billion of Bitcoin with no other exposure. That's the other point, because you can't own anything else. If you own real estate or bonds or high tech or Nvidia, all of that stuff is dilutive and distracting, and it undermines the volatility. The reason MicroStrategy works is it is pure Bitcoin 2x. And so you have to create, and by the way, it's pure Bitcoin 2x and trusted. You know, you have to have $100 billion of investors in the options market and $100 billion of investors in the equity market who have to trust you to not sell the Bitcoin and to keep buying Bitcoin. So we're kind of unique. I don't claim any brilliance. We literally backed into it and got lucky. But the truth is, I think Apple and Facebook and Google and Microsoft got lucky too. I mean, and Nvidia, it's like they were doing something. They knew it would be good, but they didn't know it would be 100x better than they expected. It's like, they kind of, you do something and then the market 100x's and you just happen to be there and then you're Google. Okay, so MicroStrategy kind of happened to be there when the market exploded, so good for us. But I think focusing upon us is the wrong point. Here's the point. You can create a Bitcoin treasury company in France, in China, in Russia, in Hong Kong, in Tokyo, in Brazil. You can probably create one or two more in the US. Have at it. I'm fine with it. I'm not really worried. We raised 13 billion last month. We're going to go very, very hard. If you can go that hard, Bitcoin would go to millions of coin. If you can't go that hard, you'll just be another one. And then there's a lot of room it's very constructive competition. The more important point is every Bitcoin miner should recapitalize to Bitcoin. That's the important point, right? The big idea is there's like 20 publicly traded miners. When you raise $1 billion and you buy Bitcoin mining equipment, you're buying hardware, which is depreciating 20% a year physically, where it's getting 20% a year less profitable because of the hash rate, where it's getting 20% a year less profitable because of the protocol, or 10%. So you're buying something that is minus 60% a year in productivity. You're investing in an asset which is losing 60% a year in productivity. When you buy Bitcoin, you're investing in an asset which is increasing 60% a year in productivity. So it's a very simple idea. Why would you burn 60% of your money every year, throwing it into a competitive hardware business where the protocol is taking you to zero, when you could increase your capital by 60% a year by simply buying the asset which the entire world wants? So that's what Mara is doing. That's what Hut 8 is going to do, right? That's what all the enlightened miners are doing. I think the fiat miners somehow think it's better to invest in data centers or invest in hardware. And by the way, you could say, well, we're going to switch to NVIDIA chips. The only difference between NVIDIA chips and Bitcoin mining chips is NVIDIA is depreciating 20% physically because it's burning out and obsolescing, and then another 20% depreciation because of competition. So instead of minus 60% a year, it's minus 40% a year. And so I think that if you're in the crypto ecosystem and you're a publicly traded company, you ought to recapitalize the Bitcoin. You should sell equity and you should sell debt to buy Bitcoin. You're going to make money. You'll rinse and repeat. You're going to go from a $5 billion or $2 billion business to 10 billion, 20 billion, 40 billion, 80 billion, 160 billion. That is the Bitcoin way. The fiat way is you're going to invest in expensive electricity, expensive data centers, and depreciating NVIDIA chips or in depreciating in Bitmain chips. And that's basically taking you to zero, right? And that doesn't really make a lot of sense. Now, every other company in the world, every zombie company, every restaurant, every hotel, every travel company, every airline, every whatever, they've all got a US dollar capital structure. It's like you got a wood burning stove in your house, and I'm telling you, put a crypto reactor and fuel it with Bitcoin, and you'll have unlimited clean energy forever. And the most useful thing we could do is get that word out and get people to wrap their head around the idea of a crypto reactor on your balance sheet where Bitcoin is the fuel. And if you do that, then your balance sheet becomes a wealth creating asset. And for 50 years on the fiat standard, when the dollar is 0-0, zero vol, zero ARR against itself, for 50 years, the balance sheet was just a nuisance. It's like your appendix, or we don't know what it does, but it's like having your left arm tied behind your back. It's now possible to use your left arm and your right arm. You ever see someone try to lift a weight with their arms and not their legs? What I'm saying is use your legs, use your whole body to lift your weight. Don't just use your arms. Nothing could be simpler. All you have to do is think in Bitcoin, embrace the volatility. By the way, everybody runs from volatility. Volatility is fire. Are you the primitive Neanderthal that runs from fire? Because animals and wolves and sheep run from fire. Or are you an engineer? Are you going to embrace the fire, put it in an engine, and then put it in your plane, your train, your automobile, and your house and your factory? Because that's what Henry Ford did. We just need to embrace the volatility. Don't fear the volatility. Embrace the crypto reactor.
How did Microsoft respond? Apparently you presented them. Apparently you only had three minutes. First of all, is it true that you only really had 3 minutes to present to them?
That is a shareholder proposal driven by a very enlightened activist. They managed to get it on the shareholder ballot for the shareholder meeting. The meeting is December 10th. So the meeting hasn't even taken place yet, and the vote hasn't taken place yet. It turns out, per shareholder law, Microsoft needs to give the person that proposes the act. They need to give them 3 minutes to present it in the meeting. So the Microsoft legal team said, "You have 3 minutes. Give us a video. We'll play it during the meeting." and the activist approached me and said, "Would you like to make the presentation?" So I spent 40 hours doing the modeling, creating the Microsoft model, building on Bitcoin 24. Then I did the analysis. Then I created the presentation. And then I figured out how do you present it in 180 seconds or in 3 minutes. And I did it 21 times. And after 21 times, I said, it's not going to get much better than this. and I recorded it, and I said, well, I'm not just going to wait and have it played for 10 directors of Microsoft, because it'll be too late for the shareholders to act or vote on it. I'm just going to release it to the world so that millions of people see it. And I think, millions and millions of people have seen that video. It's gone viral. And hopefully the shareholders will look at it and they'll vote in favor of Bitcoin and send a message to the company. I don't have any illusions that, mega corp, is going to stop and completely change their direction based on a 3-minute video. But I think it sends a message to all the Magnificent Seven. Maybe Microsoft won't, but Meta will, right? Maybe Meta won't, but Apple will. Maybe Nvidia will. Maybe Tesla will reevaluate and decide they could buy another $10 billion of Bitcoin. And maybe the other 50,000 publicly traded companies will, because my advice is the same for everybody. It's not any different. I mean, the strategy works for anybody that generates cash flow. And so it's right out there. And this is like the first shot across the bow. we're going to wage a campaign. At some point, I actually said, I offered to the Microsoft legal team, I said, hey, we'll withdraw the proposal if you let me meet with Satya Nadella for an hour anywhere in the world. And I'll go fly and I'll sit with him for an hour and I'll explain to him why it's worth $1 to $5 trillion to Microsoft with no risk. As I would think, but I think he's a very smart guy. And I think that he gets technology. He was smart enough to invest billions in AI. And I think he really turned Microsoft around and got them in the cloud. And he was the brains behind Office 365. So he's very smart. I just think that maybe he hasn't focused on this because when you're a smart person managing a mega corporation, everybody's pulling you a million different ways. But I have no doubt if I get an hour just to explain it, I'm like, well, you just do this and this and this, and you double your market cap, you cut your risk in half, and you make trillions, and you delight 600 million people, and you stave off the regulators, and Microsoft becomes the greatest company of the 21st century, and it, costs you nothing. It's like, why wouldn't you do it? I mean, the issue is just there are a lot of brilliant ideas in the world that if people focused on them, and then they made it a priority, they would execute. But a lot of very intelligent, powerful, rich people, they just have other things that they're focused on, and they got 100 people whispering in their ear every day, and so they're just not paying attention. And we just got to get the world to pay attention.
Yeah, I hear you. Mike, just a question. You guys were very aggressive now, as we said. You raised 13 billion now recently. And I guess that 13 billion was part of the 42 billion, the 21 billion in equity and 21 billion in fixed income, right?
Yes.
Okay, so that's 13 billion of 42 billion down. How long is this plan supposed to last for? So in other words, the 42 billion raise, what's the time horizon on the raise?
What are you doing?
It's iGaming traffic. Don't scare them away.
Luckily, it doesn't have to be that hard. Getting iGaming traffic is easy when you know much smarter ways, and it can attract users that will be much more engaged. So, 3 ways how to get it for free. The first, SEO. If you can build a website with engaging iGaming content, go for it. Couple of ideas: site of reviews on iGaming platforms, gaming highlights or scores, or gaming tips blog. Second, Twitch. Play and show how you're playing. This format is not dead and will attract a great deal of converting traffic. The third, social media. Instagram, Twitter, TikTok. If you create content that doesn't break the platform's rules, you can strive for much more organic traffic. Oh, wait, you have money? Why didn't you say? You can get even more iGaming traffic then. Look, you go to Propellerets. You create a pop-under campaign. Your iGaming offer gets an impressive reach and you scale it with a push campaign. You can also try out a new targeting for pop-under, social traffic. Yeah, the same social media traffic, but more engaged. And don't forget, the best iGaming hunting season begins when there are big sports events around. No, you don't need to Google. We have a special sports calendar. Did we create it for no reason? Just check the video and find it in the description. If you want to learn more about how to get iGaming traffic and run iGaming campaign, read the full article on our blog. And finally, subscribe, hit the bell, and we'll come back with more insights.
Look, I don't have a crystal ball. You're asking me to predict the future. Okay, so when we announced this on October 30th, we didn't know that we would have a very enthusiastic embrace by the capital markets. We didn't know who was going to win the election. We didn't know what Jerome Powell was going to say a few weeks after the election. We didn't know that David Sachs was going to be the crypto czar. I mean, there's a lot of things we didn't know when we announced it. So that was a few weeks ago, and we laid out what I viewed was a conservative plan. My view is you should always underpromise and overdeliver. This probably won't come as a surprise, right? So you lay out a plan. I was reasonably confident that we would be able to do this in less than 3 years when we announced it October 30th. But I literally didn't know what would happen in the next 4 weeks. So the answer to the question is, we go as expeditiously as the capital markets will allow. And when the political winds blow in our favor, and when the capital markets winds blow in our favor, we put up the sail, we go fast. And if the wind turns against us, and by the way, there's a certain mood in the convertible bond market, and there's a certain mood in the Bitcoin market, and there's a certain mood in the equity market, and there's another mood in the preferred stock market, and there's another mood in the bond market, right? When people change, if Jerome Powell lowers the interest rates tomorrow, if he were to drop them 200 basis points, there would be a surge in demand for corporate bond and fixed income, you see? So if Jerome Powell were to say, hey, we decided to go faster, the wind starts blowing and billions of dollars flow. And if Jerome Powell were to say, I think we're going a bit too fast, we're going to need to study the data, it goes the other way. So the answer here is, we're an operating company. We operate. If you're investing in us, you're investing in me, Fong, Andrew, Sharish, and we're sitting every day. Every day I'm looking at, what is the options market? What is the equity market? What is the debt market? What is the Bitcoin market? What is happening now? What's about to happen? And I can tell you the volatilities, the liquidities, the flows. And so if I have the ability to raise $2 billion in one day, I'll do it. If I have to do 200 million in a day, I'll do it. If I have to stop and wait, I'll do it. We decided to go to the bond market, and we'd sold maybe an $800 million bond, and we came to the market 2 weeks ago, and we started at 1.75 billion. So we doubled it. And then a few hours later, we took it to 2.5 billion. And a few hours later, we took it to 3 billion. Okay, so sometimes that's a 20-minute phone call. So the question is, how fast will we go? As fast as we can, right? Subject to market conditions. And of course, we're not going to do anything that isn't going to generate BTC yield, right? Our real acid test is it accretive or is it dilutive? And look, I could sell stock at $100 a share, but it would be dilutive. Or I could wait until the stock is $1,000 a share, but I wouldn't get that much capital. It would be accretive, but I wouldn't get that much volume. So we're always evaluating every capital market transaction versus BTC yield and the BTC spread. And that's really the strength of the company, because those numbers change every minute. And some days you can do $1 billion at a 70% spread and make $700 million. And would I? Of course I would. And some days, you go faster, and some days you go slower. And we live at the mercy, of the utterances of the gods and the demigods of the capital market. And there are people, believe it or not, a lot more powerful than me. And what they say, causes billions, tens, hundreds of billions, or trillions of dollars to move from the left to the right side of the screen.
Yeah. Mike, this headline that came out, Palantir MicroStrategy lead list of stocks that could join the NASDAQ 100. what's the path to get to the Nasdaq 100? Because as I understand it, if you do make the Nasdaq 100, effectively all the index funds and everyone would have to add MicroStrategy to basically have to be a representative of the index. I mean, is this something that you're looking at?
You know, this is something that we have no control over. It's above my pay grade. It will either happen or it won't happen. I will find out the same time you find out if it happens. And if it does happen, it would be good for us.
Very good.
If it doesn't happen, we're going to do just fine. You know, and I think we'll just wait and see, right?
All right. Lastly, before I let you go, so I want to talk about the risks. And Vinny Lingham brought up a risk. And I mean, there's various other risks that have been brought up. So he says Michael Saylor is now the second most powerful person in Bitcoin after Satoshi. He can single-handedly decide the fate of any future contentious issue with a simple, it's either my way or I dump it all. And he says decentralization, not so much anymore. And I do know of the principle that, you know, in the Bitcoin ecosystem, it's the miners that have the power. You need the mining power. But there is like something in what he's saying, and not that I believe that you'd ever act against the best interest of Bitcoin, but fast forward to a MicroStrategy where Michael Saylor is not around and they're still continuing with the same strategy. Is this a real risk? Is this a real risk where if there's a fork in the road, a MicroStrategy board can decide, well, if this is the way Bitcoin's going to go, we're going to dump all our Bitcoin or something like that?
No, I think it's fairly uninformed take. It's a very uninformed. If Vinny thought about it a bit harder, if he understood Bitcoin better, he'd realize that what he's saying is ridiculous.
Okay, tell me why.
Who would be stupid enough? Like it's like if you owned a bunch of land in the U.S. and something, you know, in the system happened that you disagreed with, you're going to rage quit the United States and dump all your land at a 95% discount? Not likely. No. I mean, the future of the Bitcoin protocol is determined by all the holders, all the miners, all the exchanges. Like it's a very, very diverse ecosystem. You know, the Chinese, the Russians, the foreigners, the Americans, every possible business, every possible holder, you know, even the regulators, they all have some say one way or the other. And the truth is, the reason Bitcoin works is because nobody wants to change it.
So I'll remind you.
The less you want to change. And if Vinny understood Bitcoin, he would be a Bitcoin maximalist and he would own 40 billion of it. But I mean, he doesn't. So, like, why would someone that doesn't actually own the asset be an expert at all? Nobody that actually is a Bitcoin OG thinks that, right? By the way, how many proposals to change Bitcoin have I made in the 4 years? Name one.
Zero.
Right? So the point really is that's really a shitcoiner narrative. And it's a shitcoiner narrative by activist programmers that don't own any Bitcoin, that have no influence, that desperately wish that they could change the network. And they kind of go at it with this reverse double psychology, which is we want to change and corrupt the network, but the person that actually believes in it doesn't want to support our batshit crazy scheme, and therefore they're the threat.
Okay.
I just think
fair enough.
It's utterly ridiculous. It's like saying, oh, Microsoft, you know, might rage quit the enterprise software business and just all of a sudden shut down all their servers for every company in the world. I don't think so. You think Apple Computer is going to rage quit mobile phones and shut down every mobile phone in the world? I don't think so. I think it's their business. And to make the other obvious point, we're not even 2% of the market. I mean, like. Yeah,
but you are growing. You're not even 2%, but 2% is very, very big. First of all, and secondly, you guys are growing at a crazy rate. In fact, I mean.
Nantikan Shopee 12.12 birthday sale midnight sale 12 Desember dari jam 12 malam hingga 2 pagi. Nikmati promo ulang tahun. Nantikan Shopee 12.12 birthday sale midnight sale 12 Desember.
Do you think that MicroStrategy's purchases were a factor in Bitcoin going up so much between the elections and 100,000? I mean, if I look at the price of Bitcoin at just after elections, that's here. It was 68,000. We're at 100,000 now, and that's also the period where you guys bought $13 billion worth of Bitcoin. So, how much of this do you think was the $13 billion that you guys, the $13 billion of buying pressure that you guys put in the market?
It's impossible to know, right? Because the market is set by, there's a huge number of sellers, right? Massive selling. So, when Germany is selling, if the US is selling, if anybody, there's obviously a huge number of sellers, they must be offshore, and I don't know where, and there's a huge amount of capital from the traders that are speculating in it. And the market is really set based upon the balance between the buyers and the sellers. I think what's clear is the Bitcoin miners and the mining subsidy or the 450 Bitcoin a day isn't really material to the price anymore, because MicroStrategy was buying 10x that. But I'll tell you the price. Sometimes I've watched. We bought 200 million an hour, and the price moves down. So there's someone dumping 200 million an hour. And by the way, we're never moving it up. So if we're actually in the market buying or selling, we're never selling, but if we're in the market, there's someone on the other side of the trade that is selling faster than we are buying oftentimes. So I think that we're an element, BlackRock is an element, but I think that the options markets are a massive element. Keep in mind, there's a $90 billion to $100 billion interest in MicroStrategy options. So I think there's arbitrageurs, there's options traders, there's a lot of hedge funds, there's a lot of deep equity funds. They're all playing, and then I think probably there's just a lot of people that maybe held Bitcoin for a long time. I think a lot of the big sellers, by the way, were the bankruptcy trust, people that seized FTX's assets or Celsius assets or BlockFi or whatever, or like the German government when they seized Bitcoin and they just dumped it. There's a lot of those non-economic actors, and more than you would think. And there could be a lot in China, right? Like if the Chinese government were to seize Bitcoin, they wouldn't be putting out a press release to tell you about it. But governments don't really think like Bitcoin investors. And so the market's going to go back and forth. I would say it's true that MicroStrategy is a positive force driving the price up. I mean, how could it not be, right? The more capital we raise, the more pressure there is to drive it up. But it's also true that Mara is, and it's also true that IBIT is, and it's also true that every other ETF and every other Bitcoin standard is, and now Similar Scientific and MetaPlanet and Rumble and who knows how many other Bitcoin miners they are. An equally powerful force, by the way, is just the sentiment of Bitcoin investors. If they actually start to believe that the asset is going to be around a long time, their time horizon stretches. If it stretches from 1 year to 10 years, selling pressure drops by a factor of 10. And so there's a lot of things like that at play.
And I mean, lastly, before I let you go, just someone said in the comments, and I think it's a real thing, but not really a real thing. Says, what if something happened to Michael Saylor? And I'm assuming that you have a board, and the board's bought into all these into the strategy, and the board will nominate a new leader or elect a new leader to lead the strategy. But is there a risk that one day MicroStrategy will just change its strategy? Because right now there's a CEO at the helm. He's pro Bitcoin. He's Michael Saylor. There is only one Michael Saylor. They call you the GOAT. They call you everything else in the chat. But what happens if something had to happen to Michael Saylor?
Well, let me make the point. I'm not the CEO.
Okay,
that's what you're missing.
You stepped down as the CEO. You stepped down as a CEO. I think.
I'm not the CEO.
Yeah,
I'm the chairman.
The chairman.
And so the simple answer to your question is no. There's not a risk. The reason that we're able to raise the capital is because we're a publicly traded company and the capital markets trust us. The reason they trust us is because we're a U.S.-based company. We have a board of directors.
Hotel dan tiket pesawat murah, mau. Diskon tiket pesawatnya bikin dompet relax. Diskon hotelnya bikin dompet happy. Cuma di booking sekarang.
Pursuant to U.S. SEC rules. So we have good corporate governance. We have an officer team. We have a general counsel, a CFO, a CEO. All of them are not me. I'm the chairman. They're all fiduciaries. They actually have legal fiduciary obligations to the shareholders, to the company. We're subject to the Foreign Corrupt Practices Act. We're subject to Sarbanes-Oxley. We're subject to Dodd-Frank, right? And the company at this point has, I think, a very straightforward, simple, laser-eyed strategy. And, Ron, the capital markets probably wouldn't be so sure in August of 2020 what was going to happen. And in August of 2021, not so sure. And August 22. But after a company has done the same thing 45 times, and it's done the same thing every quarter, and after they haven't done the other thing, like what's the test? Bitcoin traded down 80%. We didn't sell any Bitcoin. Okay, what I could say laterally drive things. I have to act with consensus of the board and with the general counsel and the CFO and the CEO. And if anything, the company the company just keeps getting more stable. If I were to disappear tomorrow, the strategy would just continue. There's nothing complicated about it. You wouldn't have a colorful figure wearing a Bitcoin T-shirt with quotable quotes on your podcast, but you would have a button-down Bitcoin treasury company that would keep raising capital, keep buying Bitcoin, because I think it's pretty obvious to everybody that we have a franchise there. That's our strategic advantage. Right? You would be destroying shareholder value to walk away from such a good business. It really is an insanely great business. And at this point, all of the officers and all the directors are behind that strategy. I think the capital markets, they can see that we're building that trust. And one thing that I even did this year, which I think builds trust, is I allowed my voting control to slip from the mid-50s into the 40s. And the message really is the company is being run for the benefit of, in partnership with, the common stock shareholders, right? The truth is, if you have one person that can single-handedly determine the course of the company, it's a bit more of a bumpy ride. And sometimes you need that in startup phase. But once the company has become mature, if people have invested $100 billion in MicroStrategy stock because they want us to buy Bitcoin and not sell Bitcoin, well, at that point, you don't really want the bumpy ride, right? You don't want the founder that says, I've decided to buy Disney Corp and I've decided to buy, like a billion acres of real estate. You don't want that. You actually want 100% Bitcoin strategy. And the way the company is structured right now, that's what it does. I will point you to Microsoft and Apple and Amazon. And those are three companies that actually do things, but no one goes to sleep at night with anxiety that they're going to stop doing the thing they do, right? People still think Microsoft, Satya Nadella doesn't have 50% of the voting stock, but they think that Microsoft is a well-run company for the benefit of the shareholders that will kind of go forward like a juggernaut. And they think that about Apple. And Steve Jobs, by the way, didn't have 100% of, he didn't have 50% of the voting stock of Apple either. So MicroStrategy is a publicly traded company. The reason we can raise the capital is because we are constructed to build the trust, right, and discharge the trust of the capital markets. That means sometimes you go slower. That means sometimes you have to be much more articulate in your disclosures. If you read our 8Ks, we don't just tweet, MicroStrategy bought this and this was our yield. That would be what you do if you're a crypto entrepreneur. We actually attach it to an 8K. It's a 2-page or 3-page disclosure full of 1 page of financial tables and then 2 pages of legal disclosures and articulations explaining all the nuances. And that's required for you to actually make a statement. That's just a public company thing. So I think we're going to be doing the Bitcoin strategy with or without me. And everything we've done is to assure the shareholders that the company will be buying Bitcoin and holding it forever. And I do believe we have a strategy where it is reasonable for us simply to acquire more Bitcoin progressively forever and never sell the Bitcoin. And our value proposition is we're going to securitize the asset class. We're going to issue fixed income and equity securities that give investors the ability to get Bitcoin exposure with the volatility and the leverage they want, whether it's double or whether it's half. And that is a very sustainable business model. The world needs that. There's $500 trillion of investments in securities. And if one day 10% of that is in the crypto economy, someone's got to issue $50 trillion worth of Bitcoin-backed securities, right? I mean, someone's got to do that. That's a good business. We're going to be one of the players that do it. We won't be the only one. And no, you don't need me. I mean, you could put my podcast on rewind. In fact, I rather think that
Pokoknya kalau mau belanja di Shopee aja ya, termurah di Shopee, gratis ongkir lagi. Yuk, download Shopee sekarang.
Kirim barang besar dengan aman. Bosankan aja. Barang dijamin aman, ongkir pasti hemat, dan juga tepat waktu.
within the next 12 to 24 months, you know that guy L.A. Dozier? He created all the Michael Saylor, all of my cool portraits. They're actually an AI model. They're not really me. They're an AI that made a portrait of me. I think they'll just create an AI model and they'll just feed everything I've said into the AI. And then you'll just interview AI Mike, and you don't need the real Mike. And probably the AI Mike will be better looking and more articulate and harder working and a bit smarter, you know, and less grumpy and better informed than I am. And so really, we're only in this 4-year transition where, you know, real world Michael Saylor is important. I think we'll transition to artificially intelligent Michael Saylor. And if you want, you know, an artificially intelligent Michael Saylor to beat up or bat around, you'll have more fun playing with him. And then MicroStrategy will just be a Bitcoin treasury company with a great set of real world executives, because probably the law will require flesh and blood people to be the officers of those corporations for a while to come.
I have to ask you something on a personal note. What
Yeah.
you've done now is the biggest thing you've ever done. I mean, I've gone through your history. This is by far the biggest thing you've ever done, and certainly it's the biggest trajectory that you've ever done. Do you ever like look at yourself and go, I can't believe what I've just pulled off? Like do you ever like think to yourself, like, do you ever look down and look back and look down and just go like, I really can't believe that I pulled this off, or like that like this is like, I can't believe that I managed to do this.
You know, what I think is I'm grateful for Satoshi. I'm very thankful for Satoshi, because without Bitcoin, I think life is without a lot of hope, right? You know, I've said Bitcoin is hope. I dedicated hope.com to Bitcoin. I think that when I was pretty disillusioned and depressed in 2020 when I discovered Bitcoin, and it actually gave me hope. Then I think, you know, the crypto community and the capital markets gave me an opportunity that evolved into a mission, right? And the mission for the world became educate the world on how to recapitalize on Bitcoin, and then on the promise of the future crypto economy and digital assets, and that is expanding, and that's very exciting. And then the company got a mission, which is securitize Bitcoin and become a Bitcoin treasury company. And that's just an insanely great business, and I'm grateful for it. I would love to. Do I think I deserve it? No. I mean, like, I think that all the people that have great businesses, they kind of were hardworking, intelligent people, but then they got lucky. And so I classify myself as I'm the hardworking, intelligent guy walking through the forest and lightning struck and I saw fire. But I'm smart enough to realize that Prometheus gave me fire or God struck, the tree with lightning. I'm smart enough not to let the fire go out. And I take the fire around and I say to people, you can put this in the car or the plane or the train or your factory and you can scare away the wild animals and you can probably heat yourself and cook your food and not freeze to death. And I'm really excited. I got a mission. I feel like that. I don't feel like I deserve it. I feel like I'm fortunate enough to have found it. I'm very grateful, and I would like to share it with others.
Well, let me tell you, as someone that's been watching you from the sidelines all the way from the time that you said Bitcoin would never work, all the way back then, till the time that you actually accepted Bitcoin and then did what you did. I've watched you on the sidelines. I've watched you appear at conferences, podcasts. I've watched the evolution in your mind and what you've taken. I can tell you that I'm absolutely blown away. And I think, like, human to human, not Bitcoiner to Bitcoiner, but human to human, I think you should be super, super, super proud and impressed with what you've done. I think that you're one of the most important people in the world after, like, the Elon Musks and that in what you're doing. So just on a personal note, I think you should be really proud.
Thank you. That's very kind of you. One of the things that motivates me is the community. Like one thing when you walk around and you see people that are enthusiastic or grateful, they say you gave me hope or you gave me a way out or you showed me a light at the end of the tunnel. I think that that's what makes all the difficult work or difficult days worthwhile. And one thing that I don't feel like I had so much before Bitcoin was the community, and I think afterwards I really feel like I found a community and I enjoy it, and we're all on this mission together, right? And education and commercialization and adoption of new technology for the benefit of the human race, and I think that it kind of gets you excited to get up in the morning and go do things. So thank you.
I'm proud to be
working with you.
I'm proud to be on the mission with you, my friend. Thank you so much. Thank you for giving us this time. I know we went well over time, but thank you again. And thank you for every time that you give us time. Thank you so much, my friend.
Always.
Ooh, okay.
Dasarku bercukur peri. Mereka jilat blue refleksi. Mata pisau peka di kulit. Jangan cukur perih, abangku.
Thank you, sir. Wow. Okay, that was hectic. That was an incredible alpha. And I certainly got a lot of the answers that I wanted to know about MicroStrategy. And I tried to pick up as much as I could from the comments from you guys. And I think we can agree that I think what Michael's pulled off has been absolutely amazing. I must remind you that these Friday banters, and this is one of those amazing Friday banters, are actually sponsored. And this one is specifically sponsored by NordVPN. And thanks, Mike. And I just want to remind you guys that as we get into this crypto bull market, people are making a lot more money, and as we make a lot more money, more and more scammers are picking up picking this up, and the number of scams is actually going up exponentially. I try to pick up the number of scams that are actually going on, but everywhere I look, there's scams. Yeah, the scammer created an identical UI to deceive users, and bang, people lost their money. Here's another one, another scamming site which looks exactly like the real site, and people clicked on it, and they actually end up losing money. Now look, it's going to happen a lot more now that we are in the crypto bull market, and so I urge you guys to protect yourselves. I've lost money on one of these scams, and I'm seasoned, guys. I'm seasoned. So it's exactly. I think the one way that you can protect yourself is by using a VPN. For those of you who don't know what a VPN does, a VPN masks your IP address, which means that, as you can see right now, my IP address is here, and everybody can see my IP address, right? That means that hackers can see it, governments can see it, DeFi protocols can see it. If you use a VPN, you actually mask your IP address and no one knows where you're at, and it stops hackers and it stops governments and it stops DeFi protocols and anyone knowing where you're at. To get a VPN, there's still a Black Friday special. I don't know why the Black Friday special is still on. You're paying $3 a month and you're getting four months extra and 30-day money back guarantee. Do me a favor. We're going to make a lot of money in this bull market. Protect yourself. Get a VPN. And it's not enough to get a VPN, but also get Threat Protect. This is the important one. Threat Protect is the thing that protects yourself from the malicious websites. This is the one that picks up the malicious websites before you pick up the malicious websites. Guys, do it, because I want you to keep your money in this bull market. Anyway, I'll see you guys again tomorrow. Remember, tomorrow we have a Dexcelerate tutorial for those who want to trade in the trenches, on-chain, and whatever else. I'll see you guys again tomorrow. Until then, trade well, my friends.
Ayo Shopee 12 birthday sale termurah di Shopee.
Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Last month, we said that the hurricanes and the fact that there were tens of thousands of workers on strike affected the number, and this month landed exactly where we expected it to land.
The 800-pound gorilla in the room is technology beginning to create some unemployment. What economists would kindly call technological unemployment. It's what everybody worries about, artificial intelligence. Now, we just don't know, but my gut tells me we're probably on the outer edges of that. And that might be why there's some redundancies out there in the workforce.
TikTok could just become kind of a negotiating ping pong between Trump and China to a certain degree. It could set the tone in terms of how certain digital assets from China are perceived by US capital markets. And TikTok is not just the only one. There are other companies such as Temu, such as Shein, and various different other factors that could start to be put on the negotiating table, if you will, as Trump puts this in a bigger kind of scheme of things.
We got 1 hour to go until the market close. So let's take a look at the major averages here. We got a mixed picture here today, Josh. We got first the jobs report this morning, much awaited. And it was pretty much in line with estimates, a little bit better than estimates, although the unemployment rate did tick up. You got a lot of Fed speak also. Kind of mixed, I guess. So let's look at the markets, then we can talk a little bit more about that. 148 points is the drop that we're seeing in the Dow today, about a third of 1%. The S&P up a tenth of 1%. The Nasdaq up 0.6 of 1%, but not huge moves here, even though, again, we've been waiting for this jobs report.
Yeah. I mean, the jobs report was, listen, we know the story that at least a lot of economists on the show have been telling, and a market it's moderating, it's cooling, but no signs of crashing. And I think today, you saw that report, Julie, and it feels like a lot of folks concluded, hiring picked up. Okay, the unemployment rate edged up a bit, but maybe they looked through it and decided, you know what, the story for now on that labor market, that narrative seems to be broadly intact.
Yeah, and it does seem like also that the expectation remains intact that the Fed is going to cut at its December meeting and then maybe not cut very much after that. We're seeing a little bit of a drop in the 10-year note for the moment. And that sort of seemed to be borne out by the Fed speak that we got today as well. That seemed to indicate, okay, maybe we'll get another cut and then we'll see what happens next year. If you look at the groups that are on the move today, you got energy down, you got utilities down, consumer discretionary has been on kind of a tear. Amazon is helping lead it higher today. But if you look at the move that we have seen on the week, We're up more than 4%.
Yeah, I do think it's true. I wonder as we go into the weekend too, folks are already with that jobs report, Julie. You mentioned the Fed speak, and we did get, I saw Austin Goolsbee, I think, saying labor market looks broadly stable.
Yes.
I do want to already next week, of course, got the jobs report right away. Now you're looking for key inflation data, which is another big piece everyone's going to focus on. Of course, that includes the Fed too.
Yeah, CPI on Wednesday is what we got. And then let's check on crypto as well, right? Because you see a lot of green on your crypto map today. Ethereum getting a little bit of a pop up here above 4,000. Here's the 10% move that we've seen over the past week. It had been lagging some of the other cryptocurrencies. And then, of course, got to talk about Bitcoin here, which went up above 100,000, then came down below, and is now back above it again.
Yeah, and interesting. I mean, as Trump continues to sort of build out his team here, so obviously, yesterday we heard about David Sachs. You got Paul Atkins, who he wants to lead the SEC. I mean, at least if you're a crypto investor, those are the names you wanted to see.
Yes, those are not things that are going to necessarily slow this down.
Right, exactly.
In their view.
All right, meanwhile, a federal court came to decision to uphold a law requiring either a sale or ban of TikTok. And Yahoo Finance's Alexis Keenan joins us now with the latest on that.
Hi, guys. Yeah, so this is a district court, a court of appeals in the D.C. Circuit saying that they are denying TikTok and TikTok users their request to strike down a U.S. law that was signed into law by President Biden in April, saying that the app would have to either divest to a U.S. owner or eventually be banned. And that deadline is January 19th, so the day before President-elect Trump would be taking office there. TikTok's claim here, they said that this law violated the constitutional protection against free speech, constitutional protection of free speech, rather, and also some other constitutional protections as well. But the court here saying, no, this law is constitutional, so it is the law of the land. And what it does is it requires not just TikTok to divest, but other apps controlled by foreign adversaries. Those include other apps, prospective apps as well in China, Russia, North Korea, and Iran, all of them having to divest or face this ban on January 19th. So the three-judge panel here making the decision, they wrote this. They said if the First Amendment exists to protect free speech in the U.S., here the government acted solely to protect that freedom from a foreign adversary nation and to limit that adversary's ability to gather data on people in the U.S. The court said if it is not divested, the TikTok app, that TikTok's millions of users would have to find alternative media for their communication. There is this little caveat, too, that the court gives President Biden, and that's to have a 90-day extension, put it on pause, but that's only if TikTok is making progress towards this required divestment. Yeah.
So what happens on January 19th?
Yeah. So, I mean, January 19th is a fuzzy day.
Like if I have TikTok on my phone, does it stop working?
In theory, yes, but you'd also have to have action happening, right? Someone could run into court and say this has to be shut down, and whether there'll be the motivation to do that at this level, I don't know. But there are some options on the table, not so many right now, maybe looking for President-elect Trump, even if he does want to undo it, right? Because on the campaign trail, he had said that he would save TikTok from this type of repercussion. But this is a law that Congress has passed, that the president has signed into law. So Congress would really have to be brought back in and would have to undo this law. And that would take a lot of, I think, that's a big ask. They just passed it. It's relatively new. So I don't know how much motivation there would be for that either. Also, there could be a chance that TikTok runs into either the Supreme Court or to the Court of Appeals. In the case of the Court of Appeals, they could ask for the full court, right? Because this were just three judges on a panel deciding this. They could ask for the full court to hear this. The court does have to grant that request, but what they don't have to grant is a pause. So we don't know if the court would say, okay, we're not going to go forward and enforce this law while it's being litigated. Otherwise, they're going to have to go to the Supreme Court. Again, no guarantee that the Supreme Court is going to take this up.
Whew, okay. Yeah, lots to keep track of. Alexis, thanks for doing that for us.
Sure.
Appreciate it. For more on what may lie ahead for TikTok as it faces that potential ban in the U.S., we've got University of Minnesota Associate Professor of Law, Alan Rosenstein. Alan, thanks for joining us as we try to understand here. So it seems as though the court gave more weight to the government's concern about national security than it did to the claimants' talk about free speech. Is that fair to say, how we should be thinking about this?
I think that's mostly right. The court clearly thought that the government's concerns about national security, both the data privacy and the information manipulation concerns, were very serious. But I don't think this is just a story of national security versus free speech. I think this is a story of free speech versus free speech in a sense, because I think at least part of what the court was reacting to was the idea that on the one hand, you did have the free speech interests of TikTok and its users. On the other hand, you had the interests of people on TikTok to not have their platform controlled without them realizing it by a foreign government here, China. And so this was an interesting area in which you had different conceptions of free speech. And I think that's one reason why the court was comfortable with this law.
Alan, let's say this goes to the Supreme Court. Two questions. One, do you think they would agree to hear this case? And two, if they did, Alan, can we make any kind of educated guesses about what their decision might be?
Yeah, so on the first, it is ultimately up to the Supreme Court to decide whether to hear this case. I think it will, though. This is a case of extreme importance, both practically speaking and also in terms of First Amendment law. And over the past couple of years, the Supreme Court has shown a real interest in these kinds of cases. So I would think that they would want to have their word be the last word on this, and not just the DC circuits. But I do think that even though they're likely to take this case, I don't think they're going to do that to reverse the DC circuit. I think they're probably going to uphold it. I think one thing is notable about the DC circuit was that you had a 3-0 decision in favor of the government. You had a cross-ideological panel, one judge appointed by President Trump, one judge appointed by President Obama, and then one judge appointed all the way back by President Reagan. And these are three of the most experienced and three of the most respected judges on the DC circuit. So I don't really see a reason why the Supreme Court would overturn what the DC circuit did. Now, they may, in the meantime, pause the law while they deliberate. That's something they often do, especially with laws that can have such a big impact. But I do think that when it comes to when the Supreme Court ultimately decides on this case, which will likely be sometime in the summer of 2025, they will ultimately come down in an opinion that reads very similarly to the opinion that the DC Circuit just issued.
And then if we can sort of extrapolate forward, are there any repercussions or potential repercussions for other Chinese companies that have state ties that operate in the United States?
So the law specifically singles out TikTok and applies to TikTok and ByteDance, but the law also applies potentially to other similar social media companies that are owned or controlled by entities in Russia, China, North Korea, or Iran. And here, really, China is the main story because China is the one that has these popular social media platforms. Now, with those companies, those don't automatically fall under the law. The law gives the president the discretion to designate those companies for a similar kind of divestment or ban. But that being said, there are other substantial Chinese companies that could fall under this. So WeChat is an example. And then actually some video games, Fortnite, and some other games have this kind of massively multiplayer social media aspect to them that potentially makes them fall under this law. And they are, in many cases, owned by Chinese entities. So if the president here, President Trump, wanted to apply this law to other companies, he potentially could do so.
And Al, let's say this ban does go through. I'm curious, what is the legal responsibility of the app stores and all this, Al, Google and Apple?
That's right. So the law, although it's targeted at TikTok, it's enforced against the app stores, Google and Apple, and then also the cloud service providers like Oracle that actually host TikTok in the United States. And they're the ones that have to comply with it. The enforcement mechanism that the law provides is that these companies can be on the hook for up to $5,000 per user. And when you think of TikTok, which has 170 million users, that adds up to a lot of money very quickly. So I would expect on January 19th, unless the law has been paused, for Apple and Google to stop distributing the app and for Oracle to stop hosting TikTok.
Alan, thank you so much. Helpful to get some perspective and context around this. Appreciate it.
Thank you.
We're just getting started here on Market Domination. Coming up, Apple reportedly preparing to bring its in-house modem system to market. What that means for some of its competitors on the other side. And shares of Hewlett-Packard Enterprise soaring higher today on the back of its latest earnings report. Company's CEO Antonio Neri, we're going to hear from him later in the hour to break down the results. Stick around, much more Market Domination still to come.
Mau spread mas super tipis? Hanya di Quick Pro, spread mas mulai dari $0,1. Gratis biaya inap alias free sweep. Nggak cuma itu, deposit mulai dari 140.000 dan WD berapapun pasti dibayar. Ayo jadi trader jago, bergabung dengan lebih dari 200.000 trader hanya di Quick Pro. Buktiin sekarang.
Stocks mixed as investors digested the last monthly jobs report of the year. Join us now to break down those numbers is Thomas Simons, Jefferies senior U.S. economist. Thomas, always good to see you on set.
Likewise. Thank you for having me.
So let's talk about this report. Hiring picks up, unemployment rate or that edges up a bit.
Yeah.
It seemed like a lot of economists kind of looked at the report and said, you know what? Storyline seems to be intact. Moderating, cooling, not crashing.
Yeah, I mean, we've seen some month-on-month changes in non-farm payrolls for the last year or so that have been really all over the map. Obviously last month with the 12K initial print revised up only a little bit here. We had a big print in September. We had some bigger prints earlier in the year. But if you look at moving averages, 3-month moving average is like 170, 6-month is like 140, and the 12-month is like 190. And then if you think about today's number and you take out the effects of the Boeing strike and the effects of the hurricanes, call it 60K. You're at 167, right? So that's really right in line with that channel. And I don't think that there's anything within the details that suggests there's a big break in momentum anytime soon either.
One interesting thing you point out from the report is the participation rate, and not just overall, among older people in particular. Talk to me about the demographics within this workforce and what effect that's going to have over the next couple of years.
Yeah, I mean, honestly, demographics is like one of my favorite kind of vectors to examine economic data in general, especially as you look in the very long run, it tends to be a very strong predictor of what's going on, right? It's no secret that in every developed market economy in the world, no less the United States, we're heading towards a lower birth rate, higher average age, some faster than others. U.S. actually fortunately benefits from a useful immigration policy, or at least an approach to immigration, I should say, such that we are still relatively young, still growing population. That doesn't change the fact that some 10,000 people hit the age of 65 every day, right? And I remember 10 years ago hearing this stat, and it's still true now, right? And we have about 5 more years of this happening too. So if you look at just like population changes since February 2020, right before the pandemic, there's something like almost 6.1 million more people 65 or older than there were back then, right? This isn't 6 million more people coming into the United States. This is 6 million people who used to be in the 54 to 64 age bracket, right? So those people are sitting on some $90 trillion worth of wealth. If you look at some of the Fed data on household balance sheets, not all of that is fungible with things they can use to spend, but certainly they're relatively comfortable. They can and will and are retiring, right? So you have this pool of aging workers coming out of the labor force. For most of this year, we had that offset by all that immigration, but going forward, that's a much more difficult kind of picture to put together.
Yeah, on that point, Tom, I was going to ask you on immigration. With Trump coming back into the White House, obviously immigration is front and center. If he followed through with these plans of mass deportation, as an economist, how do you think about that? The possible ripple effects on the labor market, on wages.
Right. So, I mean, one of the interesting things I think about the immigration debate from this past year was everybody saying, oh, these immigrants came in and they lowered wages. Or I shouldn't say that. Maybe they reduced wage pressure, right? Like, they provided supply where it wasn't there for labor. And now you kind of think of it in the inverse, which is not only do you have the offset from the retirees, but if there's actual deportations in the scale of million, then you just have very many fewer people, right? One of the things I pointed out, and I think many others have as well, I'm not going to say this is groundbreaking, but like more population is more people is more aggregate demand. And if they're not producing more than they're necessarily demanding, then that's inflationary, right? So you kind of have these offsetting things that at the end of the day, so long as these kind of changes are relatively imbalanced, it doesn't actually move the needle in the long run. Like short-term disruption, sure. Now, if Trump actually does that, that's like the point I'm trying to make is millions of fewer people in the U.S. is a terrible thing, right? No country in the history of economic analysis has ever thrived with a shrinking population, let alone one that is shrinking and aging at the same time.
So all of that said,
yes.
When you look at the outlook for where rates are going, assuming, and as you say, it's quite a binary scenario. Mm-hmm. Either, although you could have the people deported not en masse all at once, right, or even all of them, but you are looking at a binary scenario. So what's your base case for inflation and therefore rates going into next year?
So I don't know if this is a cop-out or if it's a kind of out of consensus answer, but I think it's actually relatively similar to what we have right now, right? I mean, I think that we are going to see marginally higher rates, especially in the long run. I do think that the curve is going to steepen a little bit. We're going to get at least a few more rate cuts, so that should bring down the front end. The long end, I'm not super worried about this notion that Trump is going to start spending tons of money and like be extremely fiscally profligate, canceling income tax in favor of like trying to replace that with tariffs. So a lot of math doesn't work on that. And as much as Trump has a lot of unilateral power via the executive order pen, there's still checks and balances in the U.S. government, and there's still a lot of people there that know those aren't great ideas, right? So I think we could end up seeing maybe max upside on the 10-year yield somewhere around 4.5% to 4.75%. We could probably have some scary times like last October when we touched 5 for a brief period of time when everybody suddenly gets worried about supply. But I just really don't see the situation changing, because at the end of the day, you're talking about investing in the most dynamic, most best developed and most free market economy in the world. And, I would be happy to continue to do that.
Well, we'll see. Fingers crossed, Tom. Thanks
Always.
so much.
Thank you.
Good to see you. Appreciate it. Moving on now to Shopify. It's getting a lift as Loop Capital is utilizing AI. Joining us with more, the analyst behind that note, it's Loop Capital Markets Managing Director, Anthony Chicumba. Anthony, this is actually sort of a perfect follow on the conversation we've been having about jobs, because what stood out to me about your Shopify note is not just how Shopify is using AI in terms of its outward-facing services to clients, but how it's using it internally. And as you point out, the company's headcount hasn't changed. but its sales have gone up 20%. So is that just because they're using AI and they don't need to hire people?
Kamu pasti suka crackers renyah dengan krim keju manis. Ritz Keju, pas buat nongkrong bareng.
It's a really big part of it. And like you said, I mean, it's not just the external, merchant-facing stuff they're doing under Shopify Magic. It's the fact that they're using AI internally, right? So they're using it in their human resources department to respond to employee questions. They're using it in their finance and accounting department. I mean, one of the most stark examples was that the monthly closing process. So large companies like Shopify, they close their financial statements essentially every month, even though they only report them, once a quarter. That process is incredibly laborious. It literally took several hours. Using AI, that's down to minutes. And so there's just, if you have AI and it's making your employees much more efficient, then you don't need to have as many employees. They can continue to grow at these very fast rates while keeping their headcount pretty stable and thus keeping their expense base pretty stable.
And Anthony, one big interesting trend with the company too is the way they're moving Anthony up market. So helping big brands sell online. I'm curious what kind of traction they're seeing there, and also obviously as they move up market, there you are coming into more competition with the Salesforce, with an Adobe.
That's correct. So, basically that enterprise sort of initiative, they roughly, call it Shopify Plus. And here's the thing, we've done a lot of work on Shopify Plus. They just have a better mousetrap than a lot of the other guys out there, than the SAPs, than the Adobes of the world, right? And a lot of it is the fact that whereas like, an SAP or an Adobe, the fact they've been doing it for so long is almost like a disadvantage, right? Like Shopify almost started with kind of a clean slate, when they took this solution that they had originally come up with for small, medium-sized businesses, and they started to apply it to enterprises. The best thing that Shopify has done over the last few years in terms of enterprise is what they call commerce components. So in other words, it used to be if you wanted to switch to Shopify from some, other platform, or if you were doing it internally, you essentially, it was almost like a rip and replace. You had to replace kind of everything. Now Shopify has it where if you say, okay, you know what, I'm fine with a lot of my legacy systems, but I just want to replace like the front end, right? The customer facing part of my website, I can do that. Or even if it's just the checkout, I can do that. And so it basically makes it where you don't have to, it doesn't have to be an all or none proposition. And that makes them even more attractive to enterprise merchants.
Anthony, I want to talk a little bit about the holiday season, and maybe I'll segue to it by asking, Shopify obviously does represent some of those bigger enterprises, but it also represents a lot of smaller businesses, companies that aren't publicly traded. And I wonder, are they collectively taking share from the big guys when you look at something like holiday spending?
I'm not so sure about that. I mean, it seems like the big guys are only getting bigger, right? I mean, right now Walmart is taking share from pretty much everyone with, two hands. I mean, there's no bigger retailer in the U.S., I think, quite frankly, in the world than Walmart. So I don't know if that's necessarily happening. It just seems like the big are getting bigger. And look, we've actually seen a number of better than expected earnings reports, just within the last couple of days, right? I mean, look at the numbers that Ulta Beauty put up yesterday. I mean, certainly much better than we were expecting.
Anthony, just to circle back on Walmart, because listen, we're wrapping up a year here, and what a year for that company. This stock is up more than 80%. What are they doing right, Anthony? They are just simply firing all cylinders here.
Yeah, so I think what Walmart has really done is they've improved their execution. It's their in-store execution, right? It's also their online execution. They also, rolled out that Walmart marketplace, so where third-party sellers could sell on Walmart.com. They've always done a really nice job with click and collect, right? Where, you essentially, order your groceries online and you go to the store and they bring them right out. So they really are just hitting on all cylinders in a way that we haven't seen in quite some time.
Well, and what's interesting about that is you could also say, okay, the sort of macroeconomic environment backdrop is good for Walmart too, right? People are looking for value. but you're not seeing all of the players benefit from that kind of phenomenon equally, right? So it's sort of like circumstances plus then execution together, because just circumstances don't seem to be doing it.
You're 100% right, and I definitely have a lot of insight on that because I cover the dollar stores, so Dollar General, and then also Dollar Tree, which owns Family Dollar, and yeah, those companies are not doing well right now. They're really not, and a lot of that I think is that they are giving up market share to Walmart, and a lot of it is because of self-inflicted wounds, right? I mean, look. I mean, Family Dollar. I mean, they've just never been able to. Dollar Tree's never been able to figure out how to run that business, to turn that business around. Now they're trying to sell that business. Dollar General, basically underinvested in store labor for quite some time. The stores got pretty horrific. Now they're trying to kind of turn that around, but you don't just kind of flip a switch. I mean, particularly with a retail that has over 20,000 stores. So you are right. I mean, it is almost like a perfect storm for Walmart, where the macroeconomic environment is still quite difficult, and they are seeing consumers trade down to Walmart, but they're also benefiting from the fact that a lot of their competitors are kind of shooting themselves in the foot. And by the way, I would throw Target in there as well.
And those two names, Dollar General, Dollar Tree, Anthony, I know you have holds on both of them. Those stocks have been crushed this year, both of them. What would you need to see, I guess, before getting more bullish?
Better numbers, a lot better numbers. I mean, look, in Dollar Tree's case, they need to sell Family Dollar. And by the way, look, they'll take whatever they can get. They would take a bag of magic beans for Family Dollar, and I think that the market would applaud, right? Because the Dollar Tree, the core Dollar Tree business is still operating. I mean, it's slow, but it's still quite decent. With Dollar General, they've got to just continue this turnaround, right? I mean, so for example, they've improved their inventory in stock levels. They put more store labor into the stores. They also are sort of decluttering the stores. Like, so for example, they're getting rid of a bunch of stands that are kind of clogging the aisles. So we just need to see better execution from them. And I think if they execute better at the store level, the consumers will come back, because one thing that we haven't seen, quite frankly, is Walmart undercut the dollar stores on price. We do pricing work once a quarter, and the dollar stores are still within spitting distance of Walmart. They're as close as they need to be. So it's not a pricing issue by any stretch of the imagination. It's much more about store level execution.
Anthony, always great to see you and get those stock recommendations. We appreciate it.
Thanks for having me.
Coming up, shares of Hewlett Packard Enterprise, they are soaring higher today on the back of their latest earnings report. The company's CEO, Antonio Neri, joins the show on the other side of the break to break down those results. Stick around, much more market combination until the comment.
Wah, termurah di Shopee. Shopee 12.12 birthday sale. Termurah di Shopee.
One of the hottest tickers on the Yahoo Finance platform is HPE after the company's latest earnings report and forward guidance. Let's get to HPE CEO Antonio Neri. And Antonio, always good to see you here. Thanks for joining Yahoo Finance. What stood out to me amongst many things in this quarter is your server performance. Really strong. Is that the power, or investors, I guess, getting a taste of the power of AI and how it's going to impact businesses like yours?
Well, thank you for having me, Brian. It's not just servers, I will say. I think when you look at our performance in Q4 was exceptional on many, many metrics. Servers obviously was the flagship with AI, but also hybrid cloud did extremely well, including GreenLake and storage. But when it comes to AI, I think the market comes to recognize that HP has a right to play because of our unique innovation, intellectual properties, and capabilities. And then ultimately, we see the momentum happening across multiple segments of the markets, including now enterprise, which we saw a significant uptick in our pipeline, and now first deals through our HP Private Cloud AI. So I'm really pleased about the quarter. We delivered record-breaking performance on revenues, $8.5 billion. In that number, we had the 4.7 on servers, record profitability of $938 million. And then for the full year, we exceeded our commitments on revenue, EPS, both GAAP and non-GAAP, and record-breaking free cash flow. So we are very excited about 2025, right?
When you talk to your fellow CEOs, what are they asking you about AI, and then how have the conversations changed with them compared to 3 months ago?
Well, I think, we all address different segments of the markets, but remember, I think about AI in 4 unique, distinct segments. Number one is companies that are in the business to build this large language model. I call the large language model builders or the hyperscalers. Obviously, they lead with the latest technology because they want the best performance at scale with lower energy consumption and ultimately reduce the cost of training, right? And then you have sovereign AI, which obviously is now coming very strong on interest. And we're already building 2 very large sovereign AI clouds for Japan and the UK, but more in the pipeline. But where I was really pleased is the fact that now enterprise is deploying AI, including ourselves, right? We have many use cases, many of them already in production. But I think in that segment of the market, Brian, they're looking for time to value and simplicity of the offer because they don't have the whole expertise.
These AI models, as you know, Antonio, they're sucking up a lot of energy. Are we headed towards some form of energy crisis here? As all this stuff is converging and AI is penetrating our lives in new ways?
Well,
Baru, Fiesta Fun Pack. Surprise can be fun.
Well, definitely the path we are on is not sustainable unless we innovate around the entire ecosystem. And when I think about the entire ecosystem is sources of energy, which obviously needs to be clean. It's not just more capacity. but it also needs to be clean from the way we power these data centers. The actual architecture of these systems moving to direct liquid cooling, and there HP has unique play because we are the industry first with 100% fanless direct liquid cooling, including the switching, by the way, the networking part, not just GPUs and CPUs. And that when you go to that architecture, we have proven that you can reduce energy consumption by 90% and space by 50%. So this is why we got to innovate across the entire ecosystem. Otherwise, it's not sustainable.
How hopeful are you that the new administration coming in, they have the policies that will help unlock this United States type of investment?
Definitely, we need to invest more. The current administration now in transition started that process with the CHIPS Act and the Life Science Act and other supports into the infrastructure. But I'm hopeful with the new administration, we're going to see an acceleration of that. Also because it's important from a U.S. national security perspective as AI is deployed everywhere. And this is why a transaction like ours with Juniper Network is important for the United States because it brings more pro-competitive, allows us to stay ahead of the game, especially as we build these massive supercomputers. Remember that HP now has 7 of the top 10 supercomputers deployed in the world. And number 1, number 2, and number 3 is in the United States.
Those computers sound a lot more powerful than what Enrique's selling over at HP there, Antonio. Well, I'm just got to say it. You didn't have to say it. I'll say it. When you mentioned Juniper, there was an FT story. I'm sure you saw it 2 weeks ago. Officials at HP reportedly met with officials in the government. There was maybe perhaps some concern if this deal is going to get done. We've talked to you every step of the way. Does this deal get closed in January?
We believe the deal will get closed in the early part of 2025 within the original timelines we provided. Remember, when I announced the intent to acquire Juniper on January 10th, we said that we expect the deal to close the latter part of 2024, calendar 24, or early part of 2025. We have received pretty much all the approval outside the United States with unconditional support, which means they see the deal as a pro-competitive. And we have been working with the DOJ incredibly collaboratively to answer all the questions. Obviously, have been busy dealing with many cases, but the reality is that we still believe the deal will close in the early part of 2025, and nothing gives me pause that would not be the case, because the deal is pro-competitive, and as I said earlier, also supports our U.S. national interests.
Let's assume this deal does close, Antonio. What do the next couple quarters after the deal closing look like for HP? Do you get an earnings relift? Do you anticipate the stock to re-rate?
Well, over time, we expect the stock to re-rate because obviously we'll be adding $5 billion to the company. Remember, we just announced fiscal year 24 results at $30 billion. And that $5 billion comes with a different structural margin, which ultimately the stock P multiple will have to re-rate. But, it would not be immediate. It will take some time. Also because we have a number of synergies that we committed, which last time we talked about it, we said at least $450 million. And this is why, Brian, we only guided Q1, because we are confident that we can close the deal. And hopefully by the time we announce Q1, the deal will be closed. And that point in time, we're going to guide for the rest of 25 and obviously 26 and 27.
How important is Intel to the country's, supply chain ecosystem? I mean, Pat Gelsinger, he retired earlier in the week. Sources told me that, it maybe wasn't actual retirement, but the company's struggling. I mean, how important is it to a company like yours? I know you work with NVIDIA, but how important is a company like yours? How important is it to, the country that company turns itself around and does it somewhat quickly?
Yeah. Well, I can't comment on what happened inside Intel, but I have tremendous respect for Pat, for what he has done at Intel, at VMware, and the broader tech industry. He is a unique personality with unwavering integrity and so forth. So, but coming back to Intel, I will say we need Intel because the market needs Intel. Customer needs more competition in this space. And the United States needs a healthy Intel.
Antonio Neri, HPE CEO, always great to get some time with you. Happy holidays. Thanks for making time for Yahoo Finance. We'll talk to you soon.
Thank you, Brian. Happy holidays to you and your family.
Thank you so much. All right, Julie, Josh, back to you.
Hujan, tenggorokan nggak nyaman? Bantu legakan dengan Strepsils, hanya dalam 60 detik.
Apple reportedly preparing to bring its in-house modem system to market. Qualcomm shares under pressure as Apple looks to replace components from its longtime partner. Here with more Yahoo Finance's Dan Hellion. And Dan, we sort of knew that this was in the works, but this report today has more details, especially on things like the timeline.
Yeah, Julie, this has been something that Apple's been trying to cook up for a long time and just kind of kept hitting a wall when it came to replacing Qualcomm and with its own in-house modem. Obviously, a modem is something that connects a phone to 5G or 4G networks so that you can get online and endlessly scroll something like Instagram, not TikTok maybe for long. But this is something that is going to end up, according to Bloomberg, showing up first in iPhones in the upcoming iPhone SE. That's the entry-level iPhone that Apple has left to kind of sit and languish for a while, not updating it very often. It's expected to be the first one to get that new modem, and then it should come in the upcoming iPhone 17, which would be landing in late 2025. And so you can expect this modem to kind of shave down some of the size of the iPhone. There could be battery life improvements, maybe not if they're cutting down on the size. Maybe it'll be, just a little bit better. Maybe, kind of just the same. But really cutting down on the size is something that has been repeatedly reported for the next generation iPhone, a new physical look to it. And it's something, obviously, when it comes to the design, display, battery, and camera, those are the things that people really go out and buy a new phone for. And a new design could really start to boost sales. And then on the Qualcomm side of things, well, they still make a ton of money. I think about 20% of revenue from that iPhone deal that they have. And so they've been aware of this for some time. You can see from the messaging that Qualcomm's been pushing as of late that they're trying to be known as more than just a handset chip company. During their investor day a few weeks back, they had basically said, look, we're in the PC space. We're developing more there. We're in the auto space. We're developing more there. And they expect to see growth in those sectors as the smartphone area continues to stagnate. So obviously Qualcomm trying to get ahead of these reports, knowing that investors would say, well, you're losing this huge client. What does that mean for your bottom line? And Qualcomm saying, we're working on it. We have places where we can pick up the slack in other areas, especially as we dive deeper into PCs and autos. So it seems to be a win for Apple, a loss for Qualcomm, but they're aware of that and likely to be picking things up in other areas.
Right. And then there are some other suppliers like Qorvo also that were taking a little bit of a hit today, but Qualcomm, the one that is most closely linked to Apple historically in that way. Dan, thank you so much. Appreciate it. Now time for some of today's top trending tickers. You can scan the QR code below to check out the best, worst, and most trafficked stocks of the session on Yahoo Finance's trending tickers page. Lululemon shares surging on the back of strong third quarter results. The company also raised its full year revenue forecast. And I had the chance to talk to the CEO, Calvin McDonald, this morning. The company has been seeing very strong results in China, but also importantly, a possible inflection in the United States. Here's what he said.
There's no doubt in my mind that we have a long runway of growth still in the Americas and in particular in US. When we look at our growth around the globe, as you mentioned, we're growing in every market. Double digit, 39% in mainland China, 24% in rest of world, 9% in Canada, and we're growing men's in the US. Our opportunity is in women's in the US.
So that's what they're focusing on now, Josh. What's interesting is not all analysts are convinced that they're going to be able to really flip that business back to growth like it has seen.
China was, the big headline that dropped. It jumped about almost 40%. What explained that?
You know, basically, McDonald talked about the value of the brand in China, and he said also their brand is not yet that well known, so he looks for even more upside. But they do things like events; they do them globally. But in China, it seems like they've really tried to peg in-store activities, events, activations, try to get customers there engaged, and it just seems to be working. So that part of the business is definitely
Look at that chart
a
as well,
bright
by the way.
spot. Yeah, over the past month, we've definitely seen
What a
a
move.
big uptick in the shares, but still on the year, they're down, what, about 20%?
Yeah. Julie, thank you. And stick around, more market domination still to come.
We're seeing some big name earnings next week in the software sector, including Oracle and Adobe. And artificial intelligence will, of course, be a focus of both reports for investors. Our next guest is calling 2025 the year of the AI agent. So which companies are best positioned in this AI revolution? We're navigating how to play the software sector with the Yahoo Finance Playbook. And joining us now, Stefan Slowinski. He's Global Head of Software Research at BNP Paribas Exane. Thank you so much for being here.
Thanks, Julie. Nice to be here.
So big picture for software, it's been kind of a lumpy year in 2024, but it sounds like you're more optimistic for where we're going next year.
It has been a lumpy year. I think the sector hit a low in May. There was lots of pessimism around demand, around monetization of co-pilots, which didn't really pan out, and actually around disruption to the business model. And it's pretty safe to say that in 6 months, we've done a 180-degree turn. And so the software sector, the IGV is up 40% since the end of May. Obviously, improved outlook on the demand front, or we hope so at least in the US, although Europe remains a bit sluggish. And hope that the AI agents are finally the killer app that allows companies to monetize Gen AI. So we've seen that turn in sentiment. The problem is it's already reflected in a lot of the share prices.
Right. And is that why, let's get to some of those names. So I'm like Adobe, for example, you got the equivalent of a sell on that name. Is that, I mean, the stock has been obviously a laggard this year. Is that more about the big existential threat from AI? Is that the worry?
Yeah, we have been underperformed this year. And I think, for a lot of these software stocks, they've been riding these, what we call these waves of disruption. One moment they're seen as an AI winner, the next moment they're seen as an AI loser. And part of our concern around Adobe is just the increasing competition from the hyperscalers. So literally every day we're seeing Meta, we're seeing Google, we're seeing Amazon this week coming out with models around content creation, content editing, video creation, video editing, working that into advertising workflows. And so that's just a space where, Adobe will have a role to play, but it's just getting a bit more competitive, which is why we're cautious.
What is Adobe's response to that?
Adobe says that, and they are crucial to the enterprise customer, and we believe that they will be. They obviously have their own Firefly model, which they've created based on data that they own and therefore can be trusted by their users. And again, I think that will resonate very well with a lot of their enterprise customers, but we're worried a bit more about some of the casual, non-professional users who may go to some of these other options, or even small businesses. Look, last quarter, Meta said that 1 million advertisers were using their tools to create content. And so that's just potentially going to be a headwind to growth.
So let's get to that killer app idea that the agent AI is what, at least one of the first things that we know what AI is for, and that's one of those things. How is that playing out? Who's benefiting from it the most, and how are they benefiting? How are they using it?
First of all, it's early. Second of all, co-pilots, of course, 18 months ago was what everyone was talking about, and these were supposed to be AI tools to help each of us in our day-to-day work and help us become a bit more efficient, a bit more productive. I think the selling point for CEOs and CFOs maybe wasn't strong enough for them to fully believe in it. But with AI agents, it does become more about automating roles. You heard Mark Benioff the other night talking about digital labor forces. So we are talking about agents becoming more replacement for some employees. And so, socially, of course, that creates some questions, but you can understand how CEOs and CFOs are now seeing this technology as the value proposition, the ability to sell it based on that return is more attractive.
Another name, Stefan, I'm so interested to get your take on is Meta, because you have the equivalent of a sell on there too. And I think a lot of people, when they saw those last results, they liked what they saw with the top and bottom line. So is that a valuation call? Is it, concerns about CapEx? Because on AI, just to stick with that, there's bulls who come on this show, Stefan, and they pound the table and say, hey, that's one of the names where I see all the spending have results on engagement and advertiser efficiency.
Yeah, absolutely. So we're an underperform, so it's a relative call. A couple of concerns that we do have. One is their business model is still 99% advertising. So whereas Microsoft and Google and Amazon have the enterprise cloud computing businesses, they have a way of monetizing this already with their enterprise customers. Some of those other hyperscalers have subscription business models like Google, Amazon with Prime. They already have subscription models for consumers, so they can maybe layer in Gen AI and get people to pay for that via subscription. Meta hasn't yet developed that. That's one thing. The second thing is we are waiting for January. They will be guiding on CapEx and OpEx for next year. We expect that to be a pretty big number. And so if the top line holds up for them, that's fine. But obviously, if we get any disappointment on the top line, investors may start to get a bit spooked about the spending. You're still losing $20 billion a year on Reality Labs. And so again, relative to some of those other names, that's one that we have an underperform on.
So Josh keeps asking about what you don't like. I'm going to ask you what you do. What you do like? You alluded to Salesforce.
Yes.
We mentioned Oracle's coming next week. I believe you've outperformed on both of those.
That's right.
So let's take Salesforce first. What are they? I mean, they seem to have gotten more popular.
Yeah. So they've certainly gone from the loser category back in May to now the winner category here in December. First of all, from a valuation standpoint, you still do have some backstop, meaning on a free cash flow multiple basis, the stock is still reasonable. And so, yes, we are are starting to embed more hope and expectation, but at the same time, valuation is still reasonable. They are coming out with Agentforce, which is their platform to build AI agents. They're running at that 100 miles an hour. And the initial, again, it's very early, but the initial feedback has been quite positive. So that's one that we expect potentially could see revenue growth acceleration in the second half of the year. And Oracle's already seeing that revenue growth acceleration. Some of that is mechanical with Oracle Cloud Infrastructure growing at close to 50% and becoming a bigger portion of the business. But I think when you do look at next year, because of where valuations have run, you need to be confident that the company you're investing in will see revenue growth accelerate. We think that's the case with Oracle, and with Salesforce, probably the back half of the year, we could start to see that happen.
Great year for Larry Ellison and Software Cats.
Absolutely.
What a rocket ship. Stefan, thank you so much. Appreciate it.
Great. Thank you.
While we are wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There is the closing bell on Wall Street on this Friday. It is Market Domination Overtime now. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's start with the major averages here. The Dow, the laggard of the session, off by 0.25%. That's about 123 points. The S&P 500 up by 0.25%. And the NASDAQ leading up 0.8%. And the NASDAQ has really come back this week, up by 3.3% here. We've been talking for a while now about the broadening out of the rally, but that broadening kind of stalled this week. The NASDAQ was up 3.3%. Contrast that with the S&P Equal Weight Index down 1.25%. So it was large cap tech that came back. We've been talking about this sort of day by day as it's been happening, but now I think it's official. It's a trend on the week, Jared. We'll see if it continues beyond this week.
Yes, I was looking at tech all week long. It's been an interesting mix because you can break it into a few different categories. And let's just skip right to that. I'm going to show you the semiconductors on a 5-day basis. And we're going to see a lot of green here. NVIDIA up 3%, Broadcom up 10%. Software did better. And we can see bigger numbers here. Datadog up 10%, Workday up 6.6%, Salesforce up 10%, just talking about that. And then we have unprofitable tech. Aside from Tesla, most of these are very small issuers, and we're seeing the outsized performance from the smaller ones. DNA up 34%, Roku over 20%, Roblox up over 18%, Coinbase 16%. We've also seen this strength in crypto. Looks like Bitcoin is once again knocking on 100,000, actually above 100,000. And we can see that 5-day total for Bitcoin about 5%, and it is trading at 101,500, not quite the 104,000, just short of that we saw the other day. But let's get to the sector action. This is what we're seeing during the week, and it's been about the mega caps. In terms of large cap, Julie, we are seeing the biggest outperformance in consumer discretionary. That's XLY, followed by tech, and then we also have communication services outperforming. But you're going to see most of the sectors up here, they are red this week. So in terms of large caps, it was just the largest of the large, and we see that in the NASDAQ 100, where you take a look at the left hand, and you can see this outperformance by some of these mega caps. Meta really among the leaders here, up 8.6%. Tesla up almost 13%. By the way, Tesla almost up to its record highs that we had all the way back in 2021. So I'm going to send it off to you, Josh, on that note.
Thank you, Jared. Now for a closer look here, mixed moves on Wall Street to round out the week. And for the bond market, yields edging lower as investors consider the future of the Fed's rate cut path. The odds of a cut rising in a few weeks after the November jobs report came in just above economists' expectations. And joining us now to talk about all this is RJ Gallo, Federated Hermes Senior Portfolio Manager. RJ, good to see you. So let's start on that jobs report. RJ, I'm curious what you made of it. Did it come in about as you expected, RJ? What do you think the Fed makes of it?
Well, I think that the report was generally favorable. I know yields came down on the release, but I would say that at this point we have a trailing 3-month average increase in non-farm payrolls of 173,000. Historically, that's a pretty healthy number. Admittedly, it's slower, less job growth than 6 months ago or 12 months ago. But everybody knew that the jobs market had to slow down some, and it's still soundly expanding and I think generally healthy. I think the Fed would probably view this release as consistent with their already underway process of easing policy to become less restrictive. As the labor market has softened compared to where it was, but is still reasonably healthy, they are easing to try to secure the soft landing and prevent a little bit of a labor market slowdown from turning into something worse, keeping the disinflation in train and keeping the economy in an expansion mode in a manner that's consistent with both of their objectives. Monetary policy is shooting for maximum employment and price stability, and we're getting close on both. And the employment side is generally pretty good, even though the unemployment rate did tick up to a still low 4.2.
I mean, at the same time, there's a little bit of like a spinning plates vibe to the whole thing, RJ, because inflation kind of has stalled out at where it is, right? And jobs, admittedly, as you say, while it's remaining relatively healthy, we don't know where it's going yet. It looks like that the preponderance of folks think that there is going to be a cut at this December meeting from the Fed. Do you think that's what's going to happen? And do you think that there are any risks to that cut?
I think it's highly, highly likely. And the market agrees. If you look at the pricing of futures that are priced relative to Fed funds rates expectations, it's highly likely that there will be another 25 basis point cut at the December FOMC meeting. Now, number one, the Fed funds rate is still well above the rates of inflation. The rates of inflation have not yet gotten to the Fed's 2% on core PCE or headline PCE, but they are basically half of where they were not all that long ago. I think that the Fed is of the view that a positive real Fed funds rate of the magnitude we currently have could be undesirably restrictive. And so their interest now is to become less restrictive. They're not easing to fight a recession. They're easing to try to achieve a soft landing. I would argue the soft landing pretty much has been achieved. The only lingering question is, will inflation get right back to 2%? Or will the Fed basically say, hey, we're comfortable with an inflation rate of 2 to 2.5%. Let's not get too precise here. If we can get disinflation of the sort that we've already had, an inflation rate 2 to 2.5%, and the unemployment rate ends up in staying in the low 4% range, I think that that would be mission accomplished to the Fed. And I think that the ease coming in December is part of that. The bigger question is, where do we go next year? How far down in interest rate space will the Fed funds rate go? The markets at one point thought that the Fed would take yields down to below 3% for the Fed funds rate. That is no longer the expectation. And I think another key aspect of next month's the Fed meeting in a couple weeks here is what does the Fed tell us via the dot plot? Where do interest rates go in terms of their projections for the end of 25 and for the end of 26? There's a good chance they're going to increase pretty sharply from the last projections that were shared with us back at the September meeting. And that's something that could be a challenge to the bond market. If the Fed tells us they're not going to take rates as low as we once had hoped, that could push back a little bit on the recent drop in bond yields as the Fed reveals that message.
And so, RJ, add it up to us, given your views there of the Fed, the economy, for fixed income investors who are listening right now, your advice is what, RJ?
Well, first of all, bonds have produced about, diversified bond portfolios, 3.5% rates of total return this year. That's not very good compared to the, north of almost 30% return you're getting off of an S&P 500 equity investment. I think the better comparison right now, given what we have been through, we went through an extraordinarily adversarial period of surging inflation, massive Fed tightening, and double-digit losses on nearly every fixed income asset class in 2022. Since then, we have found our feet. Income has been restored as a driver of total return in the bond asset class. That's the benefit of the fact that interest rates had to rise rapidly as the Fed fought inflation. So where we stand today, you actually have income providing a tailwind to your total return. That wasn't true when the 10-year Treasury was below 1% in yield. It is true when it's above 4% in yield. So I think fixed income has a place in your portfolio. I think plenty of investors have benefited from being heavily in cash or heavily in stocks, or some, barbell between those two. I think at this point in time, with stock valuations high, with a lot of policy uncertainty, it seems to me an equity investor could take some chips off the table and buy a bond market where income is going to give them a lower rate of return than stocks if stocks keep taking off, but will also manage their risk if stocks roll over. Conversely, a cash investor, and we love cash investors at Federated Hermes, we manage a lot of money market mutual funds, but the returns on those funds are going to go down as the Fed keeps easing. That means that we're going to hit a crossover point where bond investments with a little bit of interest rate risk duration can give you a better total return than your cash. So the cash investor can also look to move out to short-term bonds or intermediate bonds, diversify their risk profile, and get some upside compared to staying in cash as returns to cash decline.
RJ, thanks a lot. Have a great weekend.
Thank you.
Employers hired 227,000 folks in November, slightly more than economists expected, with Wall Street hoping a Goldilocks employment scenario will still allow the Federal Reserve to trim interest rates. However, there may also be signs that a cool down is underway, potentially. Joining us now, Yahoo Finance's Rick Newman. What are those signs that you're seeing there, Rick?
Hey, guys. Well, some of the more bearish economists I follow acknowledge, yes, we had a good monthly jobs report, but there's some questions about the methodology in this report. We can get into that later in another segment if you guys ever want to. But there are other measures of hiring in the economy that are much broader than the monthly number and much more reliable. And those show we are actually close to tipping into a danger zone. If you look at year-over-year change in employment growth, it is very small. The increases are very small. You can see it. You can see it in that chart there. So the question is, that line, where that line is going down toward the right-hand side, are we at a point where that might cross the 0 point and we might actually get into negative year-over-year employment growth? There's no sign a recession is imminent, but it's also true that we've seen curves like that or charts like that right before other recessions, such as the one that began in 2007 or the one that began in 2001. And while, a lot of our audience follows the Federal Reserve, I'm following the Biden handoff to Donald Trump as he's coming in January, and just wondering, looks like Trump's going to inherit a pretty good economy, but there are some warning signs. So I'm watching those charts.
Rick, I'm curious because I haven't gotten your take yet on what you think of the kind of core economic team Trump has assembled. I ask because, it's kind of top of mind, Rick. We had Anthony Scaramucci on the show this week, and obviously Scaramucci, not a fan of Trump. But it's interesting. No, sure not. But interesting because even Scaramucci, he was talking about Trump's team on X, Besson, Hassett, Atkins, and even a skeptic like Scaramucci said he was impressed by that team. And I'm just curious to get your general thoughts on it.
Yeah, the flaky nominees are not on the economic team. I mean, I think the most obvious ones are Pete Hegseth for Defense Secretary. He's got zero experience managing a large organization. Kash Patel at the FBI. I mean, these are the sort of Trumpy America First people who are just there because they're out of loyalty to Trump. The economic team, I think, is reassuring. I mean, Scott Bessent as a Treasury Secretary, markets like him, and we saw a favorable market reaction when he was named as the Treasury Secretary. Yes, we are going to get some tariffs and a lot of tariff threats, but the guys on the economic team have been there before, and they're sort of known quantities. So that suggests the markets are probably going to be okay. If we're going to have turmoil under Trump, it's probably going to be in some other part of the government.
Rick, always great to see you and have you on the show. Have a great weekend.
Guys. See you.
And be sure to check out Rick. And be sure to check out Rick Newman on the Yahoo Finance podcast, Capital Gains. This week, the team is joined by Raymond James Washington policy analyst and managing director Edward Mills to discuss Trump's tariffs. You can scan the QR code below to stay up to date with the latest episodes, and be sure to tune in every Friday at 12 p.m. Here's a clip from this week's episode.
What I've told clients here at Raymond James is to rank order some of the tariffs. Number one, China. Number two, Mexico, and I guess I have to add Canada after the Truth Social posted last week. Number three, Europe. Number four, the rest of the world. When I've talked to Trump trade experts, folks that worked with him in his first term, they tell me, again, take him seriously. Don't take him literally. Not everything that gets posted is going to get implemented. But I will tell you, if we do this interview a year from today, there will be more tariffs in place than there are today. And we'll probably have a conversation about Congress giving him additional tariff authority as they pass an extension of the 2017 tax cuts that expire on December 31st of next year.
Business leaders across the materials and industrial space are here at Goldman's conference as the industry looks ahead to 2025 and the incoming Trump administration. From tariffs to various regulation changes that we are expecting to infrastructure, what could these policy changes mean here for this sector? I want to bring in Joe Ritchie. He is Goldman's co-head of U.S. Industrials and Materials Investment Research. Joe, it's great to have you. Thank you so much for making the time.
Shauna, great to see you again.
So there's lots to get into here. I know you've been very busy with the conversations that you've been having over the last 2 days. I'm curious just to get your assessment right now of the industrial space and whether or not maybe the worst that we have seen is that behind the sector.
Look, from a macro perspective, the reality is that the ISM has been down for 24 out of the last 25 months. So a lot of investors that are here today are looking to see that inflection, right? We've had multiple companies on stage the last 2 days. I'd say cautious optimism is where we're at today. You know, we've had several companies say we're expecting better growth in 2025, but the reality is that they're not really seeing it in their businesses today. As we've spoken before, we're very bullish on what's happening from a U.S. manufacturing perspective here in the U.S. So it's only a matter of time before it happens, and we think it'll inflect at some point in 2025.
What is that manufacturing renaissance? Because it's something you and I talked about 17, 18 months ago. What does that phase look like here as we enter 2025 and how you see that playing out?
Yeah, so let me put some context around it. Historically, in the U.S., we've spent roughly around $70 to $80 billion a year in manufacturing investment. And right now we're tracking projects that are greater than $1 billion, tracking to roughly $270 billion that have broken ground. If you've actually taken a look at what investment has looked like over the last few years, the reality is manufacturing investment has already started to tick up. So last year it was somewhere between 190 to 200 billion. This year we're looking at close to 230 to 240 billion. The important part for the companies that we look at, and these are the HVAC companies, the electrical companies that really do the guts of the facilities and then also sell into the factory floor. The reality is for those companies, they've yet to see the inflection in their orders. A lot of the investment today has been on structures, which benefits companies like concrete, steel, you'll see the aggregate names also benefit as well. So we think a lot of the goodness right now from the manufacturing perspective is on the come for the companies that we cover.
If we do see some of the tariff threats that have been put out here by the incoming Trump administration, are some of the companies within your coverage maybe better positioned, I would guess, than others, just given where they do have their manufacturing plants? And I guess of that, how big of an overhang is that more broadly speaking?
Yeah, so it's obviously been super topical, given that we're only about a month removed from the election. The reality for a lot of our companies are insulated. And you go back to the last tariff cycle, they didn't really see a material impact to their P&L. You have some companies like Stanley Black & Decker, which is more a consumer-levered industrial, which is said, like they're already dealing with 25% tariffs, and they import roughly, call it 25 to 30% of their cost of goods sold is imported here into the U.S. from China. If we were to increase tariffs to 60%, that's roughly a $200 million cost hit to Stanley. And the reality is that they're going to try to change their supply chain in order to offset that. That'll take time, right? But the majority of our companies, pretty well insulated. You have some manufacturing that's happening in Mexico. But the reality is a lot of our companies are actually in pretty good shape.
What are you hearing just from CEOs and the various executives who are here today, those who do have exposure to this potential threat? Are they already moving on that? I mean, how are they navigating this uncertainty?
Yeah, I mean, it's so hard right now. They're having conversations with their channel partners to discuss what pricing could look like if under different types of scenarios. But the reality is until you have something that's a little bit more finite, it's tough to actually institute anything. So Stanley is a great example of that. They're having discussions with the Home Depots, the Lowe's of the world already. I would assume that it's probably easier for them to get pricing through this time around versus last time, just because we have a playbook for tariffs. It's not new. But until you actually know exactly what's going to come down the pipeline, it's really difficult to make any decisions longer term.
Joe, what's the sentiment from business leaders about the incoming Trump administration? Overall, do they view this as good for business? How should investors be thinking about that?
I mean, the stock market seriously is
they're excited about it.
Yeah, the market's certainly excited about it. I think. Look, I think the reality is a lot of the business leaders are measured. And so I had Honeywell here today as an example. We met with their DC team in late September. And the reality is that, they were well positioned on both sides of the aisle. I think a lot of our companies are like that. And so sure, there's optimism. I'd say that the areas of the economy that are probably going to benefit a little bit more are some of the kind of like more traditional oil and gas type names. And so I had Flowserve here today. I think that they view the election as a net positive for them, even if there are increases in tariffs. But generally speaking, I think that the backdrop and the feeling regarding this new regime is fairly positive.
How do you see companies accelerating their growth? When we're trying to identify just the biggest catalyst within the sector, is it M&A? How do you see that strategy evolving?
So it's a combination of new product introductions, investing organically, and M&A. So the reality is the sector that I cover, this multi-industry sector, is a list of industrial conglomerates. And what you've seen happening over the course of the past decade is they've been deconglomerizing. And the companies that were faster to move with changing their portfolio to become much more focused companies have benefited in this upcycle from a growth perspective and having better margins as well. So what you're seeing is you're actually seeing a ton of portfolio movement. I mean, I had like roughly 20 companies here. I'd say the vast majority have made some sort of change over the past decade. And there are still big companies like Honeywell was here today, 3M was here today. There's some big companies that are doing things behind the scenes to try to become a lot more focused.
Joe, within your coverage, who do you think is best positioned heading into 2025?
Yeah, so at Goldman, we have something called the conviction list. The name that I have on the conviction list is Parker Hannifin. They're a great company, really well run. They're part of what I would call the new compounders. They're one of those companies that started making moves about a decade ago to really transform their business. 2/3 of their business is tied to industrial activity, and about 1/3 of their business is tied to aerospace and defense. And so they've been able to perform incredibly well, even at a time when the industrial markets haven't been a tailwind for them. So what we're expecting is at some point in 2025, their markets are going to inflect. That's going to be really, really good for their business. But I would also have to say, look, if you're levered to the power markets today, we've been in basically a structurally declining power cycle for the better part of the last 2 decades. And so companies like GE Vernova that produce heavy duty gas turbines, had a company here called Mirion today that's really levered to the nuclear industry. And you're in the first innings of a burgeoning cycle. Those are two companies to put on your radar screen.
And Joe, another company that's very popular with a lot of our viewers, you mentioned before the conversations with 3M's CEO. Clearly, the market has been excited about the transition. We've seen that reflected in the stock price. How bullish are you looking ahead to 2025?
Yeah, so commented earlier when I had Bill on stage that I had to comment on his enthusiasm. He was full of energy. He said it was a coffee. I think it was much more than that. They're truly transforming that company. And this is going to be a multi-year journey, but it seems like there's a lot that he can do to really transform the margins of the business. And then ultimately, they can become a much more focused company as well. They've already started doing some divestitures. They divested their healthcare business, Solventum, last year. You're likely to see more from them in the future on that front. And look, he's got a new leadership team in place. So every leader that was up there today has, outside of Bill's been there for a little over 7 months. CFO just started 3 months ago, and we have a new IR person that was announced yesterday. So they're doing a lot within the organization to change the culture. And I think this is going to be a multi-year transformation for Bill and for 3M.
Joe, thanks so much for your time.
It's great to see you, Shauna. Take care.
Oil ending the week with a loss on concerns of a surplus, despite OPEC's recent decision to extend its production cuts. Joining us now, Yahoo Finance senior market reporter Inez Ferre. Hi, Inez.
Hi, Julie. Yeah, and at this rate that we're going, oil is going to be negative for the year. I'm going to pull up a year-to-date chart so you can see WTI down 4% this year, and also Brent crude down more than 6%. And for the next year, analysts are also expecting prices to go lower. I'll take that point in a second. But first, I want to note an important development this week that should have sent prices higher. That's OPEC's decision to extend its production cuts until April of next year. That's significant because the Oil Alliance has already repeatedly postponed bringing barrels onto the market. But take a look at the prices that we have seen over the last several days. Today, down more than 1% for Brent, WTI down 1.5%. We've been seeing a sell-off, and this is because of sluggish demand, particularly in China and also rising output from non-OPEC nations, including Western nations, the U.S., by the way, which currently produces about 20% of the world's oil supply. Analysts are switching their view to somewhat bearish for next year. B of A putting out its outlook earlier this week for 2025, expecting Brent to average $65 per barrel next year. And the analysts don't see massive price shocks like the ones that we've seen over the last several years, because they say that OPEC is sitting on the sidelines with spare capacity. And OPEC does want to bring those barrels back onto the market eventually. It doesn't want to keep losing market share to the U.S. Meanwhile, JP Morgan earlier this week also put out its forecast for next year, saying that Brent will average $80 this year. It'll slide to $73 next year. All of this is boding well for drivers for gasoline prices, because they're expected to hit $3 per gallon before the end of the year. Right now, they're at $3.03 on average, guys.
All right. Thank you, Inez.
Thank you.
Time now for to watch next week. We're going to start off on the earnings front, and we got some big names in the software space reporting next week, including Oracle, Adobe, and Broadcom. Oracle announcing results for the second quarter on Monday after the closing bell. Analysts saying the company's results could underscore supply challenges, but see strong demand in AI workloads. AI will also be a theme for Adobe. They're reporting fourth quarter earnings on Wednesday. Analysts expecting the conference call to be centered around generative AI advancements and the potential for monetization of text-to-video.
Taking a look at the economy, monthly CPI, that's the Consumer Price Index for November. It's coming out on Wednesday. Economists forecast total CPI will tick up to 0.3%, while core CPI will hold steady at 0.3%.
And sticking with the economy, we're also going to be getting Producer Price Index data, or PPI. That's coming out Thursday morning. Both total PPI and core PPI expected to increase to 0.3 and 0.2%, respectively.
Well, from Intel CEO Pat Gelsinger retiring to Bitcoin finally hitting the $100,000 mark, it's been a wild week here at Yahoo Finance. Here's a look back at what you may have missed over the past few days.
Bitcoin hitting a major milestone as the digital token powers past $100,000.
It's going to appreciate against the dollar forever.
So they're calling it the Paul Haul, which pulled Bitcoin across the 100K.
Atkins could well be a very good SEC head.
The SEC will be in good hands with him.
There was clearly some sort of disagreement between Pat Gelsinger and the board.
You know, part of the reason Pat's gone is his insistence on trying to make Foundry work.
And it's going to be really difficult to find a CEO just from another tech company to come run it.
The November payrolls report coming in at 227,000.
My first reaction when I saw 227 was, wow, I was actually a bit surprised that it was this high.
We're getting an unemployment rate that's kind of staying in the low 4% range. That's sort of the definition of a soft landing.
The total number of jobs created have been unprecedented under this administration.
Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. But many companies are still hesitant to hire new workers, and many employees are staying put. This means that competition for the jobs that are available remains high, and it may take job seekers longer to find a new role. So what sectors are seeing growth, and how can job seekers find them? Joining me now is Andrew McCaskill, LinkedIn career expert. Andrew, great to see you on set.
Great to see you.
So let's start with that jobs report today, Andrew.
Yeah.
Because we were talking to economists on Yahoo Finance today, and their big takeaway was it kind of showed a labor market that, let's say, it's moderating, it's cooling, but no signs of real crashing. It kind of confirmed the story we've been hearing. But you spent obviously a lot of time thinking about this jobs market. How does it look to you? How strong? How healthy?
Yeah, I mean, look, there were not any surprises in what we saw. We saw that it was really stable, right? But the thing that I think is really interesting is that we saw most of the growth in three core sectors: in government, in hospitality, and we saw it in healthcare. Now, what that also means is that for all of these job openings that we're seeing right now, if you are in the market for a role and you're not in those industries, you got to start to kind of figure out what to do, because we're looking at a situation where there's going to be a lot longer lead times for people who are out there in the market looking for jobs. You've got boomers who are unretiring, coming back into the market, adding a new level of competition. So the competition is going to be really, really fierce for jobs easily for the next 12 to 18 months.
What are some takeaways then you have for people? Tips, tricks, guidance?
Yeah, I think one of the first things that people are going to have to do is actually sort of really prepare for the fact that it's going to be a longer tail job search. Are you really ready? The first thing people have to do is look at the tools that are at their disposal. Things like LinkedIn, is it updated? Have you added your skills to it? Do you have a new resume? If you were hiring right now, would you be at the top of your list, right? So use every tool in your disposal. Turn on open to work on LinkedIn. And then you got to think about your skills. The skills that people are hiring for are really, really important. Recruiters right now, over 43% are saying they're not even going to take people to the interview process if they don't have all the skills required for a role. That means you got to look across the bow at the jobs that are out there and say, do I have the right skills for these jobs? And how do I now go out and get those skills and fill in those gaps, or tell a differentiated story about how the skills that I have actually are transferable to these other opportunities? And your network matters. You're 4 times more likely to get a job at a company if you know someone who works there. And
why is that, Andrew? Because then you have a friend, an ally in there who's putting in a good word to HR?
You've got someone there who can help you decode the process and the culture. And keep in mind, this does not have to be your work bestie. You don't have to have gone to lunch with this person every day. It could be someone that you worked with 4 or 5 years ago. You say, hey, look, Josh, I'm looking for this role at Yahoo. Can you give me some perspective on it? Or maybe can you put in a good word for me, right? There's gradations to how much help you get, but in that process, 4 times more likely. That's a great subset to help you figure out, it's worth it to reach out to that other person.
Let me ask you, so we were giving kind of general advice there. I'm very interested to get your take, what kind of advice you would give to younger viewers who might be listening right now. Maybe Andrew, they're just looking for their first job. Maybe they're already in their first job. What guidance would you tailor for that demographic?
Yeah, for younger folks, I think that the thing is that you get a mentor, somebody who's of a different generation. Most of the people who are going to be hiring and they're going to be hiring managers are not going to be from the same generation you are. So part of what you need to do is get a mentor or get a friend to help you decode how those people think about professionalism and the choreography of job hunting. That means that you're going to have to be on time. You're going to have to send a thank you note. You're going to have to be dressed professionally in a traditional way for that interview, probably because you've got 4 generations of people in the office together right now. And most of the people who are going to be hiring young folks are going to be people from those other generations and who did job hunting differently. And I think that you've got to really have an air game and a ground game if you're a younger person in the role right now. Also think about most companies are thinking your best new employee may be your current employee. So if you're looking for a job right now, companies are really holding on to talent, really good talent, and they're figuring out ways to say, hey, maybe take a stretch assignment over here or do a tour of duty over there. people want to hang on to really good talent, even if it means moving the chess pieces around on the board. Internal movement is a great alternative to going out finding a net new role for almost every employee. Even if you hate your boss, even if you hate your team, you could actually move to another team and love your new boss, love your new team at the same company.
Should you be going into work every day? Is that important, especially for a younger person who's just starting out?
If I had a kid who was a part of that sort of early career subset, I would say get ye back into the office, because I think about all of the things that I learned about building relationships. It is very hard to do that in a remote environment, especially if you've never had the experience before. I think you learn so much about, one, the art of work communication. You learn so much about just being able to lean into your coworkers, about collaboration, about culture. I'm almost 50, right? I could work remotely and still think about how to ingrain myself in the culture, how to collaborate, because I've done that all before. But many of the young professionals out there, they spent the better part of their sort of formative professional years in COVID bizarro world. Let's just be honest. And I think that now there's an opportunity. If you can go back into the office, I think people should grab onto that opportunity with both hands. Go into the office, make friends at work, learn how the business of work gets done in different parts of the organization. I think returning to office is great for young professionals.
Let me ask you a final question. I want to get your thoughts on this thing. Yeah. AI comes up a lot, right? Yeah. And there's a concern about some, you'll hear this, that this could be a kind of job killer. Others I've heard say AI is not going to take your job, but someone who actually understands the technology, can leverage the technology, that person could take your job. I'm just curious to get your thoughts on this.
Yeah, I think we're in the messy middle. We're all trying to figure out exactly what AI's impact is going to be on us at work. But what I will say, I truly believe that regardless of what the impact is going to be, it will impact us at work. The people who are going to win, the employees who are going to win, are the employees who are going out there and learning AI skills, learning the language, learning how to talk about it. And we've seen this on our platform. We've seen 3x the number of people who are taking AI and generative AI courses on LinkedIn Learning. But here's the rub. The true winner is that person who is going to learn those AI skills, learn how to talk about it, but who's also working on their human skills. Because the true winners are the people who are going to help in this big technology transformation. Tech transformations are culture transformations. And if you've got those human skills and those AI skills, that's a level of job security that we all should be looking for.
I don't see AI taking your job, Andrew, career expert. Broadcast reporter. I don't know.
I don't know that a bot could do what you do, Josh.
We'll see. I'll have you back soon for more advice. Andrew, thank you. Appreciate it. U.S. stocks closed the week mixed as the NASDAQ and S&P 500 popped to strong weekly gains. And Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Jared.
Thank you, Josh. It was a really interesting mix and really interesting to see how the winners and losers shook out. I am looking at small versus large, David versus Goliath. And let's explore that theme here. I'm going to start with the sector action, and I'll show you the 5-day price action in the sectors, which is focused almost exclusively on the mega cap sectors. So number one, we have XLY. Guess what's in that? That's retail. That's consumer discretionary, but it has Amazon. It has Tesla. Number two is tech. We know what that has. Communication services. That has Meta. That also has Alphabet. That was up 2.6%. This is the S&P 500. So those were the only outperformers. Everything else was in the red here, led down by energy. And what's really interesting, we look at my leaders board here. Look at that, ARK Innovation Fund up 8.5%. Well, what's in ARK? The biggest one is Tesla. So arguably, that is mega cap influence right there. But then overwhelmingly, this is over the last 5 days. This is a lot of green, and these are smaller ones. So it almost seems like some of the smallest in tech and some of the largest in tech really had their day in the sun this week, Josh.
You mentioned Goliath. You mentioned the big names.
Yes.
Let's go into the weekend. What about the small names, the bite-sized guys?
IWM, I think that was negative. IWM is right here. That was 1.2% to the downside. So overall, small caps did not do that well. Some small cap tech, which we were just looking at, did. So go figure there. We'll have to see what happens next week, because it'd be really fascinating to see if this tech trend continues.
All right, Blickery point number 2.
We're making dollars, are we? So This has to do with the labor market, I believe. We did get that labor market today report, and I was sitting with Joe Bruce-Wellis. He is a chief economist over at RSM, and he and Sydney and I, we were over at Stocks and Translation talking about the labor market and inflation, and I asked him to compare services inflation over to goods inflation, and here's what he had to say about that.
You take a look at service inflation, it's in that 4.7 to 4.8% year over year increase, and it's incredibly sticky. Why is that? Once wages go up, they tend not to go down. I mean, at the end of the day, that's what you really care about, right? Is 90% of our economy is services. Those prices have gone up. And let me say this again, they are not ever going to reset to 2019 levels.
All right, so these prices are not going back down to 2019 levels. We know that, but I think the hot wage number in today's report really gives you kind of a focus point for next week's inflation report.
Key inflation data on deck.
That is going to be Tuesday, and I'm going to be looking at that services inflation. Does it finally breach 5%? Let's remember that core is at 3.3%, and well, that's pretty big for core right there.
Yep. All right, Jared. Final point here.
All right, Bitcoin is channeling Star Wars.
Yeah.
You know, I got this from social media. I'm not going to pretend that I noticed this myself, but I'm going to draw you a chart here. I'm going to go to my crypto heat map. I'm going to go to Bitcoin, up 5% over the last few days. I'm going to show you a 2-month chart with candlesticks, and you tell me, this is the Darth Maul candle. Do you see it right there? Do you squint and see it? I think you got it.
Squinting hard.
Yeah,
yes.
you got to know the prequels. I didn't grow up with this, but you got to know the prequels. And if you did, what this is showing though, and this is why I love candlesticks, this is showing both a rejection to the upside and also of the downside. And you combine that, you just have this huge range bar there. It was almost $20,000 for that one candle, 24-hour period. But the net effect here, we're going to the upside. So I wouldn't be surprised to see some new highs over the weekend. If we dip back below 100,000, that's kind of ominous. And then the low of this candle here that saw such demand from the underside, you definitely want to see that hold.
So to you, Jared, as you look at the chart here, the levels you're watching would be what?
Like 92,000. 92,000 has to hold, but I'd like to see 100,000 hold over the weekend.
All right, Jared. Thank you.
All right.
Great to see you. Man, we're asking for a trend coming right up on the other side. President-elect Donald Trump proposed tariffs are sending shockwaves through a variety of sectors in the U.S., and consumer electronics certainly aren't spared. The Consumer Technology Association releasing a report about the price increases consumers could see if Trump's proposed tariffs do go into effect. And joining us now is one of the people behind that report, Ed Bristois, Vice President of International Trade for the Consumer Technology Association. Ed, it is great to see you. So Trump is moving back into the White House. That means tariffs are front and center. Ed, what could that mean for the American technology industry?
It could mean lower sales. Tariffs are taxes that Americans pay when we import products into this country. And by and large, we import a lot of consumer technology products into this country, such as smartphones, laptops, tablets, video game consoles, desktop PCs. So if the tariffs that the president-elect proposed come into effect, that will increase prices. And Americans, as we found out recently during the election, they don't like higher prices, they didn't like inflation, and they may not like higher prices on consumer tech.
And yet, Ed, what's interesting is if you look at some recent surveys and polling, including a recent one from CBS, it shows Trump's voters, and there are obviously a lot of them, overwhelmingly favor the idea of tariffs. What do you make of that?
Well, they may like the idea in concept. They may think that another country or someone else might pay the tariff, but that's not exactly how it works. Importers, companies in the United States, pay those tariffs. And if they can't absorb the costs, they pass the costs on to other entities and then eventually to the consumers. So consumers may think one thing, but in reality, they will be paying more if companies increase prices.
And yet the reality is, though, Ed, Trump has made it clear he likes tariffs. You listen to the team he's putting together there. It's clear Lutnick likes them. Bessent favors them. So how, bottom line, do you try and navigate that?
I think some of the incoming appointees have said, we believe tariffs are a negotiating tool to achieve other objectives, whether they're trade objectives, economic objectives, other types of policy objectives. So if they are going to use tariffs to negotiate new trade agreements or address barriers to trade in other markets, if they see them as negotiating leverage, that could yield better benefits for the American people at the end of the day. But if the tariffs are just put into place permanently, and there's no opportunity to open up new markets, to increase U.S. exports, to level the playing field, then that's going to be a cost on the U.S. economy over time, and it'll make our manufacturing ecosystem much more costly compared to our competitors.
I'm curious, Ed, if Trump really did impose tariffs on China the way he's talked about, how would you suspect Beijing might respond and react?
Well, we just saw Beijing retaliate this week in response to the new export controls on semiconductor manufacturing equipment announced on Monday by the Department of Commerce. And they have signaled that they're ready to retaliate against other measures too. So they imposed restrictions on exports of critical minerals like germanium and antimony and graphite. And we saw very clearly in 2018 and 2019, China did retaliate at that point in time with higher tariffs of its own, particularly on core U.S. exports to China, like in agriculture and chemicals. So I would anticipate that China is ready to retaliate again.
Ed, it's interesting to me because it's beyond tariffs. There has been this just obvious seismic shift, right, in politics in this country, in the Republican Party. I look at that party, and it's a very different party than the party I grew up with. And the values, what it's focused on, and you know this, you live and breathe it, it's economic nationalism, it's domestic manufacturing. It's this very strong view that China is not a partner, China is an adversary. And I'm just curious, someone who represents the American technology community, how you think that technology sector has to respond, react, evolve with that.
Look, we've been very clear for a long time that we need to address these unfair trading practices in China. So China is well known and it's very documented to have stolen intellectual property from U.S. companies. They forced technology transfer. The tariffs that were put into place in 2018 and 2019 were designed to address those behaviors, but China never changed its behavior. So in the technology sector, we want to do business with China, but we recognize there's a need to diversify supply chains. So many of our companies have moved to places like Vietnam or Mexico or other parts of Southeast Asia like Malaysia, or even in Europe or Japan or Korea. And we need good policy to support that supply chain diversification to keep costs down for the products our companies are designing and making so that consumers can buy them at affordable prices in the United States. And that's the trend line we'd like to continue.
And big, complex questions. Thanks so much for helping us think through it.
My pleasure. Thanks for having me on.
Stick around. Much more asking for a trend right on the other side. For our chart of the day, we are taking a look at inflation expectations between the political parties. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yeah, this is something that we have been watching and seeing this phenomenon, and it's especially measured by the University of Michigan's sentiment survey. They measure how different political parties, members of different political parties feel about the economy, and they also measure their inflation expectations. And it's that chart that was highlighted in a tweet by Michael McDonough, who's in the economics department over at Bloomberg today, looking at the flip that we have seen in inflation expectations over the next year between Democrats and Republicans since the election. So the white line you see here is Republican expectations for inflation, Democrats' expectations in blue, and independents in the sort of amber line in the middle here. Republicans, as you can see, going back to December 2021, they were feeling like inflation was going to remain much more elevated than Democrats were. We've seen them both trend down, but there's been that gap between the two, of course. Now, since the election, we have seen a flip. Democrats now, their one-year expectations at 3.2%. Republicans have fallen below them to 1.3%, and independents right in the middle, 2.9%. Incidentally, 2.9% is also where the average of the survey reading is. Well, why are inflation expectations important? Well, they have an influence on where inflation will actually end up, because customers and shoppers' willingness to pay certain prices. If you expect the prices to go up, well, maybe you're more resigned to those higher prices. You're more willing. You're not going to press back against them. At least that's one of the ways that these expectations can feed into where inflation actually ends up. And the political divide, as always, is quite interesting, especially since the election and that flip in sentiment here. So we'll see how this ends up actually feeding through and where inflation numbers actually end up. Of course, as we've been talking about, Josh, we've got CPI coming out next week on Wednesday. So expectations aside, we'll see where the number actually lands.
Yeah, it's interesting, Julie, because I've seen other polling and survey work showing that breaking down our views of not just the of the inflation have shifted, but in fact, even views of overall economy has shifted too, depending on where you sit on the ideological aisle, which I guess just bottom line emphasizes this idea that your politics, that partisanship does play can play an important role in these sort of evaluations here.
Yeah, and I haven't seen an enormously long time horizon on these types of charts, but I am curious if that gap in perception related to political parties has widened over time. I would suspect it has, but I would love to see the numbers.
All right, Julie, thank you. Appreciate it. And that is a wrap on today's Ask for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.
Ngeprint jadi mudah dengan Canon Pixma G. Canon Pixma, Canon Pixma G. Printer ink dengan tinta botolan. Canon Pixma, Canon Pixma G. Lebih murah, garansi hingga 3 tahun. Canon Pixma G, Canon Pixma G. Garansi hingga 3 tahun.
That said AI will lead to great abundance. This is a couple of years before we invest in OpenAI. AI will lead to great abundance, great GDP growth, great productivity growth, and increasing income inequality.
Mm-hmm.
So that is a separate issue we should address. I'm very optimistic of what AI can do, and this was before any of the large breakthroughs in AI. And so when we got an opportunity in 2018 to commit to investing in OpenAI, it was an easy decision to make, though pretty vague decision because it was so obtuse what we were investing in and where it would go. So I'm very optimistic of what AI can do for humanity. I think fundamentally the need to work will go away. We will dramatically increase GDP growth from probably 2% to well over 5%. That will create enough abundance to take care of the people who are negatively impacted, which is my biggest concern.
It's my biggest concern as well. I was going to say, I think some people would say the need for work to go away, or the fact that it may go away, and your version of events is pretty dystopian, and they're scared.
And I do, and this is why I recently wrote a 25-page essay called AI Dystopia or Utopia. And as I was telling you backstage, I purposely addressed the dystopian view first because I wanted to address each of those individually. There's half a dozen dystopian visions people have proposed will hurt us. And I address each one of them individually. We don't have enough time to cover that here today. But I do think there's sensible answers. And by and large, those will be societal choices we make, and they will be made country by country, and each country may make a different choice.
Well, let's talk a little bit about that dystopian version. So I think the thing that people focus on right now is misinformation. But what is the thing that you're worried about that people aren't talking about?
Well, I think people are talking about all the right issues. But they're not talking about it as a very large basket of risks. So there's all sorts of risks. I think an asteroid could hit our planet. One came by close enough recently. We could have a pandemic. We could have sentient AI try and kill humanity. Those are all risks we should take seriously. And I do think AI safety has to be addressed pretty significantly, and I cover it extensively. But by and large, the biggest risk we face is strong AI in the hands of our adversaries. I'm mostly thinking of President Xi, and I'm thinking of Putin. That is by far the biggest AI risk. And they're using it effectively. We just had an election in Georgia, and the president of Georgia declared Russian interference and didn't validate the results.
I think the confusion, at least I guess where I'm confused, is you obviously are mostly largely in favor of less regulation because you're concerned about China's lack of comparative regulation and you don't want them to get ahead. At the same time, we do need some regulation. So what is the role of government and policy here?
Well, as I say in this long essay, policy plays a really important role. We have to keep in mind our biggest risk is China. I'm a total China hawk because they have a different set of global objectives than we do, and they are an adversary, and there's no doing international treaties and all that. And we can come back to why that will never work. But given that, we still have to have safety issues. We still have biowarfare as a real risk. Nuclear is a real risk. All these things that AI can help people design and catch up on. In fact, there's a positive and a negative view of AI. You know, most of us have heard of LLMs. The next OpenAI just released a reasoning model, a reasoner. Anthropic just released something that knows how to run computers, an agentic system. So if you think of a hierarchy of capabilities, I think the next big, large capability, as Sam Altman has said, will be AI scientists. Now, with the AI scientists, you could start to do all kinds of bad science. And I do worry about that.
One other thing that we just sort of breeze by, but I think is really a huge issue, and I know that you're a proponent of universal basic income and income redistribution. I have to wonder, though, what the triggers are. I mean, we are already in a society where there are 3 Americans who have more money than 291 million Americans. So when we talk about this future, I mean, it feels like we're here already.
So capitalism tends to concentrate wealth as a natural mechanism. And so we have to have policy to equalize it so everybody has a stake in it. I do think capitalism is by permission of democracy. People can vote bad policies or bad politicians they don't agree with out. So I do think if disparity gets so large that it's a real problem, democracy will take care of it. It's a much stronger system. So I do believe that's a problem. I don't think it matters how rich the rich are. What matters is how well off are the bottom quartile of people on in a country.
Right.
And I think our policies should be focused on optimizing for them, not on optimizing policies for the top 1% or 5% or 25%. And I do think that should be the goal of policy, but that is not what often happens.
It's just hard to see how we get from here to there. And it's also very concerning because we are being asked to, a very small minority of people are sort of in charge of AI, and it's going to impact all of us, which I think is...
Well, first, there's no one person responsible for AI. There is going to be multiple systems in this country, and there'll be others overseas. So I think this notion of one person ruling the planet is a silly notion.
I'd say that if I didn't see Elon Musk running all over the country, jumping up and down.
Elon's a good entrepreneur. I can't believe he's supporting somebody with such depraved values as Trump, but I mean, look, fundamentally, and I've had this debate, I can't imagine anybody who values values voting for Trump. Forget everything else. He's so depraved. It's unimaginable to me, but obviously Trump is tapping into a vein of discontent that's very real.
I do think that
social inequality is very correlated with the spread of misinformation. And in some ways, I think that's why we're in the situation we're in right now. Do you
I
agree?
think social inequality is different than misinformation. Misinformation is because of the nature of social media and the fact that social media has taken political position.
Welcome reward spesial untuk trader baru. Mau tahu gimana caranya? Yuk simak. Daftar di DuPoint dan buka akun real. Gabung welcome reward dan dapatkan $30 di akun promo. Trading di akun promo dan klaim rewardnya sekarang. Klaim profit yang diperoleh dari trading di akun promo reward akan dikonversi menjadi voucher MAP. Tunggu apa lagi? Yuk buruan daftar. Download aplikasi DuPoint di App Store atau Google Play.
You make no friends in the pits and you take no prisoners. 1 minute you're up $500,000 in soybeans and the next, boom, your kids don't go to college and they've repossessed your Bentley. Are you with me?
The revolution starts now.
We have to pass the bill so that you can find out what is in it.
Turn those machines back on! You are about to enter the Peter Schiff Show.
Show me the money!
If we lose freedom here, there's no place to escape to. This is the last stand on earth.
The Peter Schiff Show is on.
I don't know when they decided that they wanted to make a virtue out of selfishness.
Your money, your stories, your freedom. The Peter Schiff Show.
This episode is sponsored by OneSkin. By focusing on cellular aspects of aging, OneSkin keeps your skin looking and acting younger for longer. For a limited time, get 15% off. Use code GOLD when you check out at oneskin.co. And throughout the month of December, you'll get a free travel size product valued at up to $42 with every purchase. The best part? You'll get a different gift each week. Thanks to LegalZoom for supporting my show. LegalZoom helps business owners like you take your first step and every step after, from reliable business formation to experienced guidance in legal and tax. Launch, run, and protect your business to make it official today at LegalZoom.com and use our promo code SHIFT to get 10% off any LegalZoom business formation product, excluding subscriptions and renewals. Offer expires 12/31/2024.
The Peter Schiff Show.
I'm doing today's podcast a little early. It's about almost an hour before the close of the market on this Friday. I'm doing it early. I've got a event at my son's elementary school or middle school. He's in 6th grade now, although it's the same school, but I think they break. I think he's technically middle school. But I got to be there early, so I couldn't wait for the market to close. So I am doing today's podcast while the market's still open. In fact, earlier today, we did hit new all-time record highs in the S&P 500 and I believe the NASDAQ 100 in record territory. The Dow didn't quite make it to a new record high today, and it's actually down about 138 points, which is not very much as I'm talking. The big news that came out earlier today was the jobs report. Although we just got the consumer sentiment, excuse me. That number came out earlier today as well. And I want to comment on that before I get to the jobs numbers, because we had a big jump in consumer sentiment. And I read online that this is the biggest post-election jump in sentiment since the election of Bill Clinton in 1992. So Americans are optimistic because of the election of Trump. And this is something that I expected to happen. The reason that they're optimistic is because things were so gloomy. People now think that, okay, we got Trump, we can get rid of Biden, we're not going to have Harris, he's going to make America great again. And that's great. People are looking forward to that because they've been struggling with a weak economy, rising inflation, rising debt, and they're optimistic that Trump's going to make those problems go away. Now, again, I don't share that optimism, but I understand where it's coming from. And so we had a spike. It went from 71.8 up to 74. So before the election, 71.8, now 74. If you look at the inflation expectations, though, which obviously the Fed won't like, the year ahead inflation expectations went from 2.6 to 2.9. Now, 2.9, I mean, that's almost 3. We're heading in the wrong direction. Powell is convinced that inflation is heading back down to 2%. Well, he had to convince the consumers who think it's headed more towards 3%. That might be partially why you have the stronger dollar today, the stronger sentiment, the stronger than expected non-farm payroll report, which I'm going to get to again. So the dollar index is once again above the 106 handle. A euro, I believe, is now back around 105, maybe a little bit below 105 euro to the dollar. Let me just take a quick look at those exchange rates. Well, no, 105.6, so not quite there. But the dollar has been strong. It's strong again against the Australian dollar in particular, which has been very weak of late based on some weaker than expected economic news there. Now, of course, we had a lot of weak news here, too. But again, investors are just dismissing a lot of the weak data because they just assume that it's going to turn around with Donald Trump. And I think the markets are wrong to make that assumption. But we did get the jobs numbers that came out, and they were also a positive. I think that also weighed on pushing up the dollar. I think that's also one of the reasons that gold is barely up on the day. Gold's around $4 higher, 26.35. It hasn't really been able to gain any traction to the upside. And mining stocks are getting hit hard again today, even though their costs are coming down as far as their local labor costs with the strong dollar. I think all the optimism about the stock market is causing some pessimism in the gold mining sector. And of course, and I will talk more about Bitcoin in this podcast today, because right after I finished my last podcast, I mean, as soon as I got off doing it, Bitcoin spiked up, got above 100,000 for the first time ever. It almost hit 104,000 on that spike, and then it stayed above 100,000 for most of the trading day on Thursday. And then late in the day, after the U.S. stock market closed, there was a big sell order that came in, and Bitcoin collapsed. You know, not really collapsed, but it had a big drop in a few minutes, and it went down from above 100,000 to below 93,000. It has since recovered, and as I am recording the podcast today, a little bit before the close of the market, we're back almost at 102,000 per Bitcoin. Of course, I got a lot of flack online because occasionally I said I didn't think Bitcoin would ever get to 100,000, although there are plenty of times where I conceded that it could get there. I didn't expect it would get there. And but for the election of Donald Trump, I don't think it ever would have gotten there. And I will get into the irony of that a little bit later in the podcast. In the meantime, I want to talk more about the economic data that came out this morning, in particular, the jobs data, because we got some weak jobs data according to ADP. And I went over that weak data on the podcast I did on Wednesday. And I thought that we would probably get a weak report today as well. Well, it turned out that the numbers that we got today were actually better than expected. Not a lot better, but they were better. Although, again, you got to take all these numbers with a grain of salt, because just because we got a better number the first time, you know, we could end up with a much worse number when they go ahead and revise it. And they may not just revise it next month. They can revise it in 6 months. They can revise it in a year, right? They can come back and say none of these jobs were actually created. So all these numbers are meaningless, which is even more ridiculous that the Fed claims to pay so much attention to this data, right? They're dependent on data that is unreliable. So what does that tell you about the reliability of the Feds and their forecast? One of the other questions that Andrew Ross Sorkin asked Powell the other day, he mentioned something that Trump said, and I completely agree with Trump on this one. He said that being a central banker was the greatest job in the world because you just show up once a month and flip a coin and everybody thinks you're a god. And I think that's pretty close to probably what's accurate, although they probably don't just show up once a month. They waste their time. The Fed has a lot of employees. What they do, I'm really not sure. But I mean, maybe the Doge Commission can look at the Fed, although the Fed is independent, and realize that we don't need all these pencil pushers over there. The other thing too, hopefully, is they can point out that we don't need a Council of Economic Advisors. We didn't always have a Council of Economic Advisors. That was added somewhere in the 20th century. I forget when. It was after the Second World War. I mean, we actually made it all the way to the Second World War without any economic advisors to the president, and now he has a whole army of them. But we had a much stronger economy before we had economic advisors. So, we don't need those. We can clearly get rid of them. But let me look at these jobs numbers that came out today. So the forecast was for 211,000 jobs, and that was going to come, remember last month we had a really, really weak number, just 12,000 jobs created in October. And so the consensus was for 211,000, and we got 227,000. So a slight beat, well within the range of expectations. It went from a low of 160 to a high of 275. But we did get a revision to the 12,000. They revised it up to 36,000. I mean, still a low number, 36,000, but it was an upward revision. And there was another small upward revision to the month before. Unemployment, however, notched up. It went from 4.1 to 4.2. That was what they expected, but that's what they had. But obviously, unemployment headed in the wrong direction. But the real number in the wrong direction was labor force participation, which dropped to 62.5. That's not a good thing. If you're looking for a stronger economy, you want more people working, not fewer people working. And we got people leaving the labor force. But despite the fact that people left the labor force, the unemployment rate went up, which makes it even more significant because people leaving their labor force in and of itself makes the unemployment rate go down. Because if you leave the labor force and you were unemployed, once you leave the labor force, you're no longer counted as unemployed, even though you don't have a job. So it's an even bigger boost in unemployment, maybe the equivalent of 4.3, an extra tenth because of that. Now, the private sector payrolls were actually lower than expected. They were looking for 200,000 private sector jobs and just 194,000. So the reason that we had a stronger number was because the government hired more people. Like these are the people that we're supposed to get rid of, right? That's what the Department of Government Efficiency, Elon keeps on tweeting about how we got to get rid of government workers. Well, the government workers are the jobs that we're creating. But I agree, we don't need jobs. These jobs make us poorer. They don't make us richer. And he mentioned again today on a post that we need to transition people from unproductive government jobs to productive private sector jobs. I agree. That's exactly what needs to be done. But there is some transitionary pain that is going to be associated with that nobody has been prepared for. But the private sector jobs, though, the payrolls were revised up the prior month. It was initially minus 28,000, right? It was a huge minus number, meaning that all the jobs created in October were government jobs. And that's still the case because they revised upward the private payrolls to minus 2,000, but it's still minus 2,000. So we created 36,000 jobs in total, but we lost 2,000 private sector jobs. That means we created 34,000 government jobs, and those were the only jobs that we created in the month of October. Of course, I don't even believe that those jobs were created because I think all these numbers are just made up anyway. A lot of them come from the birth-death model, and it's just all one big guess. Manufacturing, though, continues to be weak. Manufacturing number was below estimates. They were looking for 25,000 manufacturing jobs, and we only got 22,000. That's still a big number because we normally don't create anywhere near that much, but we lost so many the prior month. And in fact, that loss was revised upwards to a bigger loss. It was originally reported that we lost 46,000 manufacturing jobs in October, and now they say we lost 48,000. So manufacturing even worse. Average hourly earnings at 0.4. That's still problematic for the Fed. They were hoping for a decrease to 0.3. 0.4 matches the prior month. And the average work week stayed the same. Actually, it ticked up a bit. It was revised down from 34.3 to 34.2 for October, and it went back up to 34.3 for November. Of course, once again, it's a tale of two job reports. The household survey showed, I think, a loss of 355,000 jobs. To me, that seems more likely. Remember, we lost 368,000 jobs in that survey last month. We lost both full-time and part-time jobs. So I think that's the real tale of the economy, not the government version. And again, that's why Trump was elected, but people now are hopeful that the situation is going to change. Unfortunately, it's more likely to remain the same. Anyway, we got a quick commercial break, so stick around. I'm coming right back. The holidays are all about surprises, right? Well, today's sponsor, OneSkin, is really taking that to heart. As the first company to target skin aging at the cellular level, OneSkin wants to give you the gift of healthy aging free. Throughout the month of December, you'll get a free travel-size product valued at up to $42 with every purchase. The best part? You'll get a different gift each week. What I like most about OneSkin is the science behind it. They're not just selling you a product. They're offering you real proven ingredients to tackle aging at the root. I've tried it on my face, around my eyes, and my hand, areas that are always in the sun and show age faster than we'd like to admit. My skin feels smoother and healthier. It's really straightforward to use. Just cleanse, dry, and apply twice daily. Founded and led by an all-women team of skin longevity scientists, OneSkin is redefining the aging process with their proprietary OS1 peptide, the first ingredient proven to help skin look, feel, and behave like its younger self. Get started today with 15% off by going to oneskin.co and using the code GOLD. After you purchase, they'll ask you where you heard about them. Please support our show and tell them that we sent you. So that's 15% off at oneskin.co with code GOLD. Invest in the health and longevity of your skin with OneSkin. Your future self will thank you. All right, so I got to talk a little bit about Bitcoin. But before I just start going into Bitcoin, I want to speak about what Jerome Powell said about Bitcoin at the Dealbook conference on Wednesday, because I actually forgot about that, because I talked about that conference again on my Wednesday podcast, and I totally forgot about that aspect of it. So it's just
Nippon Elastex 3-in-1 dengan teknologi Hydroplex, perlindungan lebih maksimal, gampang meresap ke pori-pori tembok, daya sebarnya luas, pasti beres pakai Nippon Elastex.
So it's just as well, because maybe it's even more appropriate now with Bitcoin trading at 102,000 per Bitcoin to discuss it. But so Powell was asked about Bitcoin and whether or not he saw Bitcoin as, I think, a threat to the dollar or something like that. And he said, no, I don't think of it that way. I don't see it as a currency. I don't see it as a competitor to the dollar. It's not a currency. He said it's a highly volatile asset that's like gold. He said it's digital gold. And so I see Bitcoin as a competitor to gold, not a competitor to the dollar. And of course, that's exactly what the Bitcoin community wants to hear, right? Because they claim that Bitcoin is digital gold. And so now they've got the chairman of the Federal Reserve making the same claim. So he's validating the idea that Bitcoin is digital gold, right? And I get a kick out of the fact that now all these Bitcoiners, they all love Powell, right? Oh, yeah, he says Bitcoin is digital gold. Yeah, but Powell gets a lot of stuff wrong, including that. I mean, Powell doesn't understand gold at all. And in fact, gold is a competitor to the dollar. Maybe he doesn't understand that. So if he thinks Bitcoin is digital gold, then it should be a competitor to the dollar, because central banks have a choice. They can hold dollars or they can hold gold. And apparently they can hold Bitcoin, according to Powell. And so it is a competitor, even if you don't think it's a currency. If you think it's digital gold, I mean, gold isn't a currency. Gold is money. So maybe Powell thinks that Bitcoin is money, which it's not. But he clearly doesn't understand gold. He doesn't understand Bitcoin either, right? He doesn't understand a lot. That's why he's the chairman of the Federal Reserve. But he's completely wrong. But this is also helping to power Bitcoin, having the chairman of the Fed basically bless this. Plus, because Bitcoin is now being, part of the U.S., right? It's part of Trump's plan to make America great again, is to make Bitcoin greater again. And now we're trying to marry the U.S. to Bitcoin. This is another irony of Bitcoin, because initially people said, the dollar is going to go down, same as me, right? Dollar inflation, budget deficits, we're going to keep printing dollars. Bitcoin is an alternative to the dollar. You need to buy Bitcoin because the dollar is going to go down. Now they're saying that Bitcoin is the salvation of the dollar. You don't have to worry about the dollar anymore because it's going to be backed by Bitcoin. So we're going to buy all this Bitcoin in a strategic reserve, and that's going to strengthen the dollar. So if Bitcoin is going to strengthen the dollar, then there's no reason to even buy Bitcoin, right? Because if you were buying it because you were worried about the dollar, well, don't worry, because Bitcoin is going to save the dollar. That's another inconsistency, as is the one about the debt. People said, you got to buy Bitcoin because the debt is spiraling out of control. The U.S. has all this debt, and we're going to have to inflate it away. Now they're saying that Bitcoin solves the debt problem, because by buying Bitcoin, and the price of Bitcoin is going to go up so much that the U.S. government is going to be able to pay off the national debt just by selling some of its Bitcoin. So apparently Bitcoin solved the debt problem. But if you're buying Bitcoin because you're worried about the debt, but Bitcoin itself solves that problem, right? You got this circle that doesn't really work. It's kind of like a time travel paradox. But all this stuff is a bunch of nonsense. And you know what? I put a lot more stock into what Alan Greenspan said about Bitcoin, not when he was chairman, but recently in the last several years. By the way, Ronald Reagan appointed Alan Greenspan. Right? Ronald Reagan, again, was a real conservative, libertarian, Barry Goldwater guy, philosophically far more, in tune with the stuff that Elon Musk is saying, and the stuff that a lot of, hardcore Bitcoiners believe about the economy, right? And he picked Greenspan because Greenspan was a hard money guy. He was a gold fund, a gold standard advocate, an Ayn Rand disciple, objectivist, libertarian, right? That's who Ronald Reagan picked to be Fed chairman, right? He didn't necessarily realize, I didn't nominate somebody like that because he nominated Powell, right? So again, all the people who think, Donald Trump is going to succeed where Ronald Reagan failed, it's not going to happen. Reagan tried to cut government spending and he couldn't do it. And he was committed to doing it, to his core. Reagan had real philosophy. Trump is a little bit different. I mean, Trump wants to be popular, and Trump kind of goes where the wind blows with a lot of these policies, but he doesn't have any hardcore, free market libertarian beliefs that we need a lot less government. That's just not where he is. I'm not saying there aren't things about Trump I like, but he's not as good as Reagan. And Reagan couldn't deliver on actual promises when they were easier to keep. The debt to GDP was barely over 30% when Reagan came in. I mean, it's 125% now. So it's a Herculean task that needs to be accomplished. And we couldn't accomplish it when when it was much smaller. But if you look at what Alan Greenspan said about Bitcoin, he said it's nothing like gold. He said it's unlike gold. It doesn't have any intrinsic value. He said that Bitcoin is based on the greater fool theory, which is exactly what it's based on. It's just based on somebody paying more money than the next guy, and the belief that, if you buy it, someone else is going to pay more. Now, the main reason, probably the only reason that Bitcoin is over 100,000 now, that the U.S. government is going to buy Bitcoin. Yes, Senator Loomis introduced this bill to require the U.S. government to buy 1 million Bitcoin over the next 5 years, regardless of the price, right? No matter what, even if it's $1 million of Bitcoin, the U.S. government is committed to pay that price. And of course, it has an unlimited checkbook because it cranks off the money. So if people believe the U.S. government is going to buy 1 million Bitcoin, maybe more, I mean, maybe that's just the opening bid, who knows? And people are speculating that if the U.S. government buys Bitcoin, well, other governments are going to have to follow suit. All these governments are going to be buying Bitcoin. So if you think all these governments are going to forcibly take the public money and buy Bitcoin, remember, I've never bought Bitcoin because I don't want to buy it. But if the United States government buys it, then I own some. I didn't want to buy it. The government bought it by force, right? So initially, Bitcoin was born on the idea that it's about freedom and sovereignty and anti-government and move away from the government. And now it's completely dependent on government. It's not it's not like the free market. It's the coercive power of the state that is now behind Bitcoin because it's going to go in and buy it. So I think they ran out of private sector buyers to keep the pyramid going, but now they paid off all these politicians. Now, they may not actually buy it. And I don't think the Bitcoin reserve is ever going to happen. I mean, it could, but I looked up the bill. Loomis introduced the bill. She's got no co-sponsors, which, normally you would have some co-sponsors. I went on, ChatGPT and I asked it to, look through the internet, and I searched myself. I said, I find any congressman or senator who has come out in favor of this bill. And it found one Democratic congressman from Silicon Valley who had come out in support of it. But that's it. So you got one senator, one representative. I mean, that's it. And I can't see enough support out there to go out and borrow more money as if we didn't have enough debt and enough problems and just go buy Bitcoin, basically to enrich the people who are selling us the Bitcoin. So I don't think it's going to happen. But the fact that so many people expect it to happen, that's what's helping to drive the price up, because people want to buy ahead of the government or all these governments. But also, I think that is what is empowering Michael Saylor. He has purchased, or spent rather, $13.5 billion in the last month buying Bitcoin. $13.5 billion. And of course, he told everybody he was going to do it before he did it, which no buyer would do. No legitimate buyer who's going to step into a market that's relatively illiquid in a way and announce your intention to buy a big quantity. I mean, why? Well, the price is going to go up. People who might have sold are going to hold off on selling because they're going to wait for you to push up the price. Other people who might not have bought, if they know you're going to buy, well, they're going to buy ahead of you, right? So they can turn around and sell. So one of the reasons that MicroStrategy was able to raise all this money, sell stock, borrow money to buy more Bitcoin, was the idea that he's got an exit strategy too, in theory, which is the U.S. government, because the U.S. government hasn't even started buying yet. So MicroStrategy says, hey, we're going to load up with all this Bitcoin before the government starts buying. Can you imagine, because how ridiculous it would be? Everybody, the government's going to buy Bitcoin. So let's all load up on Bitcoin first to push the price way up so that when the government comes in, they're buying the top, right? We're gonna really inflate this thing up, because Saylor announced a 3-year plan to spend $42 billion buying Bitcoin. At the rate he's been buying it, the whole plan will be completed in under 4 months. Right? What's the rush? Why do I want to buy so much Bitcoin now? Because I want to buy it before the U.S. government buys it, because they're going to buy it at a higher price. Plus, all the Bitcoin that they buy, they're removing it from the market. They're reducing the supply. That means when the U.S. government steps in to buy, there's a lot less Bitcoin available. And so it's got to pay a higher and higher a price to get it. So that's what's going on here. Now, since I don't believe the U.S. government is going to be a Bitcoin buyer, at some point there's going to be a major disappointment here, and you're going to see a big drop in the price of Bitcoin when it does, and not a rebound. And everybody's excited at the Bitcoin 100,000 party right now. You know, there's an old expression about a bubble. People generally stay too long at the party, right? They don't leave. And that's what's going to happen to a lot of these Bitcoiners that are drunk on $100,000 Bitcoin. And that doesn't mean it can't go higher as long as the specter of government buying is out there. But at some point, the reality that the government's not going to buy is going to be there. And of course, the worst thing about the government buying Bitcoin, apart from the massive inflation that will be created by the trillions of dollars they'd have to create out of thin air to buy nothing, right? And all the people who sell their Bitcoin to the U.S. government are going to take the money they get and spend it, driving up the price of everything, right? And it's going to be enriching the people who own Bitcoin at the expense of everybody who didn't, right? Because they're not going to get the new money, but they're going to be stuck with the high prices that are going to be caused. But the bigger problem is the malinvestment. See, if Trump wants to make America great, part of what Trump wants is a lower trade deficit. And I'm going to go over some trade numbers after this break. But he wants us to make more stuff ourselves, right? To produce more, which means we need more factories producing the stuff, so we won't have to import it. Well, where are we going to get the money to build those factories, especially if we're taking what money we have and wasting it on crypto? If we're spending our resources mining Bitcoin and coming up with blockchain and crypto companies that do nothing, produce nothing, and lose money, right? That starves the economy of resources to actually produce the things that we need, to build the factories, to make the stuff that actually improves our lives. You know, for all the promise of blockchain and all the things blockchain is going to do, so far it's done nothing, right? Over the last 10 years of hearing all this stuff that's going to be on a blockchain, from stocks to real estate, you know, no one is trading stocks on the blockchain, right? No one is trading real estate on blockchain. So it hasn't even happened yet. You know, again, when the internet came out, within the first 10 years, it changed everybody's lives in a meaningful, dramatic way. They keep comparing Bitcoin to the internet. Well, it's been around for a lot longer than that, and it hasn't changed anybody's lives other than to enrich the people that bought it. Sure, yeah, their lives have changed just because they bought it, not because they're using it for something. And of course, the money they made comes at the expense of the money everybody else is going to lose, who is stuck holding the bag. But that is the real danger, that we further weaken the economy by diverting resources that we need into non-productive crypto-related enterprises at the expense of investing in the real economy. So by trying to make Bitcoin great, Trump would actually prevent his ability to make America great, because America would be poorer. The more money we squander on this nonsense, the poorer we're going to be. Anyway, we got another commercial, so stick around. We'll be right back. When creating your own business, the most important part is your ideas. So why let the headache of registering your business hold those ideas back? It's time to learn about a great idea that will help keep you going and growing. LegalZoom. LegalZoom has everything you need to launch, run, and protect your business all in one place. Setting up your business properly and remaining compliant are things you want to get right from the get-go. But you don't have to strain.
It's been a month since I decided to be an online assistant, and this is how I start my day as an online assistant. I wake up in the morning without having to rush. No need to face the traffic to the office as I did before. I cook for my family, have a leisure breakfast, and a refreshing shower. I open my laptop and start working about 3 to 4 hours, living my dream job, making money right from home. And you can do it too. Join our free webinar and get step by step to be an online assistant. Hello, and get your freedom of life.
In your brain or your wallet. At LegalZoom.com, you take care of business legal needs in just a few clicks. And if you need some hands-on help, their network of experienced attorneys from around the country has your back. Launch, run, and protect your business to make it official today at LegalZoom.com. And use promo code SHIFT to get 10% off any LegalZoom business formation product, excluding subscriptions and renewals. Offer expires 12/31/2024. Get everything you need from setup to success at LegalZoom.com and use promo code SHIFT. LegalZoom.com and use promo code SHIFT. LegalZoom provides access to independent attorneys and self-service tools. LegalZoom is not a law firm and does not provide legal advice, except where authorized through its subsidiary law firm, LZ Legal Services, LLC. Please be sure to use our code SHIFT. Okay, so I want to get into some of the other economic data that came out over the last couple of days, Thursday, Friday, starting with the most recent release, which was the consumer credit numbers that just came out, about 10 minutes, 15 minutes before I started this podcast. So we got the consumer credit numbers for October, and they were looking for an increase of 10 billion, which would have been a move up from the prior month, which was 6 billion. Well, they actually revised that down to 3.2 billion, but the October number shot up. We ended up with 19.2 billion in new credit on the month. That well above the upper end of the range, which was 13 billion. Low end was 9 billion. Again, why are consumers putting so much money on credit cards when credit card interest is at an all-time record high? It's about 25%. I mean, why on earth would anybody borrow money at 25%? I mean, that's like a loan shark, right, would charge you 25%. You got to be desperate to borrow money at 25%. And that's what's going on. This is desperation. People are borrowing money to buy food. That's when because if you can't afford to eat, well, shoot, I'm going to pay 25% because, I've got to eat, right? Now, I mean, yeah, maybe some people are buying iPhones and they want them so badly that they're willing to pay 25% interest to get it. But I mean, that is ridiculous because, you're going to pay for that iPhone many times over. If you make the minimum payment on a credit card when your interest rate is compounding at 25%, why can't you just save your money for a few years and then buy it? The price is going to go down because, of course, interest rates are still zero in the bank. So people don't want to do that. But I think it's a lot of desperate people. But also, I've mentioned this before. I believe that one of the reasons that people don't care about the interest is because they know they're not going to pay off their credit cards ever. They're just going to make the minimum payment until they can't make it anymore. And then they're going to default and just stop paying their credit card bills or just go bankrupt and have them wiped out. Because remember, this is all unsecured loan. So how's a credit card company, if you don't pay your credit card bill, is a credit card company going to come after you? No, they're not going to do anything. Now, they may deny you credit, although there's always going to be some new credit card company dumb enough to give you a credit card, even if you're in default on your other cards. That's been the problem with the system that we have right now. And of course, none of this would happen if we had an honest banking system without government backstops. But I think that people are racking up this credit card debt because they know it's a freebie. They are not going to pay it back, right? And so in for a dollar, in for a penny, in for a pound, right? That's what the feeling is. Because that's the only thing that would explain. There's no rational person is going to borrow money at 25% if they think they're going to pay it back with all that interest. So this just shows you how desperate people are, how weak this economy is, that credit is still growing, even though interest rates on credit cards are at an all-time record high. Now, we got the Challenger job cuts number yesterday, another decent-sized number for job cuts, almost 58,000 jobs eliminated in November, more than the 56,000 the prior month, yet somehow we managed to create all these jobs, even though 58,000 were reported eliminated by Challenger. The unemployment rate did inch up a bit, which jives with the number today. The weekly claims rose to 224,000. That was an increase of 9,000 unexpected. And the 4-week moving average now moving up as well. And the last piece of data I want to talk about is the trade deficit. Now, I already mentioned on the last podcast the merchandise trade deficit, which is the bigger number. The overall trade deficit includes surpluses where the U.S. enjoys a surplus. And again, a lot of that is financial services that we export. And I went over, Hollywood. We have a number of services that we're able to export that takes a bite out of, a small bite anyway, out of our merchandise trade deficit. But the trade deficit actually improved. It was $83.8 billion in the prior month. And that was a revision from 84.4. The consensus was 75.4 billion for October, and we got 73.8. So a little bit better. But the bad news is how we got there. And I talked about this on the other number, on the merchandise number. Imports and exports are both falling. And since we import a lot more than we export, if they both fall by the same percentage, it's going to shrink our trade deficit. And so trade is contracting, overall trade. We're importing less and we're exporting less. And of course, we're importing a lot less and exporting a lot less if you factor in prices, because prices are a lot higher today than they were 2 or 3 years ago. So volume of trade is coming down more so than just the nominal price, right? Because if you're just measuring the dollar value, if prices go up, then you're going to have bigger imports and bigger exports. But if you strip that out and just look at the volume of what's being imported and what's being exported, you can see it's contracting, and that shows a weak economy. Could be a weak U.S. economy, a weak global economy, but there's general economic weakness because there's less trade, right? If people are more prosperous, if economies are growing more, well, they trade more, right? If they're trading less, then it indicates economic weakness. So again, it's just more evidence that what Powell is saying about how miraculously strong the U.S. economy is just another lie. Now, I want to also talk about this plan by Scott Bessent, who is the president's pick, and he's a decent guy. I got nothing against Scott for Treasury Secretary. Oh, by the way, I forgot to mention that one of the catalysts for the spike above 100,000 on Bitcoin was the fact that the replacement for Gary Gensler, who was very anti-crypto and Bitcoin, and I was not a fan of Gary Gensler, apart from his crypto. He was a bad SEC. First of all, that's one of the things that the Department of Government Efficiency should recommend. Let's eliminate the entire SEC. We shouldn't have the SEC. We shouldn't have FINRA, right? So we don't need them. Get rid of them. But the guy that Trump is nominating to replace him is this guy, Paul Atkins, who is supposedly crypto friendly. And I did a little research on him. And yes, I mean, he has made some remarks that are pro the crypto industry as far as, kind of allowing it to grow and blossom and this and that. I didn't find anything where he was really yeah, Bitcoin is great. It's digital gold. It's, the greatest invention since the wheel. I own Bitcoin. I haven't seen him, speak like that about it. But clearly, the Bitcoin community is happy with this guy, or they're using this guy as another way to hype up Bitcoin. So I forgot to mention that other appointment. But anyway, getting back to Bessent. So He's got this plan that he calls the 333 plan. Now, first of all, it reminds me of two other plans. The first one that came to my mind when I hear 333 is 999. And that was the late Herman Cain, who ran for president. I met him on several occasions. In fact, I had him on my radio program when I did the daily radio program. One of the week of the Republican National Convention, I did my radio show. This is 2012 convention. I did my radio show from Radio Row at the convention, and so one of my guests was Herman Cain, and I liked the guy. Unfortunately, he died of COVID, I believe, during the COVID days. But he had his 999 plan. So 333, 999. But it also reminds me of Shinzo Abe's plan in Japan, the 3-arrow plan, right? He had a 3-pronged plan, and that didn't work very well. Abenomics, I think, was a complete failure. And so I don't know why you'd want to rebrand the 3 arrows plan as the 333 plan. But, again, this is causing some optimism for the dollar, right? It's weighing on gold that, okay, yeah, we've got this plan to tackle the deficit. The plan isn't going to work. The arrows aren't even going to come close to the target. So what is the 333 plan? So number one, the first three of the 333 plan is 3% real economic growth. And, that would mean real growth minus inflation. So, assuming inflation is, 2.5%, 3%, which is not going to be that low, but assuming it was 2.5%, you'd need 5.5% nominal growth to get 3% real growth. I don't think we're going to get 3% growth. I mean, barring some kind of productivity miracle from AI, which I don't necessarily see happening. I do see some modest boost to productivity over the next few years, but I think the bigger boosts will probably come later. But with all the debt that we're dragging, with this economy, the national debt will be $37 trillion approximately when Trump takes the reins, right? I don't want to say he necessarily inherited the debt because he was responsible for running up a good chunk of it, right? Because he was president for 4 years. I mean, he inherited the debt in 2016 and then ran it up. And so now the baton is being passed back to him, and he gave it to Obama, and now Obama is giving it back to him, right? So it's going to be about 37 trillion. Right now it's 36.2 trillion. I mean, it was just a couple of weeks ago on my podcast that I pointed out that it hit 36 trillion, and now it's 36.2 trillion, right? We're adding, I mean, officially the deficits are 2.2 trillion a year right now, but it seems like it's a lot more than that. I mean, we seem to be racking up $1 trillion pretty quick. So it may be closer to 3 trillion a year than 2 trillion. But say maybe 2.5 trillion, whatever it is. But it's a huge debt, and the interest burden continues to rise. And even if the Fed cuts rates in December by 25 basis points, which it will do, and even if we get a couple more cuts, you're still talking about over 4% rates, and that's a big number for all this maturing debt that was taken out at 25 bips, 50 bips, and now has to be rolled over. So with that huge debt burden that we're dragging, I don't see that we have an average of 3% economic growth. Plus, we're going to have a recession, during the Trump term, if not early in the Trump term. And so you're going to have growth of much higher than 3% to average up the recession, right? Which we're not going to get. So I don't think we're going to achieve the 3% growth. That is one of the three pillars of this 333 plan. The second three is
DuPoint itu, mengapa saya sangat nyaman di DuPoint? karena sangat mendukung dengan ya itu tadi seperti program-programnya. Yang pertama Market Watch setiap hari loh, bahkan sore pun juga ada jam 9.30. Analisa dari DuPoint sungguh membantu saya dalam entry point. Di samping itu program-program benefit lainnya apa sih? Kita dikasih bonus buat reward, namanya trade and reward emas seperti itu. Jadi di sore hari kadang untuk berita-berita high impact itu difasilitasi juga, biasanya pukul 4 sore. Jadi kita bisa meminimalisasi risiko dan mencari peluang di DuPoint ini. Sangat memanjakan customer satisfaction-nya itu enak banget.
Ya, Pak, ya.
Dan cara WD-nya pun juga cepat maupun deposit.
%30 off for life. So even when we add more features like long form videos, tons of more templates, and much, much more, you can keep that discount for life. So if you want to join vid.ai, which allows you to generate incredible quality shorts instantly using the power of artificial intelligence, actual good quality content that can actually get views on social media, then click anywhere on this ad and join vid.ai at this huge discount. Now, if you'd like to see exactly what vid.ai can do, I'm going to play through that right now. This YouTube channel gets 33 million views per month, posting simple AI-generated YouTube shorts, and they only have 11 shorts on their entire channel. What if I could show you a way to generate hundreds of these shorts in just a few minutes? Well, it's actually possible by using our software, vid.ai. As you can see, the most popular video on this channel is Black Panther versus white animals. What we can do is go into vid.ai, click Create New, then enter in a prompt such as Black Panther versus Snow Leopard. My name is Matt Parr from the Make Money Matt channel. Hope to see you inside vid.ai, and I'll see you there.
Is reducing the budget deficits to 3% of GDP. Now, 3% of GDP, that's supposed to be the deficits in the European Union, right? When these guys all created the European Union, they all agreed that they were going to keep their deficits at 3% of GDP, and they've all failed, right? Nobody is doing it. Nobody is following the rules, which is something I warned was going to happen from the day they conceived it, right? I said, this is crazy. They're not going to do it because there's a huge moral hazard that every country is going to run a big deficit because there is no real method for punishing them, and they're afraid to punish them. So you're a sucker if you don't run up a bigger debt because you're pushing off the cost of financing it on all the other nations. So it was a horrible plan, and it's backfiring exactly the way I predicted it would. But if Scott Bessett's plan is to have the debt the budget deficit is 3% of GDP. It's 7.5% now and growing. So in order to get the budget deficit to be 3% of GDP, you're going to have to cut over $1 trillion per year in government spending. $1 trillion. Now, again, Social Security, Medicare, Obamacare, defense, all the big ticket items are, off the table. What's on the table? There's no way to get anywhere near $1 trillion of cuts. But in order to actually reduce spending by $1 trillion, you need a lot more than $1 trillion in cuts, because every year there's automatic increases in the budget, entitlement, stuff like that, that's built in. Well, if you want to have a reduction of $1 trillion, you got to cut $1.5 trillion. You got to get rid of the increase before you can even start working on the decrease. So I don't think there's any chance that over the next 4 years, with interest rates rising, because that's an automatic, because remember, your net interest expense goes up no matter what, because we're not getting rates back down to zero. So, just offsetting that, just finding enough cuts to offset the increasing debt burden. And again, remember, I pointed this out on Wednesday's podcast when Powell was asked if he considers the impact that rising interest rates have on the federal budget. And he said, no, he doesn't even think about it. I mean, either he's lying or he's incompetent. How can he not think about it? That's got to be the most important thing on his mind. Every time the Fed hikes rates, it increases the deficit. And when they cut rates, in theory, they could reduce the deficit. But how can he not think about it? And again, he's like, well, I'm not worried about it because it's not at the point where it's a problem. I wish Andy Ross Sorkin could have said, okay, when do you worry about it? At what point does it get big enough that it's a problem? Because the reality is we don't know when it's a problem. It's a problem when your creditors no longer want to loan you money. And yes, today that's not happening. We're still borrowing money pretty cheap, despite the fact that we have a $1.1 trillion interest payment that will be $2 trillion a year from now and keep going up. But if you wait for it to become a crisis, which is apparently what Powell plans on doing, because he's saying, well, we're not there yet. It's not a problem yet. So you want to wait till we get there? Because when we get there, it's a crisis. And the fact that we will eventually get there because we're on that path means it's a problem right now, right? It's just like you jump off the top of the Empire State Building. You can't say, well, so far so good. I'm on the 50th floor and, I don't have any problems. Yeah, but you're going to eventually hit the pavement. That's a foregone conclusion. Once you jump, it doesn't matter how you're doing on the 50th floor or the 30th floor or the 20th floor. It's when you hit the ground floor, that's it. You're finished. But the minute you jumped, you sealed your fate. Well, we're in a similar situation with the debt to say, we're not worried about it because we're not at the breaking point yet, but we're on a path that's going to get us to the breaking point. You worry about it before you hit that breaking point. Otherwise, it's too late. Otherwise, it's a full-blown crisis. So I wish Sorkin would have followed up and said, well, when do you worry? At what point? But obviously they're worried now. It's just another, lie that central bankers tell because they know the public can't handle the truth. So they give us lies. But anyway, so there's no way they're going to get the budget deficits anywhere near 3% of GDP unless they make big cuts to entitlements. Now, is it possible that Donald Trump can come out and say, I know I promised not to cut Social Security. I know I promised, in fact, to eliminate the taxes on Social Security. But, we've taken a good hard look at it. I've talked to my buddy Elon Musk. And you know what? We just can't afford it. In fact, we got to cut Social Security benefits, unfortunately. So yeah, it's possible that Trump will actually lead some real reforms. And, maybe we could try to get rid of Obamacare. Even though he promised to keep it, he said, well, I'm going to replace it with something better. There is nothing better to replace it with except freedom. You got to get rid of it. The something better is free market capitalism. That's what we needed in healthcare. That's what we need in education. When Donald Trump talked about eliminating the Department of Education, he said, and we're going to give the money to the states. No, eliminate the Department of Education and apply the money to reducing the debt. Don't just give the money to the states, but he's afraid to say, I want to take money away from education. Look, I posted this today on X. Go look at the Constitution. Look at the Bill of Rights. Look at the Declaration of Independence. There are certain words that do not appear there once, like education, schools, colleges, teachers. None of that is there. Now, they had schools back in 1789 and 1776. I mean, our kids got educated. Now, they didn't stay in school, until they were an old man like they do today. They weren't in school into their 20s and 30s, right? Most kids, they had 5 or 6, the 5th or 6th grade, and that was it, right? But we had schools. The government, the federal government, had nothing to do with it. You would think that education was some kind of right. No, there is no, we have freedom of speech, press, assembly. There's nothing in there that says we all have the right to an education. We have a right to free speech, right? We don't have a right to be educated. And the government clearly has no role because the federal government can only do what the Constitution authorizes it to do. Remember, the states can do whatever the Constitution doesn't prohibit them from doing. But the government can only do what specifically it is empowered to do. Well, if the word education isn't in the Constitution, then what does that tell you? That tells you that the framers of the Constitution did not see a role for the government in education. Right? And so they should get out. And so we should eliminate it. But again, even Ronald Reagan couldn't get rid of the Department of Education, and he was far more committed to it than Trump. So we're not going to make the cuts. I mean, it's possible, but again, even if Trump decides he wants to do it, he's got to convince all the Republicans to get on board, because none of the Democrats will. I mean, they will die on that hill, right? That'll be their campaign issue in the midterms, right? All the things that the president wanted to take away, right? And that's why a lot of Republicans will defect, because they don't want to lose their seat. The House members in particular, because they're all up for reelection, and those seats are more in jeopardy than the Senate, and of course, the senators have longer terms. So I don't think it's going to happen. So third arrow is going to miss target. And what about the third one? The third one is 3 million barrels of oil extra per day produced in the United States. Now, America is already the world's biggest oil producer, and we're producing a record amount. This year is going to set a record. I think it's just over 12 million barrels a day that we're producing. And so Scott Besson says, okay, we're going to produce, 3 million barrels more. Well, first of all, that's totally beyond his control as Secretary of the Treasury. It's beyond Trump's control. I mean, they could try to create some additional incentives for the private sector to go out and drill more oil, but they could just, it's kind of like something that they hope might happen. They really can't bring it about. But I think it's very unlikely that we're going to be able to that quickly ramp up production from record levels by another 2 billion, especially if oil prices are where they are or go lower. I mean, people are talking about, well, we're going to ramp up production and oil is going to go to $40 a barrel. I heard somebody say this. At $40 a barrel, production is going to collapse because the oil companies aren't going to produce oil if they can only get $40 a barrel for it. I mean, part of the key to getting more production is higher prices, because that extra production generally is more expensive than what they're producing now. So to get those marginal barrels out of the ground, they need a higher price. And in fact, Chevron came out today and announced that they're going to be cutting CapEx next year by about $5 billion in oil and gas. What does that tell you? I mean, if a major oil company, our biggest oil company, is going to invest less, how are we going to produce more oil investing less, unless everything completely flips around in the Trump administration? So I think it's highly unlikely that we get the extra 3 million barrels a day. And even if we eventually get there, it's going to take time. It's not like it's going to happen right away. In the meantime, the debt's going up, right? Because everybody wants to pretend that we can grow our way out of the debt problem. We can't. They've been talking about growing our way out of the debt problem since we had a debt. And the problem keeps getting bigger and bigger and bigger. And the bigger the debt gets, the harder it is to grow your way out of it, because the debt is so big now, there's no way the economy can grow as fast as the debt. And the interest expense is so big. And remember, all that interest payment has to be borrowed too and added on top of the debt, so that the following year, you got to pay interest on that. So if we have a $3 trillion deficit this year, that's another $3 trillion added to the debt. And if we have $1 trillion in interest, right, on that debt, and we don't have the $1 trillion, we have to borrow that too. Well, now the money we borrowed to pay the interest is now part of the principal. And now we got to borrow more money to pay interest on that interest. And it continues to go, right? Just like the Americans are stuck with 25% credit card debt, right? This is a spiral. And eventually, foreigners are going to realize that we ain't good for this money, and it's all going to be inflation. And yes, there's a jump in optimism for Trump, but there was a similar jump in optimism when he was elected the first time. And the problems got worse, not better, despite the fact that Trump says it was the greatest economy in the history of the world. It wasn't. The problems he inherited got worse, not better. He didn't make America great again. Our trade deficits went up. Our budget deficit's up. He just succeeded in blowing more air into the bubble. That's it. And if he hopes to repeat that, well, it's a much bigger bubble now. The economy is in far worse shape in 2025, or will be, than it was in 2016. So it's going to be much more difficult for him to repeat that. And I think, once again, the people who are optimistic are going to be disappointed, just like they were before. Look, I would hope that we could do all the right things. But I know that doing the right things means breaking a lot of promises, and it means some short-term pain, a lot of it actually for certain people, to get the long-term gain. I would love that to happen. I would love to be a part of it. Unfortunately, that's not the way I see things playing out. Anyway, that's it for today. On that note, have a great weekend, everybody. Don't forget, if you like the podcast, let me know. Leave a comment, like it, thumbs up. And again, don't forget, more and more of you, I've noticed, have been signing up for Shift Sovereign. In fact, we have some of our members now down in El Salvador. I guess they're having a good time with Bitcoin at 100,000. We have a special trip to El Salvador that Total Access members are on now, and so that's something else that you can look into once you start subscribing to Shift Sovereign. You can look into becoming a Total Access member. Bye for now.
Get your own Pump Fund clone, fully customized with your branding and features. Launch your meme coin platform on popular blockchains like Base and Solana, with different wallet connections to profile creations for the users, to execute trades, to charts, to holders distribution, to migrating to Uniswap upon bonding curve completion. We have covered everything for you. With complete flexibility, you can set custom fees for each token creation, manage bonding curve limits, and define trading fees for your platform. Monetize your platform through multiple revenue streams, including token creation fee, token trading fee, and ads on different pages. Reward your platform users using a customized leaderboard to engage your community. Track performance with a comprehensive dashboard that gives you insight to make informed decisions. Plus, set up trending channels and bots to add value for your platform users by providing real-time alerts on the latest token activities. Take control and build the meme coin launchpad you've always envisioned.
Bringing you stories of capitalism. This week, why families from Las Vegas to Vancouver can't afford to buy a house and what can be done about it. Plus, if you can buy the house, why you may not be able to afford to insure it, particularly if you live in Florida or in California. And U.S. ports are consistently ranked among the least efficient in the world. What sort of investment would it take to fix that? But we start with the story about that trade balance President-elect Trump focuses on so intently. On Thursday, we got the numbers which once again showed the U.S. in the red. But what does that tell us about the economy? And is restoring the balance, as Mr. Trump insists, really so important? Here's Bloomberg International Economics and Policy correspondent Michael McKee.
There is a story about a college professor who told his economics students anyone who used the term bilateral trade balance would automatically fail. That's because international trade is a system, not a series of summable individual country-by-country relationships. A country's trade balance is the difference between what it consumes and what it produces. In the U.S., we consume more than we make. Aggregate demand is greater than aggregate supply. So we end up importing the difference to satisfy that demand, and we have a trade deficit. China, on the other hand, produces more than it consumes. It sells its excess to us and the rest of the world.
Our
vision is to build a smart city that changes how people think about urban living. We always think to push the boundaries, how we can shape our future.
It has a trade surplus. To Donald Trump, the answer is to slap tariffs on Chinese-made goods. But that won't solve the problem, because we are the problem. As long as we demand more than we produce, the trade balance won't change. We will just buy more stuff from countries other than China. If China isn't the lowest cost supplier, someone else will be. Why won't we make more stuff here? We likely will, just not enough. Meanwhile, our other economic policies are working to worsen the trade deficit. The U.S. has a large and growing budget deficit, which we fund by selling debt. As the deficit rises, interest rates have to rise to attract buyers. That strengthens the dollar, which makes American exports more expensive and harder to sell. It makes imports cheaper. Tax cuts, meanwhile, give people more money to spend, increasing demand for those imports. We increase demand without increasing supply, and the trade deficit gets worse. Not even Donald Trump is above the law of supply and demand.
So why does the difference between exports and imports matter to a country that hasn't had a goods trade surplus since 1975? We asked Mary Lovely of the Peterson Institute.
We shouldn't care about the trade balance. The trade balance is an accounting number, and sometimes a country has a trade surplus, sometimes it has a trade deficit. What it means is it reflects how much you are spending relative to how much you're earning. And just like in your own private life, there are times when you should spend more than you earn. For example, the country of Norway discovered North Sea oil, and it did not want to depress the consumption of the current generation, the people alive at that time, to build up the investment necessary to exploit that new resource. And so they ran trade deficits as they borrowed from the rest of the world to begin to drill and to get this precious resource, from under the ocean. And lo and behold, now they run trade surpluses. So they invested the money wisely in an asset that played off for years to come. So the answer to is the trade deficit bad or good is really, why do you have one?
We like to buy. We're big consumers. We have the most open market. We have low tariffs, and it's actually been a benefit.
Fred Hochberg was president of the Export-Import Bank under President Obama and author of Trade is Not a Four-Letter Word. Like Mary Lovely, he questions all the emphasis on the balance of trade.
Yes, there are obviously some shortfalls, but we have the greatest array of products. You go to a supermarket, there are over 30,000 different products. So that's been a great benefit to our economy.
Even if it were important to address the trade balance, Lovely is not at all sure that the 60% tariffs on Chinese imports and 25% on imports from Mexico and Canada are the way to go.
There's a misunderstanding of thinking that tariffs, because they'll lower our imports, will change our trade deficit. So if President Trump goes ahead and put on tariffs, we would expect that the US dollar will strengthen. That will make our exports less attractive to foreign customers, to buyers abroad who have to pay more for them. And so both imports and exports can shrink, and the balance could very well be unaffected. So it may have zero effect on the trade deficit. It could even increase the trade deficit. That is, if we don't handle the underlying drivers, which have to do with domestic saving and investment.
When the president-elect talks about the problem of the U.S. trade deficit, he consistently focuses on goods, not services, when much of U.S. strength is in the latter category. Hochberg says that means the trade balance numbers may be distorted.
We're the second largest exporter in the entire world. We're second only to China. And one of the things we excel in is service exports, whether it's media, like Bloomberg Media, financial services, insurance, travel. Those are much harder to calculate and capture. So my hunch is our exports are somewhat understated as a result.
Beyond their effects on the trade balance, there's another aspect to tariffs that have attracted President-elect Trump, the prospect of raising revenue.
Why did we turn away from tariffs? The historical record shows us what folks were talking about 100 years ago. What they were talking about is that it was a tax on consumption, and it left earnings that were saved untaxed. So what you had was lower income people who save relatively small percentage or even zero of their income, really facing taxes on everything that they buy. Whereas rich people were only taxed on the small share of their income that they actually use to buy things.
Donald Trump is far from alone in thinking that the sort of across-the-board free trade approach taken in the past has done real damage to certain industries and workers in some parts of the country. The question is whether tariffs are the best way to address the issue, or whether a more selective approach is called for.
We have something called trade adjustment assistance. It's never been really fully funded to sort of support workers whose jobs have been compromised or lost due to trade to make sure that they can find other jobs and seek other employment. That needs to be far more robust than it's ever been.
To say that we may be misled by focusing too much on the trade deficit, or that imposing tariffs may not get us where we want to go, is not to say that the new President Trump's trade policies could not help the U.S. accomplish things it needs to get done.
Well, I think what he likes to do is one-on-one negotiations. He doesn't want to, like the Trans-Pacific Partnership, and there's a talk he might want to do some other one-on-one trade deals that would include higher tariffs that they would impose on China to sort of stop the Chinese overproduction. And China is overproducing and exporting a lot of their goods because they want to keep people employed. That hurts other countries that are trying to increase their businesses, their manufacturing, or their agriculture.
In the end, maybe the most important point about the U.S. trade deficit is that it can distract us from its underlying cause and a much bigger problem: how much the U.S. is borrowing from the rest of the world.
A trade surplus is the excess of your saving over investment. So that can change when your saving rate changes or when your investment rate changes. The U.S. has had very healthy investment, and that's good. Our saving, though, has gone down. So we have a relatively low savings rate comparing across countries. And part of that is due to low private savings, but also low government savings. So here we get back to the large federal budget deficit, and evaluating whether you think that deficit is something that should be made smaller.
You know, what drives our economy? It's consumer spending, business investment, government spending, and a deficit, whether it's exports or our budget deficit. So that it's only one of four components. We need to up our exports. We probably need to have our budget in better alignment because we are spending a lot more than we're taking in. It's one of the things Scott Bessent, the incoming Treasury nominee, says he wants to work on. So we have to look at it in the totality. But it's easy to focus on the trade deficit because it's like foreign, and we don't have to talk about raising taxes.
Coming up, the U.S. is way behind in the efficiency of its ports. Does it matter? And what can be done about it? That's next on Wall Street Week.
We want to build the future of marine services, autonomous ships. Jumpstart really pushed it over the edge for us. When you're going to a different region, you need to have the right partner.
This is a story about American exceptionalism, but not necessarily the good kind.
The World Bank comes out with this list of the top 400 or 500. The USA ports are not hardly ever in the top 100.
That's Mario Cardera, CEO of the Port of Long Beach in California, America's second busiest port. It ranks number 9 in the world in level of activity, but number 373 in the list he refers to, the World Bank's annual Container Port Performance Index, which measures efficiency based on how long a ship stays in port. That index for 2023 ranked Yangshan, China, Salalah, Oman, and Cartagena, Colombia first, second, and third. The only U.S. ports that made the top 100 were Philadelphia at 55 and New York, New Jersey at number 92. Of the bottom 50 ports listed, 6 of them are in the U.S., making America's shipping infrastructure exceptional in the length of its delays. Turlock Mooney is the global head of port intelligence and analytics at S&P Global, which partnered with the World Bank to create the efficiency ranking.
Ports are critical to fluid supply chains. Efficient ports are extremely necessary to keep goods flowing smoothly. Efficient ports are actually catalysts for development. They attract investment, they attract logistics infrastructure, and they ultimately help to drive growth. Conversely, inefficient ports can have the opposite effect.
Time, as they say, is money. And when it comes to United States imports, it can be a lot of money, given the importance of consumers, which makes ports like Long Beach an indicator of the strength of the economy overall.
You have a great economy, and the American consumer is spending. In terms of Port of Long Beach, our numbers lately have been historic. So we're approximating now, after 9 months, we're up in terms of TE volume. We're up about 19% over and above last year's number.
To handle all that volume, ports like Cordero's Long Beach have been changing the way they do business, trying to make sure that they're as efficient as they can be, improving that low ranking in the World Bank Index. And some of that requires automation.
The research right now points to the fact that automation clearly is a cost reduction policy. For the Port of Long Beach, we're interested in productivity. As a global community, we've entered the fourth industrial revolution, so to speak. And that is the coming of robotics, automation. If you go back to a report that McKinsey issued back in 2017, they predicted that by 2030, we would lose 2/3 of American jobs as we know. For every robot that you put in place, there's 6 jobs that are eliminated. So I think for the Port of Long Beach, how we navigate that issue, as a public port, we have to consider all factors. And I think what we've been successful at, and when we do talk about automation, or in the case of Long Beach Container Terminal, semi-automation, we have that discussion as a stakeholder group, a collaborative effort.
Automation at seaports is not an all or nothing proposition. Loading and offloading ships and moving cargo from one form of transportation to another involves many complex steps, some of which are more readily automated than others, and some of which don't lend themselves to automation at all, given current technology.
The main benefit of automation, and the reason that it is the future, and the reason that you see the most efficient ports in the world automating operations more and more, is that it sits very well with digitization. So it's an important part of the technical foundation for interoperable data, sharing of data between different stakeholders, sharing of good quality data, so that action can be taken where necessary to drive efficiency and improve efficiency of port operations.
Automation is far from the only way that ports like Long Beach are seeking to improve efficiency. Indeed, it may not even be the best way. A better approach may be to get more productivity from the system the way it's now configured, particularly by extending the hours the port operates.
One of the things that I was very vocal about is how we move to 24/7 operations. Now, we're not working 24 hours a day, 7 days a week anytime soon. Imagine if you told the American consumer you can only fly during the week and the airports were closed on weekends, or you can only fly between the hours of 8 a.m. and 6 p.m. I mean, imagine what the airport bottleneck would be like. So I think the same emphasis needs to be put in terms of how we move cargo.
Nippon Elastex 3-in-1 dengan teknologi Hydroflex, perlindungan lebih maksimal, gampang meresap ke pori-pori tembok, daya sebarnya luas. Pasti beres pakai Nippon Elastex.
Another route to improved efficiency is rail. One train can carry 750 trucks worth of cargo. And earlier this year, Long Beach broke ground on a $1.5 billion expansion of its rail yard that will triple the amount of cargo it can handle annually. John Gabriel is Group President for Consumer Products at BNSF, one of the two railroads servicing Long Beach.
October of 2024 was the biggest single month moving intermodal that we've had as BNSF Railway. Tying that back to the ports, this year it's on a record pace for the most ship-to-train movements that we've done. It's the fastest we've ever gotten to 1 million containers loaded onto trains and departed out of the ports of LA and Long Beach. And I would certainly say that's a testament to, the investments we've made. Again, we've invested in tracks, facilities, more than $2.5 billion over the last 5 years. I think it's a testament to the collaboration we have with the ports of LA and Long Beach and the investments they've made. That's so important right now. Right now, we're handling more volume than we were post-supply chain crisis, where we saw the huge uptick in consumer demand, post-pandemic. And we're doing it about 50% faster from ship to train. And ultimately, the ship to end destination across our intermodal network is about 75% faster than it was from a transit perspective back in 2022. And, really, I would say the entire supply chain and all stakeholders have really stepped up. And it's really been a great demonstration of, capacity and supply chain resiliency for all the goods moving through the West Coast.
Containers in Rotterdam are only 33% of the total cargo throughput. The major cargo, nearly 50%, is liquid bulk.
Half a world away, Hanna Stelzel is working on maximizing efficiency in Rotterdam, where she's the director of containers. It's the world's 10th busiest port and ranks 91st in the World Bank's efficiency index. As with Long Beach, Rotterdam is facing increasing demand.
We're expanding our container capacity. We do know from research that the container business in Europe will be growing. Actually, it will be growing all over the world. That has to do with containerization, that has to do with a growing middle class. And in order to prepare for the growth and to participate in that growth, we had decided to invest into our infrastructure.
Rotterdam is a leading port in a new system called Gemini, involving shipping companies Hapag-Lloyd and Maersk.
The trends that we see is that transshipment volumes are growing. That has to do, for example, with the fact that we have hub and spoke concepts that are being introduced. Maersk, together with Hapag-Lloyd, introduced the Gemini concept.
The Gemini project features a series of hub ports around the world that handle the bulk of the cargo. Containers are then immediately loaded onto smaller ships destined for spoke ports dotted all over the world. Central to the project in Rotterdam is APM, which bills itself as the most advanced, most fully automated terminal in the world. Its CEO is Harold Kunst.
The Gemini approach is different than the traditional shipping line approach we took for many decades. With the hub structure integrated into the network of the 5 hubs in the east-west approach from the trade, is that we are able to enable the ships to be 9 days earlier from Far East into Europe.
Ports like Rotterdam in Europe and Long Beach in California are seeing greater demand than ever for cargo handling and are investing and innovating to keep up with what's coming their way. So why is it that they still lag so far behind their counterparts in Asia, in the Middle East, and even in Latin America? Why is it that it takes 2 or 3 times as long to move a container at a U.S. port than it does in China? It turns out that there are several reasons. First and most basic is that 24/7 schedule that Cordero is pushing for at Long Beach, but that hasn't yet been accomplished.
After 9 months in the year 2024, because of expanded hours of operation, which commenced with the 24/7 conversation. Again, are we 24/7 today? No. Have we taken incremental steps to expand operation hours? Yes. That's a big reason why we don't have congestion and bottlenecks at the Port of Long Beach, because our terminals have been able to work with us in making sure that we use night gates, we use early morning gates, we use weekend hours in times that we have historic volume, which is what we have done. So I think, again, we'll get there.
Even if Long Beach were up and running all the time, it would be very difficult for it to approach the efficiency level of some major ports because of where it fits in the supply chain. Goods coming into Singapore or Oman, for example, are transferred from one ship to another. rather than being moved overland by train or truck for distribution in the United States.
We're not a transshipment port. I mean, some of the larger ports that you look at, for example, Singapore, they are a transshipment port. They always have been and they always will.
We want to build the future of marine services, autonomous ships. Jumpstart really pushed it over the edge for us. When you're going to a different region, you need to have the right partner.
And finally, there is the question of automation, something that others make more use of than the US. But as much as automation promises to be an answer to so many prayers for greater efficiency, first, it comes with a price, quite literally, in the investment it requires, with the associated questions of where the capital will come from and whether it will earn the return on investment normally required.
There's about 1,200 legitimate container terminals throughout the world. Only about 4% are automated. So the challenge with any type of transformation of technology is a costly endeavor. So from a private sector perspective, what's the return on investment? I think that question is probably going to be more challenging moving forward, because obviously none of this happens unless there's private sector investment.
In the United States, it's not just a question of the capital investment and return. Automation also has potentially substantial effects on employment, which led 47,000 members of the Longshoremen's Union to go on a 3-day strike in U.S. ports on the eastern seaboard and Gulf Coast in October, something Cordero on the West Coast is very aware of.
For a port like Long Beach, who are public ports, we need to take into account the social impacts that has. I think that at the Port of Long Beach, we're proud about the footprint that we have in terms of job production. 535,000 at the local level. At the state level, 704,000 plus jobs directly and indirectly as a result of Port of Long Beach. And at a national level, the number is like 2.6 million. So we're talking earlier about the great economy that we have, our dependency of our GDP based on consumer spending. Robots don't spend money. Consumers do. So that's the conversation that I haven't really heard amplified, because for us, it's very important to keep labor in place. Because hypothetically, you eliminate labor, what are you doing to the economy and spending in terms of consumer spending?
And that story will be an important part of the larger story of American exceptionalism and whether the U.S. can remain the dominant economic force in an increasingly competitive world. Coming up, Romain Bostic will bring us the story of home ownership and why it's out of reach for so many in the U.S. and in Canada. That's next on Wall Street Week.
This is a story about unattainable goals, how something that was once commonplace became so hard to reach, and what we can do about it.
We're just looking for ideally it would be a bedroom for each kid.
Yes.
And
yes.
that's it, and a second bathroom, and a dishwasher or a washer dryer on a little outdoor space.
Yeah, functionality.
We're not looking
and
for
it
the world.
Seems to be hard to find.
Vancouver residents Gail and Kevin Arnone are looking to purchase a new home, a challenge that 49% of Canadians will face in the next 5 years.
We live near Vancouver General Hospital, and we live in a 2-bedroom, 1-bath, walk-up apartment with 3 kids.
It's kind of a tight fit, and I've got 3 kids now. So
yeah.
3 growing kids. And I feel like I'm kind of running out of time in that place.
Vancouver faces one of the most extreme housing affordability crises in North America. The average price for a single-family home, just under $2 million. 10 years ago, those same homes were $900,000 less.
The biggest thing that we need to acknowledge is that home prices have really run away from incomes. In the past, we had 50% of households that could afford the median price new home. Today, it's down to just 30%. The housing affordability crisis, though, really started in the Great Financial Crisis. So we know that builders were building so many homes going into the mid-2000s, and then the music stopped. There were a lot of homes that were available, and a lot of builders ultimately went out of business. This caused a lot of risk aversion in the market.
Ali Wolf of Zonda also says prices are being driven higher by opposition to real estate development in one's own neighborhood. It's a phenomenon that's become so prevalent, it has its own nickname, Not in My Backyard, or NIMBY.
When we look at individuals that live in a neighborhood, people that have lived there, they've established roots, their kids go to school there, they're happy with their quality of life. Then you have a developer that comes in, and the developer says, hey, we want to increase housing supply. You have people that live in that neighborhood that say, I don't want that in my neighborhood. That could impact my home value. So what happens is these NIMBYs get together and they list off all of these reasons to the city council why there should not be more homes built. Congestion, overcrowded school, impact to home values. And they're trying to convince the city council to either deny the new project, don't allow more home building, or lower the density of the community. If you think about how we solve housing affordability, the fastest way you can solve housing affordability is by building more homes.
We're always told, oh, supply, demand, build more supply, it'll bring down costs. That's a fallacy that is being perpetuated by those that stand to profit.
We've got another 2 billion people projected to join us on the planet over the next 30 years. We haven't worked out how to house those people yet. Tackle a problem and find the solution.
Colleen Hardwick is a former Vancouver councilwoman who has been grappling with the city's housing issues for more than a decade. She says rezoning for higher density is the problem, not the solution.
Every time you rezone a piece of property, you inflate its value by definition. And when you do that hundreds and thousands of times over, a rising tide lifts all boats. So the city adopted a business model which is basically selling zoning to generate revenue, and in doing so have exacerbated the affordability problem.
The conflicts between those who want to slow housing development and those who think it's the best answer represent just one piece of the puzzle. A report by TD Bank found 30% of all the residences bought in Canada were snatched up by investors rather than people seeking to call those places home. In the US, that number is 14.8%.
Investors are much more active in the entry-level market versus the overall market. What is happening now is some investors are looking at the market and they're saying, okay, there's one home here, but the lot could support 3 or 4 or 6 homes. They can tear down that home, build additional homes, increase the housing supply, and still make money doing so.
I think that the provincial government, along with the local government here in Vancouver, are listening to the wrong voices. They're not listening to the people that live here. And what I'm seeing is increased pressure to promote growth rather than to balance growth. And that's really at the heart of the problem.
On our way to see newly constructed apartment buildings in the area, we ran into a resident who is adamantly against high-density developments in her low-density neighborhood.
How long have you been living in this area?
35 years.
What do you think these buildings, when they are completed and maybe some of the additional developments, what is that going to do to the complexion of the neighborhood?
It's totally affecting it because then some people are selling because of that. And I understand they're trying to allow all neighborhoods to have higher density. But is this the formula? Is this the right place? Are there services? This is going to be, I think, 7,000 condos when it's all done. Do we have all the services, the sewage, the schools, everything that's needed? We don't. And it's going to create a huge traffic. I'm sorry, yeah, I hate it.
The housing market has been a point of contention for buyers not only in Vancouver, but throughout North America. We made a stop in Las Vegas, Nevada, a city grasping for solutions to its own housing crisis. Commissioner Justin Jones is helping to sponsor a state-led project in Clark County, aiming to build affordable single-family homes, a solution he and his allies hope will combat the crisis.
There's been a tremendous interest in Southern Nevada. You have people moving from the northwest part of the country to come to a sunnier area, to come to a place where a lot of people saw a lot of promise. And then you also have people flocking from California because of the cost of living there. And then we also have a land availability issue.
The land behind me, it may not look like much. Gravel, tumbleweeds, about 20 acres of it. It's a far cry from the glitz and glamour that you'll find on the Las Vegas Strip, which is really just about a 15 to 20 minute drive from where we are right now. But this is going to be the cornerstone of a huge affordable housing push in Clark County, Nevada.
The project you're working on now kind of stems from a legislation passed back in 1998, which effectively allowed the Bureau of Land Management to start releasing some of these acres as they see fit, of course. The amount of acres that they originally promised, that all hasn't been released yet, has it?
No, and we didn't really have the ability or the resources to make it happen. But as a result of ARPA dollars and some other funding, we're able to really put the Community Land Trust into effect and really push forward with a historic agreement with HUD and BLM.
Once these are built, we're talking roughly 200 homes, is that correct?
Yep, 210 homes. These will be folks who are in 80% of adjusted median income. So that's between roughly $60,000 to $80,000 of income. And as you can imagine, those are going to be folks who really are teachers, firefighters, nurses, people that you would expect to see in those neighborhoods anyways, and really can benefit from this type of a program. There's a lot of work that needs to be done in identifying redevelopment areas.
What do both of these cities have in common? A disconnect between buyer demand and builder supply, exacerbated by a stalemate between homeowners and home seekers. Tom Shapiro is the founder of GTIS Partners, a global real estate investment firm.
One of the issues right now is how few existing homes are on the market. So last year there were 1 million existing homes on the market. This year there's 1.3 million. The normal market is 2.25 million. We haven't had this few existing homes on the market in 30 years when we had 80 million less people. So why is that? 75% of the population who own homes have mortgages under 5%. Today, a mortgage is close to 7%. So if you are, let's say, in Dallas and you have a $400,000 or $500,000 home, you have a $500,000 home and you want to trade up to a $600,000 home, you'd say that could cost 20% more. Well, no. It actually probably costs almost double because you're now trading out of your 4% mortgage for a 7% mortgage.
Where builders will have the most success is with the higher price points. Wealthier individuals are not as impacted and not as sensitive to what happens with home prices and interest rates. They have wealth that they can tap. The entry-level buyers or the more cost-conscious buyers are the ones that have pulled back from the market the most. But if you look at the overall size, the sheer size of those cost-conscious shoppers, it's huge. There are so many people that want to potentially buy a home, but they can't find what they can afford. So by builders building more high-density projects, they're trying to lower that average sales price. They're trying to meet the consumer demand. Unpacking how investors impact the housing market is quite complicated. Because if you look at the overall share of how many homes investors own, it's only in the single digits in terms of a percent of our overall housing stock. So while it's very easy to point blame at investors and saying that they're the reason that we don't have as many homes, the numbers, at least nationally, say that that's unfounded. But what's interesting about investors is they usually concentrate in certain price points. So they'll be purchasing more lower priced homes, and they'll be purchasing more lower priced homes in certain areas. So in parts of the Southeast, parts of the Southwest, parts of the Midwest, you could say that investors are at least partially to blame for the housing imbalance, for the housing supply crisis, for the housing affordability crisis. There are a lot of repercussions on the middle class with what has happened with housing affordability. If you look at wealth building, the best way to build wealth is through homeownership. Those that do not own homes today have not been able to see their wealth go up. In a lot of cases, they're putting more of their income towards rent. They're not able to save as much. So the housing affordability crisis is really causing this bigger gap between the haves and the have-nots in the US economy.
Back up in Canada, the Arnons will continue their house hunt until they find a home that fits their family, doing whatever it takes.
Part of the problem is we want to stay in Vancouver, and the prices in Vancouver have gone so through the roof that we have to go deeply into debt in order to do that.
We're really just asking for not much, really, just to move up to a little bit more.
I'm surprised it's gone this far.
No,
still, to this day.
I'm not.
Absolutely. Yeah.
No.
No, I mean, I at least expected someone to step in and make a difference about it. Whether it could be a politician or some active group that's working on it, but it hasn't happened. Nothing's been done. The government's let it go and go and go until it's to the point of a breaking point.
Coming up, from buying houses to insuring them, mapping risk from Florida and across the globe. That's next on Wall Street Week.
This is a story about risk, how much we are willing to pay to protect against the risk of losing something we value. It's a story that always begins when something goes very wrong.
This is where we designated the water levels for Helene.
Glenn Scarpa and his wife own Scarpa's Coastal Restaurant in Boca Grande, a small island town in Florida.
We cut everything around the whole restaurant at 2 feet, to get all the wet stuff and insulation out. 10, 12 days later, we got this one. And then we walked in here and said, oh.
December 1st marks the end of the Atlantic hurricane season, and it's been expensive and deadly. In Florida alone, 3 hurricanes made landfall in 2024, tying the highest years on record. And although the toll is still being added up, we now know the storms sweeping through the United States took more than 300 lives and cost over $190 billion across the country. That price tag makes it the 3rd costliest season in U.S. history. Scarpa, like millions of other Floridians, turns to insurance to help protect against losses from extreme weather. As the insured, he's the first step in a food chain of risk that starts with individuals or businesses, goes up to insurers, then to reinsurers, and ultimately can hit investors or even taxpayers. With each step, the risk is calculated, changed, repackaged, spread around. But one thing we know for certain, it never goes away. As risk increases in the United States and costs to insurers stack up, insurance premiums have also been on the rise. Are we at a historical high here in the cost of insuring a home?
I'd say yes. The average cost for Florida homeowners policy is about $6,000.
Jerry Theodorou is director of the Finance, Insurance, and Trade Policy Program at R Street Institute, a DC-based think tank that promotes free markets.
In the insurance world, in rate making and pricing, the rate follows the risk. The risk magnitude has increased. So because the risk has increased, the losses have increased, and insurers are playing catch up and raising prices. And there are some unique factors for Florida which differentiate it from.
In our lifetimes, we cover the distance from Earth to the Moon. It takes a global network to harness the Moon's possibilities and build the lunar economy.
The rest of the country.
It turns out that extreme weather is only one of those unique factors. Insurance has also gone up because of people moving to the state and building more expensive houses in risky locations.
There's more built up value. Florida had a population of 2.2 million in 1946, and it's now 22 million. It increased 10 times. So there's a lot more built-in value in Florida that's available there to be hit by a hurricane and be destroyed. So we've got climate change, we've got the built-up environment, which has grown. There's more real estate out there to be destroyed, and you have the inflation in these prices. So it's like a trifecta.
A lot of circumstances hit at the same time.
One step up the ladder of risk, from insured to insurer, Tim Serio is CEO of Citizens Property Insurance Corporation.
You had, COVID and post-COVID, a lot of folks flocked to Florida. You had property values skyrocket, which, you could be very happy that your home was worth more, but if it costs a lot more to replace it, you're going to be paying more in insurance. You had inflation over the last several years, which drove up construction costs, cost to replace your home.
It's not just Florida that's been hit by higher insurance costs recently. Across the country, insurance prices have surged over the past 2 years. Since the beginning of 2023, the cost of homeowners insurance nationwide has climbed over 21%, while CPI rose just 5%. The price of some commercial insurance is up nearly 15% over the same period. Theodoru says the greatest problems facing insurance markets have been man-made. Companies leave states like Florida and California not because they can't price climate risk, but because they know the risk, and state laws and litigation won't always let them keep up with it.
If they're underpricing, they're not going to have a 6% profit margin, which is the going rate for insurance companies. Insurance companies are not fat, rich organizations. So that's why you have this seeming exodus from California.
This problem of insurance companies leaving the state gave rise to Serio's Citizens Property Insurance Company.
Citizens is the state-created insurer of last resort. The idea is that we exist to help the people of Florida find insurance when they really have no options. Maybe it's because of, maybe they're a higher risk, not necessarily because they've done anything wrong, but the characteristics of their home.
Today, the last resort has become the only one for many who live in Florida. Citizens is the largest insurance firm in the state.
Our rates were artificially suppressed, and we became probably on the whole the cheapest in the state of Florida, which caused us to grow exponentially. And that's not a good thing. There has been pretty much bipartisan agreement that a very large Citizens is not healthy overall for Florida, because if we grow too large and there's a storm or a series of storms and we can't pay our claims, the good news for our policyholders is their claims will always be paid because we have the requirement to levy a surcharge on Citizens policyholders. And if that doesn't suffice to pay claims, then it's an assessment on policyholders and non-policyholders alike to make sure claims are paid.
Individuals may be struggling to pay their premiums, and states may be struggling to keep premiums within reason. But it's not because the insurance companies are pocketing big profits. Profit margins for the S&P 500 insurance sector have climbed over the last few years, but to levels that are far from shocking, peaking around 12% this year before sliding to 7% in November. Compare that to 2024 highs of around 16% for the financial industry and over 24% for big tech. One factor constraining profit margins for insurers, beyond the claims they're paying out, has been the rising cost of insurance that they themselves have to pay. One more step up the ladder of risk.
Swiss Re is a global reinsurance company, and our clients are insurance companies. We partner with insurance companies to protect their balance sheets.
Monica Ningen is CEO of U.S. Property and Casualty Reinsurance at Swiss Re, one of the largest reinsurers in the world.
When it comes to reinsurance rates, there is an impact from climate change, but it's relatively small. The other factors being economic inflation, wage inflation, inflation of construction plays a big factor, especially in the last few years. But you also have things like urbanization and people moving into areas that are more susceptible to catastrophes.
Each of those factors helped push reinsurance rates higher every year since 2017, with an especially sharp rise in 2023. But early figures for this year suggest the trend might finally be leveling off. And even though we're closing the books on one of the worst hurricane seasons on record, signs are that this year's natural catastrophes haven't led to financial ones.
it's a chain there that spreads the risk around so that when you have a catastrophic event like Hurricane Helene, it didn't hurt the third quarter earnings. A remarkable thing that happened at the end of September. Helene went up to North Carolina, but the insurance companies, they just reported the third quarter earnings last few weeks, and they were pretty upbeat, didn't lose a lot because very sound, prudent use of reinsurance. And there's also private investors that want a piece of the action in the form of insurance-linked securities, also called catastrophe bonds. So there's a lot of capital. So whereas people are talking about, oh, this is going to be a $40 billion or $50 billion event, insurance companies can handle that. They're built to do that. That's what they do. So we're seeing some positive, some tailwinds that are really worth watching.
Despite all the factors driving insurance costs up, those who know the industry well see cause for hope, at least in Florida, where the government has worked to reduce lawsuits that have cost a good deal to insurance companies.
The good news is that about a year and a half ago, the governor of Florida signed into law some comprehensive tort reforms that really cut the feet out or cut the legs off from some of these excesses of litigation. After the tort reforms went into effect last year in March, we've seen that the number of lawsuits in the first 3 quarters of the year, because we just saw the Q3 numbers, went down by 24%.
We hit 1.41 million policies in October of 2023. We're a little over 1 million now. We should end the year at around a little over 900,000 policies. That means that private carriers are coming in. They're taking policies out of citizens. They're willing to write more risk. So, I mean, that is evidence that the market's getting healthier.
Recently, one of the publicly traded insurance companies in Florida said that we're not doing more rate increases. So it appears as if the insurance industry has caught up with the loss magnitude.
Whether or not lower insurance rates find their way to businesses and homeowners in Florida and across the country in the short term, we do know that climate risk and development in risky areas isn't going away. Monica Ningen says what happens next will come down in part to those of us at the bottom of the chain.
So when you look to the future, I think there's a few things that will change. I think that consumers will start to better understand their own risk exposure and what their own resiliency looks like. As events impact our lives every day, whether it's snow impacting, your commute to work, or it's a flood that's imposing on you returning back to your home, consumers are being more aware than they ever have been on the risks that their homes face.
Back in Boca Grande, Glenn Scarpa says he's very aware of the risk of another hurricane, but he's hoping to manage with a little bit of luck and insurance.
I mean, you got to anticipate that, it's probably going to happen again. Who knows? It could happen next year, could be 30 years, it could be 100 years, but it's going to happen again at some point.
Having a business on the island, Scarpa says, is still worth the risk. But after moving there 5 years ago and seeing the destruction to both his restaurant and his home, he's decided to sell his condo and move inland onto greener and, he hopes, drier pastures. Next on Wall Street Week, the view of the regulator who oversees insurance in Florida, the epicenter of helping homeowners cope with the risk of catastrophic loss.
We want to build the future of marine services, autonomous ships. Jumpstart really pushed it over the edge for us. When you're going to a different region, you need to have the right partner.
If Florida is at the center of so much loss, Michael Jaworski has one of the toughest jobs around, regulating the insurance industry and trying to find a balance between insurance companies and the ones they insure. Why do we need state regulation of insurance companies? I mean, Florida's not the only one. Obviously, states across the country regulate insurance companies. Why do we need regulation?
It's so pivotal. This is probably the only mainline business that exists where at the time where the seller is selling the good or product, they're not entirely sure how much it is going to cost. And so if you don't have a well-regulated insurance infrastructure, you could wind up in a place where there's rampant insolvency, waste, fraud, and abuse within the system. So it's very important that there's a third party like a state or other entity that's out there monitoring the behavior of insurers. And the reason states are best equipped to do that is because on the other half of that is that insurance is fundamentally it's a local game. Every single market is different, has its strengths and weaknesses, and we've got to be on hand we got to have people ready that understand that to monitor the insurers.
Well, pick up on that specifically. What is different overall in Florida than the rest of the world? Certainly you get a fair number of those hurricanes that come in.
That's a key part. Hurricanes, the coastline that we have, there's not an inch of Florida that is more than 70 miles away from coastline. We've a sandbar, and so we're in a special place where we have millions of people. We have about $7 trillion worth of property in the state of Florida on TIV, and so it's important. It's kind of puts us in a unique place because then we're on the other hand we are surrounded by water that can generate hurricanes, and so it's a critical market. It's probably one of the most unique markets in the world as far as who participates in it. We're heavily reliant on reinsurance, so it keeps us very busy throughout the year, keeping an eye on all of that.
What factor is climate change in the risks you're facing? Are you seeing a change in risk, either in the severity of the storms or the number of storms because of a warming climate?
Climate's a very, very long-term game, and insurance contracts are written out over the course of a year after year after year after year. And so to the extent climate is impacting rates, it's a little bit uncertain. That when we talk to reinsurers, they're factoring in generally about 0 to 2% or 1% add-on for climate change itself as part of that risk. But fundamentally, I think the bottom line is, we went a decade without storm impacts between 2007 and 2017. So there's a lot of emerging data on what the impacts of climate are, but I think our climate changes. But I think the bottom line is that a state like Florida, and frankly any coastal state or states that may have impacts such as wildfires like California or others, resiliency, fortification are really the key. Building up your infrastructure across the country to make sure you have what it takes to build to withstand whatever's coming your way.
You mentioned that there's trillions of dollars invested in real estate around Florida. Is one of the factors also the building out of Florida? There's been a lot of people moving to Florida, a lot of people building very expensive homes and businesses there. Is that also increasing the risk when it comes to insurance?
Fundamentally, you have an increase in risk because you have a larger footprint within the state where there's value that's been added by human activity. But at the end of the day, you should be, if you're actuarially sound, you're collecting rate to compensate for that. So you should have an incremental increase year over year on both of those sides. So it should be relatively in equilibrium. As
Commissioner of Insurance in Florida, how do you balance the risk? On the one hand, for the insured, because the premiums can't go up too much. It really puts a lot of pressure on a household or a business. But on the other hand, making sure the insurance companies make a reasonable return, because otherwise they just won't insure anymore.
Well, that's right. You've got to make sure that it's a fair game for all players. And so when we look at the table, we want to make sure that we're operating in a way that is fair to companies that are coming here. We want to regulate very efficiently and fairly, but not too aggressively or on a basis where it just seems like this isn't a fair state to operate in. But on the other hand, we need to make sure that they're doing right by consumers. And so the easiest way to do that is to make sure that we're following the law. The law is very clear. We can't approve rates that are inadequate, excessive, or unfairly discriminatory, and that's generally what we do. And then we also, on the market conduct side, we've ramped up significantly in the past couple of years, making sure that companies are fulfilling their contracts and following the law when it comes to paying claims when they're due.
There are some states where reportedly insurance companies have decided not to insure there. California comes to mind, for example. Have you had that challenge in Florida?
Our markets, we have an old story here. It's really since Hurricane Andrew. We're 30 years into kind of a mixed bag of participation from major insurance companies. We're working hard to show them the value in returning to Florida. Today, just in the past year, State Farm became our largest carrier once again in the state of Florida with over 670,000 policies in the state. So we're working on getting a big mix in there. You want bigger participants. You want to kind of be able to soften any, if you think of the market as in total as kind of a sea. You want big rocks that can break the waves and keep things relatively shallow. And then you want slower, smaller players that are in there filling in the gaps. And so that's where we want to get to eventually. I think we're making progress on that front. The biggest thing that insurers want to see when they are deciding whether to enter a state is stability. They want to see a regulatory structure that's stable. They want to have a clear understanding of what the risk is, and they don't like uncertainty entering that sphere. So we need to make sure that we're creating that environment, again, in a way that is ultimately favorable to consumers as well.
Now, all Propeller Ads users can advertise in Telegram mini apps. It's a new ad format that seamlessly fits Telegram's look and feel. And here's what it looks like. How will the user see your ad? While a user interacts with the mini app, an ad appears natively, say when a user runs out of lives in the game, and a user clicks on the ad, and it's then taken to your landing page, your Telegram mini app or channel. So why is Telegram traffic the new holy grail for advertisers? It is a new source of traffic, so the competition is still very low. Users are engaged, they make purchases in mini apps, play games or use wallets, and when they see native banners, they're more likely to click on the ads. Huge amounts of available traffic, multiple unique targeting options you can only find in Propeller Ads. Zone bidding, auto optimization, CPA-based pricing, and most importantly, Telegram traffic is already in your Propeller account. Use it exclusively or mix ad formats. No need for an extra account or additional tracking solution. In other words, if you're an advertiser with a product, a Telegram mini app owner, or you have a Telegram channel that needs a larger audience, this ad format is just for you. Find it on our platform.
Welcome Reward Spesial untuk trader baru. Mau tahu gimana caranya? Yuk simak! Daftar di Dupoin dan buka akun real. Gabung Welcome Reward dan dapatkan $30 di akun promo. Trading di akun promo dan klaim rewardnya sekarang. Klaim profit yang diperoleh dari trading di akun promo. Reward akan dikonversi menjadi voucher MAP. Tunggu apa lagi? Yuk buruan daftar! Download aplikasi Dupoin di App Store atau Google Play.
There's the risk of loss to insure against. What about the risk of litigation and really outsized awards? As I understand it, there was an issue of Florida, but there's been some reform there.
Yeah, we took some dramatic action. The governor showed tremendous leadership, the House and the Senate finally saying enough is enough in Florida. We had about, just as an example, in 2019, we had about 8% of all property claims in the United States and 76% of property claim litigation in the United States. And so we had one law in the book that was the primary driver of that, which was it was called the one-way attorney fee statute, where if you sued your insurer after they had offered you $1 and you wound up getting $2, then all of the attorney fees that went into that were automatically paid for by the insurer, which is ultimately policyholder dollars. And so we found that we went to a system that is consistent with that of just about every other state in the country, which is a contingency fee-based system, and that makes sure that consumers still have the option to litigate should it become necessary. But also, we also stepped up our market regulation to make sure that companies are ultimately paying the claims when they're due and acting efficiently and swiftly. And so as we're looking at it, litigation is down about 30% this year compared to last year. And we think that is a good sign that litigation is available to consumers, but ultimately all that any unnecessary or frivolous litigation is leaving the space.
What have you learned in Florida that you think might be applicable elsewhere in the United States, other states might benefit from?
I think the biggest thing is honestly data collection. When we talk to a lot of our peer states, they're a little bit behind in where we are. We've obviously had a challenging market again for decades, so we've collected a lot of really fundamental pieces of data on what's going on within our space, and we can now see that. But also, I would be very I advise strongly to pay attention to human behavior in all of this. Ultimately, that when you buy insurance, when any of us buy insurance, we're entering a risk pool, and anything that happens to that pool is going to be paid out by everyone else. And when you have third parties behaving in a way that is not helpful, acting with litigation that's unnecessary or fraudulent behavior, we all pay for that. So it's important to watch that. And finally, the other thing is Florida's building code is the strongest in the country at this point. And it's taken a long time to build that in and to have homes that are built that comply with that code. But ultimately, when we're looking at Hurricane Milton that just hit this recently, estimates were coming in that was going to be a $27 to $30 billion event. So far, the actual losses are a little bit over $3 billion. And so that's at least partially attributable to the strength of our building code and the infrastructure that has been put in over the decades to make sure we have that in place.
That does it for us on Wall Street Week. I'm David Weston. We'll see you again next week for more stories of capitalism.
You don't start a startup if you want to sleep at night. We are building the tools that will enable users to transform their industries. I want to get to a world where quantum computing is the way we're solving all of the hard problems.
The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
The U.S. stock market heads for a third week of gains, while the U.S. labor market heads for who knows where. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. Whether or not we're going to notch another record high is definitely a question, Romaine.
Absolutely.
So let's take a look at where we're headed into the close here. The S&P is up 0.1%. We're well off the highs. Whether or not we're going to notch that record, TBD. Now, the NASDAQ 100 at another record high as well. That would be the 43rd record high if it is able to close around those levels. And mid-caps were also at a record high, but giving up those gains. The Russell also now negative territory. And I got the mid-caps up by 0.1%.
Record highs for the S&P 400, Alex Steele.
57 to up today.
All right. We should note, though, that the market price action around the latest jobs report that we got out this morning is indeed actually a bit restrained. Just put it there with her board. There is a bid to stocks helping extend that record rally, but the conviction and the volume behind that bid, not quite a picture of euphoria. And why would it be? I want to go through a breakdown now of that monthly employment report that we got this morning. It was consequential. 227,000 jobs created in the most recent month. That was relatively in line with estimates. You had a minor uptick in the unemployment rate to 4.2% and a minor drop in the labor force participation rate to 62.5%. In line, in line, in line. While that data may alleviate some of the market's worst fears about a softening economy, it does nothing to really ratify their greatest hopes for a resurgence in economic activity. But the hope now is turning back to the Fed, that the economy is in just that right sweet spot where the Fed will follow through on all of those promised rate cuts, something Tiffany Wilding at PIMCO says is likely, but maybe not at the pace investors had banked on.
We think you likely will get another 25 basis point rate cut. But at the same time, when the Federal Reserve releases its new summary of economic forecast projections, you'll see just a expectation for, a stronger, more resilient economy.
And a lot to parse ahead of that Fed meeting, which is just about a week and a half away, Alex. But we go back to that report that we got this morning. We kind of forget it's really not just one report.
No, you're right. With the revisions, et cetera, it was much more than just that one. Here was another head scratcher. And this takes a look at the household employment survey. That's that blue line. And the white line is that non-payrolls. Now, clearly, they don't track each other perfectly, but what caught everyone a little bit off guard is the big gap between the household and the overall survey. And if you dig in beneath the household, there were a couple worry points. First of all, the labor force shrank by roughly 100,000, and the participation rate fell to 62.5%. That's the lowest rate since May. And overall, we've seen this decline by about 355,000 jobs. So you can call it Goldilocks, or you could say, hey, actually, are the cyclical parts of the economy just maybe not as good as the other parts? And is that a level of concern, Romaine?
Absolutely. Stephanie Roth joins us right now, kicking us off to the close here on this Friday afternoon, chief economist at Wolfe Research, and a jobs report that on the surface, at least on the headline, seems relatively encouraging. When you dive deeper into it, Stephanie, any concern?
I mean, and the biggest thing that would be of concern from the print would be on the unemployment rate. So rising to 4.2, and you mentioned it was modest, but it is still notable. And we have seen a step and upwards from 3.5% towards the 4.2%. And this was a notable uptick, and this would be the thing that is likely to push the Fed to cut in December. So I think that's the biggest takeaway from this report is it largely solidified the fact that we're going to get a cut in December. And if you make some adjustments for the strikes and then also hurricanes, it looks like the print was something like 137,000. And if you make similar adjustments for the prior month, it was about 126,000. So the combination is a labor market that's okay, not overheating and not really that weak either.
But when we get back to the inflation side of the picture and we take a look at average hourly earnings, 4% on a year-over-year basis, 0.4 on a month-to-month, slightly above what analysts and economists were expecting, Stephanie, is there concern, or should the Fed have some concern about a potential resurgence in inflation?
I don't think so. Of course, there is always the concern, but I don't think it's going to be related to the wage data that we got today. It was 0.366 when you look at it on an unrounded basis, so it barely rounded up to 0.4. And this is not necessarily seen as the key measure of wage inflation. The employment cost index is a much better measure. Granted, it's a little bit lagged, but the most recent index suggested that it was coming back down towards something that's closer to 3.5%, which is what the Fed's looking for. And by the way, the fact that productivity is picking up means that the Fed is going to be more comfortable seeing wage inflation running a tiny bit higher. So the fact that productivity is running closer to 2% as opposed to 1.5% cycle allows the Fed to be a lot more comfortable with a 4% wage inflation as opposed to 3.5%, which they would have thought previously before we saw this pickup in productivity.
That's a really good point. To the distinction of the different sectors, though, I'm wondering if you see any signs of a slowdown in the cyclical parts of the economy. Bloomberg Economics has been saying that and used the household survey as an example of why they do still see that.
I mean, you saw
the power of dreams.
Why does one of the richest men in the world drive a 1997 Honda Accord? Probably for the same reason the world's biggest tech giant drives a Honda too. Simply because it's a Honda.
Aku tuh kalau nggak ngopi kayak nggak on deh. Kalian gitu juga nggak? Apalagi kalau misalkan lagi banyak deadline. Extra shot tuh wajib sih. Tapi tiap aku ngopi, bukannya jadi fokus, malah sakit mah yang kambuh. Rasanya perih kayak ditusuk-tusuk gitu loh. Selep, selep. Untung sekarang aku minum Proma Herbal sebelum ngopi. Lambung terlindungi. Kerjaan aku lancar, bos tetap happy.
Gue tuh suka ragu kalau diajak ngopi bareng temen-temen gue. Mau nolak gak enak. Tapi kalau gak ditolak, lebih gak enak. Soalnya setiap minum kopi, sakit mah kambuh. Mulut terasa asem. Lambung terasa mengkerut, keret. Kalau gue minum Proma Herbal dulu, gak ragu buat ngopi lagi. Lambung juga jadi terlindungi. Sekarang hangout bareng temen, gaspol.
Sebagai seorang barista, mah, kembung, mual sudah menjadi bagian proses yang harus gue hadapin sehari-hari. Perih. Gue pernah divonis untuk nggak boleh ngopi, bahkan sampai harus putus hubungan dengan kopi. Tapi sekarang, sebelum ngopi, gue minum Proma Herbal. Lambung jadi terlindungi. Karena coffee is my language. Nggak terpisahkan.
Mereka sudah membuktikan, minum Proma Herbal sebelum ngopi bisa mencegah munculnya gangguan lambung. Proma Herbal dengan 8 bahan herbal yang melindungi lambung dari iritasi kopi. Gimana? Masih worry buat ngopi? Proma Herbal dulu, ngopi no worry.
I mean, you saw a rebound in manufacturing, so I'm not that worried about it. You have seen the strongest parts of the labor market have been the more defensive things, so that's fair. But I wouldn't say that's the entire story. Generally speaking, the trends have been fairly solid for much of the other sectors, even though healthcare and government have been a big contributor from that perspective. The one thing to flag, retail fell on the print. That's probably tied to the holiday hiring season rather than a real indication about the cyclical parts of the economy or even necessarily the retail environment. People are shifting towards online as opposed to shopping in stores these days.
Okay, fair enough. Although we are getting data out right now that a U.S. October consumer credit rises almost $20 billion month on month, almost double what was expected. So we'll have to wait to get that data on how they're spending and on what they're spending. Okay, so then Stephanie, breakdown for the Fed, because we got a slew of Fed speak today, and the overwhelming conversation seemed to be like we're kind of at the level where we can maybe pause. Do you think that's true? And how long might that pause be?
This is a level where they could start talking about slowing down the pace. This is not necessarily the level that they're likely to want to pause. We think that's closer to 4%. And it seems that the sort of the goal is to get there, not necessarily regardless of the data, but they're going to be a lot more lenient about the data until we get to 4%. And then it's going to be a real question about how much more do they want to cut, if they want to cut further at all. So we do think that there'll be a slower pace to that 4%. And then it's going to be a real question of how much more do they want to cut. So base case is they'll cut in December and a couple times next year to that 4%, and then it's going to be on the data to prove whether they should continue cutting or if they can wait a little while, and also see how things are playing out from a fiscal perspective.
Well, let's talk about the fiscal perspective here, and I know there's still a lot of big hypotheticals surrounding that, but a lot of people making hay over debt levels and more importantly deficit levels and its relationship to GDP, some of the highest levels that we've had in decades, and I am curious as to when the Fed could even start to factor that in. Do they have to basically wait for it all to happen before they factor that in?
I mean, Chair Powell has said that a couple of times that they're not making any forecasts about fiscal at this point. I would imagine they're gonna not take it into account until at some point in the middle part of next year, until it becomes more clear what the plan is going to be. The thing that's most relevant, though, is most likely the fiscal package won't be actually stimulative for the economy in a big way. The real question is about the tariffs. So from a perspective, even though the deficits are quite high, there's very likely to be a big fiscal impulse as a result of any package that's likely to get done. Yeah. Extending TCJA is really just expensive, but it's a continuation of current policy. The question is how they handle tariffs. That's a tough one. So basically our assumption is that they'll probably pause for an extended period of time, see how it plays out on the economy. Because it's stagflationary in our view, we're expecting that they'll ultimately have to cut another couple of times after a couple of quarters of waiting it out.
All right, Stephanie. Great to have you. Stephanie Roth, Chief Economist over at Wolfe Research, helping us break down that employment report that we got earlier this morning. When we come back after the break, we're going to break down a slew of changes in the C-suite. CEOs are, being tossed out of their jobs at a record pace this year. A conversation up ahead with management consultant Davia Temin about why it's happening and, more importantly, what the trajectory is for 2025.
All right. Also coming up, Open Table dishing out the data on diners' biggest trends this year and what to expect next year. A conversation with the company's CEO, Debbie Sue. All that and more coming up. This is The Close on Bloomberg.
In our lifetimes, we cover the distance from Earth to the Moon. It takes a global network to harness the Moon's possibilities and build the lunar economy.
Equities are going up over 20%, like that's more exciting. So if you said, I could take risk in my portfolio, do I need long end interest rates, which is obviously a long durated asset, or would I buy equities for my long duration risk? Like I'll take equities all day with an economy that's growing, an operating leverage machine called the S&P 500. I would take that, and then I just clip loads of yield in the front of the belly of the yield curve.
That was Rick Reeder, CIO of Global Fixed Income over at BlackRock on Bloomberg earlier today on why he'd choose equities over fixed income for that duration risk in his portfolio. So joining us now for more is Tracy Chen, Portfolio Manager at Brandywine Global. What do you think? Just clip some coupon in the belly and then buy equities?
I think the U.S. fixed income is definitely in a very interesting stage right now because the coupon does look very attractive. But I think Treasury market is now pretty much trading in a range. So if you look at year to date, the range was for the 10-year was between 3.6 to 4.7. And I think next year the range could be slightly shift up, probably between 4 and 4.75. It's really hard to say. Let's see what Trump's policy looks like, and also how resilient the growth will be, and how sticky the inflation will be next year. But I think if the U.S. exceptionalism continues and sustains, I think the Treasury market will be still in a range-bound market, and also it really depends on how the inflation will look like next year.
Well, what do you think? Because when we look at, say, what's happening in D.C., you have tariffs and you have immigration on the downside, then you have sort of tax reform and deregulation on the positive side, and the sequencing can really then affect inflation and growth. What are you guys modeling?
Yeah, I think we look at it all depends on the composition of the policy and the magnitude of the policy, how much tariff he's really going to impose, and also the sequencing of all those policies. So if you look at the tariff, it will be higher, but how much higher? Will he use a tariff as kind of a negotiation tool, or he will just impose tariff on day one? And then the massive deportation is easy to say, but hard to implement. But these two should be easier to do than lower tax rate and deregulation, because the latter two will need some congressional approval.
I am curious, though, Tracy, for investors, like what's going to be easier for them to parse? I think I can kind of understand what the president-elect he'll be able to accomplish more easily than others. But investors, of course, you look at things like immigration, tariffs, it's still kind of esoteric, and it's not really clear how that's going to feed through into the economy and, more importantly, asset prices. When you look at the fiscal situation and some of the changes they want to make there, on tax policy as well there, do you see maybe a little bit more certainty in being able to model those outcomes?
It's really hard to model, to be honest. I think on the fiscal side, it also depends on how the DOGE proposal will be implemented. I think there were so many oppositions to a fiscal cut. If you look at Europe, things are not easy there, like France and Germany. It's almost universal. It's so difficult to cut fiscal spending. I think U.S. is not exceptional there either. So I give them the credit of doubt. But at this stage, I think fiscal is still the biggest problem. The bond vigilante is still right out there to closely monitor the situation. So, but to be honest, the government is the most levered sector. So as credit investors, we don't like leverage. So we will be very cautious on investing in the government bond market right now. And it's so correlated across the US and Europe.
Well, I'm curious. I mean, but how much pushback do you think these so-called bond vigilantes can really do, Tracy? We look at the price action in the Treasury market. It's kind of been range-bound now for the last few weeks. And you know, it's anyone's guess whether we see a shoot up higher in the benchmark to 5%, or maybe it goes down closer to 4%. At the end of the day, as you sort of try to figure out whether you buy into the benchmark, whether you buy into duration, or whether you stay short, or whether you don't do anything at all, what is going to be the determinant of that decision?
I think the yield is definitely looking more attractive comparing to 2020 and 2021. So it's hard to be short here. So we are kind of neutral because it's all trading in a range. So it's hard to have a high conviction, but the yield is very attractive. But there are other ways to achieve even better yield, like the credit market or agency MBS market. You can get extra carry, and especially when the Treasury trading in a range, the agency MBS thrive on the range bound Treasury market.
How much credit risk, Tracy, do you want to be taking on right now?
Yes, definitely. So if you, we like both corporate credit and also securitized credit. Corporate credit, the spread has been tightening drastically this year. But if you look at all-in yield, they are still very attractive. So why not take short duration, high yielding credit asset or either floating rate or fixed rate. But again, you can get easily like 6% to high single digit yield without taking too much credit risk.
All right, Tracy Chen, portfolio manager over at Brandywine. That 10-year yield camped out right around 4.4 and change here on this Friday afternoon. Meanwhile, equities continue to get a bid. In fact, if you look at the biggest movers in the S&P, a lot of stuff in the discretionary space, including Ulta Beauty. A beautiful day for those shares, having their best days since August as a cosmetics and health retailer beats key metrics in its most recent earnings report. We're going to have a deeper dive into that when we come back in our top call segment right here on The Close on Bloomberg.
Batuk dan pilek mengganggu keluarga. Fix Formula 44. Legakan batuk tidak berdahak, tenggorokan gatal, pilek, dan bersin. Untuk rasa hangat di tenggorokan. Fix Formula 44.
Suatu hari, sekeluarga nonton TV. Tiba-tiba, tembok rembes, plafon netes. Nippon Elastex 3-in-1 siap beresin. Dengan teknologi Hydroflex. Pasti beres pakai Nippon Elastex.
All right, let's get a view from the sell side. It's our top calls, big movers on the back of analyst recommendations. And we're going to start off today with Asana. This is the work management software platform having a phenomenal day after KeyBank upgraded the stock to sector weight on the back of a solid but not exceptional third quarter earnings report. The analyst seeing encouraging signs of stabilization driven by demand for Asana's AI Studio product and expects the company's financials to improve. Those shares having their biggest one-day gain on record. Next up, Dollar General, a double upgrade to buy from underperform. This over at Bank of America. The analyst highlighting the discount retailers' improved inventory position and better in-stock levels. He also expects store closures by competitors like Family Dollar, CVS, and Walgreens to offset some of the pressure on Dollar General from Walmart. Those shares up 3.5%. And let's take a look at Peloton. Remember Peloton? Those shares pedaling higher after UBS upgraded the stock to hold from sale and quadrupled its price target to $10. UBS says while Peloton's growth outlook remains elusive, there should be EBITDA support from additional cost cuts. Peloton, which just a year ago had 5 sell ratings, now has just 1. That's over at BNP Paribas. The shares up 4% on the day, and those are some of our top calls. We do want to take a look at another company, one company whose shares are getting into shape, and that's Ulta Beauty. The retailer having its best days since August after a stellar third quarter report yesterday. Olivia Tong joins us right now. She's managing director and senior analyst covering consumer brands at Raymond James. She's got an outperform and a $4.95 price target on the stock. All right. When I look at Ulta, Olivia, and I look at the way that you and your team are valuing this, is this kind of about the potential growth story that we're going to see out of Ulta going forward, or is this more about the run-up that we've had to where we are today?
Thanks, Romain. Thanks for having me. It's more about the go forward. Q2 was quite challenging for them, and then Q3 got a lot better. Comps reflected positive in Q3, which we think bodes quite well for holiday. Obviously, Q4 very important for retailers, and particularly in beauty, and that usually accounts for over 30% of sales. So we think that they had some missteps in Q2. They corrected a lot of them quite quickly in Q3, and importantly, they didn't really touch the Q4 outlook. So we think that is prudent in this environment where we do have 5 fewer shopping days between Thanksgiving and Christmas this year, and with a shakier macro backdrop right now. We think that bodes well. The path forward after some more effective promotion and some newness coming looks pretty good for Ulta.
Well, that's one thing I'm interested about is kind of the catch up that this stock has to do when you consider its underperformance relative to some of its peers and other places in the discretionary space. What is kind of the thing that separates Ulta for a consumer that has a lot of options? You can buy a lot of this stuff at a department store, or obviously a place like Sephora or some of the other dedicated stores that sell beauty products.
Great. I think ultimately we're pretty bullish on beauty longer term. We think that the addressable market has increased. Consumers are getting into the category at a younger age. And at the end of the day, this is a fun category to shop. People like to do it in person. They like to touch, feel, smell, try things on. So that's something that Ulta does obviously provide. They also have a lot of technology tools with respect to trying on virtually and also buying online, pick up in stores, so that you can you have a lot of different options, and they're trying to meet the consumer where they are, whether it's buying online or whether it's in store. So we think that this is one way that they can differentiate themselves. You're right that competition has gotten more challenging. There's been more retailers getting into beauty. Sephora has opened quite a few doors in Kohl's, over 1,000 doors at this point. But the majority of those are now done. So the incremental headwind that we see from competition seems to be subsiding.
I want to get your take on how beauty is going to stack up when it comes to, say, tariffs and inventory and how they manage that. We're starting to hear on different companies' conference calls that they're thinking about what to do if those tariffs come into play.
Yeah, it's a great question. And obviously, there's a lot of discussion still going on with respect to China manufacturing. Of course, what we've heard with respect to Canada and Mexico, too. So a lot of different things that companies and we're all trying to solve for. Within beauty, there's not a ton of direct manufacturing exposure there. Certain companies have it. But we think that one area with respect to beauty is that pricing typically is a little bit easier in these categories, vanity categories. You do see a little bit, the consumer being a little bit more amenable to pricing. So our suspicion is that if tariffs came into play, that you would start to see some companies potentially address their prices and see some price increases there.
Interesting. And you feel like then that would be acceptable to the consumer? Like they could pass it on for the most part?
Within reason. Obviously, if it comes with innovation, then there's a case for the pricing. And then, of course, if everybody is getting hit by the same amount of tariffs, then, of course, it wouldn't be surprising that many of them try to pass it on to the end consumer.
True. It's like a sector. It's not specifically an Ulta Beauty situation. Olivia, thanks a lot. Really appreciate it. Olivia Tong joining us from Raymond James. I want to go back to that breaking news at the top of the hour that U.S. consumer borrowing remained increased by almost $20 billion month on month in October. The estimate was for $10 billion, and revolving debt, like credit cards and stuff, surged $15.7 billion.
Yeah, well, this is where now we're going to get into this debate as to whether this is a healthy sign of consumer spending
I
or
know.
an omen of what's to come here.
It's always both, right?
Well, but what I will point out is go back and look at the data that we had in holiday season 2023, holiday season 2022. More people were making further purchases using cash rather than credit. There's a big difference now this time of year. Now, again, whether folks can actually afford to pay that down, we're going to find out over the next few months and years.
Well, we heard also from the New York Fed in November that 3.5% of outstanding consumer debt was in delinquency in some capacity in the third quarter. Anyway, a wild week for the C-suite. We'll break it down. This is Bloomberg.
We want to build the future of marine services, autonomous ships that can be used for different things at the same time. Initially, people said that this looks like something I can build in my garage. Jumpstart really pushed it over the edge for us and build our network. When we are trying to scale up and going to a different region, you need to have the right partner. We just want to build something that becomes the norm.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. We're losing a little bit of steam. You're looking at an S&P. It's still up by just 0.1%, but mid-cap's kind of rolling over. We could end a little bit mixed.
A little bit mixed here, certainly on the Friday. On a weekly basis, the rally does continue to carry on. It's been relatively strong, but I was actually taking a look earlier at that rally, and it is pretty much all the Mag 7 this week.
Mag 7 is still at a record.
You strip them out, and we're basically in the red.
Yeah, I mean, you have Meta, you have Amazon, Apple, all sitting at record highs today. What's also interesting this week, if we take a look at themes, is just how much C-suite shakeups there was on the CEO and CFO level, and in so many different sectors also.
Yeah, it's been relentless. And at first I thought to myself, well, it's kind of the end of the year. Companies obviously rethink a lot of things, but you can see the numbers here. I mean, we're kind of approaching levels that are historically well above averages. And it kind of makes you, and that's just the CEOs.
Yeah.
I mean, don't forget, they're all the CFO changes, a CTO, CEOs and all these other C-suite changes at so many companies, Stellantis, Etsy, Intel, Bumble, and a bunch of more that we're forgetting. And we still got, 3.5 weeks left in the year?
Yeah, and it raises the question, why? Why now? And if there's something more we need to read into this. So we want to delve into this a little bit more with Davia Temin, president, founder, and CEO of Temin & Company. The firm specializes in corporate crisis and risk management. Davia, if we try and connect all the dots through the CEO and CFO changes that we've seen, what is your takeaway?
Takeaway is that we're in a time of unprecedented disruption, technological disruption. What is AI going to do to my company? Everybody's being said, you'd better pay attention to what AI is doing. And how do you grow value from that? There's disruption, obviously, geopolitically, disruption ecologically, disruption all across the board. So you almost have to be superhuman to be a CEO, that one person who is in charge of all of these different responses. And those are hard to find.
Yeah, and what I also find interesting too is that we've seen, at least in the case of Intel as well as Stellantis, like the CEOs leaving before there's a replacement, and then in their place are like multiple CEOs that are all magically going to work together. That also feels somewhat unusual. Can you give me your perspective on that?
Well, again, it reflects the mosaic of what everybody's got to be facing. And there are very few people who can be facing all of these kinds of challenges and do great on every single one. Most importantly, what boards, what investors are interested in is creating value for them. That's, of course, number one. And what consumers are interested in is creating something that's of value to them. So, but the game is changing as we speak. You don't just have to be like humanly agile and fluid and resilient. You have to be superhumanly such.
Well, I want to talk about kind of the selection and kind of what these folks are facing, particularly headed into 2025, at least here in the U.S. with the change in administration. I'm just going to cherry pick one name, Brian Nichols, who, of course, went from Chipotle to Starbucks and was kind of lauded at the time as basically being kind of really one of the best CEOs, if not the best active CEOs out there. He's taken over a company like Starbucks, which had a lot of challenges just selling products. He's heading into a lot of DEI controversy that could come back against him. He's got union issues. He's got issues in China. Of all the jobs to take, this one was probably way more complicated than anyone that he's taken prior to that. And I know you probably don't know the answer, but I'm going to ask you anyway. Why? Why take it? Is it just money or what?
No, I think that leaders want to lead. And leaders want to lead under challenging circumstances. It's just that it is conceivable that they discount just how hard it's going to be, and that maybe they're not going to be able to do everything that the folks who hired him, that their board wants them to do, and that they have some limitations as well. We don't know. I don't know what his psychology is, what his psychological bents are. But to want to grow and to go to the top of the mountain and get it and bring back value, of course he wants to do this. Can he is another question.
Yeah, and that's the big question, as balancing all of these different and competing interests. And of course, you're also dealing with employees who have demands, customers who have demands as well. As we start to see more of these vacancies come up, and as Alex kind of pointed out, I mean, we're seeing some departures where the replacement either hasn't been named or even they haven't even started looking. And it raises a question that if you see a vacancy like that, if you're a potential CEO and you're on the market, you see a vacancy like that, is that tantalizing to you? Or do you maybe think to yourself, wait a minute, I don't want any part of that. If they can't figure out a proper transition, why would I want to be there?
Well, I think there's probably somewhere in the middle where they think, I mean, first of all, you're not going to be running toward it necessarily, but you are going to be thinking, I could have managed this succession better. I know how to manage. I have some skills that they really need. And here's where my skills are congruent with what I can see they need. And if that's really true, then they are the right person.
Well,
it's conceivable.
But Davia, what I also find confusing is like the boards are also there, right? Like the CEO just can't do their own thing. Like they have to report to a board, and the board approves what the CEO also wants to do. So are we going to see a lot of board replacements and activists come into these kind of companies also? Or what do you think of that?
Yeah, you probably are going to see more activists, but it used to be that the mantra for boards was noses in, thumbs out. Meaning you ask a lot of questions, you make sure you're comfortable with everything, but then you let the leaders lead, let the management lead. and you don't take on that responsibility, even if you're a CEO of your own right in another company. These days, what I certainly find is that when trouble comes along, and it does come along far more frequently than it ever did before, boards forget this and they don't just put their noses in, they roll up their sleeves and they put their whole arms in to try to fix the situation. Boards may or may not have the capability to do that. And you've got a lot of expectations that are on one person, a CEO and his or her management team. So, there probably need to be far more realistic expectations of what the trouble's going to be at the outset of a CEO being hired. And I'm not sure that always happens.
Yeah, and that's what's so interesting, like with Boeing. They sort of chose a steady route, nothing crazy, just, steady as she goes and nothing really transformational. I wonder if we're going to keep seeing something along those lines. So crystal ball it for me. Is 2025 going to be better for CEOs than 2024?
No. I don't think it is going to be better because especially with technology, especially with AI, then quantum coming online, everything has to be rethought on what the value proposition is going to be. All of the various constituencies, how you deal with them, that's all being rethought as we're speaking right now. And we see that from Robbie Starbucks. We see that from all the companies that are changing one way or another. That pressure, I don't think, and one more thing, you've got a president who has chosen a cabinet that are disruptors.
Yeah.
So the disruptors disrupt.
Absolutely. David, this is a great conversation and obviously something that a lot of us are paying a lot of close attention to. It'll be interesting to see how some of these positions get filled and more importantly with who. David Temin, president and founder and CEO of the management consultancy Temin and Company. I do want to see kind of the final tallies on this as we get towards the end of the year. And also too, really, it's kind of that second tier too that kind of struck me. Like even with the Etsy announcement, was it yesterday, earlier this week? I mean, it was kind of almost wholesale changes in a lot of those key C-suite positions. And maybe this is the CEO deciding, okay, here's what I need to really sort of carry out my vision for next year. But I don't know if that's the safest way to do it.
Well, I also find it interesting too what she was saying about how it's because we're in a world of so much disruption. I hadn't thought of it from that lens. I thought of it more of like a company execution specific issue, not necessarily that. But if you tie in AI, it's right. Like if you don't handle that disruption well and you can't manage that into your business, you might get some real problems with that.
Absolutely. All right, a lot more coming up here on the program. We're going to take a look at some of the big movers on the day, including Qorvo and Qualcomm taking a hit on the news that Apple will debut an in-house modem chip. It's our stock of the hour. It's coming up next right here on The Close.
Our initial vision is to build a smart city that changes how people think about urban living. We always think to push the boundaries, how we can shape our future.
Welcome back. Time now for our stock of the hour and keeping a close eye right now on shares of Qualcomm as well as shares of Qorvo, each down fractionally on the day following Apple's announcement that it will debut an in-house modem chip next spring. Apple is planning to use its own modem chips, which will reduce its reliance on external suppliers like those two names you see on the board. Abigail Doolittle joins us right now to talk us through this. And, we've kind of known this was coming. Mark Gurman has been reporting on this, I feel like, for years. But it finally seems like this is finally coming to fruition. Is the market reaction that we're seeing on Qualcomm and Qorvo, is that warranted?
It's priced in, essentially. I mean, at the lows, they were down 2 or 3%, but now down less than 1%. I can actually remember breaking this news from a stock reaction point in 2018 or 2019. Wow. And at that time, there were big reactions. Yeah. Now, they were supposed to have this modem ready for market by 2021, but lots and lots of delays. It's interesting in Mark Gurman's piece, he talks about the speculation as to why they're actually doing this, because they've spent billions of dollars. It's taken a lot of time. This first generation, that one that's going to come out, that's called Sinopay. SINOPE. In any case,
if you say so.
Yeah, I'm not sure if that's the pronunciation.
That's the code name, by the way.
That a code for a little bit slower than Qualcomm's version. So, and they're testing it on the lower end phones for that reason. Then they have another one that I'm not going to attempt to produce coming out in 2026, and then Prometheus in 2027. And at that point, that's going to be a higher end one that will match Qualcomm. They of course were in a legal battle that they lost. So Mark Gurman's piece speculates that maybe that's some of the impetus for spending so much time and so much money on basically hardware, something that's not too all that proprietary. But in terms of the stock reaction, especially for Qualcomm, largely priced in. Qorvo maybe a little bit less so. One stock that's also down and interesting is because they of course created this chip, which is basically a modem. A modem connects the cell phone to the tower, to the internet, to the Wi-Fi, is Taiwan Semiconductor. They are actually going to be producing it. You would think that stock's up. Last time I looked, the ADR down about 2%. So I think, a lot of this basically priced in and
well, I think it also is a question of how successful Qualcomm has been / will be at diverting some of its revenue. If it gets more than 20% of its revenue from the iPhone, right? They've known that, as you point out, for years. So, how successful are they at migrating to different sources of revenue?
I think that will be something to be seen for sure. In terms of, I don't think that I've heard too much of their play into AI, but that would seem as though potentially that would be like a new area for them to go into. But Qorvo, again, is the one where I think it's a little bit less priced in. So that could be a one to keep an eye on.
All right, Abigail, thanks a lot. Stocks of the hour. We appreciate that. Something else to pay attention to here. Meta is at a record high, Romaine, and you have to look at the ruling with TikTok. The court upholding the ban on TikTok. It should go into effect on January 19th. Clearly, there's an execution problem here, and there is how do you actually enforce all of this?
Yeah.
But nonetheless, stocks are moving.
Yeah, you're also seeing Snap higher by about 3%, Pinterest up as well. A lot of interesting to see whether this was a January 19th deadline, which we should point out is the day before the inauguration of the new president, who has said that he's maybe amenable to letting TikTok survive.
And you have to look at the investors in TikTok and ByteDance, for example. A lot of rich VC guys in the United States. Anyway, we're counting down to the closing bell. 15 minutes delay. We're losing steam. We'll get the technical update for you. This is the close on Bloomberg.
The fact that productivity is picking up means that the Fed is going to be more comfortable seeing wage inflation running a tiny bit higher. So the fact that productivity is running closer to 2% as opposed to 1.5% last cycle allows the Fed to be a lot more comfortable with the 4% wage inflation as opposed to 3.5%, which they would have thought previously before we saw this pickup in productivity.
Stephanie Roth there kicking us off to the close just about 50 minutes ago, a conversation that we started the show off with about that jobs report that we got this morning. It wasn't bad.
Nope.
But there was some bad in it. And I guess you put it all together. The net effect of it is what? We get rate cuts and whoopee, stocks go up?
Yeah, pretty much. Okay. I mean, it's just that Goldilocks scenario. The question is, how long I feel like I've been saying this for weeks. How long does that actually last? And how do you protect yourself against a potential downfall when you have record high after record high of the S&P?
Yeah, I mean, look at this, 6,088 and change right now. And it's that incremental move higher here. And of course, this week and today, certainly powered by the Mag 7. But it gets to the idea here that if you don't care too much about valuations, or you're not at least obsessing over it here, then it does become a momentum market. And, some folks, they have no option but to chase that momentum.
And that's the FOMO retail trade. It's also mechanical fund buying. So if you get both at the same time, higher prices. I am curious as to the mid-cap underperformance because you have that record high in the S&P and the Russell's outperforming, and then where are the mid-caps?
And I thought, though, that if you believe that rates are coming down, I would think that would feed into
sweet spot.
The mid-cap story, right? But I guess for today, most people are just gravitating, of course, to the big cash generators. Once again, Alex. That is, of course, been the story of the day and on the week as we start to talk about how these market moves sustain themselves into next week and beyond. Let's get some insights out of John Kolobos. He's the chief technical strategist at Macro Risk Advisors. What are the charts telling us, John? I mean, can I bank on additional gains, meaningful gains out of this market?
Thanks for having me. I would say on a short-term basis, yes. Seasonality trumps sentiment right now. I do expect that it will still have robust gains into the end of the year. The S&P, thinking 6150, 6200 by the end of the year. And then looking into next year, given how strong trends are, given how robust breadth is, given how cross-asset implied volatility levels have come down. Yeah, I think you can continue to see the market push higher, the S&P. And my targets for next year on the lower end are around 6,600 and on the high end, 7,700.
Wow. Okay. 6,600, certainly relatively in line with some of the estimates we've heard from other folks on Wall Street. The 7,700 certainly out of line, but it raises a question in all seriousness, though. I was just looking visually at the S&P chart on a year basis. So 2024, I looked at the one from 2023, so on and so on and so on. It was hard to find a chart that looked like 2024. I mean, this has basically been a straight shot up. I mean, we had a little bit of that downturn, I think, what was it, like late July, early August. But for the most part, this has been a straight shot up, holding above all those key moving averages, both on the short and the long term here. Is there any historical precedence to say that this repeats itself for another year?
Sure. Yeah. So the 1990s really come to mind. You got to remember that in the 90s, what we saw were 4 consecutive years of the market being up 20% or more. And we almost got 5. 1999 was only up 19.5%. That was a robust, that was like almost a very steady uptrend. I don't believe the market even touched its 200-day moving average for a couple of years at that time. So short answer is yes, I think it can continue to do that. And reminds me a lot of what happened then.
John, that gives me to big tech because we've seen big tech really outperform. It's the story of the Mag 7 this week at a record high. If you look at the Mag 7 index, is that tapped out?
No, actually, I think it's what's quite interesting with the Mag 7 index is that it's just breaking out of another consolidation pattern. So it basically has been pausing for the last couple of months, basically since the summer. Basically, when NVIDIA peaked, Mag 7 kind of just stalled out and just took the backseat to, say, financials taking leadership. So I think they're about ready to continue to push up higher. And that's actually a very important component to my call for next year is that these key bellwethers are trending higher and they actually look fine. I mean, we can complain about a few of them, but by and large, most of these Mag 7 charts are intact and actually count higher. Yeah.
John, does that spread? I mean, the Russell it made a new high, the end of November, for example, but the Russell has not been able to keep pace over the last couple of weeks. Mid-caps keep making record highs, but still. So does that bullish call spread out?
I think so. And that's generally what part of my call for next year also is that we see a general broadening out of equity participation. So some of the studies that I've shown recently, reports have shown like the value line index, when that rate of change exceeds 20% or so, that continues to push up higher. Why is value line index important? Because that represents the average stock. So the studies I've done say that, breadth should continue into next year. The market should continue to push up higher to next year. But think about this. If like the Russell is just making new highs, it's testing it, right? The S&P made its all-time high a year ago. There's about 40% of the equity market, in my estimation, that is just about getting their sea legs. They're just starting the party. Mm-hmm. It's uncommon, really, to see breadth expand this far into a bull market, but it's happening nonetheless. And I think with the Fed earlier on, by hiking rates as aggressively as they did, they really put the kibosh on these smaller domestically focused companies. Now you remove that, it's kind of like a coiled spring, I should say, sorry, and that can push them higher. And so I think that's what's going to happen next year.
So that's the stock market. I'm curious, John, what your view is right now of the direction for benchmark interest rates. There's been a lot of speculation about the 10-year yield, whether it's headed towards 5 or maybe back down to 4. Anything you're seeing in those charts that would give us a bit more clarity on directionality? Yeah,
absolutely. So big picture, I'm a bear for bonds, right? I think it's a structural bull market for yields, and they're going to go higher over time. What does that mean? Yeah, we'll get to 5, we'll get to 6, we'll even get to 7% over the next couple of years. But shorter term, what's more important for right now in the market, I get the sense that we're probably entering into more of a range, if you will, 475-ish being the top end of it, the lower end being around 390. But my guess for next year, my best guess reading the wiggles for next year is that we'll break that 475. 530 seems to be about where I think the 10-year gets to next year.
All right, John, we'll all keep an eye on those wiggles. John Kolovos, have a wonderful weekend. Chief Technical Strategist at Macro Risk Advisors, helping us count down to these closing bells on this Friday afternoon. We're just about 3 minutes away, Alex, and stocks are holding on to some of those gains. It looks like the S&P 500. Can I do it?
Do it.
6,900. 90 and change, which would be its 56th record high.
7th.
Okay. Oh gosh, I failed. All right.
And what about the
56
Nasdaq 100?
This is why we keep you around, Alex.
Really, the only reason.
Because we'd be completely lost. But still, pretty meaningful gains on the week. The S&P only up a percent on the week, but you have the Nasdaq up about 3%. And of course, a lot of that fueled by the Mag 7.
Nasdaq 100, another record high, which would be the 43rd record high for the Nasdaq 100 so far this year as well. So, you know,
All right.
technically in the way.
We are going to keep counting those record highs, and we are going to keep counting you down to the closing bell here on this Friday afternoon. A full breakdown of all our coverage. It starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Alex Steele. We're taking you through that closing bell with a global simulcast that starts right now. We're joined in the TV studio by Scarlett Fu, as always, Tim Stenovic in the radio booth, Nora Melinda filling in for Carol Massar today as we welcome our audiences across all of our Bloomberg platforms. Here on what looks to be another record-setting day, Tim Stenovic, 3 straight weeks of gains for the S&P 500, and it looks like it's going to be, I'm told, a 57th record high.
Yeah, I heard that somewhere as well. 57th record high. I'm looking at other record highs too, including Meta platforms. We can't stop talking about TikTok over here. I'm not a big TikToker.
Yeah.
Romaine, are you a big TikToker?
I thought we renamed that to Bloomberg Originals.
That's such an inside joke.
Nice inside joke. We did used to have a TikTok here. That was
the other TikTok. Oh, I'm sorry.
Yeah, the other
Go
TikTok. The one that could be, January 19th. No longer be allowed here?
No, we don't do TikTok here.
See, I'm using it.
Nora does.
I do. Thank you, Alex.
Nora's the one who's been telling me about TikTok, guys,
Yeah.
to be fair.
I know all the deets.
All right. What are the deets? Are you actually going to be able to use TikTok on January 20th?
I surely hope so.
Okay. All right.
I have a TikTok account. I haven't checked it in a while, but that's for another day. What's interesting about this market high is that it's not accompanied by a whole lot of volume. It just feels like a lot of people are sleeping until the new year, until January 20th, honestly, until we get some new catalysts, because until then, it's a whole lot of uncertainty.
Yes, it is a lot of uncertainty, which is interesting, though, why you still see the Russell 2000 doing well, even though the mid caps have not. So that's interesting to take into effect there.
All right, let's walk you through the numbers here because it was an interesting week for the markets in the Scarlett's point too. We should point out volume of roughly about 10 to 15% below where it would normally be over the past 20 days here. A Dow Jones Industrial Average right across the screen there, down more than 100 points or roughly about 0.3%. It's also lower on the week as well by 0.6%. The S&P 500, 6,089 or 990 as these numbers, of course, take time to settle, but that's going to be good enough for a record high, up 15 points or about 0.2% on the day and about 1% roughly over the 5-day stretch. The Nasdaq Composite higher by 159 points or 0.8%, a 3% gain on the week. But the Russell 2000 kind of sitting this one out. Green on the screen for the day, 0.5%, but on a weekly basis, it's down 1.3%.
All right, well, let's take a deeper dive into the S&P 500. We did have 205 stocks move higher today, 295 stocks move lower, so showing that those stocks that did advance were those larger market cap names.
Yeah, and the larger market cap names are also the growthier parts of the market as well. Look at the IMAP here, and it shows you that consumer discretionary up 2.4%, communication services gaining 1.4%, and tech just barely positive, but it is still a gain of 0.1%. Growthy parts of the market gaining ground. The weak parts of the market, energy, utilities, and healthcare.
All right, let's take a look at some of the stocks that did move higher on the day today. Back to this idea of TikTok being banned. Bad news for TikTok, good news for Meta platforms. Meta platforms closing at a new record, higher today by more than 2%. Shares of Meta surging after that U.S. Court of Appeals in Washington refused to block that law requiring TikTok's China-based owner to sell the app or face a U.S. ban, 2.4% to the upside today, closing at $623.77. Look, the next stop is the Supreme Court. We'll see what happens if the Supreme Court does indeed hear this. We also saw shares of Alphabet, Snap, and Pinterest rise on this news. Let's talk Lululemon because shares posted their best one-day gain in 6 years, higher by 16% today. This after the company edged up its full-year outlook. Strong sales overseas, a sign that the company is spending off those upstart competitors, navigating slower growth in consumer spending. And finally, shares of Asana having their best day ever today. Shares just surging This after the company provide third quarter revenue that beat estimates, a sign that the business is stabilizing, according to analysts. Look at that, up by 43.5%.
Can I throw an honorable mention too? I thought the rebound that we saw in DocuSign today was pretty phenomenal. I think it closed higher by more than 20% on the day, Tim.
You know, I only get 3, Romaine.
Oh,
so
I know.
I appreciate.
But you know, Carol usually
He's doing what he can.
6 or
so, I'm a rule follower here, guys.
I like that.
I get 3.
Same, Tim. All right, Nora, what do you got?
Well, so let's look at some of the names in the red here. I'm keeping an eye on Cooper Companies. Now, this is actually the maker of contact lenses, but they also do some different providing sources for different gynecologists and medical companies here as well. But we're seeing the shares down about 4.3% at the close, and this is coming after it reported a 2025 forecast that disappointed expectations. But I did want to keep an eye also on some of those healthcare names that we saw falling. Of course, we know United Healthcare. We did see United Health Group, ticker UNH, falling, led the decline for many of these health insurance companies after, of course, that news that we had when they had their investor day, and as well as the shooting of the head of their insurance department. But those are some of the names that I'm looking at, as well as DraftKings. I mean, this is also a company that I'm keeping an eye on because of its Flutter, which is a parent company, actually fell after senators are seeking an FTC probe. So something to keep an eye on in this space.
All right, I'm taking a look. Yeah.
I just want to just point out to it, just another decliner. We kind of missed this. AMD took a big leg down towards the close here. There was a report out on Business Insider about Amazon expressing some concerns about not enough demand for the company's latest AI chips. And remember, it kind of has that partnership with AMD, and that's the feed through there. Those shares end of the day down 2%.
2 honorable mentions?
Yeah, 2 honorable mentions.
That's something. All right, bless you, Charlotte. Bless you again. I'm taking a look at the bond market here because we had sort of a rally pretty much the second those the jobs data number came out at 8:30. Obviously, it was centered in the front end. You get the 2-year yield down by 5 basis points. I do want to point out that we got a lot of Fed speak today as well. Then the blackout period starts, and it was a little bit mixed. Like Michelle Bowman talking about lower rates cautiously and gradually. You also had Beth Hammock saying the same thing. They're near or at a point where it makes sense to slow down those rate cuts. And Mary Daly saying she also believes in gradualism. Goolsby, a different story, a little bit more dovish, but it was an interesting read through today.
I don't understand though how this sort of all fits in though, right? Because if you look at what we saw in the market and the repricing in a lot of the swaps market here, everyone still thinks we're getting a ton of rate cuts now and through 2025.
I think they're just airing all the possibilities as we wait for more data when it comes down to it, right? Next week, you have CPI on Wednesday and then PPI on Thursday. That'll give a little bit more direction as to what the Fed does on December 18th. And then, of course, it's the outlook for rate cuts and unemployment for 2025. That's really going to set the tone.
I guess I'm surprised a lot of people aren't talking more about the unknowns that you have with the incoming administration. If he does go through with the tariffs that he's announced, if he does end up going through with deporting millions of Americans and what potentially inflationary aspects that could bring, what that does to rates.
But I feel like isn't this kind of a repeat though of what we saw in 2016? I mean, people talk about that Trump rally, but they kind of forget most of that rally occurred before he was ever actually inaugurated. It was sort of like, okay, you know, we're euphoric, we all bake it in right now. And then, of course, once you started to see those policies, that's when you saw maybe a little bit of a consolidation in the market.
Yeah, remember all the volatility around the implementation of those China tariffs?
Yeah, absolutely.
But those are there now, and they're still there. So.
Yeah, absolutely.
Okay,
are you stocking up? You know, people are hoarding things, Tim, now.
I heard they're hoarding toilet paper.
Toilet paper, so we learned.
Wait, toilet paper, though? Yeah. That's the one that you're going to stock up on ahead of tariffs?
But also it's interesting, too. We saw it in the UMich as well. I was talking to Joanne Shu, who leads the UMich data on radio earlier, and she was saying that people are buying durable goods now because they're worried about higher prices later. I mean, she didn't make the line for tariffs, but one can draw a conclusion. And the expectation for inflation is also higher because of that.
That's certainly what a lot of manufacturers are pushing, too. I mean, they're out there kind of marketing this idea, like, get it now before prices go up next year, because you never know.
Have I told you guys about the driverless car that I took in San Francisco a few weeks ago?
There's a segue here, right?
Yeah, this is the segue. I'm just changing the subject. I took a Waymo, and I don't know if I'm surprised I haven't told you because I'm just talking to everyone about it. It was awesome. I took it at night in the rain.
Yeah,
totally cool. I recommend everybody try this stuff.
Wait, you were going from point A to point B, or this was kind of just like an experiment?
I went point A to point B. I downloaded the app and just did it.
Was it cheap?
Yeah, it was $29. It was like the same price that an Uber would cost to do it.
I'll take it.
I didn't know this, but our own Ellen Hewitt, who we're going to be speaking to a little later today, apparently in San Francisco, some folks are attacking these self-driving cars. They've been smashed. They've been lit on fire.
They're getting lots of hate.
Well, they are like a symbol of the apocalypse, right?
I guess. They're so kind, though. You get in and the music's playing. They're clean.
Did you give it 5 stars?
I did give it 5 stars. There is a rating system too. It's just like Uber or Lyft.
Is it like talk to you? How can it be kind? I don't get it.
It's a very welcoming environment.
Okay.
But there's no one to welcome you.
No, there's not. But your initials are on the top of the car.
So that makes you feel welcome.
It's made me feel welcome.
Well, you know,
nice.
I'm going to segue to something else because
Okay.
Tokyo, the city of Tokyo, the
Feeling
government
welcome?
of Tokyo is trying to make female employees there feel more welcome. They're introducing a 4-day work week to help boost fertility rates and support working women, knowing that, having to balance work and parenthood is very difficult for a lot of people. And they really need to get their fertility rate up. It's at a record low of 1.2, which is far below the replacement rate needed globally of about 2.1.
And this is all because people are working too much?
This is because people aren't having enough kids to support the pensioners.
Well,
who
I get that. I mean,
need to get
and I guess
paid.
we're trying to be delicate about this, but the point is because they're at the office too much, or
But then the idea is like if you're a woman that doesn't have kids and is not married, do you not get the 4-day work week?
Good question.
I don't understand how they implement this without
a weird
this
line.
being
No,
kind of
or
weird, so.
working dads will get a 4-day work week, for instance, and then they can help out at home, and then maybe the mom can
Yeah.
go back to the office and work as well, and maybe feel more comfortable having kids.
I do think it's interesting too when they talk about kind of the salary concessions they're giving as well. So maybe you get a shorter work day, though you still come in, for the 5 days. So I guess look, at the end of the day, it looks like it's just kind of flexibility, right? So if you want to have a family or you're planning for a family, maybe you have the flexibility to
But
that out.
I think the hard part about a policy like this is it takes so many years to understand if it actually works.
Yeah, absolutely.
So, we'll see.
Well, there's one way to know if it works, Tim.
Try it.
Go ahead.
And that's whether you end up with a baby in 9 months.
Guess I got to go. That is going to do it for our cross.
What? I mean,
coverage. Of
come on.
He's cutting straight to the chase.
Somebody had to say it. You guys are too diplomatic.
All right, Tim, take
Bye,
us out.
Tim.
Come on now.
Bye, Nora.
Guys, have a great weekend. We'll see you same time, same place on a Monday. Enjoy a couple days off.
We want to build the future of marine services, autonomous ships. Jumpstart really pushed it over the edge for us. When you're going to a different region, you need to have the right partner.
And we continue our coverage right here on Bloomberg Television. A closer look here at investors looking to diversify their portfolio, but they might not be seeing an opportunity that's actually hiding in the bottom of a bottle of whiskey. We're going to talk about how investing in casks of liquor is rising in popularity. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Stocks back to their winning ways here on this Friday afternoon. A record high for the S&P 500. 3 straight weeks of gains now for the benchmark index. The gains on the day may not look like much. Even on the week, we're talking about 0.9% here. But we should point out that the rally that we saw this week was not the broad-based rally that we saw in the weeks prior. You take the Magnificent Seven, 1.7% gain on the week, even on the day, even more on the week. But if you strip out the Mag 7, heck, if you just strip out the Fab 5, the S&P 500 would be deep into the red. Your yield picture is basically where it's been for quite some time. Your crypto picture is where it's been for the last 48 hours. As we head into next week, more economic data, more earnings. It'll be interesting to see how the market moves.
Yeah, but in the meantime, you have some of those Mag 7 names gaining, and it is record highs for Meta as well as Palantir. Not a Mag 7 name, but certainly one of the AI names people are excited about. Meta Platforms getting 2.4% on the day after a court upheld a law that could lead to TikTok getting banned within the U.S. fairly quickly. So we saw Meta climb in a knee-jerk reaction. Snap also gaining ground as well. Palantir up 6%, rallying to a record after it announced a partnership with Booz Allen Hamilton, a fellow government contractor. On the downside, Qualcomm and Qorvo are lower. Bloomberg has learned that Apple is finally ready to start rolling out its in-house modem chips that would replace products made by Qualcomm. And it's all part of a bigger effort by Apple to bring its supply chain and manufacturing back in-house and make its supply chain more resilient. Qorvo is another company that supplies Apple's, and its products may also be vulnerable to Apple's modem efforts. Romaine?
All right. Well, we have to talk about an interesting story because just yesterday, Bloomberg published this whole story about $105 trillion inheritance windfall that it's on its way. And today, someone wrote a column about how wealthy baby boomers are willing to make their heirs wait for that money. That's at least according to a new Charles Schwab survey out there, which found that boomers are less likely to want to pass down their wealth during their lifetime compared to Gen X and millennials. Joining us right now, Bloomberg, Suzanne Woolley, who covers personal finance and investing for us. I both chuckled and cried a little bit at this story. I guess I don't really understand what's happening here. You have this money. You know, at some point you're going to pass away. You think you would sort of make some sort of accommodations to make sure that your children, grandchildren, whoever, got a little bit of piece of that pie while you were still alive. But I'm told this isn't going to happen, Suzanne. You're shaking your head, no?
The boomers seem to want to keep a close, keep their money close. I think a lot of boomers, it seems kind of stingy, but in a way, maybe it's thoughtfulness. I mean, I would think you would want to sort of see your heirs enjoy the money while you're alive. But I think a lot of boomers are worried about healthcare costs, and they're worried about being a burden on their family later in life. So it gives them peace of mind to sort of hold on to that money.
Yeah.
Or maybe younger boomers are in that sandwich generation where they're helping their adult kids and also their parents. So they're really not sure of what the costs will be. Or, maybe boomers are just like, I want it all for myself. I want to go out and travel.
Well, boomers have a lot of this wealth, but not all of it is liquid. I mean, a lot of it is in hard assets as well. What do we know about how their assets are distributed?
Well, they're overall the wealthy Americans that Schwab surveyed, which were people that had over 1 million in investable assets, excluding their home and their retirement accounts. They were saying they wanted, on average, to distribute about 40% of their wealth over their lifetime. I think the average value would be 4.1 million, but 40% of that was in real estate. 31% was expected to be in investable assets, about 18% in cash, about 11% in life insurance proceeds. Mm-hmm. So a lot of it is in real estate.
Well, one thing that's interesting about that really kind of caught my eye about this also is the idea that, estate planning, there are some serious advantages by doing this before you pass away. The idea is that if you can sort of transfer some of those assets or at least get those wheels in motion while you're still alive, the tax burden on your heirs, in theory, should be less. I mean, at least that's how I learned it when I was taking my economics classes, when I was studying for the CFA. I don't know, has the world changed or something? Have the rules changed?
No, I mean, I think that still holds. It makes a lot of sense to pass along some of your money when you're alive and to sort of lessen your taxable estate, although the estate tax exemption is so high now at, 11.2 million. Most people don't have to worry about that too much. But it does make a lot of sense to do estate planning that passes along some of your wealth along the way and not just all upon your death. But I suspect a lot of it is emotional.
Sure.
It just feels comfortable to have that money, and it gives peace of mind. And peace of mind is really big, especially as people are getting older and worrying more about healthcare and what's going to happen with Social Security and Medicare, things like that.
Yeah, it speaks to the sense of uncertainty that people feel, even those who are older in their age, given what they're confronted by. Suzanne, really appreciate you joining us. Suzanne Woolley of Bloomberg News, covering personal finance and investing. And Romaine, we had a chart up there earlier that showed how millennials will surpass Gen X as the biggest inheritors in 2039. As you and I are both members of Gen X, it was kind of sad to see the Gen X curve just go,
Yeah, I've just given up. I don't even talk to my parents about this stuff. I just assume they're just going to, go with it.
And you'll make your own way.
Yeah, self-sufficiency. That's what they've taught us. Correct. Gen X, we are the bedrock. So
when they remember us.
Yeah, when they remember us. All right. Well, we all actually still want to talk about budgets. In fact, when we come back, we're going to talk about the federal budget. We're going to take a look back at history, a look back to 39 years ago, and the roots of the budget deficit battles that we're having right now, and that landmark Graham-Rudman compromise that imposed the first ever binding spending constraints on the federal budget. This is Bloomberg.
In our lifetimes, we cover the distance from Earth to the Moon. It takes a global network to harness the Moon's possibilities and build the lunar economy.
All right, for today's look back in history, I really want you to think about the never-ending U.S. government budget battles, the string of federal shutdowns and near shutdowns, the downgrading of the Treasury's AAA rating back in 2011, all of that. The roots of that drama can be traced back to a major change in the law that began to unfold in the waning hours of December 6, 1985. That was when congressional negotiators reached an agreement on legislation that would ultimately mandate the government balance its budget within 8 years and abide by annual deficit ceilings that, if violated, would trigger automatic cuts to discretionary spending called sequestration. The resulting law, commonly referred to as Graham-Rudman-Hollings, and widely derided as an automatic Pac-Man that would gobble up the budget indiscriminately. It was on the surface a sincere effort to halt and to remedy decades of bad budget decisions. But with 39 years of hindsight, we now know Graham-Rudman never achieved its promise. The deficit, which simply is the money the government collects minus the money it spends, that was a thin record $172 billion. Today, it's a staggering $1.8 trillion. To pay for that widening gap, the Treasury has to borrow money by selling securities. As a result, the national debt, which is just the accumulation of that borrowing and the interest accumulating on those securities, that has now surpassed $35 trillion, 19 times the debt load we had back in 1986. So what went wrong? Well, Graham-Rudman had several fatal flaws, including exemptions for entitlement programs and loopholes where Congress could technically breach that deficit ceiling without actually triggering those mandatory cuts. Congress tried a second round of Graham-Rudman deficit controls to address those loopholes, but unfortunately, the results were the same. More legislation followed with the same goal and the same lack of results. But in 1993, newly elected President Bill Clinton did manage to push through a separate deficit reduction plan that did indeed appear to do the trick. By the late 1990s, the U.S. actually posted its first back-to-back budget surpluses in more than 40 years. But like most good things in Washington, that opportunity was squandered and squandered quickly. The bursting of the dot-com bubble, a recession, and wars in Iraq and Afghanistan would flip those surpluses back to deficits, and this country and its finances have never been the same since. A deficit now at fathoms some say can't be ignored, representing roughly 6% of GDP. And the total national debt as a percent of GDP, that's tripled from 40% in the mid-'80s to 120% at the end of calendar year 2023. Scarlett?
Yeah, those are some big numbers. And it's something that, of course, we expect to focus on, the budget deficit and the national debt in the coming weeks, especially as Congress faces a December 20th deadline to avert a government shutdown. Greg Vallier is Chief U.S. Policy Strategist at AGF Investments. And Greg, I want to start here. Is there any real threat of a shutdown when you've got a bunch of lame duck people in Congress for about a month before a new session begins and the Republicans control the House, the Senate, and the executive branch?
No, I don't think there's much chance that that would happen. There'll be a lot of hot air. There'll be people who feel they can do something. I wouldn't be shocked if in certain budgets from various agencies get frozen. That's the most you can hope for, is to get frozen. And of course, there are other, as we just heard in that great summary, there are other things that just dwarf this relatively small amount of spending we have. Other things like Medicare, Medicaid, Social Security.
How safe, though, are some of those entitlement programs, Greg? I mean, that has been the third rail that no politician really wants to touch. But we've heard from Trump himself, as well as some of his surrogates, who said they're actually open to that idea.
They may say that, but I'd say good luck with that. I mean, that's the third rail, as you guys know. And if anyone tried to even mess around with the cost of living adjustment, the COLA provision, I think there would be a rebellion. People feel that this is money entitled to them. I think this would blow up in the Republicans' faces if they tried to really make any kind of serious cut in these programs.
And that's why they really haven't tried to do that before. But now you've got some people coming in from the outside. Elon Musk with the Department of Government Efficiency. I have a lot of relatives asking me, is Elon Musk going to cut Social Security? Is he going to cut Medicare? Because he's coming in from the outside and he's not beholden to voters in the same way that elected officials are.
Well, there are some things that will get considered. For example, the tariffs that Trump talks about incessantly could raise some revenues. He says they would raise enough to not need any more revenues. That's just doesn't make any sense mathematically. But there are things that can be cut. There are agencies that have a lot of fat that can be cut. So I don't totally dismiss it. But any kind of huge revolutionary spending cut would die in Congress.
Greg, I do want to pivot here and ask you a little bit about foreign policy. The president-elect is supposed to be in France over the weekend for the reopening, the official reopening of Notre Dame. But of course, everyone really wants to take a look at the interplay between him and, I guess, the now current president of France, Emmanuel Macron. When you talk about Trump's foreign policy chops, his relationships that he had with world leaders during his first term, is that going to be materially different in his second term?
It could be a little more sophisticated, a little more nuanced. He did see Trudeau a week and a half ago down in Mar-a-Lago, and they had a very constructive 3-hour meeting. So I think Trump may be a little bit more sophisticated. The thing that he needs is a victory. And, maybe we'll see something out of Elon Musk that could look like a victory on a program or two. But what I think Trump really needs is something geopolitically, and that would be Ukraine. I think that we could be in an environment by mid to late winter where there's actually constructive talks on Ukraine.
You don't start a startup if you want to sleep at night. We are building the tools that will enable users to transform their industries. I want to get to a world where quantum computing is the way we're solving all of the hard problems.
Yeah, it'll be interesting to see. Of course, a lot of his surrogates are already trying to negotiate something, at least based on the reporting that we have. Greg, we have to leave it there. Always wonderful insights. We're going to catch up with you soon again, I'm sure. Greg Valliere there, Chief U.S. Policy Strategist at AGF Investments. And you do kind of wonder which sort of foreign policy Trump is going to sort of attack first, whether it is going to be the issue in Ukraine, obviously what's going on in the Middle East, and then you have all the issues with our relationships with Europe and China.
Right. Or will he continue to, make fancy trips to places like France and, talk up his relationships with France's Emmanuel Macron and his daughter's father-in-law, Charles Kushner,
well, I tell you what,
ambassador.
Yeah, well, I tell you what, Scarlett, I'm making a fancy trip to a nice restaurant later tonight. So let's talk Open Table and get some insights out of their CEO, Debbie Su. That's coming up next on Bloomberg.
The pockets of areas that are Republican dominated are thriving, and those that are not are having a harder time. We've even seen in our own restaurants that are in a more conservative area have definitely seen an increase in business post-election.
And that was part of my conversation with restaurateur Carolyn Stein. She is co-founder of the Loop Group. And Romaine, it goes to the idea that the restaurant industry is very sensitive to consumer sentiment. Perceptions of higher inflation or an unstable economy lead immediately to a pullback in eating out. But that doesn't happen across the board, across the nation, depending on how confident you feel about things like your political leadership.
Yeah, it's all about perceptions here. And we talk about restaurants. And I mean, you have to kind of just point out the obvious, which is probably one of the more ultimate of the discretionary spends for most people here. You don't have to eat out. We choose to. We like whether it's the food or just meeting up with our friends and family to do that.
Yep.
But again, how you feel about your own personal situation and the broader economy is going to be a big determinant of whether you're willing to actually go out and spend that money. Let's get some insights out of somebody who knows this industry better than anyone. Debbie Su, she's the CEO of Open Table, of course, the restaurant reservation booking platform. Debbie, and I do want to start off with the idea of optimism. I was kind of regaling my co-anchors a little bit earlier about all my fabulous plans this weekend. They weren't as enthralled about it as I was. But, I feel good. And we're going to go out tonight. We're going to go out tomorrow. We got another dinner on Sunday. And it's great. But as we kind of heard from Caroline Stein, it depends on where you live, how you view the economy, how you view the world, and whether you're going to actually feel comfortable doing that. I know you track this kind of optimism data, don't you?
We do track it, and we track it across all of the cities that we operate in. And I'd say on the whole, especially because it's the holidays, and we've consistently see holiday dining, whether that be Valentine's Day, Mother's Day, Thanksgiving, and then, the remaining holidays of this year, demand is coming in really strong. And we're seeing that across mostly all of our markets here in the US and even abroad, up 8, 9, 10% year over year. So we're expecting a really strong holiday season, regardless of how you're feeling about the economy, your optimism on what's going on in the world. when it's the holiday time, people are showing that they want to go out, they want to be in restaurants.
Is there any sense, I mean, do you have a sense of kind of where people are spending their money? I mean, I know most of the restaurants that you have an open table, they're kind of more high end. I know you have some that are maybe a little bit more middle of the road here, but are you seeing any sort of selectivity in terms of what types of restaurants people are selecting?
The future of marine services, autonomous ships, Jumpstart really pushed it over the edge for us. When you're going to a different region, you need to have the right partner.
We're not seeing a downgrade, if you can call it that, in terms of going to a different type or less inexpensive restaurant. The booking activity we're seeing is consistent, right? If you're looking for a 3-4 star restaurant, you're going to go out and do that. Where we are seeing this year a decline is how much you end up spending at that restaurant. So you might be still going to a nice, expensive restaurant, but you may not be ordering 3 drinks, right? You might be doing 2. So we're seeing check sizes be impacted this year. But during a recent Open Table survey respondents said that for the holidays this year, they are planning on splurging, they're planning on spending more, and we hope to see that because, of course, that helps our restaurants.
Absolutely. One thing that you've noticed as well is that people are starting to dine out, not just on the weekends or on Thursday, but on Wednesday as well. Can you explain that?
Yeah, so we're calling Wednesday the new Friday. And we're seeing activity and reservations happening on Wednesday, almost double digits year over year. And I think there are a couple of reasons at play here. With the rise of remote or hybrid work, often people are not going into the office on Mondays or Fridays, but they are going in on Wednesdays. So after work, you can grab drinks with a coworker or a group of your friends, things that you would normally pre-pandemic days do on a Friday. Often people are doing on a Wednesday. And when we ask people, they say, Wednesday, because we can break up the week.
You can break up the week. It just gives you something to look forward to. And I guess with the advent of hybrid work and people having more flexible schedules, that idea of eating starting at around 7 p.m. may be no longer what needs to happen. I'm guessing that people are starting to make reservations for earlier in the evenings as well. And sometimes maybe just dining out on their own too.
Yes, so we're seeing on the time front back in the day, dinner spot, and it continues to be a very popular time. But what we're also seeing, even in cities like New York City, 5:30, 5 o'clock, 6 in the front, and then at the end, people are now booking towards later in the night, 9:30, 10 o'clock. And as you mentioned, solo dining continues to be going strong. People are very confident and feeling good going out to a restaurant by themselves. And we're also seeing group dining increase. So groups of more than 6 people are on the increase as well.
So quickly, if people are making reservations at
architecture is about creating movement and motion. There's a huge community that is working together to bring it further. AI technology is evolving every day, unlocking the new possibilities.
People are making reservations at 5 p.m. Does that allow the restaurant to add in more seatings? They can get 3 seatings in as opposed to 2.
It depends on the restaurant and how long, but yes, certainly if you can start earlier, you might be able to get a third turn in versus the 2.
I am curious, Debbie, though, about when you're dealing with your restaurant customers, meaning the actual restaurants themselves, the owners. How are you feeling right now? Because we talked a lot about coming out of the pandemic and how a lot of restaurants really sort of had to find a way to get their footing for this new world order, whether it's how people dined or the amount of money they spent, and obviously things like labor and supply chain costs. Are you seeing more optimism from them, from the ownership side?
It varies really across each market and what restaurant you're talking to. But generally, I would say people are feeling very optimistic about this holiday season. There were times this year, for example, summertime in some big cities like New York, that were slower than we thought it would be. And so restaurateurs definitely felt that. But the holidays, starting from Thanksgiving all the way through, Christmas and New Year's, are generally very strong times for dining demand. And we're all feeling very optimistic. We're starting to see the reservations come in, that will be the case. And oftentimes for a lot of restaurants, this is the period where they make their margin for the year.
Yeah, absolutely. And what about like new restaurants, like the creation of new restaurants? I mean, I was looking at some data for New York City, which obviously has a tremendous amount of churn in restaurants for a variety of reasons. And the new creation. Newly created restaurants, that number was down pretty significantly from prior years. So you're just not seeing as many new entrants come into the place. And I know that's just one city, but I am curious as to whether you're seeing anything nationwide that might be reflective of that.
I think you're right that the trend you're seeing in New York is the trend that we're seeing across the country. However, we are still seeing a lot of new entrants, right? The chefs have these genealogy trees. So if you worked at one restaurant, then you come out and open your own. That type of activity, I think, is still very much happening. People who have been in the industry for a long time and coming out and trying their own hand at it. We love that, and we really love supporting chefs who are new and up and coming. Many of them are part of our Icons and Visa Dining collection. So new, hot, buzzy openings in cities like New York City are definitely still happening and very, very exciting. But I do agree with you that on the whole, we're not seeing as many openings as we did pre-pandemic.
Well, there's a lot of costs and inflation concerns out there, whether it's the ingredient of food or of imported goods that might see tariffs, or even labor, especially if there's going to be a crackdown on illegal immigration, which, let's face it, does power a lot of the kitchens across many cities.
That's right. Labor is a huge issue for all of the restaurants we talk about or we talk to. They're constantly, right, the churn and the overturn of staff has been huge. The cost of that staff. That's when we talk to restaurateurs, and it doesn't matter what city, that's the first thing they talk about in terms of the challenges they're facing.
Yeah, it's the first thing that diners talk about too when they sit down and look at the menu as well. Debbie, always appreciate your time. Debbie Su is CEO of Open Table, the restaurant reservation company. Romain, you are a child of the 80s and 90s, so you know about Chi-Chi's. Some of our producers who were not around at the time don't know about this, but Chi-Chi's, the Mexican restaurant, disappeared about 2004, very popular in the early 90s.
Yeah.
It's making a comeback.
I was kind of intrigued by this and surprised by this as to why they would bring it back. I guess it is a brand name, and I guess it resonates for people of a certain age. But it also comes at a time where we're seeing so many closures of these sort of chain restaurants, these national chain restaurants that have struggled. We've seen a couple go into bankruptcy this year, major ones, TGIF, obviously the struggles with Red Lobster, and there are quite a few others that are, at least in terms of their finances, certainly seem to be on the edge. So the fact that this one could kind of be resurrected, and maybe that IP is valuable enough where they could turn it into the next, I don't know, Chili's. What do we compare it to?
Well, maybe, for a younger generation, it's like, oh, there's Chipotle, and like now there's a play on Chipotle, Chi-Chi's, even though Chi-Chi's predated Chipotle.
So you're saying that basically just need to make it like kitschy and,
and I mean, if you can play off of the popularity of Chipotle, then like maybe there's a place in the marketplace for you.
Yeah, it'd be interesting. Chi-Chi's. I just want to point out that when we saw the story this morning, I think half the people in this newsroom had never heard of it.
Right. Or they called it Chai-Chais, which, I get it.
Which also means they never heard of it.
All right. Let's just give you a recap of what happened in trading today. We know the S&P 500 closed out a third straight week of gains. That is a record high. What number is it? Record high?
57.
57th record high of 2024, the S&P closing at 60.90. And it wasn't just stocks. Bonds also gained modestly following what some people are describing as a Goldilocks jobs report that keeps hope alive for December rate cuts.
Split? Do they do stock splits on Bitcoin?
No, they don't do that. They have a halving thing, but that's separate from the stock split. Yeah.
I never understood that.
I know. I feel like it's
everyone always tells me the halving is going to be a big thing, and it's never a big thing.
It's a big thing for those who are in the know. Okay. You're not in the know, nor am I.
2% on Bitcoin, over 100,000. How you like the math?
That's not even a gain for Bitcoin, really.
Yeah, I'll take it. This is the close on Bloomberg.
It is time now for Next Up, where we highlight the entrepreneurs and trendsetters moving the needle in the markets, technology, and venture capital space. Investors often stress the need to diversify their portfolios, maybe include some hard physical assets like maybe whiskey. CaskX, this is a company, makes it possible for everyone to invest in bourbon barrels and Scotch whiskey casks from leading distilleries. How does this work? Joining us now to explain is Jeremy Kassler. He is founder and CEO of CaskX. So Jeremy, are we talking about investing in the barrels, the physical barrels, or the whiskey inside, or both?
Well, both. So you invest into a new fill barrel of bourbon, which is a barrel that's been newly filled, as the name suggests. And then the barrel gets put into a rick house or a storage facility for up to 8 years. And as it ages, the flavor profile changes and it increases in value. And then at some point, we hope to sell the barrels and make some money.
And how many barrels does one buy? Do you buy 1 barrel at a time, 100 barrels at a time?
Well, we would go out normally to a distillery and we would source maybe, say, 2,000 barrels. And then we would sell them in smaller quantities of 50 or 100. So most of our clients come in around the, say, 50 to 70 barrel mark, something like that.
For those folks who will come into this investment, Jeremy, I mean, is there like a lockup period where, basically they have to go to stay invested in this? What's the general structure of it?
Well, legally, they have to hold the barrels for at least 1 year. That's the SEC guidelines, because this is considered a security for SEC purposes. In order to make money, you would need to hold the barrels for at least 4 years. But we would ask our clients to expect to hold for up to 8 years. So generally speaking, anywhere from 4 to 8 years would be the premium spot.
Of course, there are a lot of people that will invest in this simply because they like whiskey or like the concept. But at the end of the day, a lot of investors, as you know, Jeremy, just want to know what the return's going to be. What type of returns do you? I know you can't make promises for returns, but what type of returns do you think could be typical on a year-to-year basis?
Well, we've seen historically somewhere between sort of 12 and 14% per annum, something like that. There is a real bourbon boom at the moment. There's more bourbon being sold in the US, but more importantly, internationally, there's a massive demand, and the supply isn't quite meeting demand. So the prices are going up exponentially.
How do you source your distilleries? I mean, if there's a bourbon boom, that means a lot more people are going to get into it, and that means a lot more supply coming onto market too.
Yeah, well, we have our due diligence. We look at different distilleries. We build relationships over a number of years, because if we look at, say, 20 distilleries, we might recommend one. So once we've recommended that distillery, again, we build a relationship and we try and buy as much as we can, which isn't always easy. And whatever we can get, we can sell them to our clients.
So give us a sense of the size of the investor base for casks. What did you start with? Where is it now? What's the growth rate here?
Well, as a company, CaskX started in the US 4 years ago. We were formed initially in Australia, then we opened in Hong Kong. Year one, we did around about 5 million in revenue. Year two, 10 million. Year three, 20 million. And this year, we're looking at somewhere close to 30 million in revenue.
Wow. And I am curious, though, too, and it gets to something that you just said a little bit earlier, and also to Scarlett's previous question, too. When we talk about the boom, and more importantly, the export opportunities, earlier this week, there was a lot of concern coming out of Brown-Forman, of course, a behemoth liquor maker, about tit-for-tat tariffs under the Trump administration and whether that would affect its ability to export some of its American whiskey to places like Europe. I assume you have to have this on your radar. And if so, how much of a factor will it be in how you model your financials going forward?
Well, tariffs come and go. So, previously there were tariffs in Europe. And when the tariffs came into place, the American whiskey market started focusing on different markets. Then the European tariffs were taken away. So it's something that's cycle. One minute there's tariffs, then there isn't. So at the end of the day, the international demand is absolutely huge. There's more people drinking whiskey in India, in China. All these new markets are now coming into play. So it's not necessarily just about the US market. There's 8 billion people who are potential clients overseas, as opposed to 350 million here.
Have you thought at all about diversifying Cask X. And I ask that because while a lot of us love whiskey, myself included, as you know, tastes can change on a whim. And all of a sudden, everyone starts drinking vodka or for some strange reason, tequila, and these things kind of come and go. And so all of a sudden, whiskey falls out of favor. Are you prepared to deal with that? Or do you sort of have a plan in place to continue that growth, specifically in the bourbon and whiskey market?
Yeah, well, it's hard to plan for changing tastes, of course, but getting back to the international demand, that India historically has been the world's biggest market for drinkers of spirits. So as those markets expand, it's kind of irrelevant whether tastes change, a little bit here or there. So, we're quite confident the boom is current. It will continue. If you go to Kentucky or Tennessee, all you see is distilleries being built and rick houses being put in place. So we're very confident, very bullish about the market.
All right, Jeremy, great stuff and really interesting concept here. Jeremy Kessler there is the founder and CEO of the company Cask X, part of our next up segment here. You can invest in this, Scarlett. I don't know if you're a whiskey drinker or not, but you don't have to be, as long as you believe that other people are.
I know, but what would I give up? Do I not invest in wine because of this? I mean, like if I have an alternative asset, which one do I pick?
I don't know. I mean, it's either this or Bitcoin. I don't know what else is out there.
Bitcoin, $100,000. Anyway, let's go now to the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Paul Krugman, the Nobel Prize economist, retiring as a columnist for the New York Times after 25 years. He's going to write his final column before the end of the year. And what's fascinating is that during his time as a columnist, he has taken readers through the Bush era, Obama era, Trump era, Biden era, and leaving before Trump too.
Yeah, I mean, he's obviously one of the great minds in economics, and of course, he won the Nobel Prize, a couple decades ago, back in 2008. I read his columns. I mean, it was a must read. Yeah. And he, as you know, he was not afraid to sort of poke the bear, so to speak.
Ruffle feathers.
Whoever was in power. That earned him a lot of enemies, but it earned him a lot of fans as well. To point out, he is 71. He's been doing this a long time. Maybe he just kind of wants to move on.
Yeah, go on vacation, Paul.
Out there. All right, somebody who's not moving on is a guy named Brian Hill. You may not know his name, but you certainly know his company, Aritzia. It's a big Canadian retailer, and it's been building a big presence here in the U.S. He now has a net worth of over $1 billion following that expansion into the U.S. They now have roughly, I think, about 22 stores in the U.S. They've been primarily Canadian-based. What I thought was interesting about this was I only knew this company from the few times I went to Canada when I was younger, and I didn't know it was kind of moving into the U.S., but apparently this is blown up on social media.
It's everywhere now.
Bella Hadid and all these big stars are posting stuff on social media, wearing the clothes, and that's been a big impetus for their growth here in the U.S.
Absolutely, and what they've done is aggressively open stores in the U.S. They have a lot of prime locations, and these are leases.
They got one somewhere downtown in New York.
Yeah, they have one opening up on Fifth Avenue soon too. They signed their leases towards the end of the COVID era.
What I was talking about, Scarlett. They got one in Chicago too, by the way.
Yes.
Get there
no, very popular. Very popular. But they took advantage of when leases were low and leases were low, rents were low, and they signed their long-term leases.
Do you own any items?
I do. I have a pair of pants I wear for some time. Yeah.
I've never bought anything. Yeah. I'm gonna go check them out.
No, you should. Yeah. I don't know if they have men's clothing though.
Oh, well, maybe I won't check them out.
All right, let's round out the top three with Taylor Swift. The singer is set to conclude her 2-year-long Eras tour this weekend in Vancouver. Some last-minute tickets still available online, $500 each.
Yeah, this is the end of an era, Scarlett Fu, pun intended.
Yep.
Look, this was a juggernaut. We talk about the first tour for an artist, single artist, to gross over $1 billion, and maybe more than that, depending on what happens over the next 3 days in Vancouver. What's next for her?
Architecture is about creating movement and motion. There's a huge community that is working together to bring it further. AI technology is evolving every day, unlocking the new possibilities.
What's next for her? Scarlett,
she could do anything.
You're a Swiftie, right?
I'm not really a Swiftie, but she did appear on my Spotify
You're
list.
Kelsey. Or whatever.
No.
I don't know how you pronounce it.
I don't like him either.
All right.
But, I just love the fact that she's been a boon for the local economy no matter where she went.
Yeah, it was always kind of funny seeing that. And I was actually just in Vancouver on assignment, and that was all anybody was talking about. Well, and that was like 2 weeks ago. And everyone was just talking about
the lead up
about the lead up here. They were already making plans for that. So obviously an economic force in and of herself. It'll be interesting to see what her next move is for 2025. Meanwhile, we're going to set you up for what's happening over the next 5 trading days with what to watch. That's coming up next right here on Bloomberg. As we wrap up this week, we look ahead to next week and what could potentially move the market. On Monday, we do get some inflation data out of China, and Euro finance ministers are meeting. You going to be watching them, Scarlett?
Well, Trump is going to be in Paris, so I guess we're all going to be watching it.
A lot of people are going to be watching that. We do get earnings out of Oracle as well as MongoDB that day. The next day, we get additional earnings out of names like AutoZone, Dave & Buster's, and GameStop. Remember them?
Yeah, but there's not much to say about revenue at GameStop. We also have a RBA rate decision on Tuesday.
And then we go to Wednesday. Back here in the U.S., we do get that monthly CPI report, consumer inflation, Scarlett.
And that's going to be critical to whether the Fed does indeed cut rates the following week, because the jobs report kind of came in the way that everyone says sets us up for CPI really mattering.
Yeah, that report coming 1 week away from the big Fed rate decision. But then on Thursday, December 12th, we do get a decision out of the European Central Bank.
And they're expected to cut interest rates. That's been kind of the consistent theme there. We also get another read on inflation in the U.S., wholesale inflation with PPI.
Look for earnings out of Costco as well as Broadcom. And on Friday, we get some data on the import price index. As always, we thank you for tuning in to us this week. We'll be back next week right here on The Close, right here on Bloomberg.
The U.S. economy still has significant advantages versus the rest of the world.
The labor market has continuously been strong.
The data continues to show a resilient labor market as a theme.
The story of the labor market is that we're in a quiet period. How long that quiet period lasts is undetermined.
Last month for payrolls was an anomaly. We got to make sure we're still on a really good track here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend, live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now as we come into Payrolls Friday after snapping a 4-day winning streak on the S&P 500. Your equity market is shaping up as follows. Equity futures on the S&P negative by 0.1%. On the NASDAQ,
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York, this is Bloomberg Technology. Coming up, TikTok still faces an ousting in the United States after a DC appeals court upholds the divest or ban law. Plus, more VC voices in the new administration as Donald Trump selects venture capitalist David Sachs to serve as his AI and crypto czar. And HPE reaches a record high after posting earnings. We talk AI servers with the company's CEO, but first, we check in on the markets and other record highs than just HPE. We have the NASDAQ 100 at a new record, up 0.7%. The macro picture being that of a resilient jobs market. And even though there's still some inflationary pressure, the market almost pricing in some sort of rate cut for later this month coming from the Fed. So we see stocks move higher. The S&P at a new record too, 57th that we'd see, up almost 30% year to date. In terms of points contributors, you're looking at Broadcom doing well, also Meta as well, which we'll dig into in a moment. And that's all because of TikTok's Chinese parent company, ByteDance, still facing that ban here in the United States. But doesn't meet the January 19th deadline to divest TikTok. This after a federal appeals court just came out with its decision to uphold the ban. Bloomberg's Alexandra Levine joins us now, who covers all things social, all things TikTok, and you aren't surprised ultimately by this ruling.
This is what we expected, but it still is very surprising in the sense that we've never seen this happen in the United States before. So if this ban comes to pass late in January, it will be the first time that any foreign-owned social media app has ever been banned in this country. And again, it's not just any social media app. This is a social media app used by more than half the American population.
And backed by some very powerful people, potentially close to the next administration, venture capitalists, PE funds. But what's interesting is what's the effect this is having on the company itself?
Yeah, inside the company, I think the sentiment has been fascinating. It's sort of been twofold. I think there's a lot of folks inside the company who had been more actually scared the first time that this happened with Trump's first administration, when Trump was originally the one who tried to ban it back in 2020 unsuccessfully. So that then, when all of this has been transpiring this year, you had a lot of people who were like, we've seen this movie before. This is sort of Boy Who Cried Wolf. They didn't actually believe it would come to this. But I think the court upholding the legitimacy of the law today could well change people's tune.
Just for our audience, we have a little live fire drill going on here in Lexington Avenue, New York. So bear with us when we have some of these particular announcements coming through the camera. Alexandra Levine, we thank you so much on all things TikTok. Let's go to Bloomberg Intelligence analyst Matthew Schuttenhelm for more, who I'm pleased to say isn't sat in New York, so we won't get the sort of interference from a noise perspective. Matthew, from the legal perspective here, what was the ruling from the judges? Ultimately, they think that national security out-trumps, to pardon the pun, what's happening from a freedom of speech perspective.
That's exactly right, Caroline. Looking quickly at the 65-page opinion, this looks like a sweeping loss for TikTok, where the court completely rejected its First Amendment argument and said that national security concerns trump all of those complaints. The court said that this fails both intermediate scrutiny and even strict scrutiny, which almost never works. But the court said, look, the government's interest in national security trumps the First Amendment concerns, no matter what the test is. This is a tough loss for TikTok, and I think it's going to be difficult for TikTok to overturn it.
To that point, you had, a 70% chance that TikTok would lose on this particular DC court. Their only inning here now is to go to the Supreme Court. What are your probabilities on that, or is it too early to tell?
No, I think that is going to be the option. In theory, they could ask for rehearing at this appeals court, but this decision leaves little hope of that. So I think you're right that the next move is an emergency petition to the Supreme Court to say, justices, hit pause on this January 19th date. This is an important First Amendment case. As Alexandra said, this is sort of novel in American law. And so trying to entice the justices to at least look at it before the date comes up. The thing is, it's difficult to do that, though. It takes 5 justices to vote in support of that. And with this sweeping decision, 2 of the 3 judges who wrote this decision are Republican appointed. One of them is President Trump appointed. And this Supreme Court tends to agree with those judges. I think there's a real possibility the Supreme Court looks at this and says, you know what, the DC Circuit got it right. We might not even need to take this up. So there's a chance of that they hit pause and the Supreme Court has to rule on it. But there's also, I think, a better chance the Supreme Court says, no, they got it right. This case is over. Let the ban take effect.
What then, legally speaking, does TikTok do? What does ByteDance do?
Yes. So the question then is, will it do a divestiture? You know, the law gives it a path around an effective ban by selling the service to someone who's not located in China. The problem is that China has said it won't approve a sale of the algorithm. So TikTok's in a bit of a tough spot in that sense. The other big question is, what will President Trump do with this? Will he enforce this law? The enforcement mechanism is the Department of Justice here. And President Trump, in theory, could direct his Department of Justice to say, don't worry about enforcing that one. That would be highly unusual. And the companies that host TikTok would be taking enormous risk. He wouldn't change his mind, but it's at least a possibility.
We don't rule out anything, of course, for the future. And I am interested as to whether you know from behind the scenes, ultimately, what it could look like if they did divest, and legally speaking, how that might have to ultimately look.
Yeah, I mean, there's a big question. I think the biggest question around the divestiture is whether TikTok would, or potential buyers would, look at a transaction that doesn't involve the algorithm. And if China won't approve a sale of the algorithm, maybe you're looking at selling, just the users and the platform, but without the secret sauce that makes it work. And so I think you could see the company exploring those sorts of alternatives in the near term.
We will await to see whether indeed it does get pushed onto the Supreme Court. But can you give us a feeling of timing here, Matthew? January the 19th feels incredibly close now. It is one day before the new administration is sworn in. Here we go with the fire alarms again. But what are you thinking in terms of just an extension past January 19th?
Exactly. So what I expect we'll see here in maybe today, maybe in a matter of days, is this emergency petition to the Supreme Court asking the justices to hit pause on that January 19th date. And I think the Supreme Court will take that petition. It will ask for briefs on that leading into January. And then the Supreme Court is either going to say yes or no, probably in mid-January, about whether it will grant this case, take the case, and hit pause on that January 19th date. So that's where the legal action is likely to be in this pushing the justices to hit pause on that January 19th date. And as I said, I kind of think that the justices might say, no, we don't need to step in here. Let's let the law take effect. The DC Circuit got it right.
And then it's over to Trump and the new administration. Matthew Shedenholm.
Right.
Fascinating. You called it right this time. We'll check in with you later. Meanwhile, here's another Trump pick. David Sachs as White House AI and crypto czar. Trump posting on Truth Social that the venture capitalist will, quote, guide policy for the administration in artificial intelligence and cryptocurrency, two areas critical to the future of American competitiveness. Bloomberg's Katie Roof helps cover all things venture. And once again, we have another venture capitalist, other than, of course, we have who's the deputy, the vice president-elect as well, being one. David Sachs has been close to Trump of late. Can you just tell us how we got here?
Sure. He was a big fundraiser for the presidential campaign, and he's also quite close to J.D. Vance, the vice president-elect. David Sachs was hosting fundraisers and also getting other Silicon Valley supporters to come on board and support Trump. So it's not surprising that there's some sort of role or partnership here.
And indeed, not a full at the seat role in politics that means he has to step away from Craft Ventures. We know that he has sort of ultimately focused there because he's got a key man risk. His venture capital history is extraordinary. He's been in the angel rounds of Facebook, now Meta, in Palantir, in some of the most successful exits that we've seen coming out of Silicon Valley. He built his own company that was exited to Microsoft, earning him $1.2 billion, well, earning at least the sale price of $1.2 billion. How intimately is he interweaved within AI and crypto? Because he has BitGo, Bitwise, Lightning Labs, for example, within his portfolio.
Sure, there's already questions where people are asking, does he have a conflict of interest here? But given that this is a less formal role, it's unclear if there's any roadblocks there. He's, certainly, very much a part of the ecosystem. He has a popular All-In podcast that many people in Silicon Valley and beyond listen to, but I would see this as a sign of deregulation. He is definitely very tech friendly, with crypto and AI. He is going to want to make moves to prevent anything that is obstructing the growth of these technology companies.
Katie Roof, we thank you. All in on the all-in announcement. Meanwhile, coming up, HPE reported a better than expected fourth quarter. AI driving strong sales for its servers. We speak with the CEO, Antonio Neri. That's next. This is Bloomberg Technology. HPE reporting strong fourth quarter results. Seeing shares at a new record high. It's all around the sales strength that we're seeing for servers to power AI workloads. How resilient is that? Let's ask Antonio Neri, HPE CEO. So what's interesting about the AI server business was that it's still growing fast, but is it cooled sequentially? Are you feeling confident about the purchases here?
Well, good morning, Caroline. Thank you for having me today. We had an exceptional quarter, and obviously one of the flagship elements of that quarter was AI. But I have to say it was more than AI. It was also a hybrid cloud business exceptionally well. And the server in general, because ultimately we have growth both on the traditional CPU and obviously on the AI side. But on the AI, demand continued to be very, very strong. As of today, we have more than $3.5 billion in backlog. That shows the momentum that's there in the market. Now we're seeing a significant uptick in the pipeline in enterprise AI, but in total, we have a pipeline that's a multiple of the backlog. So as we go into 2025, obviously there is a transition to the direct liquid cooled set of technologies with Blackwell and Grace Blackwell. And as you know, 2 months ago, we announced a new architecture, which is 100% fanless direct liquid cooling, is the industry first. And more than one third of that $3.5 billion backlog is already on Blackwell. So we expect continued growth as we go into 25.
How are those Blackwell shipments looking? How certain?
Well, it definitely is all very consistent to what we have seen. The number of customers continue to grow. The demand across 4 different segments continue to be very solid. When I think about AI, I think about 4 distinct segments. I call it the model builders and the hyperscalers, then the tier 2, tier 3 service providers, the sovereign, which is growing very rapidly in terms of interest, and the sales cycles are a little bit longer there, but you're talking about large-scale deployment, and we are in the process to building in the UK, the UK Bristol AI Cloud, and in Japan, the AI ST, and then the enterprise, which obviously the order value is significantly lower, but the number of transactions is significantly higher.
But the supply side has been the issue with Blackwell in particular. How swiftly are those shipments arriving? How on track do you now feel it is?
Yeah, I will say, the supply will come in due time because of the transition that Jensen and team are driving. I will not say it's problematic. It's just the transition in the early part of 2025. Today, we continue to ship, H100s and the H200s. But as I said earlier, Caroline, we already have more than one third of that, more than $3.5 billion already in Blackwell. And a lot of that has to do with companies that lead with that technology because they want to get better performance, better energy density, and ultimately lower the cost per training.
You were really interesting articulating just the breadth of demand coming from there, mentioning sovereign as well as enterprise, for example. How resilient is that demand? What's interesting about your backlog, which you say is very resilient and strong, but there was a $700 million debooking. How confident are you in some of these purchases, in some of these deals that have been signed?
Yeah. So in our current more than $3.5 billion, we're very, very confident. In Q4, we booked $1.2 billion of new orders. And we decided to book a specific orders because we had specific concerns about the risk associated with that order. And we have very, very strong controls in place. And we felt that because of the risk associated with even the financing side, we felt this was not worth the headache. And honestly, we decided to focus on the number of growing customers we have and allocate the supply to the customers. So that's why we decided to debook that specific order, Caroline.
You're also doing deals, of course. We are hearing confidence on Juniper Networks acquisition for the early 2025. Is that just going to sail through DOJ, do you expect, with the next administration?
Yeah. Well, first of all, we have received pretty much all the approvals around the world with, what I call unconditional support. Basically, it tells you that the rest of the world sees this pro-competitive. And with the DOJ, we have had a very collaborative process throughout the last several months. And we expect the transaction to close in the early part of 2025, which still is within the original timelines we stated when I announced the deal on January 10th, which was end of calendar 2024 or end of calendar 2025. And so nothing gives me pause that will not be the case. And then in addition, for the United States, this is good, not just pro-competitive, but also for U.S. national security, because ultimately the combination of Juniper and HP provides a better ability for us to compete outside the United States, particularly when you have Chinese competitors around the globe. And remember, Carol, that for the United States, we provide the largest supercomputers that are doing also AI, and that requires a lot of networking. And today, Hewlett Packard Enterprise owns 7 of the top 10 supercomputers. Number 1, number 2, and number 3 are HP systems.
Well, being reflected in a new record high on the share price, and Morgan Stanley sounding very upbeat about eventually what Juniper does in terms of accretion. We thank you, Antonio Neri, CHPE CEO today. Meanwhile, coming up, US hiring picked up in November, adding 227,000 jobs. We've discussed the resilience in the tech sector, what it means in terms of impact. Meanwhile, just reflecting on a couple of stories out of France today. Ubisoft, up 12, let's call it 13%. This as we get an articulation of potentially what some sort of management buyout could be looking like. The Guillemot family holding talks with Tencent, as has been reported by Reuters and other investors. We're up 13% there, and boy, are we down on Atos. Look, we're basically nil point, 98% lower that you're seeing for a price point on Atos stock. This as we are expecting the subscription price of its recent rights offering sinking, ultimately coming to a very low number, stocking trading, as you see, at zero. This is Bloomberg Technology.
Our initial vision is to build a smart city that changes how people think about urban living. We always think to push the boundaries, how we can shape our future.
Time now for Talking Tech. First up, NASA hasn't landed on the moon in 50 years. The next one now won't happen until at least 2027. The newly announced delays come as engineers race to fix a crucial safety issue related to hardware. Now, the agency also announced it will delay a moon flyby until 2026. The scheduling setbacks are the latest in a program plagued by spacecraft cost overruns and technical hurdles. Meanwhile, Uber launching its first robo-taxi service in Abu Dhabi, making good on a partnership struck with Chinese vehicle partner WeRide. Customers are able to request autonomous vehicles around key tourist areas in the UAE, and Uber expects to fully launch its driverless service in 2025. And the dramatic events in South Korea this week has catapulted a year-old movie to the top of the Netflix chart. The film 12/12 The Day became the #1 Korean film streamed since South Korean President Yoon Suk-yeol stunned the nation by imposing martial law. The 2023 blockbuster depicts the events surrounding a coup in 1979. Now, there have been some big market moves today, and in large part, it's on the back of US jobs data. November payrolls coming in strong, 227,000 added, but we want to get the tech perspective. Sarah Franklin, Lattice CEO, joins us now. And Sarah, we are fascinated by ultimately how resilient this US jobs data looks and how that resilience is potentially being borne out in tech, is it?
So what you're saying is true. We're seeing this resilience, we're seeing predictability, and we're seeing balance in the data. And we're seeing incredible time in tech, not just with the jobs report and the 227,000 jobs, but also with a new entrant to the labor force with digital labor.
Let's just talk about how augmenting digital labor is or not. It's interesting, your alma mater, Salesforce, coming out saying they're going to be reallocating 1,000 workers to be going out and selling their agent force. How much are we having to see people work in tandem with the growth of generative AI?
You're definitely seeing this new world where AI is working together with humans and where people are successful working together with AI technology. And every CEO is looking to the future and saying, how do I reshape my workforce? How do I bring AI in to help us be more productive, more efficient from the public to the private sector?
Okay, so where are some of the worries that are still overhanging in CEOs? It does seem to be this disconnect that we've got all of these generative AI tools fit for use to buoy our productivity, but actually a lot of the workforce are either scared to use it because they think they'll be deemed lazy or indeed just aren't getting the training. Is that starting to change?
So AI literacy and AI proficiency are more important than ever. And yes, every CEO is saying, how do I bring my workforce along, my people along, to skill them, to train them, to make them proficient, not just literate, but proficient in these technologies. It's critical for every job function, whether you're doing customer service, sales, accounting, data operations. AI is a part of everyone's jobs. And so the skilling and the training is hand in hand with the implementation of the technology.
I ask it, I'm sure each time you're on, but I ask it again, is it affecting the number of people that companies can have?
So there's definitely efficiency gains that we'll see, and companies are looking to have a way to scale their workforce in ways that meets their needs. And so we're going to see shifts in the labor, and jobs will change. Some jobs will be created, some jobs may go away, but the future is one where AI and digital labor is here. The reports coming out of Deloitte say that a quarter of enterprises next year are going to be deploying digital agents. And so it's important that everybody learn this technology, and every CEO is looking how they shape their workforce with both people and with the new digital labor entrants.
Lattice, #1 AI-powered people platform. Someone to listen to, Sarah Franklin. Thank you so much, Lattice, CEO there on jobs in tandem with AI. Meanwhile, coming up, data management company Rubrik. It beats earnings estimates. CEO Bipul Sinha is going to be joining us. What's driving that demand? This is Bloomberg Technology. Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York, and in New York, markets are trading in a new record high. NASDAQ 100 continues to grind higher, up 3% over the course of the last 5 trading days. Today, the moon music continues to the upside because of jobs data looking resilient, but not too hot to cause unnerve to any fulfilling of a Fed rate cut outlook. We're currently up, as you see, 3.1% on the 5 days. Where has crypto gone over the last 5 days? It has been a volatile ride, at one point eclipsing $103,000. We're still up 1.4% for the last 5 trading days. We're currently back at 99,178, as we call it, just inching higher on the day. We're basically stabilizing after what had been a bit of a pullback after reaching that psychologically important number. Let's dig into that number and into what else is riding behind it. Isabel Lee joins us. What's interesting, of course, we get the new crypto czar, crypto and AI czar, David Sachs coming in. That's going to be yet more positive moon music around crypto. It was the SEC announcement. What else caught your attention?
That everything is aligning. The stars are aligning for the crypto space. Everything is just, nothing can beat it. It's like the perfect holiday for them. We have Bitcoin soaring, but we have bearish wagers actually taking up. Of course, investors are taking back their profits. I mean, who wouldn't, especially if you put in a lot of bet. But I want to bring your attention to the Bitcoin ETF. BlackRock's IBIT is the 5th most active ETF option underlying. When it approved options just less than a month ago, it now is the 5th most active according to ASIM. So that's really impressive because it's only behind the biggest ETFs from SPY to QQQ to TLT. And it's the most successful ETF so far. It officially hit 50 billion. So you really see institutional demand going into that. We have Wall Street investors are not scared anymore of Bitcoin ETFs.
Well, they're not scared of really quite leverage plays as well. People getting into MicroStrategy, playing the volatility around it. We dug into that. Where are we starting to see other areas of growth from institutional and retail?
So that's what we're not seeing yet for the altcoin ETF. So we have Ether ETF. It debuted mid this year, and it really saw kind of lame inflows. But when Trump was elected as president, that's when it saw massive inflows. So now we have a lot of pending ETFs from XRP to Solana, 4th and 5th largest altcoins. So it remains to be seen whether we will see inflows for them. But judging by Ether, such a promising start, but with the Trump presidency and, to your point, David Sachs and the new SEC pick, maybe investors will pile into those ETFs.
And what's interesting is, of course, this is becoming so much more of a macro picture now. This is an asset class that people do feel that they almost ought to have exposure to, not should do as a risky propensity.
At least for Bitcoin, because if you talk to my mother or anyone who is like Gen Z or whatever label of generation you have, digital gold they get, finance supply they get, inflation hedge they get, but how do you sell Ether, XRP, Solana? So those are a bit more complex, but you're right. Bitcoin at least now is becoming a little bit more mainstream. It's easier to accept, easier to digest. BlackRock Investment Institute, in fact, in their 2025 outlook, included Bitcoin for the first time. They said it's a great diversifier because of the erratic stock-bond relationship. So it's getting there. Conversation is moving into crypto for now.
I literally was at the station yesterday and 2 police officers were telling each other how they were in Bitcoin and how it was going to go higher. So there we have it, everyone. Well, Lee, thank you so much on all things crypto. Let's turn from crypto to data security now, because data security software firm Rubrik's come out with its company beat earnings expectations boosted its full year revenue guidance. You can see the market reaction, extraordinary, up 34% on the day. And of course, that's a record high. Let's talk to Rubrik CEO and co-founder, Bipul Sinha. I mean, congrats on the numbers. Analysts really liking what you've been able to show in terms of cross-selling here. That many saying, look, you're the only game in town when it comes to cyber and data security. How are you seeing in your clients pick up?
Thanks, Caroline. We had another outstanding quarter, and we are very pleased to not only have a strong growth at this scale, top line, but we also improved profitability and generated free cash flow. So exciting time for us. What is fueling Rubrik's demand is really this realization that folks have spent a lot of dollars in stopping attacks across network, endpoint, cloud, but you can't stop the unstoppable. You need to have a resilience strategy to ensure that when the inevitable breach happens, you can still run your business. The kids can go to school because schools are open, hospitals can admit patients, and confronted with cyber attack. And that's what is fueling our demand.
It's interesting today, a really well-read story on Bloomberg by Ryan Gallagher is all about ransomware gangs really targeting not just really big institutions, but smaller, medium-sized enterprises. And when you got ransomware attacks up 70% in 2023, what is the outlook for everyone having to adopt some sort of protection here, Rubrik?
Ransomware continues to be a huge problem because that's a monetizable way for cyber gangs and criminals to actually make use of cyber attack. So the issue is, who are they targeting? And they are targeting the weakest link, which is our local governments, local schools. They are targeting the hospitals and other healthcare institutions because these organizations are not protected properly. If you just think about healthcare, there is so much sensitive data in healthcare, 3 times more sensitive data than average enterprise. And the amount of digital transformation that is happening in the healthcare space to reduce the cost of healthcare, to deliver better services, it's creating more surface area of attack.
Yeah.
And as a result, we are focused on really protecting the unprotected.
We're just going to break some news. Hold on for a minute, people, but we have news out of our own Mark Gurman regarding Apple with us. Breaking news that Apple is preparing, in fact, to finally bring one of its most ambitious projects to market, basically the cellular modem chips that we've been hearing about that's going to replace components for its partner, but also basically, let's call it its adversary, Qualcomm. Qualcomm off by a percentage point, Apple up 0.3%, more than half a decade, more than 5 years. They've really been focused on this in-house modem system, and it's going to be debuting next spring, according to people familiar. We will bring you more on that story, but let's just get back to Bipul of Rubrik, because we were just talking about how the expansionary nature of these attacks, ransomware attacks, unfortunately. Can you paint the picture of what it looks like going into a next administration, 2025? Are we likely to see in any way the narrative there change around data protection, data security, cybersecurity?
The next administration will be America First administration, and that will actually spur more industrial espionage, more cyber warfare, more cyber activities, both insider attack, cyber attack. And so we believe that as we are digitizing faster, and the next administration will be quite business-focused administration. So we believe that the outlook for cybersecurity is obviously grim, and we are ready and prepared to help businesses protect themselves as they expand internationally, as they expand their business, as they create more digital transformation. Our goal is to help every business confidently transform themselves digitally without worrying about how they can keep their services up and running.
We haven't mentioned Gen AI yet. How much are you having to reference it to your clients?
Look, Gen AI is a big driver to our business because Gen AI applications are actually data hungry, and they're pulling data from all the nooks and crannies of business applications into a centralized place and ensuring that that data doesn't fall into the wrong hand who uses the Gen AI applications. You don't want salespeople in a hospital to have access to the patient record. And this is where we are focused on really delivering data security, ensuring that the Gen AI applications are trusted and responsible.
Rubrik soaring 34% on the back of your numbers today. Great to have some time. Rubrik CEO. Now, more earnings coming up. DocuSign is going to be joining us. That's next after the firm also beats expectations on its earnings. This is Bloomberg Technology. Electronic signature software company DocuSign, its third quarter numbers really did beat expectations. The company is boosting its revenue forecast for the full year as well. We're up again 25% on this particular company. Let's have a talk about it with the DocuSign CEO, Alan Tigerson, who ultimately is displaying what seems to be a that is not just coming from early contract renewal, but also new products that you're offering. How much are they to be said for the galvanization and growth?
Yeah, well, first of all, it was a quarter for us. I think we beat on all the metrics and we're able to raise for the full year. And that was really a reflection of strength across the board. So in our existing business, the signature business, everyone knows well, we significantly improved retention and reduced churn. We've grown our channels from being predominantly direct sales to now also having a very strong digital channel and building out our partner channel. And then, as you mentioned, our new products, which we launched at the end of May to a limited distribution to mid-sized customers in North America, started contributing this quarter as well. So it's still early, but I think DocuSign's on a very positive trajectory of rejuvenation.
Rejuvenation. Let's talk about that, because the acceleration in billings are basically coming from a very depressed level. And everyone is saying that this is really encouraging. But when I look at Piper Sandler in particular, they're sort of waiting for really the new solutions, the new offerings to make meaningful difference to your revenue. When will that happen? Will it happen?
Yeah, well, look, it's a journey, and we're working on that. Our goal is to return to double-digit growth. We're not putting a particular timeline on that, but as we roll out these new products across more geographies and segments, we just launched around the world here about a month ago, and just started shipping to enterprise rollouts, departmental level rollouts in enterprises. So we're still adding customer segments and geographies, and as that impacts more and more of our book, we can drive more growth. And of course, any continued improvement in our core business also helps. And so you're starting to see some early signs of that. We got more work to do, but it's very encouraging, the progress that we're making.
You've got some more convincing to do, because when I'm looking at the Bloomberg terminal, it points out what the revenue expectations are for your business going out to 2027. I'm afraid we're staying in single digits for all of those expectations out as far as we go. What do you think really catalyzes back to, I'm not saying the 40% increase in revenue we used to be having in 2021, 22, but at least the double digit? What gets you there, Dan?
Yeah, I think we get there through the combination of continued improvement and retention in our core, and then the full rollout and adoption of our new products we call it Intelligent Agreement Management. It's a much broader value proposition than DocuSign has had historically. It's a true C-suite sell. It's across the entire enterprise, and we have, I think, tremendous greenfield opportunity. Are in the best position to really help transform how agreements get done. That's our opportunity. As we execute on that, then we can deliver on that growth opportunity.
You've got about 1 billion users, 1.5 million customers. What sort of numbers do you end up getting to, do you think?
Well, so we already, as you mentioned, over 1 billion signers. I'm sure we will add more signers, but we got a lot of people who are already used to signing DocuSign documents. And from a customer perspective, we're adding about 10%, growing our customer base 10% year over year, every quarter. But those tend to be smaller customers. We are already present in most large companies in the world. I believe over 85% of the Fortune 500 are already DocuSign customers. So our opportunity is more adding breadth, basically cross-selling and upselling our new broader solutions into clients that are already generally happy customers of DocuSign. So that's a fantastic starting point.
Where's the competition for you? Who do you pit yourself most often up against?
Yeah, historically, we've had some competition in the electronic signature space. We're by far the market leader. I think the preferred branded solution, but we have some lower price competition there. I think increasingly as we move into this broader agreement management space, those competitive dynamics change. And as I mentioned, we believe that's mostly open field running, and we're the first to, I think, articulate this broader vision and execute on it. So if we can keep that going, I think we're in a very good position competitively.
And just give us a bird's eye perspective. When you're in 180 countries, where is growing most geographically? How resilient does the US look when we're entering a new administration?
Yeah, well, the U.S. economy has been the strongest of the major developed markets, and so we're certainly benefiting from that. On the other hand, the U.S. is also the furthest along in the adoption of electronic signature, which still remains the bulk of our revenue, whereas some other major markets, for example, Germany and Japan, are a much earlier state of adopting various forms of electronic contracting. So we have a lot of growth opportunity there. We're growing faster, infinitely faster outside the U.S. Than we are in the U.S., and I think that will continue to be the case for years to come.
DocuSign CEO Alan Thygesen, it's great having some time with you. Congratulations on the share pop on the numbers. We appreciate your time. Meanwhile, coming up, Elon Musk's AI startup XAI nabs a more than $40 billion valuation. Details next on its fundraise. This is Bloomberg Technology.
Architecture is about creating movement and motion. There's a huge community that is working together to bring it further. AI technology is evolving every day, unlocking the new possibilities.
Meta AI. You using it? Probably, because 600 million people are using it every single month. Meta platforms at a new record high. Also on the back of the TikTok news, of course, that TikTok's ban or divest will continue to January the 19th and maybe gets pushed over to the Supreme Court, but the Washington court upholds it. But also happening with Meta now is the CEO, Mark Zuckerberg, saying in a post on Threads, the company is releasing its Llama 3.3 70 billion text model, saying it performs similarly to previous models. And the CEO is also noting that Meta AI has nearly 600 million monthly active users as it interweaves generative AI across its entire product range. We'll delve into generative AI and the competition there right now, because Elon Musk's XAI has raised $6 billion in new capital, wrapping up a funding round that has been in the works for basically months now. It was said to value the AI startup at about $40 billion. This is all according to a regulatory filing, which indicates the equity financing came from some 97 investors who were not named. Bloomberg's Kurt Wagner has been going through those details. And XAI is more about the generative AI models being built, large language models, and plenty more. What is he using the money for?
Yeah, a big portion of this money is expected to go towards this supercomputer that XAI has been building in Memphis, Tennessee. You may remember, I believe they announced it over the summer, the idea that this would be possibly the largest supercomputer in the world, with tens of thousands of NVIDIA chips all sort of running at the same time. So that's obviously a very expensive project. It's a very, ambitious project. And so that sort of explains why Elon Musk not only raised $6 billion here for XAI in the filing that we just saw yesterday, but also $6 billion additional dollars in funding back in May, right? So this is $12 billion that has been raised just in the last 6 months or so.
And we know who previous investors have been. I mean, one of them is now the AI and crypto czar to the next administration. Right. David Sachs has been putting money into XAI and every other Elon Musk business, really. But who else has previously wanted to write checks to this company?
Yeah, we see a similar roster almost every time Elon goes out to raise money. Andreessen Horowitz, Sequoia Capital, Valor Equity. These are the sort of, the continuous or regular investors in Elon's businesses, not just XAI, but also X, formerly Twitter, SpaceX, Tesla, right? So we see the same names kind of crop up every time. We don't know exactly who's in this latest round, but you can bet that it's most likely the same names we see regularly with him. And
what's been so interesting to understand what XAI means to the rest of the businesses, because we have at one point concerns that some of the GPUs, or at least spending that was heading towards Tesla, was being pinched over to XAI. But then you have perhaps how much AI is going to help Tesla's business model? How much it's going to continue to innovate on Grok, for example?
Yeah, this is sort of the thorny world in which Elon operates with all of his businesses, right? Where he tends to borrow resources from one company to help another company. In this case, he's talked about, obviously X and all the posts that are showing up on X as being the data that's powering XAI and the chatbot Grok that they built. He's talked about using XAI with Tesla and maybe even investing in XAI via Tesla. So, his universe, as you know, Caroline, it's just everything kind of blurs together. And so we're seeing this as sort of the AI layer for, I think, a bunch of his companies. And I think the more funding they get, especially from investors who are already invested in the other businesses, you'll see this continue, this kind of connection between XAI and everything else in Musk's empire.
And meanwhile, let's just talk about the ecosystem that surrounds it, because we've had Sam Altman on stage at the DealBook conference this week talking about how he's not too worried or perturbed about Elon Musk hitting in on OpenAI's future success. But what about, we've got Meta just announcing how many people are using their generative AI products across the whole gamut of their product offering. Where are people going at the moment for generative AI offerings more broadly?
Yeah, I think ChatGPT from OpenAI still sort of is maybe the first thing that comes to mind when people think about this. It's probably the most well-known. But Meta, as you point out, they just had an announcement literally a few minutes ago, 600 million monthly users of their Meta AI bot. Now, they benefit from the fact that they put that bot into Instagram and Facebook and WhatsApp. So they're reaching, billions of people just by putting the product in something that they are already using. But I do think that, we're getting to this place where there's going to be a couple winners or a couple, companies kind of coming out in front. I think ChatGPT, Meta AI, and then Grok obviously is built into X. So those are the three that come to mind for me when I think of these generative AI bots.
Co-Wagner across the space. We appreciate it. And look, let's just dig a little bit more into these models, because the tech industry has kind of been hitting a bit of a wall when it comes to building better generative AI models. Bloomberg's Shirin Ghaffari has been writing about this, your latest newsletter, Q&AI. What's interesting is Mark Zuckerberg just releases Llama 3.3, and he's, seeing it as the next base model. How have people been hitting up against improvements here, though?
So here's the thing. AI is certainly getting better, but we have to think about the kind of bold bets and predictions that the leaders of these AI companies are making, which is that we are going to reach some kind of all-knowing, very powerful, matching or surpassing human intelligence level AI in the next few years. And so that is the kind of intense race that these companies are going against right now. And that is why there are some kind of missed expectations around the pace of which they'll be able to actually deliver on that.
But Sam Altman this week, just briefly saying 2025, right?
That's right. And, again, we are seeing progress, but by now some people were hoping, we haven't yet seen a GPT-5 level model. We haven't yet seen the next big model from Anthropic. So that's what sort of the end goal is.
Go read your newsletter. Shirin Ghaffari, thanks for joining us today. That does it for this edition of Bloomberg Technology. Don't forget to check out our podcast. Find it on the terminal, as well as online on Apple, Spotify, and iHeart.
Our initial vision is to build a smart city that changes how people think about urban living. We always think to push the boundaries, how we can shape our future.
Futures turn higher after the jobs number beats. 30 minutes until the start of trading. I'm Matt Miller.
I'm Shonali Bassett.
And I'm
the market. So we do hope that we'll see some additional rallying in 25.
So Nina, I know you can't predict rates, but is there any type of floor, any type of ceiling, especially when we consider factors like the Federal Reserve? There could be a higher for longer policy stance from the Fed, along with the incoming Trump administration. If there's any policy changes that we could see there, what are you looking at?
Well, we're looking at everything that is coming out right now. A lot of the economic indicators around unemployment and inflation, that even just today's job support. But we are not opining on any specific policies. Our key here is to remain available for customers who are looking to get into a home buying situation or they're looking to refinance. And right now, affordability is a challenge for many customers. And so we're very focused on making sure that we can help alleviate some of those challenges and also educate customers, make sure they're financially prepared to enter the home buying market if they choose to do that.
I mentioned the Trump campaign, and we know that one of his campaign promises has been mass deportations. What's the pull-through impact that could have on the housing market, especially when we think about things like the construction labor force?
I think our main focus is on making sure that home buyers can be prepared to get into the market when they're ready. We're not really focused on any specific policies, but again, our focus has been to work very closely with every single administration and to make the goal and the dream of homeownership a reality for as many customers as possible. We really just want to make sure that customers can enter the market when they're ready, and that things like home buyer grants and assistance programs are available for customers who are looking to alleviate the cost of homeownership.
In the current market, it's often been categorized as locked in, priced out. In other words, people aren't leaving their homes because they're locked into these ultra low mortgage rates, and that's pushing up the prices of these homes, which has led to the affordability crisis. So how can that supply and demand story change? Is it more buyers coming into the market? How are you looking at the different housing dynamics?
Here's how we're thinking about it. Obviously, with the recent rallying in September and October, and the Fed cutting their rate by about 50 basis points, that created some alleviation in the refinance rates and also purchase rates, and we saw some good momentum in that period of time, and that helped to open up this sort of equation for customers looking to enter, as well as customers looking to refinance. So we would expect that as customers continue to get more comfortable with more elevated rates, that they may be willing to get out of the lock-in effect that you mentioned, Alexandra, that if they're sitting on an ultra low rate, that they may be willing to try that for a higher rate in order to be able to move and switch into a different home. That will then create more inventory and more opportunities for prospective home buyers to get into the market. But a lot of this will generally be very rate driven into the next year.
I'll see how things change in 2025. Nina Gidwani, thank you so much for your insights.
Thank you.
Well, from one house to another, we're talking about the moving business. Piece of Cake is a New York-based moving company founded in 2018. The company moves people across all 50 states, bringing in more than $100 million in revenue last year. The founder and CEO of Piece of Cake, Vojo Popovic, joins me now. And Vojo, what made you want to start a moving company? Because it's very labor intensive, especially in New York City, can be very saturated, not a ton of innovation. So what gravitated you towards this line of work and really this service?
Sure. Thanks for having me, first of all. So I started working in the industry at a very young age, at the age of 21. And after a few years moving in different roles and working in the industry, I figured it was very outdated and it hadn't been modernized to meet today's customer. And I saw there was plenty of room for improvement. And I always wanted to run my own business. And that created kind of a perfect opportunity for me.
So how have you modernized this business?
So it sounds simple, but it's essentially simple, but it's all in execution. So we focus heavily on customers' experience throughout the whole moving journey. So we went to create a Michelin star moving experience. And so we do that by focusing on every touch point a client has with Piece of Cake. So for example, from a moment a client calls, they will be assigned a personal consultant who will be with them throughout their whole moving journey. So a client always has a live person to talk to text to email to. And another thing that we do is, and we call it internally a matchmaking between a crew and a customer, is we try and figure out where in life is that customer. Are they upgrading, downsizing? Are the students moving into the their first home or a family moving out of town. And then we would try and match and kind of pair pace and energy of the crew with the customer to provide the most personalized moving experience.
Yeah, it feels very personalized. And I mentioned how successful your company has been in terms of the revenue growth, $100 million in 2023. That's up from $900,000 in revenue in 2018. What do you credit for that type of rapid success? Is it the marketing? Is it your labor force? What has really driven that for you?
It's definitely a mix of all of that, everything that goes in one company. But number one resource and number one reason we credit that for is definitely our people. So we always we wanted to create a workplace and a moving company that any mover will say this is the best moving company I've ever worked for. So that was for us. It was number one that. People who represent the brand, that they feel they're part of the brand, that they are the brand, and I definitely credit all of our success to our people.
Yeah, and to that point, out of your first 5 employees, 4 are in leadership roles and are in charge of departments now, which is very impressive. Now, you also have received no outside funding, just reinvestments into the business, which was surprising to me. What led you to that decision? Would you ever consider sourcing funding down the line?
So we never taken, as you said, we never taken outside funding. We never considered it. I believe in reinvesting. I believe in keeping customers happy, keeping employees happy, and that will undoubtedly lead to growth and future customer acquisition.
And for other entrepreneurs out there, what lessons can be learned? You had a lot of barriers to entry, right? You came over here at the age of 20, you had no college degree. What would your advice be to those that are starting their own business and maybe feeling discouraged or not sure where to go next?
So the advice, I'm not the one to give advices, but what worked for me is every day you visualize where you want to be, where you want to go, and you put up that vision in front of your mind every single day. And then every decision that you make daily, you put it up that vision and see if it works for that vision or not. And that's how you make decisions. And and stay away from. I always try to stay away from indecision, because any decision is better than indecision.
I like that. Any decision better than no decision. Vojo Popovic, thank you so much. Appreciate your time today.
Thank you for having me.
Of course. Well, if you're looking to start your own business, transition jobs, or even apply to your first ever job, we have you covered with some expert advice. Yahoo Finance spoke with a number of Wall Street leaders at our annual Invest conference last month, and they offered some great insight into what they wish they knew before they started their careers. Take a listen.
The one thing I wish I knew before I started my career is that no career is linear, and each new adventure unlocks and leads you to the next.
I wish I knew how many things that I thought were important when I was younger are actually not important. Don't get hung up on a bunch of small stuff.
If you don't really love what you do, you just can't be successful. It's only if you really enjoy what you're doing are you going to put in the time, the effort, have the curiosity, have the passion to actually do really well in it relative to all the other smart people who are also going to work real hard.
Make sure that you always are seeking more and more opinions from more and more people as you decide to do something. When you're young, you think you know the answers. As you get older, you realize not only do you not know the answers, you better have a lot of people's thoughts about the answers.
It doesn't matter what people think of you. Don't change. Just stay focused, stay centered, and be authentic, and that'll serve you well.
Enjoy the ride. Every single step is going to be meaningful in your life. You don't get them back, so have fun.
We are 2 hours into the trading day, and it is time for Yahoo Finance's Market Minute. The S&P 500 and NASDAQ hitting new highs on a better-than-expected jobs report. The only one in the red. 3 trending headlines we are watching today. Shares of Palantir Technologies getting a lift on a new partnership with defense contractor Booz Allen Hamilton. The deal to drive innovation for the U.S. military expands on an existing agreement between the two companies. Shopify is popping after a Wall Street analyst upgraded its stock, citing the company's use of AI. And Uber's teaming up with Chinese robo-taxi firm WeRide to offer self-driving service in Abu Dhabi. The fully autonomous rides are set to launch next year. That is your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below. More wealth when we return.
retailer originally known for its yoga wear, Lululemon has evolved into a competitor of Nike, Adidas, and many more. But what led to Lululemon's success? Let's dive into the company's biggest moments with Beyond the Ticker. Lululemon was founded in 1998 by Chip Wilson. On July 27, 2007, Lululemon went public via an initial public offering, an IPO, on the NASDAQ at $18 per share. In March 2013, Lululemon recalled 17% of its black yoga pants for being too sheer, which cost it roughly $60 million in lost sales, according to the New York Times. That November, Wilson resigned as chairman following accusations of fat-shaming brand strategies. Wilson previously told Bloomberg TV that issues with his company's leggings were because, quote, some women's bodies don't work for the pants. In June 2020, Lululemon took a chance at home online fitness with the acquisition of Mirror for $500 million and rebranded it as Lululemon Studio. In 2023, the company announced plans to ditch the Mirror fitness hardware with plans to end its classes in 2024. To soften the blow for investors, it signed a 5-year strategic global partnership with Peloton, which would stream its classes on the connected fitness platform and produce and sell Peloton-branded clothes. Lululemon shares soared over 57% in 2023, with the company hitting an all-time high stock price of $511.29 on December 29th. Lululemon continues to expand and compete with the giants of the athletic apparel industry, just this year announcing new footwear offerings, including its first ever men's collection.
The average wealthy American, which according to Charles Schwab is a person who has $1 million or more in investable assets, has about $4 million of value to transfer. But the way they plan to pass that money along often varies by generation. Here with more is Susan Hirschman. She's the Director of Wealth Management at Charles Schwab. And Susan, we often talk about the great wealth transfer on this show, but there are a lot of nuances around it. So I wanted to ask first, what made you want to pursue this as a study? Is this something your clients often ask you about when it comes to planning for this?
Well, in terms of wealth transfer, the great wealth transfer, right, is expected to happen over the next 10 years or so. And so it's a big focus of clients' concerns, as well as the people that are going to be receiving the money's concerns. And educating people on the what, the why, the when, the how is incredibly important to us.
One interesting part of this report, I thought, is the debate about whether or not to pass on wealth when you're still living. So what are those preferences? What are the factors that go into that? And how do we see this split among the different generations?
Yeah, I think that's a fascinating outcome of the studies, is that we saw a difference in generations. So the baby boomers are looking to pass on wealth after they pass, where the millennials and Gen X are looking to pass on wealth during life. And I think a few different factors happen because of a few different factors cause that. And one with the millennials and Gen X is I think they want to experience life, right? And the joy with their kids, as well as when we look at housing costs, right? And you look at how are the millennials doing in terms of outpacing their parents. They're the first generation to be below 50% in terms of outpacing their parents. And so there's help needed to purchase homes and the like.
So that brings me to my next question. What type of wealth is most being transferred? Is it real estate? Is it cash and investable income? Or is it?
Yeah, it's a combination thereof, but real estate is a big portion of people's wealth. So real estate is one aspect, as well as investable assets and the like, yes.
What about something like Bitcoin? It's an asset that we're talking about a lot recently. Is that something that you've seen become more of a wealth transfer question from your clients, or is it still a little too new?
It's a little too new still, and I think it's more, I mean, obviously there were early adopters, but for more of our clients, they tend to be very much goal-based asset allocators looking to achieve their wealth over time. And so the Bitcoin is more of a speculative investment for them. So it doesn't really come into the wealth transfer conversation.
Okay, and for those that are starting this process, is there an ideal time to start it, whether it be age or if you hit a certain amount of wealth, should you start to think about this?
You know, what we saw in the survey was that people begin to talk about this in and around age 45, and when they have $1 million of those investable assets, not considering their IRAs and or their real estate, right? And so that's when they start considering it. However, if you do have kids, right, estate planning should be done before you reach those milestones. But estate planning is about two things. One is about incapacity, and the other is transfer of wealth and to who are you giving those assets to. And so you have to think of both. So it's not just about dying. It is a little bit about disability as well.
Is estate planning an area that sometimes falls through the cracks when it comes to that planning process?
Exactly. And I think a lot of people just put it off because it is an emotional issue. And also making decisions sometimes are hard. And you have to think of family and the dynamics of the family and complications of the family. And sometimes it's best in certain people's minds just to avoid everything. But when you avoid, I always say you leave a legacy of chaos versus a legacy of calm and control.
So if you're in that position where you are ready to do this, you are starting this journey, this process, what are the first steps that you should take?
The first steps is taking an inventory, right? What do I have? What's my balance sheet? What's my income statement look like? And then what do I want? Who do I want to give my assets to? So we always say there's 4 places your money can go. It can go to you, it can go to your family, it can go to charity, or it can go to taxes. And figuring out, usually the taxes is the least, and figuring out which of those 3 quadrants, how you want your money allocated to those, is what you do next.
Well, some great nuggets in this study. Susan Hirschman, thank you so much. Appreciate your time.
Thank you.
Well, we're in the home stretch of 2024, which means now is the time to make sure your finances are set up for the new year. Yahoo Finance's Molly Moorhead has the top 3 most important financial moves you need to make before the year is over. So Molly, what should folks be keeping in mind?
Yeah, there's a lot to do before the end of the year, but I think the 3 most important ones are, first, do a checkup of your budget. Even if you're not somebody who writes down every single purchase you make, it's still a good idea to go in and pull a couple of months worth of bank statements, credit card statements, and make sure those line up with what you're spending and with what you think you're spending. Maybe you took out a couple of new subscriptions, streaming services, gym memberships this year, and you're not aware of a monthly recurring expense. And this is just a way to get that visibility and get on top of what you're actually spending against what you're taking in. The second thing is to shore up your emergency fund. Ideally, you want to have 3 to 6 months worth of expenses set aside in a savings account, money you can easily access. And so let's say that's $5,000 for your household and you only have $2,000 in there. Well, maybe you can't immediately put $3,000 in there. That's when you can go back to your budget and make a plan for the first few months of the year to put a few $100s in that emergency fund to get it up to that healthy level. And then the third thing, this is really calendar dependent, is if you have flexible spending accounts through your employer, these are those pre-tax accounts where you contribute money and you can use it on specific expenses like healthcare or childcare. These accounts are great, but the catch is you have to use the money by the end of the year. If you don't, you forfeit it. So if you've got money left over in an FSA, find some medical receipts, find some daycare receipts, and spend that money and get reimbursed for yourself.
All on my end of year to-do list. Molly Moorhead, thank you so much.
Thanks, Allie.
Much more on wealth after the break. You're watching Yahoo Finance.
On my end of year to-do list, Molly Moorhead, thank you so much. Much more on wealth.
Gak perlu berlebihan buat dapat lebihnya jalan-jalan. Karena cukup dengan Danamon Lebih Pro, kamu bisa punya 9 mata uang dalam satu tabungan. Dan rate falas yang berani diadu. Danamon Lebih Pro emang banyak lebihnya. Buka tabungan Danamon Lebih Pro sekarang.
A programming note on this week's episode of Warrior Money, hosted by former Congressman Patrick Murphy and veteran investor Dan Coons, Edge Runner AI CEO Tyler Saltzman points out the need for VC firms to recruit people with more diverse backgrounds as they seek to enter the defense tech space.
The biggest problem I see with VCs, and I've talked to many of them, is you have these kids with 5 or 6 of real world experience. They get an MBA from Wharton or GSB, and they're now the gatekeeper of a bona fide VC firm. And if they never built anything and they never really had life experiences, how is this person the gatekeeper into a potential a seed round or a Series A? And I think that's very concerning. And I would challenge VCs to look for folks with different types of backgrounds rather than just MBAs. Let's get some military people. Let's get some folks that have actually built things.
You can catch episodes of Warrior Money Fridays at 12:30 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. A Gallup survey this year found 51% of U.S. employees are watching or actively seeking a new job. And 34% of people surveyed said moving away from a bad manager or leader is very important when considering whether to take a new job. Here to discuss the employee-manager dynamic is Jamie Wolf, founder and CEO of Creativity Partners, a firm that helps organizations build healthy workplace cultures. Jamie was also the first director of culture at Pixar Animation Studios. Jamie, thank you so much for joining us in studio. I love this topic because it's one I think most people can relate to. So can you break down the financial impact of having a bad boss, whether it be for the employee, but also for the corporations?
Yeah.
Well, first of all, the problem is massive. If you talk to employees, your average employee, about 75% will say that their boss is the most stressful part of their job, not deadlines, not the work, the boss. So with bad bosses, there's really high turnover, and turnover we know is costly. The recruitment costs, the cost of onboarding, the cost of the downtime when we're replacing the employee. And then there's the healthcare costs. There's a study that shows that if you have a bad boss that causes you stress, you're 60% more likely to have a heart attack or another serious health issue. And not to mention the quiet quitting, so for the time that you're not enjoying this stressful boss, you're at the water cooler spending all your time talking about how much this boss is causing us all stress.
So let's say you do have a bad boss. What can you do to protect yourself, protect your mental health, but also make sure that you are performing and not falling into that quiet quitting trend?
Yeah. Well, it's difficult, and I would say it is a massive mental health crisis. It really is. It's one that we don't talk about, but because it's a mental health problem, find support systems at work. Find people who you could share the perspective with, not in a complaining kind of toxic way, but just people who can support your sense of self-worth. But one of the things that I think people neglect is to just try to give the boss feedback. That's always a good first step, is to say, look, when you shut my idea down, it makes me less likely to bring ideas up to you. And I know you want us to surface problems to you, but when you said to me, well, stop complaining, it makes me feel reluctant to continue to have an open door to you. The other thing is to document the conversation verbatim, not just to create a paper trail, but also just to remind yourself of your self-worth. You're not making this up. There's a pattern that you're now documenting. And the other thing is just to remember you shouldn't have to survive a bad boss.
Right. So with that, is there no other option really than to leave a company? Because I sometimes feel like if people bring it up, there's no immediate changes right away, right? And that could be frustrating, and that can trickle through in your performance at the office. So is that ultimately what you normally see happen?
It just depends, because there's so many kinds of bad bosses. There are bad bosses that you can reform with feedback, for example. So sometimes people complain to their friends, but they haven't even complained to the boss. So that's why I say, see if this boss is reformable. If it's a pattern and it is causing you sleep disruption, stress, there are so many people that I coach who have had really serious health problems. It is time to start writing your resume and get out. But I think there's also options within companies to look for jobs within companies. I don't recommend to people to stay with a boss where you've tried, it hasn't worked, and it just feels like your mental health is deteriorating.
And as a workplace, how do you foster an environment where you don't have negative leadership, that you're supporting your employees?
Yeah. Well, one thing, we work with companies, and so we talk to the executives, stop promoting people who have a reputation of being a jerk. It's just not worth it. You can have bad bosses, you can have good bosses who get quality work, who are exacting, who have high standards, and who elevate and empower people. So you can have both. So start promoting those people and start hiring those people with 360-degree feedback. So, bosses have blind spots. The higher up they go, the more distorted the truth, because people stop telling you the truth and they start nodding their head, laughing at your jokes. And so it's really important to give the feedback and have that be anonymous, and make sure that the company is ensuring there's accountability, that there's action after the 360.
So is that key to keep it anonymous? Because you probably have employees that are scared to speak the truth.
And they are. And so, 360 is suspect, because even if it's anonymous, people are afraid. But that's what I've seen turn things around more than anything, is a good 360 process.
Right, some great advice, Jamie Wolf. Thank you so much. Appreciate your time.
Thank you.
And that's it for Wealth. I'm Alexandra Canal. Thank you so much for watching, and stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern.
Tiada cara.
It's been a year of profound political change in Africa and really the globe.
Nation. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Last month, we said that the hurricanes and the fact that there were tens of thousands of workers on strike affected the number, and this month landed exactly where we expected it to land.
The 800-pound gorilla in the room is technology beginning to create some unemployment. What economists would kindly call technological unemployment. It's what everybody worries about, artificial intelligence. Now, we just don't know, but my gut tells me we're probably on the outer edges of that. And that might be why there's some redundancies out there in the workforce.
TikTok could just become kind of a negotiating ping pong between Trump and China to a certain degree. It could set the tone in terms of how certain digital assets from China are perceived by US capital markets. And TikTok is not just the only one. There are other companies such as Temu, such as Shein, and various different other factors that could start to be put on the negotiating table, if you will, as Trump puts this in a bigger kind of scheme of things.
We got 1 hour to go until the market close. So let's take a look at the major averages here. We got a mixed picture here today, Josh. We got, of course, the jobs report this morning, much awaited. And it was pretty much in line with estimates, a little bit better than estimates, although the unemployment rate did tick up. You got a lot of Fed speak also, kind of mixed, I guess. So let's look at the markets, then we can talk a little bit more about that. 148 points is the drop that we're seeing in the Dow today, about 1/3 of 1%. The S&P up 1/10 of 1%. The Nasdaq up 0.6 of 1%, but not huge moves here, even though, again, we've been waiting for this jobs report.
Yeah, I mean, the jobs report was, listen, we know the story that at least a lot of economists on this show have been telling, and a market it's moderating, it's cooling, but no signs of crashing. And I think today, you saw that report, Julie, and it feels like a lot of folks concluded, hiring picked up. Okay, the unemployment rate edged up a bit, but maybe they looked through it and decided, you know what, the story for now on that labor market, that narrative seems to be broadly intact.
Yeah, and it does seem like also that the expectation remains intact that the Fed is going to cut at its December meeting and then maybe not cut very much after that. We're seeing a little bit of a drop in the 10-year note for the moment. And that sort of seemed to be borne out by the Fed speak that we got today as well. That seemed to indicate, okay, maybe we'll get another cut and then we'll see what happens next year. If you look at the groups that are on the move today, you got energy down, you got utilities down. Consumer discretionary has been on kind of a tear. Amazon is helping lead it higher today. But if you look at the move that we've seen on the week, we're up more than 4%.
Yeah, I do think it's true. I wonder as we go into the weekend too, folks are already with that jobs report, Julie. You mentioned the Fed speak, and we did get, I saw Austin Goolsbee, I think, saying labor market looks broadly stable. I do want to already next week, of course, got the jobs report away. Now you're looking for key inflation data, which is another big piece everyone's going to focus on. Of course, that includes the Fed too.
Yeah, CPI on Wednesday is what we got. And then let's check on crypto as well, right? Because you see a lot of green on your crypto map today. Ethereum getting a little bit of a pop up here above 4,000. Here's the 10% move that we've seen over the past week. It had been lagging some of the other cryptocurrencies. And then, of course, got to talk about Bitcoin here, which went up above 100,000, then came down below, and is now back above it again.
Yeah, and I mean, as Trump continues to sort of build out his team here, so obviously, yesterday we heard about David Sachs, you got Paul Atkins, who he wants to lead the SEC. I mean, at least if you're a crypto investor, those are the names you wanted to see.
Yes, those are not things that are going to necessarily slow this down.
Right, exactly.
In their view.
All right, meanwhile, a federal court came to the decision to uphold a law requiring either a sale or ban of TikTok, and Yahoo Finance's Alexis Keenan joins us now with the latest on that.
Hi, guys. Yeah, so this is a district court, a court of appeals in the DC circuit saying that they are denying TikTok and TikTok users their request to strike down a U.S. law that was signed into law by President Biden in April, saying that the app would have to either divest to a U.S. owner or eventually be banned. And that deadline is January 19th, so the day before President-elect Trump would be taking office there. TikTok's claim here, they said that this law violated the constitutional protection against free speech, constitutional protection of free speech, rather, and also some other constitutional protections as well. But the court here saying, no, this law is constitutional, so it is the law of the land. And what it does is it requires not just TikTok to divest, but other apps controlled by foreign adversaries. Those include other apps, prospective apps as well, in China, Russia, North Korea, and Iran, all of them having to divest or face this ban on January 19th. So the three-judge panel here making the decision, they wrote this. They said if the First Amendment exists to protect free speech in the U.S., here, the government acted solely to protect that freedom from a foreign adversary nation and to limit that adversary's ability to gather data on people in the U.S. The court said if it is not divested, the TikTok app, that TikTok's millions of users would have to find alternative media for their communication. There is this little caveat, too, that the court gives President Biden, and that's to have a 90-day extension, put it on pause, but that's only if TikTok is making progress towards this required divestment. Yeah.
So what happens on January 19th?
Yeah. So, I mean, January 19th is a fuzzy day.
Like if I have TikTok on my phone, does it stop working?
In theory, yes, but you'd also have to have action happening, right? Someone could run into court and say this has to be shut down, and whether there'll be the motivation to do that at this level, I don't know. But there are some options on the table, not so many right now, maybe looking for President-elect Trump, even if he does want to undo it, right? Because on the campaign trail, he had said that he would save TikTok from this type of repercussion. But this is a law that Congress has passed, that the president has signed into law. So Congress would really have to be brought back in and would have to undo this law. And that would take a lot of, I think, that's a big ask. They just passed it. It's relatively new. So I don't know how much motivation there would be for that either. Also, there could be a chance that TikTok runs into either the Supreme Court or to the Court of Appeals. In the case of the Court of Appeals, they could ask for the full court, right? Because this were just three judges on a panel deciding this. They could ask for the full court to hear this. The court does have to grant that request, but what they don't have to grant is a pause. So we don't know if the court would say, okay, we're not going to go forward and enforce this law while it's being litigated. Otherwise, they're going to have to go to the Supreme Court. Again, no guarantee that the Supreme Court is going to take this up.
Whew, okay. Yeah, lots to keep track of. Alexis, thanks for doing that for us.
Sure.
Appreciate it. For more on what may lie ahead for TikTok as it faces that potential ban in the U.S., we've got University of Minnesota Associate Professor of Law, Alan Rosenstein. Alan, thanks for joining us as we try to understand here. So it seems as though the court gave more weight to the government's concern about national security than it did to the claimants' talk about free speech. Is that fair to say how we should be thinking about this?
I think that's mostly right. The court clearly thought that the government's concerns about national security, both the data privacy and the information manipulation concerns, were very serious. But I don't think this is just a story of national security versus free speech. I think this is a story of free speech versus free speech in a sense, because I think at least part of what the court was reacting to was the idea that on the one hand, you did have the free speech interests of TikTok and its users. On the other hand, you had the interests of people on TikTok, foreign government here, China. And so this was an interesting area in which you had different conceptions of free speech. And I think that's one reason why the court was comfortable with this law.
Alan, let's say this goes to the Supreme Court. Two questions. One, do you think they would agree to hear this case? And two, if they did, Alan, can we make any kind of educated guesses about what their decision might be?
Yeah, so it is ultimately up to the Supreme Court to decide whether to hear this case. I think it will, though. This is a case of extreme importance, both practically speaking and also in terms of First Amendment law. And over the past couple of years, the Supreme Court has shown a real interest in these kinds of cases. So I would think that they would want to have their word be the last word on this, and not just the DC circuits. But I do think that even though they're likely to take this case, I don't think they're going to do that to reverse the DC circuit. I think they're probably going to uphold it. I think one thing is notable about the DC circuit was that you had a 3-0 decision in favor of the government. You had a cross-ideological panel, one judge appointed by President Trump, one judge appointed by President Obama, and then one judge appointed all the way back by President Reagan. And these are three of the most experienced and three of the most respected judges on the DC circuit. So I don't really see a reason why the Supreme Court would overturn what the DC circuit did. Now, they may in the meantime pause the law while they deliberate. That's something they often do, especially with laws that can have such a big impact. But I do think that when it comes to when the Supreme Court ultimately decides on this case, which will likely be sometime in the summer of 2025, they will ultimately come down in an opinion that reads very similarly to the opinion that the DC Circuit just issued.
And then if we can sort of extrapolate forward, are there any repercussions or potential repercussions for other Chinese companies that have state ties that operate in the United States?
So the law specifically singles out TikTok and applies to TikTok and ByteDance, but the law also applies potentially to other similar social media companies that are owned or controlled by entities in Russia, China, North Korea, or Iran. And here, really, China is the main story because China is the one that has these popular social media platforms. Now, with those companies, those don't automatically fall under the law. The law gives the president the discretion to designate those companies for a similar kind of divestment or ban. But that being said, there are other substantial Chinese companies that could fall under this. So WeChat is an example. And then actually some video games, Fortnite, and some other games have this kind of massively multiplayer social media aspect to them that potentially makes them fall under this law. And they are, in many cases, owned by Chinese entities. So if the president here, President Trump, wanted to apply this law to other companies, he potentially could do so.
And Alan, let's say this ban does go through. I'm curious, what is the legal responsibility of the app stores and all this, Alan, Google and Apple?
That's right. So the law, although it's targeted at TikTok, it's enforced against the app stores, Google and Apple, and then also the cloud service providers like Oracle that actually host TikTok in the United States. And they're the ones that have to comply with it. The enforcement mechanism that the law provides is that these companies can be on the hook for up to $5,000 per user. And when you think of TikTok, which has 170 million users, that adds up to a lot of money very quickly. So I would expect on January 19th, unless the law has been paused, for Apple and Google to stop distributing the app and for Oracle to stop hosting TikTok.
Alan, thank you so much. Helpful to get some perspective and context around this. Appreciate it.
Thank you.
We're just getting started here on Market Domination. Coming up, Apple reportedly preparing to bring its in-house modem system to market. What that means for some of its competitors on the other side. And shares of Hewlett-Packard Enterprise soaring higher today on the back of its latest earnings report. Company CEO Antonio Neri, we're going to hear from him later in the hour to break down the results. Stick around, much more Market Domination still to come.
Dan ratusan juta voucher belanja.
Stocks mixed as investors digested the last monthly jobs report of the year. Join us now to break down those numbers is Thomas Simons, Jefferies senior U.S. economist. Thomas, always good to see you on set.
Likewise. Thank you for having me.
So let's talk about this report. Hiring picks up, unemployment rate or that edges up a bit.
Yeah.
It seemed like a lot of economists kind of looked at the report and said, you know what? Storyline seems to be intact. Moderating, cooling, not crashing.
Yeah, I mean, we've seen some month-on-month changes in non-farm payrolls for the last year or so that have been really all over the map. Obviously last month with the 12K initial print revised up only a little bit here. We had a big print in September. We had some bigger prints earlier in the year. But if you look at moving averages, 3-month moving average is like 170, 6-month is like 140, and the 12-month is like 190. And then if you think about today's number and you take out the effects of the Boeing strike and the effects of the hurricanes, call it 60K, you're at 167, right? So that's really right in line with that channel. And I don't think that there's anything within the details that suggests there's a big break in momentum anytime soon either.
One interesting thing you point out from the report is the participation rate, and not just overall, among older people in particular. Talk to me about the demographics within this workforce and what effect that's going to have over the next couple of years.
Yeah, I mean, honestly, demographics is like one of my favorite kind of vectors to examine economic data in general, especially as you look in the very long run. It tends to be a very strong predictor of what's going on, right? It's no secret that in every developed market economy in the world, no less the United States, we're heading towards a lower birth rate, higher average age, some faster than others. U.S. actually fortunately benefits from a useful immigration policy, or at least an approach to immigration, I should say, such that we are still relatively young, still growing population. That doesn't change the fact that some 10,000 people hit the age of 65 every day, right? And I remember 10 years ago hearing this stat, and it's still true now, right? And we have about 5 more years of this happening too. So if you look at just like population changes since February 2020, right before the pandemic, there's something like almost 6.1 million more people 65 or older than there were back then, right? And this is 6 million more people coming into the United States. This is 6 million people who used to be in the 54 to 64 age bracket, right? So those people are sitting on some $90 trillion worth of wealth. If you look at some of the Fed data on household balance sheets, not all of that is fungible with things that they can use to spend, but certainly relatively comfortable. They can and will and are retiring, right? So you have this pull of aging workers coming out of the labor force. For most of this year, we had that offset by all that immigration, but going forward, that's a much more difficult kind of picture to put together.
Yeah, on that point, Tom, I was going to ask you on immigration. And with Trump coming back into the White House, obviously immigration is front and center. If he followed through with these plans of mass deportation, as an economist, how do you think about that? The possible ripple effects on the labor market, on wages.
Right. So, I mean, one of the interesting things I think about the immigration debate from this past year was everybody saying, oh, these immigrants came in and they lowered wages, or it shouldn't say that, maybe they reduced wage pressure, right? Like, they provided supply where it wasn't there for labor. And now you kind of think of it in the inverse, which is not only do you have the offset from the retirees, but if there's actual deportations in the scale of million, then you just have very many fewer people, right? One of the things that I pointed out, and I think many others have as well, I'm not going to say this is groundbreaking, but like more population is more people is more aggregate demand. And if they're not producing more than they're necessarily demanding, then that's inflationary, right? So you kind of have these offsetting things that at the end of the day, so long as these kind of changes are relatively in balance, it doesn't actually move the needle in the long run. Like short-term disruption, sure. Now, if Trump actually does that, that's like the point I'm trying to make is millions of fewer people in the U.S. is a terrible thing, right? No country in the history of economic analysis has ever thrived with a shrinking population, let alone one that is shrinking and aging at the same time.
So all of that said,
yes.
When you look at the outlook for where rates are going, assuming, and as you say, it's quite a binary scenario.
Mm-hmm.
Either, although you could have the people deported not unmasked all at once,
right,
or even all of them, but you are looking at a binary scenario. So what's your base case for inflation and therefore rates going into next year?
So I don't know if this is a cop-out or if it's a kind of out of consensus answer, but I think it's actually relatively similar to what we have right now, right? I mean, I think that we are going to see marginally higher rates, especially in the long run. I do think that the curve is going to steepen a little bit. We're going to get at least a few more rate cuts, so that should bring the long end. I'm not super worried about this notion that Trump is going to start spending tons of money and like be extremely fiscally profitable, canceling income tax in favor of like trying to replace that with tariffs. So a lot of math doesn't work on that. And as much as Trump has a lot of unilateral power via the executive order pen, there's still checks and balances in the U.S. government, and there's still a lot of people there that know those aren't great ideas, right? So I think we could end up seeing maybe max upside on the 10-year yield somewhere around 4.5 to 4.75%. We could probably have some scary times like last October when we touched 5 for a brief period of time when everybody suddenly gets worried about supply. But I just really don't see the situation changing, because at the end of the day, you're talking about investing in the most dynamic, best developed and most free market economy in the world. And I would be happy to continue to do that.
Well, we'll see. Fingers crossed. Tom, thanks
Always.
so much.
Thank you.
Good to see you. Appreciate it. Moving on now to Shopify. It's getting a lift as Loop Capital upgrades the stock to a buy, noting that investors are underappreciating how Shopify is utilizing AI. Joining us with more, the analyst behind that note, it's Loop Capital Markets Managing Director, Anthony Chikumba. Anthony, this is actually sort of a perfect follow on the conversation we've been having about jobs, because what stood out to me about your Shopify note is not just how Shopify is using AI in terms of its outward-facing services to clients, but how it's using it internally. And as you point out, the company's headcount hasn't changed, but its sales have gone up 20%. So is that just because they're using AI and they don't need to hire people?
It's a really big part of it. And like you said, I mean, it's not just the external, merchant-facing stuff they're doing under Shopify Magic. It's the fact that they're using AI internally, right? So they're using it in their human resources department to respond to employee questions. They're using it in their finance and accounting department. I mean, one of the most stark examples was that the monthly closing process. So large companies like Shopify, they close their financial statements essentially every month, even though they only report them, once a quarter. That process is incredibly laborious. It literally took several hours. Using AI, that's down to minutes. And so there's just, if you have AI and it's making your employees much more efficient, then you don't need to have as many employees. They can continue to grow at these very fast rates while keeping their headcount pretty stable and thus keeping their expense base pretty stable.
And Anthony, one big interesting trend with the company too is the way they're moving Anthony up market. So helping big brands sell online. I'm curious what kind of traction they're seeing there, and also obviously as they move up market there, you are coming to more competition with the Salesforce, with an Adobe.
That's correct. So basically that enterprise sort of initiative, they roughly, call it Shopify Plus. And here's the thing, we've done a lot of work on Shopify Plus they just have a better mousetrap than a lot of the other guys out there, than the SAPs, than the Adobes of the world, right? And a lot of it is the fact that whereas like, you know, an SAP or an Adobe, you know, the fact they've been doing it for so long is almost like a disadvantage, right? Like Shopify almost started with kind of a clean slate, you know, when they took this solution that they had originally come up with for small, medium-sized businesses, and they started to apply it to enterprises. The best thing that Shopify has done over the last few years in terms of enterprise is what they call commerce components. So in other words, it used to be if you wanted to switch to Shopify from some, you know, other platform, or if you were doing it internally, you essentially, it was almost like a rip and replace. You had to replace kind of everything. Now Shopify has it where if you say, okay, you know what, I'm fire a lot of my legacy systems, but I just want to replace like the front end, right? The customer facing part of my website, I can do that. Or even if it's just the checkout, I can do that. And so it basically makes it where you don't have to, it doesn't have to be an all or none proposition. And that makes them even more attractive to enterprise merchants.
Anthony, I want to talk a little bit about the holiday season, and maybe I'll segue to it by asking, you know, Shopify obviously does represent some of those bigger enterprises, but it also represents a lot of smaller businesses, companies that aren't publicly traded. And I wonder, you know, are they collectively taking share from the big guys when you look at something like holiday spending?
I'm not so sure about that. I mean, it seems like the big guys are only getting bigger, right? I mean, you know, right now Walmart is taking share from pretty much everyone with, you know, two hands. I mean, there's no bigger retailer in the U.S., I think, quite frankly, in the world than Walmart. So I don't know if that's necessarily happening. It just seems like the big are getting bigger. And look, we've actually seen a number of, you know, better than expected earnings reports, you know, just within the last couple of days, right? I mean, look at the numbers that Ulta Beauty put up yesterday. I mean, certainly much better than we were expecting.
Anthony, just to circle back on Walmart, because listen, we're wrapping up a year here, and what a year for that company. This stock is up more than 80%. What are they doing right, Anthony? They are just simply firing all cylinders here.
Yeah, so I think what Walmart has really done is they've improved their execution. It's their in-store execution, right? It's also their online execution. They also, you know, rolled out that Walmart marketplace, so where third-party sellers could sell on Walmart.com. They've always done a really nice job with click and collect, right? Where, you know, you essentially, order your groceries online, then you go to the store and they bring them right out. So they really are just hitting on all cylinders in a way that we haven't seen in quite some time.
Well, and what's interesting about that is you could also say, okay, the sort of macroeconomic environment backdrop is good for Walmart too, right? People are looking for value. But you're not seeing all of the players benefit from that kind of phenomenon equally, right? So it's sort of like circumstances plus then execution together, because just circumstances don't seem to be doing it.
You're 100% right, and I definitely have a lot of insight on that because I cover, you know, the dollar stores, so, you know, Dollar General, and then also Dollar Tree, which owns Family Dollar, and yeah, those companies are not doing well right now. They're really, really not, and a lot of that I think is that they are giving up market share to Walmart, and a lot of it is because of self-inflicted wounds, right? I mean, look. I mean, Family Dollar. I mean, they just never been able to. Dollar Tree's never been able to figure out how to run that business, to turn that business around. Now they're trying to sell that business. Dollar General, basically underinvested in store labor for quite some time. The stores got pretty horrific. Now they're trying to kind of turn that around, but you don't just kind of flip a switch. I mean, particularly with a retailer that has over 20,000 stores. So you are right. I mean, it is almost like a perfect storm for Walmart where, you know, the macroeconomic environment is still quite difficult, and, you know, they are seeing consumers trade down to Walmart, but they're also benefiting from the fact that, you know, a lot of their competitors are kind of shooting themselves in the foot. And by the way, I would throw Target in there as well.
And those two names, Dollar General, Dollar Tree, Anthony, I know you have holds on both of them. Those stocks have been crushed this year, both of them. What would you need to see, I guess, before getting more bullish?
better numbers, a lot better numbers. I mean, look, in Dollar Tree's case, they need to sell Family Dollar. And by the way, look, they'll take whatever they can get. They would take a bag of magic beans for Family Dollar, and I think that the market would applaud, right? Because the Dollar Tree, the core Dollar Tree business is still operating. I mean, it's slow, but it's still quite decent. With Dollar General, they've got to just continue this turnaround, right? I mean, so for example, they are they've improved their inventory in stock levels. They put more store labor into the stores. They also are sort of decluttering the stores. Like, so for example, they're getting rid of a bunch of stands that are kind of clogging the aisles. So we just need to see better execution from them. And I think if they execute better at the store level, the consumers will come back, because one thing that we haven't seen, quite frankly, is Walmart undercut the dollar stores on price. We do pricing work once a quarter, and the dollar stores are still within spitting distance of Walmart. They're as close as they need to be. So it's not a pricing issue by any stretch of the imagination. It's much more about store level execution.
Anthony, always great to see you and get those stock recommendations. We appreciate it.
Thanks for having me.
Coming up, shares of Hewlett Packard Enterprise, they are soaring higher today on the back of their latest earnings report. The company's CEO, Antonio Neri, joins the show on the other side of the break to break down those results. Stick around, much more market domination still to come.
One of the hottest tickers on the Yahoo Finance platform is HPE after the company's latest earnings report and forward guidance. It gets to HPE CEO Antonio Neri. And Antonio, always good to see you here. Thanks for joining Yahoo Finance. What stood out to me amongst many things in this quarter is your server performance. Really strong. Is that the power, or investors, I guess, getting a taste of the power of AI and how it's going to impact businesses like yours?
Well, thank you for having me, Brian. It's not just servers, I will say. I think when you look at our performance in Q4 was exceptional on many, many metrics. Servers obviously was the flagship with AI, but also hybrid cloud did extremely well, including GreenLake and storage. But when it comes to AI, I think the market comes to recognize that HP has a right to play because of our unique innovation, intellectual properties, and capabilities. And then ultimately, we see the momentum happening across multiple segments of the markets, including now enterprise, which we saw a significant uptick in our pipeline, and now first deals through our HP Private Cloud AI. So I'm really pleased about the quarter. We delivered record-breaking performance on revenues, 8.5 billion. In that number, we had the 4.7 on servers, record profitability of $938 million. And then for the full year, we exceeded our commitments on revenue, EPS, both GAAP and non-GAAP, and record-breaking free cash flow. So we are very excited about 2025, Brian.
When you talk to your fellow CEOs, what are they asking you about AI, and then how have the conversations changed with them compared to 3 months ago?
Well, I think, we all address different segments of the markets, but remember, I think about AI in 4 unique, distinct segments. Number one is companies that are in the business to build this large language model. I call the large language model builders or the hyperscalers. Obviously, they lead with the latest technology because they want the best performance at scale with lower energy consumption and ultimately reduce the cost of training, right? And then you have sovereign AI, which obviously is now coming very strong on interest. And we are already building 2 very large sovereign AI clouds for Japan and the UK, but more in the pipeline. But where I was really pleased is the fact that now enterprise is deploying AI, including ourselves, right? We have many, many, many use cases, many of them already in production. But I think in that segment of the market, Brian, they're looking for time to value and simplicity of the offer because they don't have the whole expertise.
These AI models, as you know, Antonio, they're sucking up a lot of energy.
Yeah.
Are we headed towards some form of energy crisis here? As all this stuff is converging and AI is penetrating our lives in new ways?
Well, definitely the path we are on is now sustainable unless we innovate around the entire ecosystem. And when I think about the entire ecosystem is sources of energy, which obviously needs to be clean. It's not just more capacity, but it also needs to be clean from the way we power these data centers. The actual architecture of these systems moving to direct liquid cooling, and there HP has unique play because we are the industry first with 100% fanless direct liquid cooling, including the switching, by the way, the networking part, not just GPUs and CPUs. And that when you go to that architecture, we have proven that you can reduce energy consumption by 90% and space by 50%. So this is why we got to innovate across the entire ecosystem. Otherwise, it's not sustainable.
How hopeful are you that the new administration coming in, they have the policies that will help unlock this United States type of investment?
Definitely, we need to invest more. The current administration and transition started that process with the CHIPS Act and the Life Science Act and other supports into the infrastructure. But I'm hopeful with the new administration, we're going to see an acceleration of that. Also because it's important from a U.S. national security perspective as AI is deployed everywhere. And this is why a transaction like ours with Juniper Network is important for the United States because it brings more pro-competitive, allows us to stay ahead of the game, especially as we build this massive. Remember that HP now has 7 of the top 10 supercomputers deployed in the world. And number 1, number 2, and number 3 is in the United States.
Those computers sound a lot more powerful than what Enrique's selling over at HP there, Antonio. Oh, I'm just got to say it. You didn't have to say it. I'll say it. When you mentioned Juniper, there was an FT story. I'm sure you saw it 2 weeks ago. Officials at HP reportedly met with officials in the government. There was maybe perhaps some concern if this deal is going to get done. We've talked to you every step of the way. Does this deal get closed in January?
We believe the deal will get closed in the early part of 2025 within the original timelines we provided. Remember, when I announced the intent to acquire Juniper on January 10th, we said that we expect the deal to close the latter part of 2024, calendar 24, or early part of 2025. We have received pretty much all the approval outside the United States with unconditional support, which means they see the deal as a pro-competitive. And we have been working with the DOJ incredibly collaboratively to answer all the questions. Obviously, have been busy dealing with many cases, but the reality is that we still believe the deal will close in the early part of 2025, and nothing gives me pause that would not be the case, because the deal is pro-competitive, and as I said earlier, also supports our U.S. national interests.
Let's assume this deal does close, Antonio. What do the next couple quarters after the deal closing look like for HP? I mean, do you get an earnings relift? Do you anticipate the stock to re-rate?
Well, over time, we expect the stock to re-rate because obviously we'll be adding $5 billion to the company. Remember, we just announced fiscal year 24 results at $30 billion. And that $5 billion comes with a different structural margin, which ultimately the stock P multiple will have to re-rate. But, it would not be immediate. It will take some time. Also because we have a number of synergies that we committed, which last time we talked about it, we said at least $450 million. And this is why, Brian, we only guided Q1, because we are confident that we can close the deal. And hopefully by the time we announce Q1, the deal will be closed. And at that point in time, we're going to guide for the rest of 25 and obviously 26 and 27.
How important is Intel to the country's, I guess, supply chain ecosystem? I mean, Pat Gelsinger, he retired earlier in the week. Sources told me that, it maybe wasn't actual retirement, but the company's struggling. I mean, how important is it to a company like yours? I know you work with NVIDIA, but how important is a company like yours? How important is it to the country that company turns itself around and does it somewhat quickly?
Yeah. Well, I can't comment on what happened inside Intel, but I have tremendous respect for Pat, for what he has done at Intel, at VMware, and the broader tech industry. He is a unique personality with unwavering integrity and so forth. So, but coming back to Intel, I will say we need Intel because the market needs Intel. Customer needs more competition in this space. And the United States needs a healthy Intel.
Antonio Neri, HPE CEO, always great to get some time with you. Happy holidays. Thanks for making time for Yahoo Finance. We'll talk to you soon.
Thank you, Brian. Happy holidays to you and your family.
Thank you so much. All right, Julie, Josh, back to you.
Apple reportedly preparing to bring its in-house modem system to market. Qualcomm shares under pressure as Apple looks to replace components from its longtime partner. Here with more Yahoo Finance's Dan Hellion. And Dan, we sort of knew that this was in the works, but this report today has more details, especially on things like the timeline.
Yeah, Julie, this has been something that Apple's been trying to cook up for a long time and just kind of kept hitting a wall when it came to replacing Qualcomm and with its own in-house modem. Obviously, a modem is something that connects a phone to 5G or 4G networks so that you can get online and endlessly scroll something like Instagram, not TikTok maybe for long. But this is something that is going to end up, according to Bloomberg, showing up first in iPhones in the upcoming iPhone SE. That's the entry-level iPhone that Apple has left to kind of sit and languish for a while, not updating it very often. It's expected to be the first one to get that new modem, and then it should come in the upcoming iPhone 17, which would be landing in late 2025. And so you can expect this modem to kind of shave down some of the size of the iPhone. There could be battery life improvements, maybe not if they're cutting down on the size. Maybe it'll be, just a little bit better. Maybe, kind of just the same. But really cutting down on the size is something that has been repeatedly reported for the next generation iPhone, a new physical look to it. And it's something, obviously, when it comes to the design, display, battery, and camera, those are the things that people really go out and buy a new phone for, and a new design could really start to goose sales. And then on the Qualcomm side of things, well, they still make a ton of money. I think about 20% of revenue from that iPhone deal that they have. And so they've been aware of this for some time. You can see from the messaging that Qualcomm's been pushing as of late that they're trying to be known as more than just a handset chip company. During their investor day a few weeks back, they had basically said, look, we're in the PC space. We're developing more there. We're in the auto space. We're developing more there. And they expect to see growth in those sectors as the smartphone area continues to stagnate. So obviously Qualcomm trying to get ahead of these reports, knowing that investors would say, well, you're losing this huge client. What does that mean for your bottom line? And Qualcomm saying, we're working on it. We have places where we can pick up the slack in other areas, especially as we dive deeper into PCs and autos. So it seems to be a win for Apple, a loss for Qualcomm, but they're aware of that and likely to be picking things up in other areas.
Right, and then there are some other suppliers like Qorvo also that were taking a little bit of a hit today, but Qualcomm, the one that is most closely linked to Apple historically in that way. Dan, thank you so much. Appreciate it. Now time for some of today's top trending tickers. You can scan the QR code below to check out the best, worst, and most trafficked stocks of the session on Yahoo Finance's trending tickers page. Lululemon shares surging on the back of strong third quarter results. The company also raised its full year revenue forecast. And I had the chance to talk to the CEO, Calvin McDonald, this morning. The company has been seeing very strong results in China, but also importantly, a possible inflection in the United States. Here's what he said.
There's no doubt in my mind that we have a long runway of growth still in the Americas and in particular in US. When we look at our growth around the globe, as you mentioned, we're growing in every market, double digit, 39% in mainland China, 24% in rest of world, 9% in Canada, and we're growing men's in the US. Our opportunity is in women's in the US.
So that's what they're focusing on now, Josh. What's interesting is not all analysts are convinced that they're going to be able to really flip that business back to growth like it has seen.
China was, the big headline that dropped. It jumped about almost 40%. What explained that?
Basically, McDonald talked about the value of the brand in China, and he said also their brand is not yet that well known, so he looks for even more upside. But they do things like events. They do them globally, but in China, it seems like they've really tried to peg in-store activities, events, activations, try to get customers there engaged, and it just seems to be working. So that part of the business is definitely
Look at that chart
a
as well,
bright
by the way.
spot. Yeah, over the past month, we've definitely seen
a
big uptick in the shares, but still on the year, they're down, about 20%.
Yeah. Julie, thank you. And stick around, more market domination still to come.
We're seeing some big name earnings next week in the software sector, including Oracle and Adobe. And artificial intelligence will, of course, be a focus of both reports for investors. Our next guest is calling 2025 the year of the AI agent. So which companies are best positioned in this AI revolution? We're navigating how to play the software sector with the Yahoo Finance playbook. And joining us now, Stefan Slowinski. He's Global Head of Software Research at BNP Paribas Exane. Thank you so much for being here.
Thanks, Julie. Nice to be here.
So big picture for software, it's been kind of a lumpy year in 2024, but it sounds like you're more optimistic for where we're going next year.
It has been a lumpy year. I think the sector hit a low in May. There was lots of pessimism around demand, around monetization of co-pilots, which didn't really pan out, and actually around disruption to the business model. And it's pretty safe to say that in 6 months, we've done a 180-degree turn. And so the software sector, the IGV is up 40% since the end of May. Obviously, improved outlook on the demand front, or we hope so, at least in the US, although Europe remains a bit sluggish, and hope that the AI agents are finally the killer app that allows companies to monetize Gen AI. So we've seen that turn in sentiment. The problem is it's already reflected in a lot of the share prices.
Right. And is that why, let's get to some of those names. So I'm like Adobe, for example, you got the equivalent of a sell on that name. Is that, I mean, the stock has been obviously a laggard this year. Is that more about the big existential threat from AI? Is that the worry?
Yeah, we have been underperformed this year. And I think, for a lot of these software stocks, they've been riding these, what we call these waves of disruption. One moment they're seen as an AI winner, the next moment they're seen as an AI loser. And part of our concern around Adobe is just the increasing competition from the hyperscalers. So literally every day we're seeing Meta, we're seeing Google, we're seeing Amazon this week coming out with models around content creation, content editing, video creation, video editing, working that into advertising workflows. And so that's just a space where, Adobe will have a role to play, but it's just getting a bit more competitive, which is why we're cautious.
What is Adobe's response to that?
Adobe says that, and they are crucial to the enterprise customer, and we believe that they will be. They obviously have their own Firefly model, which, they've created based on data that they own and therefore can be trusted by their users. And again, I think that will resonate very well with a lot of their enterprise customers, but we're worried a bit more about some of the casual, non-professional users who may go to some of these other options, or even small businesses. Look, last quarter, Meta said that 1 million advertisers were using their tools to create content. And so that's just potentially going to be a headwind to growth.
So let's get to that killer app idea that the agent AI is what, at least one of the first things that we know what AI is for, and that's one of those things. How is that playing out? Who's benefiting from it the most, and how are they benefiting? How are they using it?
First of all, it's early. Second of all, co-pilots, of course, 18 months ago was what everyone was talking about. And these were supposed to be AI tools to help each of us in our day-to-day work and help us become a bit more efficient, a bit more productive. I think the selling point for CEOs and CFOs maybe wasn't strong enough for them to fully believe in it. But with AI agents, it does become more about automating roles. You heard Mark Benioff the other night talking about digital labor forces. So we are talking about agents becoming more replacement for some employees. And so, socially, of course, that creates some questions, but you can understand how CEOs and CFOs are now seeing this technology as the value proposition, the ability to sell it based on that return is more attractive.
Another name, Stefan, I'm so interested to get your take on is Meta, because you have the equivalent of a sell on there too. And I think a lot of people, when they saw those last results, they liked what they saw with the top and bottom line. So is that a valuation call? Is it, concerns about CapEx? Because on AI, just to stick with that, there's bulls who come on this show, Stefan, and they pound the table and say, hey, that's one of the names where I see all the spending having results on engagement, advertiser efficiency.
Yeah, absolutely. So we're an underperform, so it's a relative call. A couple of concerns that we do have. One is their business model is still 99% advertising. So whereas Microsoft and Google and Amazon have the enterprise cloud computing businesses, they have a way of monetizing this already with their enterprise customers. Some of those other hyperscalers have subscription business models like Google, Amazon with Prime. They already have subscription models for consumers, so they can maybe layer in Gen AI and get people to pay for that via subscription. Meta hasn't yet developed that. That's one thing. The second thing is we are waiting for January. They will be guiding on CapEx and OpEx for next year. We expect that to be a pretty big number. And so if the top line holds up for them, that's fine. But obviously, if we get any disappointment on the top line, investors may start to get a bit spooked about the spending. You're still losing $20 billion a year on Reality Labs. And so again, relative to some of those other names, that's one that we haven't underperformed on.
So Josh keeps asking about what you don't like. I'm going to ask you what you do, what you do like. You alluded to Salesforce.
Yes.
We mentioned Oracle's coming next week. I believe you've outperformed on both of those.
That's right.
So let's take Salesforce first. What are they? I mean, they seem to have gotten more popular.
Yeah, so they've certainly gone from the loser category back in May to now the winner category here in December. First of all, from a valuation standpoint, you still do have some backstop, meaning on a free cash flow multiple basis, the stock is still reasonable. And so yes, we are starting to embed more hope and expectation, but at the same time, valuation is still reasonable. They are coming out with Agentforce, which is their platform to build AI agents. They're running at that 100 miles an hour. And the initial, again, it's very early, but the initial feedback has been quite positive. So that's one that we expect potentially could see revenue growth acceleration in the second half of the year. And Oracle's already seeing that revenue growth acceleration. Some of that is mechanical with Oracle Cloud Infrastructure growing at close to 50% and becoming a bigger portion of the business. But I think when you do look at next year, because of where valuations have run, you need to be confident that the company you're investing in will see revenue growth accelerate. We think that's the case with Oracle, and with Salesforce, probably the back half of the year we could start to see that happen.
Great year for Larry Ellison's software cats.
Absolutely.
What a rocket ship. Stefan, thank you so much. Appreciate it.
Great. Thank you.
While we are wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
there is the closing bell on Wall Street on this Friday. It is market domination overtime now. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's start with the major averages here. The Dow, the laggard of the session, off by 0.25%. That's about 123 points. The S&P 500 up by 0.25%. And the NASDAQ leading up 0.8%. And the NASDAQ has really come back this week, up by 3.3% here. We've been talking for a while now about the broadening out of the rally, but that broadening kind of stalled this week. And the NASDAQ was up 3.3%. Contrast that with the S&P equal weight index down 1.25%. So it was large cap tech that came back. We've been talking about this sort of day by day as it's been happening, but now I think it's official. It's a trend on the week, Jared. We'll see if it continues beyond this week.
Yes, I was looking at tech all week long. It's been an interesting mix because you can break it into a few different categories. And let's just skip right to that. I'm going to show you the semiconductors on a 5-day basis. And we're going to see a lot of green here. NVIDIA up 3%, Broadcom up 10%. Software did better. And we can see bigger numbers here. Datadog up 10%, Workday up 6.6%, Salesforce up 10%, just talking about that. And then we have unprofitable tech. Aside from Tesla, most of these are very small issuers, and we're seeing the outsized performance from the smaller ones. DNA up 34%, Roku over 20%, Roblox up over 18%, Coinbase 16%. We've also seen this strength in crypto. Looks like Bitcoin is once again knocking on 100,000, actually above 100,000. And we can see that 5-day total for Bitcoin about 5%. And it is trading at 101,500, not quite the 104,000, just short of that we saw the other day. But let's get to the sector action. This is what we're seeing during the week, and it's been about the mega caps. In terms of large cap, Julie, we are seeing the biggest outperformance in consumer discretionary. That's XLY, followed by tech, and then we also have communication services outperforming. But you're going to see most of the sectors up here, they are red this week. So in terms of large caps, it was just the largest of the large, and we see that in the Nasdaq 100, where you take a look at the left hand, and you can see this outperformance by some of these mega caps. Meta really among the leaders here, up 8.6%. Tesla up almost 13%. By the way, Tesla almost up to its record highs that we had all the way back in 2021. So I'm going to send it off to you, Josh, on that note.
Thank you, Jared. Now for a closer look here, mixed moves on Wall Street to round out the week. And for the bond market, yields edging lower as investors consider the future of the Fed's rate cut path. The odds of a cut rising in a few weeks after the report came in just above economists' expectations. And joining us now to talk about all this is RJ Gallo, Federated Hermes Senior Portfolio Manager. RJ, good to see you. So let's start on that jobs report. RJ, I'm curious what you made of it. Did it come in about as you expected, RJ? What do you think the Fed makes of it?
Well, I think that the report was generally favorable. I know yields came down. At this point, we have a trailing 3-month average increase in non-farm payrolls of 173,000. Historically, that's a pretty healthy number. Admittedly, it's slower, less job growth than 6 months ago or 12 months ago, but everybody knew that the jobs market had to slow down some, and it's still soundly expanding and I think generally healthy. I think the Fed would probably view this release as consistent with their already underway process of easing policy to become less restrictive. As the labor market has softened compared to where it was, but is still reasonably healthy, they are easing to try to secure the soft landing and prevent a little bit of a labor market slowdown from turning into something worse, keeping the disinflation in train and keeping the economy in an expansion mode in a manner that's consistent with both of their objectives. Monetary policy is shooting for maximum employment and price stability, and we're getting close on both. And the employment side is generally pretty good, even though the unemployment rate did tick up to a still low 4.2.
I mean, at the same time, there's a little bit of like a spinning plates vibe to the whole thing, RJ, because, inflation kind of has stalled out at where it is, right? And jobs, admittedly, as you say, while it's remaining relatively healthy, we don't know where it's going yet. It looks like that the preponderance of folks think that there is going to be a cut at this December meeting from the Fed. Do you think that's what's going to happen? And do you think that there are any risks to that cut?
I think it's highly, highly likely. And the market agrees. If you look at the pricing of futures, that are priced relative to Fed funds rates expectations. It's highly likely that there will be another 25 basis point cut at the December FOMC meeting. Now, number one, the Fed funds rate is still well above the rates of inflation. The rates of inflation have not yet gotten to the Fed's 2% on core PCE or headline PCE, but they are basically half of where they were not all that long ago. I think that the Fed is of the view that a positive real Fed funds rate of the magnitude we currently have could be undesirably restrictive. And so their interest now is to become less restrictive. They're not easing to fight a recession. They're easing to try to achieve a soft landing. I would argue the soft landing pretty much has been achieved. The only lingering question is, will inflation get right back to 2%? Or will the Fed basically say, hey, we're comfortable with an inflation rate of 2 to 2.5%. Let's not get too precise here. If we can get disinflation of the sort that we've already had, an inflation rate 2 to 2.5%, and the unemployment rate ends up in staying in the low 4% range, I think that that would be mission accomplished to the Fed. And I think that the ease coming in December is part of that. The bigger question is, where do we go next year? How far down in interest rate space will the Fed funds rate go? The markets at one point thought that the Fed would take yields down to below 3% for the Fed funds rate. That is no longer the expectation. And I think another key aspect of next month's the Fed meeting in a couple weeks here is what does the Fed tell us via the dot plot? Where do interest rates go in terms of their projections for the end of 25 and for the end of 26? There's a good chance they're going to increase pretty sharply from the last projections that were shared with us back at the September meeting. And that's something that could be a challenge to the bond market. If the Fed tells us they're not going to take rates as low as we once had hoped, that could push back a little bit on the recent drop in bond yields as the Fed reveals that message.
And so, RJ, add it up to us, given your views there of the Fed, the economy, for fixed income investors who are listening right now, your advice is what, RJ?
Well, first of all, bonds have produced about, diversified bond portfolios, 3.5% rates of total return this year. That's not very good compared to the, north of almost 30% return you're getting off of an S&P 500 equity investment. I think the better comparison right now, given what we have been through, we went through an extraordinarily adversarial period of surging inflation, massive Fed tightening, and double-digit losses on nearly every fixed income asset class in 2022. Since then, we have found our feet. Income has been restored as a driver of total return in the bond asset class. That's the benefit of the fact that interest rates had to rise rapidly as the Fed fought inflation. So where we stand today, you actually have income providing a tailwind to your total return. That wasn't true when the 10-year Treasury was below 1% in yield. It is true when it's above 4% in yield. So I think fixed income has a place in your portfolio. I think plenty of investors have benefited from being heavily in cash or heavily in stocks, or some, barbell between those two. I think at this point in time, with stock valuations high, with a lot of policy uncertainty, it seems to me an equity investor could take some chips off the table and buy a bond market where income is going to give them a lower rate of return than stocks if stocks keep taking off, but will also manage their risk if stocks roll over. Conversely, a cash investor, and we love cash investors at Federated Hermes, we manage a lot of money market mutual funds, but the returns on those funds are going to go down as the Fed keeps easing. That means that we're going to hit a crossover point where bond investments with a little bit of interest rate risk duration can give you a better total return than your cash. So the cash investor can also look to move out to short-term bonds or intermediate bonds, diversify their risk profile, and get some upside compared to staying in cash as returns to cash decline.
RJ, thanks a lot. Have a great weekend.
Thank you.
Employers hired 227,000 folks in November, slightly more than economists expected, with Wall Street hoping a Goldilocks employment scenario will still allow the Federal Reserve to trim interest rates. However, there may also be signs that a cool down is underway, potentially. Joining us now, Yahoo Finance's Rick Newman. What are those signs that you're seeing there, Rick?
Hey, guys. Well, some of the more bearish economists I follow acknowledge, yes, we had a good monthly jobs report, but There's some questions about the methodology in this report. We can get into that later in another segment if you guys ever want to. But there are other measures of hiring in the economy that are much broader than the monthly number and much more reliable. And those show we are actually close to tipping into a danger zone. If you look at year-over-year change in employment growth, it is very small. The increases are very small. You can see it. You can see it in that chart there. So the question is, that line, where that line is going down toward the right-hand side, are we at a point where that might cross the 0 point and we might actually get into negative year-over-year employment growth? There's no sign a recession is imminent, but it's also true that we've seen curves like that or charts like that right before other recessions, such as the one that began in 2007 or the one that began in 2001. And while a lot of our audience follows the Federal Reserve, I'm following the Biden handoff to Donald Trump as he's coming in January, and just wondering, it looks like Trump's going to inherit a pretty good economy, but there are some warning signs. So I'm watching those charts.
Rick, I'm curious because I haven't gotten your take yet on what you think of the kind of core economic team Trump has assembled. I ask because, it's kind of top of mind, Rick. We had Anthony Scaramucci on the show this week, and obviously Scaramucci, not a fan of Trump. But it's interesting.
Not anymore.
No, sure not. But interesting because even Scaramucci, he was talking about Trump's team on X, Besson, Hassett, Atkins, and even a skeptic like Scaramucci said he was impressed by that team. And I'm just curious to get your general thoughts on it.
Yeah, the flaky nominees are not on the economic team. I mean, I think the most obvious ones are Pete Hegseth for Defense Secretary. He's got zero experience managing a large organization. Kash Patel at the FBI. I mean, these are the sort of Trumpy America First people who are just there because they're out of loyalty to Trump. The economic team, I think, is reassuring. I mean, Scott Bessent as a Treasury Secretary, markets like him, and we are going to get some tariffs and a lot of tariff threats. But the guys on the economic team have been there before, and they're sort of known quantities. So that suggests the markets are probably going to be okay. If we're going to have turmoil under Trump, it's probably going to be in some other part of the government.
Rick, always great to see you and have you on the show. Have a great weekend.
Guys. See you.
And be sure to check out Rick Newman on the Yahoo Finance podcast, Capital Gains. This week, the team is joined by Raymond James, Washington policy analyst and managing director Edward Mills to discuss Trump's tariffs. You can scan the QR code below to stay up to date with the latest episodes, and be sure to tune in every Friday at 12 p.m. Here's a clip from this week's episode.
What I've told clients here at Raymond James is to rank order some of the tariffs. Number 1, China. Number 2, Mexico, and I guess I have to add Canada after the True Social post of last week. Number 3, Europe. Number 4, the rest of the world. When I've talked to Trump trade experts, folks that worked with him in his first term, they tell me, again, take him seriously. Don't take him literally. Not everything that gets posted is going to get implemented. But I will tell you, if we do this interview a year from today, there will be more tariffs in place than there are today. And we'll probably have a conversation about Congress giving him additional tariff authority as they pass an extension of the 2017 tax cuts that expire on December 31st of next year.
Business leaders across the materials and industrial space are here at Goldman's conference as the industry looks ahead to 2025 and the incoming Trump administration. From tariffs to various regulation changes that we are expecting to infrastructure, what could these policy changes mean here for the sector? I want to bring in Joe Ritchie. He is Goldman's co-head of U.S. Industrials and Materials Investment Research. Joe, it's great to have you. Thank you so much for making the time.
Shauna, great to see you again.
So there's lots to get into here. I know you've been very busy with the conversations that you've been having over the last 2 days. I'm curious just to get your assessment right now of the industrial space and whether or not maybe the worst that we have seen is that behind the sector.
Look, from a macro perspective, the reality is that the ISM has been down for 24 out of the last 25 months. So a lot of investors that are here today are looking to see that inflection, right? We've had multiple companies on stage the last 2 days. I'd say cautious optimism is where we're at today. We've had several companies say we're expecting better growth in 2025, but the reality is that they're not really seeing it in their businesses today. As we've spoken before, we're very bullish on what's happening from a U.S. manufacturing perspective here in the U.S. It's only a matter of time before it happens, and we think it'll inflect at some point in 2025.
What is that manufacturing renaissance? Because it's something you and I talked about 17, 18 months ago. What does that phase look like here as we enter 2025 and how you see that working out?
Yeah, so let me put some context around it. Historically, in the U.S., we've spent roughly around $70 to $80 billion a year in manufacturing investment. And right now, we're tracking projects that are greater than $1 billion, tracking to roughly $270 billion that have broken ground. If you've actually taken a look at what investment has looked like over the last few years, the reality is manufacturing investment has already started to tick up. So last year, it was somewhere between 190 to 200 billion. This year, we're looking at close to 230 to 240 billion. The important part for the companies that we look at, these are the HVAC companies, the electrical companies that really do the guts of the facilities and then also sell into the factory floor. The reality is for those companies, they've yet to see the inflection in their orders. A lot of the investment today has been on the which benefits companies like concrete, steel, you'll see the aggregate names also benefit as well. So we think a lot of the goodness right now from the manufacturing perspective is on the come for the companies that we cover.
If we do see some of the tariff threats that have been put out here by the incoming Trump administration, are some of the companies within your coverage maybe better positioned, I would guess, than others, just given where they do have their manufacturing plants? And I guess of that, how big of an overhang is that more broadly speaking?
Yeah, so it's obviously been super topical, given that we're only about a month removed from the election. The reality for a lot of our companies are insulated. And you go back to the last tariff cycle, they didn't really see a material impact to their P&L. You have some companies like Stanley Black & Decker, which is more a consumer-levered industrial, which is said, like they're already dealing with 25% tariffs, and they import roughly, call it 25 to 30% of their cost of goods sold is imported here into the U.S. from China. If we were to increase tariffs to 60%, that's roughly a $200 million cost hit to Stanley. And the reality is that they're going to try to change their supply chain in order to offset that. That'll take time, right? But the majority of our companies, pretty well insulated. You have some manufacturing that's happening in Mexico, but the reality is a lot of our companies.
What are you hearing just from CEOs and the various executives who are here today, those who do have exposure to this potential threat? Are they already moving on that? I mean, how are they navigating this uncertainty?
Yeah, I mean, it's so hard right now. They're having conversations with their channel partners to discuss what pricing could look like if under different types of scenarios. But the reality is until you have something that's a little bit more finite, it's tough to actually institute anything. So Stanley is a great example of that. They're having discussions with the Home Depots, the Lowe's of the world already. I would assume that it's probably easier for them to get pricing through this time around versus last time, just because we have a playbook for tariffs. It's not new, but until you actually know exactly what's going to come down the pipeline, it's really difficult to make any decisions longer term.
Joe, what's the sentiment from business leaders about the incoming Trump administration? Overall, do they view this as good for business? How should investors be thinking about that?
I mean, the stock market seriously is
they're excited about it.
The market's certainly excited about it. I think look, I think the reality is a lot of the business leaders are measured. And so I had Honeywell here today as an example. We met with their DC team in late September. And the reality is that, you know, they were well positioned on both sides of the aisle. I think a lot of our companies are like that. And so, sure, there's optimism. I'd say that the areas of the economy that are probably going to benefit a little bit more are some of the kind of like more traditional oil and gas type names. And so I had Flowserve here today. I think that they view the election as a net positive for them, even if there are increases in tariffs. But generally speaking, I think that the backdrop and the feeling regarding this new regime is fairly positive.
How do you see companies accelerating their growth? When we're trying to identify just the biggest catalyst within the sector, is it M&A? How do you see that strategy evolving?
So it's a combination of, you know, new product introductions, investing organically, and M&A. So the reality is the sector that I cover, this multi-industry sector, is a list of industrial conglomerates. And what you've seen happening over the course of the past decade is they've been deconglomerizing. And the companies that were faster to move with changing their portfolio to become much more focused companies have benefited in this upcycle from a growth perspective and having better margins as well. So what you're seeing is you're actually seeing a ton of portfolio movement. I mean, I had like roughly 20 companies here. I'd say the vast majority have made some sort of change over the past decade. And there are still big companies like Honeywell was here today, 3M was here today. There's some big companies that are doing things behind the scenes to try to become a lot more focused.
Joe, within your coverage, who do you think is best positioned heading into 2025?
Yeah, so at Goldman, we have something called the conviction list. The name that I have on the conviction list is Parker Hannifin. They're a great company, really well run. They're part of what I would call the new compounders. They're one of those companies that started making moves about a decade ago to really transform their business. 2/3 of their business is tied to industrial activity, and about 1/3 of their business is tied to aerospace and defense. And so they've been able to perform incredibly well, even at a time when the industrial markets haven't been a tailwind for them. So what we're expecting is at some point in 2025, their markets are going to inflect. That's going to be really, really good for their business. But I would also have to say, look, if you're levered to the power markets today, you hear called Mirion today that's really levered to the nuclear industry, and you're in the first innings of a burgeoning cycle. Those are two companies to put on your radar screen.
And Joe, another company that's very popular with a lot of our viewers, you mentioned before the conversations with 3M's CEO. Clearly, the market has been excited about the transition. We've seen that reflected in the stock price. How bullish are you looking ahead to 2025?
Yeah, so commented earlier when I had Bill on stage that I had to comment on his enthusiasm. He was full of energy. He said it was a coffee. I think it was much more than that. They're truly transforming that company. Now, this is going to be a multi-year journey, but it seems like there is a lot that he can do to really transform the margins of the business. And then ultimately, they can become a much more focused company as well. They've already started doing some divestitures. They divested their healthcare business, Solventum, last year. You're likely to see more from them in the future on that front. And look, he's got a new leadership team in place. So every leader that was up today has, outside of Bill's been there for a little over 7 months. CFO just started 3 months ago, and we have a new IR person that was announced yesterday. So they're doing a lot within the organization. And I think this is going to be a multi-year transformation for Bill and for 3M.
Thanks so much for your time.
It's great to see you, Shauna. Take care.
Oil ending the week with a loss on concerns of a surplus, despite OPEC's recent decision to extend its production cuts. Joining us now, Yahoo Finance senior market reporter Ines Ferre. Hi, Ines.
Hi, Julie. Yeah, and at this rate that we're going, oil is going to be negative for the year. I'm going to pull up a year-to-date chart so you can see WTI down 4% this year, and also Brent crude down more than 6%. And for the next year, analysts are also expecting prices to go lower. I'll take that point in a second. But first, I want to note an important development this week that should have prices higher. That's OPEC's decision to extend its production cuts until April of next year. That's significant because the Oil Alliance has already repeatedly postponed bringing barrels onto the market. But take a look at the prices that we have seen over the last several days. Today, down more than 1% for Brent, WTI down 1.5%. We've been seeing a sell-off, and this is because of sluggish demand, particularly in China, and also rising output from non-OPEC nations, including Western nations, the U.S., by the way, which currently produces about 20% of the world's oil supply. Analysts are switching their view to somewhat bearish for next year. B of A putting out its outlook earlier this week for 2020. The analysts don't see massive price shocks like the ones that we've seen over the last several years because they say that OPEC is sitting on the sidelines with spare capacity. Essentially, it doesn't want to. JP Morgan earlier this week also put out its forecast for next year, saying that Brent will average $80 this year. It'll slide to $73 next year. All of this is boding well for drivers for gasoline prices because they're expected to hit $3 per gallon before the end of the year. Right now, they're at $3.03 on average, guys.
All right. Thank you, Inez.
Thank you.
Time now for to watch next week. We're going to start off on the earnings front, and we got some big names in the software space reporting next week, including Oracle, Adobe, and Broadcom. Oracle announcing results for the second quarter on Monday after the closing bell. Analysts saying the company's results could underscore supply challenges, but see strong demand in AI workloads. AI will also be a theme for Adobe. They're reporting fourth quarter earnings on Wednesday. Analysts expecting the conference call to be centered around generative AI advancements and the potential for monetization of text-to video.
Taking a look at the economy, monthly CPI, that's the Consumer Price Index for November. It's coming out on Wednesday. Economists forecast total CPI will tick up to 0.3%, while core CPI will hold steady at 0.3%.
And sticking with the economy, we're also going to be getting Producer Price Index data, or PPI. That's coming out Thursday morning. Both total PPI and core PPI expected to increase to 0.3 and 0.2%, respectively.
Well, from Intel CEO Pat Gelsinger retiring to Bitcoin finally hitting the $100,000 mark, it's been a wild week here at Yahoo Finance. Here's a look back at what you may have missed over the past few days.
Bitcoin hitting a major milestone as the digital token powers past $100,000.
It's going to appreciate against the dollar forever.
So they're calling it the Paul Haul, which pulled Bitcoin across 100K.
Atkins could well be a very good SEC head.
The SEC will be in good hands with him.
There was clearly some sort of disagreement between Pat Gelsinger and the board.
You know, part of the reason Pat's gone is his insistence on trying to make Foundry work.
And it's going to be really difficult to find a CEO just from another tech company to come run it.
The November payrolls report coming in at 7,000.
My first reaction when I saw 227 was, wow, I was actually a bit surprised that it was this high.
We're getting an unemployment rate that's kind of staying in the low 4% range. That's sort of the definition of a soft landing.
The total number of jobs created have been unprecedented under this administration.
Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. But many companies are still hesitant to hire new workers, and many employees are staying put. This means that competition for the jobs that are available remains high, and it may take job seekers longer to find a new role. So what sectors are seeing growth, and how can job seekers find them? Joining me now is Andrew McCaskill, LinkedIn career expert. And to see you on set.
Great to see you.
So let's start with that jobs report today, Andrew.
Yeah.
Because we were talking to economists on Yahoo Finance today, and their big takeaway was it kind of showed a labor market that, let's say, it's moderating, it's cooling, but no signs of real crashing. It kind of confirmed the story we've been hearing. But you spent obviously a lot of time thinking about this jobs market. How does it look to you? How strong? How healthy?
Yeah, I mean, look, there were not any surprises in what we saw. We saw that it was really stable, right? But the thing that I think is really interesting is that we saw most of the growth in three core sectors: in government, in hospitality, and we saw it in healthcare. Now, what that also means is that for all of these job openings that we're seeing right now, if you are in the market for a role and you're not in those industries, you got to start to kind of figure out what to do, because we're looking at a situation where there's going to be a lot longer lead times for people who are out there in the market looking for jobs. You've got boomers who are unretiring, coming back into the market, adding a new level of competition. So the competition is going to be really, really fierce for jobs, easily for the next 12 to 18 months.
What are some takeaways then you have for people? Tips, tricks, guidance?
Yeah, I think one of the first things that people are going to have to do is actually sort of really prepare for the fact that it's going to be a longer tail job search. Are you really ready? The first thing people have to do is look at the tools that are at their disposal. Things like LinkedIn, is it updated? Have you added your skills to it? Do you have a new resume? If you were hiring right now, list, right? So use every tool in your disposal. Turn on open to what people are hiring for are really, really important. Recruiters right now, over 43% are saying they're not even going to take people to the interview process if they don't have all the skills required for a role. That means you got to that are out there and say, do I have the right skills for these jobs, and how do I get those skills and fill in those gaps, or tell a differentiated story about how
a tremendous growth runway ahead of it.
So you guys looking for dips. I think everybody's looking for a dip in Amazon stock to buy it. All right, great stuff as always, Megan. Have a great weekend.
Thanks, you too.
All right, that's Megan Brantley, VP of Research at Likefolio, breaking down the consumer sentiment data on that. All seems to be pretty positive, and I've seen some analyst calls recently that naming it their top pick in internet and retail there. So we're going to look at a trade maybe that goes against maybe what the stock's been doing, because I did mention that RSI, the relative strength indicator, at 72, anything above the 70 levels overbought. So I looked at a strategy that's not, uber bearish on it, but maybe this stock's warranted for some consolidation, maybe a slight pullback, and this type of strategy takes advantage of this. I went out to the December 27th weekly cycle on this one. So giving myself 3 weeks to expiration going into the end of the year, where I'm going to buy an unbalanced put butterfly here. And this allows me to offset my costs as opposed to maybe just buying a put outright or buying a put vertical. So I made this unbalanced put fly, buying one of the December 27th weekly 225 puts, selling two of the 215 puts, and then buying one of the 210 strike puts. So in essence, within this strategy, I'm buying a bearish $10 wide put vertical, offsetting some costs by selling a $5 put vertical in here that lowers the cost. You're paying roughly about a $260 debit for it. There's your risk, $260. It takes your break even down to $222.40. That's only a couple bucks below the current share price. So like I said, it's a bearish setup, but you don't need a monster $5 or 5% pullback in the shares or even a $10 move in the stock down. You look at the risk profile here. Where's the apex of profitability? Well, it's at or near that short strike of 215. Now, if it does continue to fall and maybe your profitability goes away a little bit, but even above or below that 210 level on the stock price, which would be $14 below the current share price, it's still going to be almost a double on this one. So that's the way that you kind of look at it, where, hey, it's a moderately bearish type of trade here to the downside. That break even 222.40, that's less than 2% below the current share price in there. So this might be the way to play it if you think it's due for maybe a little bit of a pullback, maybe some consolidation. You've got a few weeks in this position. It's stretched on a technical basis. But if you're more bullish on a name like Amazon, maybe you flip this and you buy this same type of setup on a call butterfly where you can offset some costs if you think it's going to continue to move to the upside here. But that's a little bit of a contrarian look at skewed or unbalanced put butterfly there in Amazon. The debit that you pay on it, $260, is going to be your risk, $260, where you want it to grind down towards 215. All right, let's take another quick break here. We come back, we're going to take a look at another big chip maker, and that's going to be AMD. That stock is now negative on the year, severely underperforming. Remember, this stock in March hit all-time highs above $150 a share, so it's pulled back pretty significantly. That's up next here on Fast Market.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your number one broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
An approach to wealth management.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. Schwab. Have a choice in how you invest with Schwab.
Welcome back to Fast Market here on the Schwab Network. Before we take a look at AMD, let's take a look at the markets, how they're faring. We've got the S&P 500 now fairly positive here, up only 0.1%. Dow Jones Industrial Average off about 0.25%, 117 points. NASDAQ still leading to the upside, up nearly 0.7% on the back of some of these big moves in the Mag 7. And the Russell 2000, the small caps, up about 0.3%. So we're fading from those intraday highs. Now let's take a look at the U.S. dollar. Firming up here, now above the 106 level. Maybe that's causing some headwinds here for equities. 10-year yield down a couple basis points here at 4.16%. That's good. And then crude oil down nearly 1.5%. getting just above $67 a barrel. Remember, $65 a barrel has been an area of support for crude oil over the last 3 years. That might come into play if we continue to see weakness post that OPEC Plus meeting. And then Bitcoin now up 1.7%. So we're back above 101,000 for the cryptocurrency at this point. So that's making up some of those losses earlier, because when I came in, it was below 100K. So we'll continue to watch those asset classes. But now we're going to talk some more chips, and we're going to talk AMD. This stock is now down 5% on the year. It's pulled back. I mentioned before the break it was over 150 bucks a share. Yeah, it was over 150 bucks a share. It went to an all-time high in March of about $227 a share. So it's pulled back pretty significantly so far in the latter stages of 2024. Let's bring in George Tillis, senior markets correspondent here, to help us break this down. George, give me the the basis and fundamentals behind maybe this move, because if you look at their earnings are good. They're still a small share of the AI chip space, but it seems like that hype is all over, over and done with here for AMD.
Yeah, I mean, at the end of the day, it's been disappointing if you're an investor in AMD. As you mentioned, year to date now, the stock's actually down, or at least in the last 52 weeks. And so it's been sort of a disappointment after a pretty tremendous run up. I believe February was the month that we saw the $225, at least on the weekly chart, approximately high. And it's just been a slow sort of melting ice cube drift to the downside since then. And it really comes down to, fundamentals. One, you have to look at the fundamental products that AMD sells. They are, again, encroaching on the inference chip segment of the AI ecosystem and the aspects of that technology. They've been growing. If you look at that in that area, if you look at last quarter, for instance, the company denoted an increase year over year of 122% of data center sales. And you look at these numbers, you think, wow, this is incredible. Stock should be higher, but the problem is that it's a smaller portion of their total revenues slice or tranche, and effectively AMD is still concentrated as a CPU company. And if you look at some of the headlines, and I've talked about this quite often when we cover this stock, Tom, is with you and Kevin, is the challenge that AMD is facing is not necessarily the same challenge Intel is facing. So let's put that Intel aside for a moment, but both of these names have been facing competitive challenges in China. China is moving up the value chain in terms of technology production. They started off in producing low valued items. Now they're moving more into higher tech areas of the technology stack, and that includes CPU technologies. And even just going back, I believe just a few days ago, if you look at the Chinese industry groups, say that they say that the chips that are sold by AMD and Intel are no longer safe. And so what's the alternative? They're actually pushing their domestic users to domestic produced CPUs, and that's cutting into Intel and AMD sales in that region of the world. And then added to that, if you go back and look at some of the reports from Micron, for instance, Lam Research, they talked about some weakness because if you look at the earnings revisions, at least for fiscal year, next fiscal year, the estimates have been cut back slightly from $5.42 to $5.11. And if you look today, Mizuho actually lowered their price target to $180 from $185, but they do maintain a buy rating on the stock, but they're adjusting their price targets lower because earnings estimates are revising lower.
Yeah, George, when you look at valuations on AMD, they've always been pretty lofty with the expectations. CEO Lisa Su has done a really good job over the last 10 years. But when you look at this from a valuation perspective, is that part of the problem that the street's having with this name, and why they've sold off from those levels that we saw earlier this year?
Sure, absolutely. There's no doubt. I mean, what we're actually witnessing is just a massive run-up in multiple expansion. Earnings, by the way, had increased in terms of estimates, so it wasn't just completely a multiple expansion. or price relative to earnings. Earnings have moved, but the problem being is the valuation metrics plus the anticipated growth in the growthier areas of the GPU segments that AMD sells. You know, they sell a lot of gaming technologies, which are embedded in of course, personal computers. But at the same time, you know, the 3D accelerator chips that NVIDIA sells to the data center space are basically monopolized by NVIDIA. AMD is actually moving downwind a little bit, or down the value chain to the inference chip segments, providing a better value proposition for data center users. They're not as high tech processing, so therefore the CPU components of their business is really where the earnings are, irrespective of the fact that the revenue growth is where the inference chips for data centers are. So with that said, it just comes down to multiple expansion all the way to February. Now we're seeing a slow drift lower in multiple compression, but at the same time, earnings for next year are being revised slightly lower. Eventually, it'll find an inflection point, but I think that the CPU space that AMD is concentrated in has been relatively compromised. And I'm looking at Intel as, of course, a corollary to that. Now, we know Intel has its own idiosyncratic or company-specific risks, but AMD is still concentrated in CPUs, and that's unfortunate for investors who were looking for huge growth in the AI space. But now, if you look at the multiples, you know, it was trading much more expensively than NVIDIA over the past few months. Now, it's actually trading at around 33 times next year's earnings. And it's getting a lot cheaper because it was trading around 48 times just about 3 months ago. So as the price is going down, it's becoming cheaper because the earnings aren't falling as fast as the price.
Yeah, and you know, to your point here, real quick here, George, that CPU segment of their business, that's a lower margins, that's lower profitability there. But the inference side of AI, is that their, you know, maybe the golden goose for them, and you know, their chips maybe perform just as well as NVIDIA, but maybe at a lot lower price point, which might garner them some market share.
Yes. See, over time, that's probably going to be the case. They will start generating more market share in the inference technology stack, but not necessarily the 3D accelerator stack, because NVIDIA is still far outperforming them in those technologies. But they're making a lot of room, a lot of progress, let's put it that way. But at the same time, it's expensive to make that progress. And the other thing is, you know, AMD has an entire field programmable array segment when they bought Xilinx. And so those chips, which are again supplied in the industrial and the automotive space, haven't been as fruitful because the automotive segment has been weak, as indicated by other chip makers who sell to the auto market. So there's been unfortunate drags. The CPU, the automotive chips that have not been offset by the growth estimates that were previously very high for the inference segment in the data centers.
All right, great backdrop for us here, George. Appreciate it. Great fundamental analysis. That's George Tillis, the senior markets correspondent here, breaking down AMD for us. But now we got to get into a trade on this one. And you're going to see some similarities with Joe Mazzola's when we talked to NVIDIA earlier in the day. The stock's trading about $140 a share. So I wanted to look at a directional bias trade with the stock down 5% on the year, severely underperforming the sector and the overall market. If you think this thing's going to rebound, maybe into earnings on the 28th of January, this type of strategy takes advantage of a move higher in the stock while offsetting some of your costs on a bullish type of trade. Went out to that same January 17th monthly options that expire in 42 days. We're going to buy that at the money 140 strike call, and then against it to offset some of the costs, because maybe I think it's going to go up, but maybe I doesn't you know, get above a specific level. I picked the 155 call to sell against my long 140 call. So a $15 wide bullish call vertical here. I'm paying roughly about a 570 debit is what we got up there. You can buy this thing for $5 right now because the stock has come off of session highs from when we looked at it earlier. But if you pay that 570 debit, any debit that you pay on this type of strategy is going to be your risk. So if you pay 570, it'll be $570 in risk per spread. If you pay $5, it's going to be $500 in risk. So whatever the price you pay on a debit spread like this is going to be your risk. You can see if you pay $5.70, that takes your break even to $145.70 over the next basically month and a half. And that's basically what, $5 above the current share price in this stock. Now, when you look at this, some people might go, well, why'd you do the vertical as opposed to just buying the 140 strike call out in January? Well, for the vertical, you're paying about $5.70. For just buying the 140 call, you're going to be paying about $7.70. So you're offsetting some of the costs on that bullish sentiment trade while still taking advantage of upside. Now, what can you make on this trade? Well, you take that $15 wide vertical, you're paying roughly about $5 right now. So you can profit about $10 on that. So, you're paying 1/3 the width of this type of vertical. So that gives you that. Now, how much is that call that you're selling at 155 offsetting the price of the $7.70 call that you're buying on the 140s? About $2.60. So you're saving yourself about $2.60 in risk on this type of position by doing the vertical as opposed to buying just the straight 140 strike call. So a good look. And those were the same strikes that we used on the NVIDIA trade too. So this is definitely one that you need to move to the upside to get above that break even, just above 145 on the bullish call vertical. That's going to do it for us today here on Fast Market. But stick around right here on the Schwab Network. Next Gen Investing is coming up.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com on all your streaming devices. Schwab Network is available anytime, anywhere, on any device for free. No place better than the Schwab Network. Join me, Oliver Rennick, alongside Schwab Network's options experts as we on is a brand new limited series to take your trading skills to the next level. Subscribe to Schwab Network's YouTube channel now.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide. No overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. Also, you can trade brilliantly.
Horn, and today joined by Diane King Hall, who is coming to us live from the New York Stock Exchange to be my co-host for the next hour. So Diane, excited to talk all the enthusiasm post-jobs number. And I know we looked at this earlier, so we had a fresh glance at these figures. I have to say, I don't know if I would have guessed that the markets would have held on as well as they have. I know Dow slightly maybe seeing a downtick here, but all things considered, I mean, there was things to like, things to not like. The market hasn't really seemed to care.
It was overall a good report, it's one of those kind of Goldilocks report, not too hot, not too cold in terms of the numbers. I mean, we beat expectations in terms of jobs added to the economy, 227,000. Yes, the unemployment rate ticked up to 4.2%, but that was in line with expectations. And then when you looked at kind of the sector breakdown, that boded well just for overall terms of what's been supportive of the market and the expectations for the Fed's path from here. It wasn't anything in terms of market watchers are looking at this that would take away from the expectation Fed would continue on its rate cutting cycle in this December meeting. In fact, you saw the odds increase for that. Now, it's not 100% odds or close to 100% like we saw in the last cycle, but still the odds are more in favor of that future rate cut. Just days from now, honestly, the expectation. And so you see that playing out in terms of the market action with some of the risk on, not as much risk on as we've seen in terms of the acceleration in the market, because, we've talked to different voices who've said, okay, maybe it's a little too far, too fast, but it's hard to hit the sell lever when you see kind of all the economic data. And of course, we had that consumer sentiment data that was supportive as well, which came in better than expected. Now, you did see some division, which matched up with other sentiment data that we've seen across party lines, but overall sentiment is strong and consumers are the backbone of the economy.
I liked the report that said that consumers, though, faith in their personal finances hit a 5-month low. And Tom White and I were joking, wait till January. We have all the post-holiday spend, and then we'll really be at some lows here. But
holiday hangover.
The holiday spending hangover, which I've already started buying, and I already have that right now, it feels like. But it's actually been amazing to see this rally without the participation of NVIDIA. And then, most of the Mag 7 names, actually, I guess Apple and Microsoft lower, but no NVIDIA love today as they have their own more specific EU news, I know. But markets are doing okay without their behemoth of NVIDIA.
It's true, but you do have some help from Meta today, and obviously that's a different story. Higher ahead of that news about TikTok and the appeals court supporting or moving in favor with Department for a ban of TikTok. That's helpful, obviously, to Meta. So you've seen Meta hit an all-time high today. So obviously a different story. Like we talk about, some of these in the mega cap tech sector have been idiosyncratic stories about them. But in general, we've wanted to see this throughout the year, broadening out beyond that.
I know, and I entirely agree the way that people were almost condemning like the strength of the small caps. It's like, wait a second, the underperformance of this market has been so many of these smaller companies. I think it's actually encouraging to see strength outside of some of the semis. So even NVIDIA, I'm saying like the lack of strength in NVIDIA, it was still up 5% on the week into today. So now it's not too shabby of a week for NVIDIA here. But as always on this show, we will start things off with upvote and downvote. We'll be going through actually two different themes here. We'll look at retail. We're diving into Lululemon, which is now the best performer in the S&P 500 today, pacing for its best day since 2008 on some really strong earnings. And we'll also be seeing more of the strength ahead on this show. We're talking airlines that have been on a tear. Americans up 20% this week. HP that's rallying today, up 13% this week. So a lot to be enthusiastic today, Diane. We're definitely talking a full Santa Claus rally here. But to start things off, we'll look at some of these moves with analysts with, of course, upvote, downvotes. These are not recommendations. We'll start off with Molson Coors. And an amazing fact that found when looking at Molson Coors, which this has nothing to do with the news today, but I think illustrates maybe its size, is if you took the market caps of Brown-Forman, Boston Beer, Constellation, Molson Coors, and then just for fun, add all the pot stocks like your CGCs, your Tilray, Kronos, that actually is still smaller than Anheuser-Busch. So that is amazing to me, how massive the Bud Light brand, the parent company tied to that. But there was a mention of that in this note today, which to me felt like we were talking about the news of 2022.
I know, right? I remember that, all the controversy around that. So it's B of A who's boosting their view on Molson Coors. They've boosted their rating to buy. Previously had a neutral rating on it. They boosted their price target to $70 a share. They previously saw it at $57 a share. Here's the thesis behind why their view on Molson Coors has changed. They said that they believe that 2025 will be a return to normal for the company and the overall beer industry, and that kind of that Bud Light controversy, which it seemed like it was in the rear view mirror already, will essentially be in the rear view mirror, and that the beer industry will kind of line back up with more of what history has been challenging in 2024. It hasn't just been challenging in 2024. Controversy aside, there had been some downtrends in terms of just drinking overall and drinking trends. So that had affected it. So now B of A saying they forecast that it will be a better year. And they also think that cost pressures, that inflation will be manageable for Molson Coors, even they said with the potential for higher aluminum costs. Obviously, that's a big factor that Molson Coors has to be mindful of. They talked about their free cash flow. They thought that was strong and that their debt leverage is moderate at this point. So it doesn't see that as a potential problem, and that Molson Coors, it's managing its free cash flow and its debt levels in a way that they will be able to continue buying back shares.
Yeah, and I'm glad you mentioned the aluminum cost, because I feel like that has been an entire sector major headwind that is, I think, under discussed, frankly, because you look at some of the underperformance of, Molson Coors is actually doing relatively well compared to some of the lagging we've seen from these other more staple or discretionary staples, I'd almost call it, like Celsius, which is our next name today. And I will say that we have some news that was positive from the analyst community, but Celsius's chart is brutal. And it's almost
this year.
It's terrible, and it's unlike Celsius. this was a growth engine. This was the stalwart of like the growth in the energy market. That has not been the case, unfortunately, as of late. And I'm a tried and true Monster Energy girl, so I cannot necessarily pledge any Celsius allegiance because I drink it, but I do know that it is very much a loved brand around this office.
It is a love brand, not around the office in general, but I don't see it as much as I was seeing it last year. So you wonder if there's been a little bit of bite there, and Monster does still lead it in terms of market share. So here's the deal here. Needham is initiating coverage on it. They're initiating coverage with a buy rating, so they are a believer. There's conviction behind their view on Celsius. Their price target is $38 a share, so it has more room to run from this level right now, just about $28 a share. Shares rising a little more than 1.5%, about 1.75% at the moment. They say it's on their conviction list. They have confidence in the potential for it to run higher from here. They have a positive outlook from there. They say even in the face of what seems to be slowing consumer trends for it, they see it as it would be the third player in the energy drink sector. And that plays out in terms of how we see the numbers. Red Bull has been the leader, Monster as well. And they talk about just consumer preferences for no sugar or low sugar products, just healthier in general. So that's one of the things that we've seen in this. But again, to your point about Monster, Monster has been ahead of Celsius. Neither stock has done well, if you will, relatively speaking, but Monster has done better than Celsius this year. So they are getting a boost today off the back of this.
That is true. And Monster has not had encouraging earnings, although I will say I don't buy into the whole like Celsius is healthier thing. I defend Monster because I'm like, it is all chemicals. So let's not, I know, frankly, like the greatest PR ever is the fact that Celsius has targeted all these like fitness influencers and all these people to promote that like it's a pre-workout drink, which I think has been a huge part of its growth and its success. Unfortunately, just I think right now somewhat getting ahead of itself, and costs are not cheap for all these names. But to completely shift gears here into more of our retail theme now, Alta, which is a major winner on the session, has not been a winner on the year, but up 10% today. So I feel like we've seen really encouraging earnings moves today from everything we got last night.
Yeah, it did. It beat expectations on both the top and bottom line, and then in terms of the road ahead. So it's a beat and a raise in terms of its guidance for the full year, for the fiscal year, saying it expects revenue to come in a range of 11.1 to 11.2 billion. So that is a little higher than their previous guidance. Full year earnings, they're expecting that to come in a range of $23.20 and to $23.75. That's up from their previous range, seeing $22.60 to $23.50. For the full year, they're expecting comps to come in essentially flat to a possible decline overall of 1%. Now, comps did improve in this latest, but up just 0.6%. So nothing compared to what we saw previously, but it does help in terms of the trajectory that we've seen. Alta faced some headwinds this year. They've talked about the challenging climate. They've talked about the competitive landscape. We talked about, you and I have talked about that before as well. They did see an increase in this latest quarter in customer transactions on both its website and stores. Those increased about 0.5%, and the average ticket rose as well, the amount consumers are spending. So the average price rose, the increase year over year. One of the things they did that I thought was neat is they leaned into this whole Wicked experience. A lot of times, you know, you feel like there's an experience, there's a trend going on, and they leaned into that. They had some exclusive makeup tied to that, to the movie. And so that seemed to help in general, Jenny.
Okay, and I was going to mention that. I think it's such a good point. I'm such a Wicked fanatic that for the first time, I think in my life, I thought about going to maybe an Ulta because I do not enjoy beauty shopping in that sense. But I was like, hey, Wicked could maybe get me in the doors of an Ulta, frankly. And encouraging that obviously resonated well. I think so many of these cosmetic and makeup companies really follow these trends. And so I think it's always encouraging when they can mention they're very much on trend right now because Wicked is everywhere as far as I can see. Last name today, though, has been one of our strongest performers in retail this year, Abercrombie & Fitch. I will say, not seeing the same degree of strength as of late, but I mean, all things considered, I'm greedy at this point because it's up 73% on the year. We've pulled back, sure, 22% from highs, but this is still objectively a winner on this year.
It is. And look, Abercrombie & Fitch has done really well ever since they've had this, this kind of turnaround story. Fran Horowitz, the CEO of the company, has really been working on changing the company and how it operates, because you remember for a while it was super popular, then it lost some of its luster, and it staged this comeback under Fran. So here's the latest news. Raymond James is initiating coverage of Abercrombie & Fitch. They've got an outperform rating on it. Their price target is $180 a share. They talked about the substantial progress in the company's transformation. They've been working on this for a while. Their projection for fiscal year 2025 EPS, they're projecting that of $12. That's higher than the overall what the street is looking for. Street looking for $11.21. They see that the revenue trajectory will be supportive of that view and just overall margin growth. Raymond James saying, quote, A&F, Abercrombie & Fitch has significantly revamped this business over the past few years by improving product, widening its customer aperture. It has done that. And closing underperforming stores. And of course, you can't forget about the digital experience, Jenny.
I know, and you even go into a store, frankly, and it's so different than what I remember many, many years ago when it was like dark and the music was blaring, and I mean, it was like a very stressful experience. I can attest to the fact that the one that at least opened by me is a delightful, bright, quiet experience. Very, very different than what I was used to growing up. But we'll be looking actually more into some of these names that are seeing this nice outperformance, more into Abercrombie as well as Celsius with our chart master coming up next. We'll also dive into some example trades. Stick around. Next Gen Investing. We'll be right back.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close. No place better than the Schwab Network.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Schwab Network.
Trading at Schwab is now powered by Ameritrade. Giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly. Schwab.
What's up, Carl Nation? It's your #1 broker with the best wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and
Technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
And Celsius and Abercrombie and Fitch. And honestly, Rick, habitually, I call Celsius a winner because that's what it has been for so long. It has not been that way as of late. It's like I need to erase that muscle memory because we've pulled back. I mean, now 47% roughly.
It's been a big reversal of fortunes for this name here. And if you backtrack a little bit on our chart, you can see that right here we hit highs 99.62. Couldn't quite make our way above that previous high close, not even close either to those intraday highs. So it gave us this kind of M-shaped price pattern here, which did eventually lead to a breakdown below those previous lows all the way over here back near like so. So now the prevailing trend is pretty close to our here from our initial high point. We have been trending downward. It's been pretty consistent across these highs here and then here once again here, kind of getting rejected most recently at this confluence of the trend line and the 50 midline that separates the bullish and bearish momentum. You could also argue here we have been trending up here, kind of making this series of higher lows. But if you were looking for the bullish divergence to play out, it did not go very well for you here. We just kind of kept trending lower here. That's why we say so often, don't just make decisions based on one thing, on one indicator. Prone to fake outs, not the most reliable thing. You need a more complete picture here. This is a good example of how things don't necessarily work out the way you want them to every single time here. And this would have been a pretty dicey situation, to say the least.
Yeah, I think a great point there because, you can find, if you really get into the weeds, you can find any technical indicator that could prove what you want to see. But I think sometimes you have to look at everything to see what you actually possibly should be seeing. So when we look now at price, though, for Celsius shares, where do we go from here? Because I think that we're trying to recover. We have risen off lows, but unfortunately, it hasn't really seen much of a momentum to the upside. I know we're sort of just now hanging out at this new range.
Yeah, kind of hovering around our yellow 21-day EMA. And you're kind of right, Jenny. You can find indicators. You can find whatever you want to kind of give yourself that confirmation bias. Maybe that's why it's better to keep it simple sometimes and just look for kind of the big thing. This is one of these kind of simple areas that stands out really noticeably to me because it was the site of the high point before we had a gap up and then a repeated stopping point for price as well. And you 30.50, that's also kind of where we topped out today. So remember this area near like 30.50, all the way up to here to this other confluence, our volume profile point of control, our linear regression line, our line of best fit, that's our solid blue line, our 63-day EMA, all come together right around 32. So 30.50 to 32 or so, that's the area I want you to remember for our example trade. If we were to keep moving beyond that here, you know, these are the kind of recent highs around 36 or so. To the downside, 25, 23, then maybe this old trend line could come back into play around 22 as support. And when we look at our long-term chart here, Jenny, really, you know, kind of illustrates the difficult situation here. And really, though, we're back in the range. We're in very familiar territory. We're at the volume profile point of control once again on a 5-year look here. Momentum not faring quite as well, but you know, it's not as maybe terrible as it might seem on the shorter term. We're kind of just back to where you know, we kind of belong in one sense.
Yeah, and I will say this is not the most discouraging of the longer term charts, because anytime I look at the 5-year weeklies of like some of these software names, for example, you zoom out and you're like, well, wait a second, what even have we done over the last year? This at least feels like we've just retraced back to, I mean, previous levels seen now about a year and a half ago, which isn't the worst thing. At least don't see highs that were made 5 years ago at this point, which I guess is something. But when we look at trading this name now, of course, for example purposes only, if we were looking to lean into more of this recovery and hoping for a lot of these staple names to see a rebound, it's not just Celsius that's seen this weakness. Of course, it's Monster. It's all these various beer companies Diane and I looked at earlier. I mean, what should we be watching for trade purposes?
Well, you know, an example trade got me to thinking, you know, we got a bullish note. We have a situation where we could be potentially breaking through a major resistance area. So I thought, you know, we could craft an example trade that's more bullish here. So what we thought about was +1 January 17th, 30-40 strike call vertical. So a $10 wide call vertical. This is a bearish trade or bullish trade, obviously. 42 days out. Break even would come in 30.75. So debit paid plus our long strike of 30 there. That would be about 12% to the upside. It would take about a 40% move to get to that max profit of 40, coincidentally. But, you know, maybe that'll happen. Maybe it won't here. The point is that our kind of break even is centered around that area I mentioned earlier, between like 30.50 to 32. So we're kind of looking for a push above that point and then a breakout that could take us further here. So I kind of played around between the 35 and 40 strike for our short call here. It was a difference of about a 50-cent credit. But when we do it this way, our max profit potential is so much bigger, and we only had to pay like $50 more. So I thought this maybe made more sense here if we do get some kind of runaway move. Max loss 175, debit paid. Max potential profit 825. And the expected move for this one is $5.75, which would be like $34 or so. So our break even is well within the expected move. So this would be a trade that, you know, what would be have the probability more on its side than maybe another different structure.
Yeah, and obviously favorable, I mean, profit and loss comparison there, because you'd be obviously risking 175 to make 825, so not too bad there for a hopeful Celsius recovery. But now shift gears here and look at a name that this name has still been a winner, and that is Abercrombie & Fitch, because the story of the turnaround of this name, I mean, should be studied, because as far as like an economic standpoint, it has been so amazing to see the financials match even the various consumer preferences. This name has fallen so out of favor and has been on nothing but a hot streak. I mean, I know mixed earnings, we have seen some chop as of late, but it's up 72%.
Yeah, you know, just from my personal experience, very popular brand when I was growing up. And like you said, it seems like it kind of became passé, maybe like kind of less popular. But here we are once again. And, you know, we can see that the chart has been pretty interesting here. Very consistent, symmetrical triangle type shape here, where we have one trend line starting with this notable low point here, kind of connecting here. It's not really very well here, but here and here as well. It kind of depends on how you draw these things. You know, different people might have drawn it slightly different, maybe connected these points a little bit better. I try to go with connecting the most points in the best way possible. This is kind of how it looks to me. And then to the downside, starting from our high, going down along these subsequent highs, we can see things get a little messy recently. We had some upside tests. We didn't quite make a convincing close above that level near like 160 or so, but we've definitely made some forays into the area above that boundary. We're above our moving averages, heavy volume during these upside pushes here. So really one that seems like it could be primed for maybe a push if we start to break above some of this resistance near like 155 to 160.
Yeah, and I guess that obviously if you're taking on a bullish stance here, you would say encouraging that we've pulled back from highs. So now you'd be getting it, I mean, obviously at a 22% discount to where we were seeing levels earlier this year. But with momentum, I mean, again, are we seeing this sort of follow suit with some of its recent price trends? Are we seeing any divergence?
Mostly kind of matching up with price here. And you can see we've got like a matching triangle shape between our green and red lines here on the RSI. Maybe a slightly more bullish bias as we are above that 50 midline here. But what you'd really want to see would be a concurrent break above both trend lines on price and our you know, a bit of a very tough fake out here because we did look like we were breaking out on the RSI as price made a nice close above that level, but it was not to be. You know, these the kind of fake out situations can be really frustrating and hard to swallow here, but you know, we could still keep going upward here. We haven't really broken down through any levels. We're kind of just back where we were before. So low volatility, often a precursor to high volatility. That's why we look for these patterns where price kind of keeps coiling tighter and tighter, because then it can have a big breakout eventually.
Yeah, and of course we are heading up, or really we are in right now a very pivotal time of the year for these retailers, especially a name like Abercrombie and Fitch, as it is right now full holiday shopping. I feel like everywhere I go there are deals and reasons just to spend and buy things you don't need, frankly. But now to close things out and look here at some levels up for price that we're watching. We obviously had earnings last week, so we have that catalyst behind us. But hey, a name that's been able to hang on to a 94% gain over the last 12 months.
For sure. To the upside first, maybe 155 to 160, kind of this area right here, maybe even like 165 would be better. Matches up with this volume node, matches up with kind of the recent highs we've seen. That would be the first area the bulls would want to overtake. Then around here, 167, kind of the next set of highs. Then here, this is the area that I really was curious about. 173 matches up with the volume node. It's a notable high point from back there. So once again, remember this area because it's going to come into play when we do our trading next year. But to the downside, if we do break through our moving averages and fill this gap, so that would be like 147 and then 142 respectively, right around here, the lower end of our triangle shape here matches up closely with the volume profile point of control, so around like 137 or so. And when we do look at our longer term chart here, you can see really nice move to the upside here, kind of giving us this very pronounced triangular shape here in the shorter term, but really all the volume all the way down here on this longer term look here. So you could see a big push if we start to break above some of these levels here that have been established.
Yeah, and again, I mean, and this is the perfect example of when you zoom out and things only actually look even better, frankly. And I know we've dipped, but it's been as impressive as a return to growth as I've ever seen of a brand. Yeah, passe is putting it nicely. I feel like Abercrombie & Fitch was effectively canceled and then has been brought back to life. So it's encouraging to see. So now when we look again at an example trade in this name, I mean, we have pulled back from highs, so it's not like we have to look at shares at all-time highs as far as price. It's actually valuation has come down reasonably. It's a little high for the apparel space. I think it's like 25 times, but all things considered, the growth has been there. So what do we watch for now for example trade purposes?
Okay, so here was my thinking. We got a bullish note. The chart looks pretty decent here. We have an area that caught my eye around 173 or so. So I started looking at the expected move for, once again, our January option series, the January monthlies here. The expected move was 23. That puts us right at that level, right at that I was talking about, around 175. So 173, 176, 175, around that area was my point of interest that I guess I would call it here. So I put together a butterfly, +1, January 17th, 160, 175, 190 strike call butterfly at a 225 debit. So we're selling 2 contracts of the 175 strikes and we're buying 1 each of the 160 and 190. So we're equidistant from our middle short strike here to give us this triangular shape here, like a pyramid shape basically here. So best case scenario, we close right at 175. Our options expire at that level. Max profit 1275. Max losses are debit paid 225 here. And we've got kind of a nice big area of potential profitability here. We our break-even points 162.25 and 187.75. So that's like 6% and then like 22.5% to the upside. So as long as we kind of stay within that boundary, this trade would be profitable for the most part. If we do get some kind of crazy extreme blow-off move to the upside, well, at least our losses are capped. It's our debit paid. We can't lose any more than that. Same deal if we get a bad downside move here. But once again, if we do look at the expected move, it lines up pretty well with our short strike here. So it's certainly possible. And even if we do get a bigger or smaller than expected move, the range of profitability is quite large relative to where this thing trades.
And as we always say, also a highly customizable trade, so you could adjust as you see fit, of course. And we know that there's been crazier January, so we'll have to see how that month fares, but at least protected in terms of some downside risk here and sort of mitigating that risk when looking at trading into what should be an interesting start to 2025. But appreciate it, as always, Rick Ducat, our chart master. And now coming up next, we will talk more strength in retail. We will be looking at Lululemon's pretty phenomenal session here. We pulled back about $4 from session highs, but all things considered, a name that's the best performer in the S&P 500 today.
Empower your portfolio with the Schwab Network. Schwab available anytime, anywhere, on any device for free. Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? $25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
Get each and every angle, the whole picture. Everything comes full circle on here at the New York Stock Exchange on Trading 360, only on Schwab Network.
What's up, Carl Nation? It's your number one broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Accelerate your market
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Work.
Welcome to Next Gen Investing. It's now time for FOMO. And joining me, of course, is Dan King Hall, coming to us live from New York. And we are talking all things Lululemon. And it is about time, Diane, because I have watched the demise of this name over and over again, earnings after earnings. And finally, some love for Lululemon, which admittedly, I mean, this show unintentionally is like where I spend all of my money. It seems like everything we've talked about. Lululemon, though, I mean, this is an international story, frankly. I can say I contributed this quarter all I want, but it was really everything that happened overseas.
It was. Yeah, it was an international story, but Lululemon needed this win. They beat expectations on their latest quarterly numbers. Revenue came in at $2 $2.4 billion. That was up from $2.2 billion the same time a year ago. Lululemon's had a tough year, and one of the challenges they've been facing, which is still a headwind, although you saw some improvement there, is U.S. markets, because same-store sales did grow. Same-store sales grew 4%, right? But a good chunk of that, came from international. They talked about international and Canada. While Canada may be in North America, again, the strength, they talked so much about China within their earnings call after they released their announcement. So you saw some strength there. U.S. markets, though, domestic falling about 2% in terms of same-store sales, which is an improvement over the prior quarter. So you are seeing some slowing in terms of the challenges that they're facing there. And there's been talk about the competition that they're facing because, you see Aloe everywhere. Everywhere I look here, I see Aloe, not necessarily at the exchange, but in New York, you see Aloe. So that's one of the competitors for Lululemon, and of course Gap's Athletica as well. But this quarter was solid. They brought consumers back in. They even gave some color. This stood out to me on their earnings call about the holiday season, and analysts wanted to hear more about what that's going to look like, especially when we think about these consumer-facing companies and then the retail sector in general. How are the holidays shaping up, especially with the shortened holiday season this year? So they said they saw good traffic over the Thanksgiving weekend. They saw solid traffic both in stores and on e-commerce platforms, whether we're talking about mobile apps, etc. On Black Friday, they said they had the most visits ever to shops, apps, and e-commerce. They don't run sales events, as we know, across the entire store, for instance. Every now and then they do things like, for instance, send stuff out to the outlets. But they saw increased traffic. So that does look good for the holidays. They said guests responded well, even with these full prices that they're paying for the inventory. They said they feel good about the start of the holiday season. They're expecting some large volume, but they said, this to me is the caveat that stands out. We continue to be thoughtful in our planning for quarter four overall, given the shorter holiday shopping season, Jenny.
And that has been something that's mentioned now time and time again. And I feel like it's the warning of disappointment, because I don't tend to think you mention that if you think it's going to knock it out of the park by any means. And I was trying to find the skeptics of this name, just because naturally to keep things balanced. I did see as many of the 16 of the 38 analysts, according to FactSet, that cover this name, did raise their price targets today. One was the new street high of $440 a share, so some nice upside, obviously, from where we're trading. But Jefferies actually took on a more negative stance. They kept their underperform rating and said sell really into any strength today that we have seen. They said competition remains fierce and is not expected to go away anytime soon. Rapidly expanding its store base and positioning stores near Lululemon doesn't necessarily bode well. They also did say that gross margins are unlikely to continue rising as inventory levels do increase, and that based on some of the uncertainties in the overall macro environment, that they think that there's international growth, sure, but that's unlikely to be sustained. And I will say, I do think that's kind of a good point, because I was looking at this name this morning with Oliver Rennick, and we were somewhat like joking. This is the only company where China has been a positive. I mean, it feels like every company with international exposure, especially to the unfortunately lagging recovery of the Chinese economy, it's been a major negative. But Lululemon, it was their point of strength. So that does make you say, if it's an outlier, I wonder how long it really lasts.
But it is, again, a position of strength. They mentioned China 15 times on their earnings call. Does it still trail the U.S. in terms of mentions on their earnings call? Yes. But again, that is nothing to sneeze at in terms of where the demand is there. By region, you saw that jumped majorly in China. They said by region, China mainland increased 39% or 36% if you turn it over to constant currency. The rest of the world grew in terms of demand there, but China saw major growth, especially when you compare it to the Americas. Now, this was another interesting piece to me when from their earnings call, Jenny. Men's increased 9%, whereas women's and accessories increased by a smaller amount, by 8%. And that's something that you've noticed over the years with Lululemon. They've been leaning into merchandise for men, and I know Oliver has talked about this before, as he shops there. So obviously he's not the only one. That's one anecdote, but it shows that there is demand there in the men's space for there. Now, in terms of the U.S., they said they have been working on improvements or actions to drive improvement there, because they do need to improve it in terms of what you said, especially about how analysts are looking at this, how shareholders are looking at this for the U.S. business. They have a new reporting structure. Obviously, that means there's some changes to how the management verticals operate, but they're also trying to introduce some new items. They said seasonal newness by the first quarter of 2025, updated colors, prints, patterns. So that would give, they want to give more options. I don't usually recall a lot of patterns there, so that may be something that we'll see more of in 2025. Jenny?
I liked that they also mentioned the baggier style clothes, which I was like, yes, more and more loose fitting. I feel like for a while it was a little bit too form fitting at Lululemon for me. So I was like, baggier clothes are definitely also, I think, in. So it's funny the way that they mentioned some of these trends that you see obviously in real time. And this market has become so saturated. I mean, they're fighting for their very small sliver of market share right now. I do like the story of them expanding overseas because, frankly, there's a luxury market to explore. It's in China. And not to say this is a luxury name, but gosh, I mean, I've been in them too recently. As of late, it's not cheap.
It is a luxury name when you consider that space. It is considered. So it may not be luxury in the sense of, when you compare it to full out like an LVMH, complete luxury. But in terms of, I mean, it's known for leggings and athleisure, where it is considered luxury, especially when you consider the price point and the fact that they don't really sales events. Every now and then you may see an item make it again to the outlet, but they don't do sales event. Now, one day obviously doesn't make a trend. The stock has been under pressure all year, but it is certainly a step in the right direction for that. And as you mentioned, some of the analyst commentary around it, a lot of analysts seem to support of this. There are who don't have conviction around this, but I saw more increases to price targets and maintaining negative commentary on Lululemon. One of the challenges, obviously, in this space, though, is not just its competitors, but the change in of clothing that people are buying in general, because the return to office trend has pulled away from athleisure. So that's one of the that say Lululemon or a Nike faces, even Athleta. The good thing with Gap is they have more than just Athleta.
More into their streetwear, which I appreciate, because again, I can't just be always wearing various sweats, but I do like their various offerings. Right. I also noticed the store by me is now half men's. It used to just be a small section. It's a massive portion of the new store by me, so it speaks to exactly what you said. And again, to find that the bear of Lululemon, it was because you're right, definitely more optimism than not today, and celebrate. A really nice day. Second best performer now on the week in the S&P 500 and pacing again for its best day since 2008, which is amazing. But of course, for Lululemon today, which is up just shy of 18%. Coming up next, though, the enthusiasm continues, frankly, when we look at airlines, especially American Airlines, which has gained 20% this week. Modestly pulling back today, up about 0.25%, but altogether a space that's been on an absolute run post the election.
Trading the trending names every day. I'm Tom White, host of Fast. Ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
No politics, no noise, from bell to bell and beyond. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
Welcome back to Next Gen Investing. I'm joined by Dan King Hall, who's coming to us from New York, as well as now Kevin Green, senior markets correspondent for the network. So Kevin, we are ending this week on a pretty positive note, looking at American. I mean, the various airline space, I think, has been so interesting. And I also think maybe, and this is obviously my own opinion, but underreported how well it's done post-election. I mean, United even is having its best year on record. So any concerns about travel demand dampening, I think were just completely squashed when we saw like TSA numbers through the roof last weekend.
Yeah, you are seeing a little bit of a bid when it comes to the airlines, pretty much across the board here, Jenny. And you're right. Usually from a seasonal standpoint, because of the Thanksgiving season and going into the holidays for Christmas and what have you, we do see a bump in travel. And that usually also coincides with investment flows going into the airline companies themselves. And they've had a really nice run over the last year here. Now, you can make the case that the valuations might be a little bit stretched, but we are seeing some guidance actually being adjusted here, both for American Airlines as well as Southwest. Now, American is trying to hold on to gains here for the most update their adjusted earnings per share guidance, upping that to 55 cents to 75 cents. That's the new range, up from 25 cents to 50 cents. And their revenue per seat mile guidance also got revised up to flat to up to 1%, and that's up from down 1% to down 3% here. So they do see some optimism. Obviously, travel and demand is boosting some of their morale, and they also probably guided a little bit light before the election as well. There was a lot of commentary that travel was kind of slumping here a little bit for bookings up until the election, and now we're probably seeing this post-election travel boom that is taking place. So American is moving to the upside here today. We also saw Southwest. They also upgraded and their guidance, but they're actually sliding here today because the cost for available seat mile is actually increasing at a pretty healthy clip, and they've got some issues when it comes to trying to manage capacity here. But from a broader index standpoint, the airline indexes out there, they're doing really well for this year.
Kevin, when you say the valuations are a little bit stretched, are you talking about, say, American or Southwest? I know they've been trailing, say, United, obviously, it's been the outperformer among the bunch, followed by Delta. Both very strong performance, both beating the S&P 500. American had its own self-inflicted problems this year where they had that business, the way they were doing business clients, like one individual name.
I would say if you look at United, American, and Southwest, I mean, even Southwest having their issues, the stock appreciation has been pretty great for this company. But when you're kind of looking at the top line growth, yes, obviously you can make a case that they are growing. But when it comes to marginability, it's just still a little bit difficult for a lot of these companies. Now, when you're looking at United and American Airlines, they have a little bit of a leg up because they have international travel. And international travel is a lot more profitable and scalable for their business rather than domestic travel, which has, for the most part, kind of been stagnant outside of this recent bump that we've seen over the last 2 weeks. And so when you're talking about kind of that valuation, the capacity that they're bringing online in 2025, pretty much everything has to hit on all cylinders for these companies to continue to beat and raise their guidance in order to make sense of the multiple. And nothing against the airlines by any stretch of the imagination, but it is very hard industry to really try to trade. And you would say, 70 to 80% of the inputs for their business is out of their control, right? From weather to fuel costs to consumer debt and consumer spending. And so it makes it fairly rich for right now, even though the consumer's fine. It always can change on a dime. That's usually the trend that we see in the airline space.
It's so true, really. Because I feel like the momentum we've seen pick up has taken such traction, and it's like the massive turnaround story, but nothing has fundamentally changed in these names. So I think a great point, and the way that, unfortunately, for these companies, they deal with a lot of factors that are out of their control, which is nicely put. I believe Oliver Rennick was very upset about his flight situation on Sunday, but I was like, hey, 3 million people.
He's always flights, Jenny. Let's
common theme here. Yeah. Who's the common denominator here? I agree. Although I will say I'm also habitually a bit late to my flights as well. But we'll leave it there for our airline discussion. Appreciate it. Kevin Green, Senior Markets Correspondent for the network. Now, coming up next, last but not least, it's time for Under 30. We are looking at Hewlett Packard, which is seeing a pretty nice session today following its earnings. So we'll dive into more optimism coming up next.
Empower your portfolio with the Schwab Network. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Welcome back to Next Gen Investing. It's now time for Under 30. As we wrap up the show, we are talking HPE, which is seeing a nice move on the back of its earnings. And joining me now is George Tillis, as well as, of course, Diane King Hall. So, George, we'll start here with what is driving a lot of this momentum. I mean, the earnings report was objectively strong, but I feel like this strength has been a lot of these names that haven't fared maybe as well in the AI hype are now doing phenomenal on the back of their earnings.
Yeah, I think if you look at some of the legacy players in the networking space, I'm going to use Cisco Systems as an example. That stock, which sells Ethernet cables and connectivity solutions to large enterprise customers and data centers, that's performed well. Companies like IBM and Hewlett Packard Enterprise, also in the IT infrastructure product and services space, have performed well because of the fact that they design systems and infrastructure solutions for data centers. And we know that there's a tremendous amount of demand for hardware and software, as well as networking solutions. And particularly now, there seems to be a trend in the market where companies like NVIDIA, which is the lead architect of hardware, GPU accelerators, has taken a little bit of a backseat to some of the network providers, as well as the infrastructure software companies like Hewlett Packard. And so they're essentially part of this mega secular trend in data, cloud, and connectivity. And effectively, they're hitting new 52-week highs on the back of some positive results in earnings, which is also quite compelling based upon the company's provisions. If you look at the EPS numbers, they printed an 11% increase compared to last year at 58 cents, beating the 56-cent estimate, and sales came in slightly higher at 8.46 billion versus 8.26 billion. That was higher by about 15% year over year. So when you start to see the sales figures improve more than EPS figures, but the stock is moving higher, suggests that HPE is spending quite a bit of money to keep up with market demand. And I think that's the case for Hewlett Packard, as well as some of the other legacy players in this particular ecosystem. And that includes Dell Technologies, IBM, and Hewlett Packard also together seem to be moving very aggressively to expand their business offerings in artificial intelligence.
And George, really quickly, they talked about the refresh cycle, expecting that to be 12 to 18 months. Does that bode well for kind of the continuation of the trend that we're seeing today?
I think so. I think, first off, the trend speaks for itself, and you got to go with the trend. You don't want to go against it. The second thing is just my interpretation of the report. When you see earnings growth or the rate of change less than sales, it gives you an idea the company is really manifesting into investments for the next few quarters, at least maybe up to the 6 quarters going forward. So, again, sometimes that can be a hang up or create a problem for price ascension. But it doesn't seem to be the case here for Hewlett Packard, because if you consider the estimates going into this quarter, trailing and even on a forward basis, sales were actually very much low in the low single digits. Now they're expected to be earnings, which were in the mid single digits. Now they're expected to be a little bit on the high end. So it's a company that isn't growing a tremendous amount, but a small percent increase in the sales and earnings profile of the underlying company, especially when you're trading at a very low multiple. In the case for Hewlett Packard Enterprises, at around 10 times this year's earnings on a fiscal basis and 9 times next year's, you can see a pretty significant increase in price, especially for a company that has, about a $30 or so billion market cap.
Yeah, and I think a good point there. And I was honestly discounting. Actually, it was underperforming into earnings. So it's actually weathered the storm of the entire space relatively well here, and seeing a nice green candle today. We'll leave it there, though. Appreciate it, George Tillis, as always, for joining us, and appreciate you for joining me for this hour a day in King Hall. Had so much fun hosting together, but that'll do it for Next Gen Investing for today. Have a wonderful weekend, all. We have the watch list coming up next.
Join me, Oliver Rennick, alongside Schwab Network's options experts as we explore the second derivative. Gamma On is a brand new limited series to take you next level. Subscribe to Schwab Network's YouTube channel now.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your
Catch me on Fast Market, weekdays at noon on the Schwab.
Fast Market, ready for you, ready.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platform needs with nearly endless customization, and track market trends with up-the-minute news and insights. Trade brilliantly with Schwab.
and welcome to Inside the Mind of a Trader, the show where we explore how brilliant traders are wired for success. I'm Dr. Indre Viscontis, neuroscientist and professor of psychology at the University of San Francisco. On this episode, I'll be talking to Kathy Lean. Kathy is a world-renowned expert in trading currencies and the co-founder and managing director of BK Traders. But when she's not trading, she can be seen on CNBC, Bloomberg, and her own popular Forex YouTube channel. Hi, Kathy.
Hi.
So I feel like I already know you because I've seen inside your brain.
I hope you found some things that are interesting.
Oh, so much. But I want to start with asking you what it was like to be a prodigy. At 13, you started college.
Well, it was definitely something that was unexpected. But to be honest, Indra, I felt like I didn't feel that much different. I felt like it was second nature. I'm in an industry where I am often the only female, the only minority, and I was the only 13-year-old at New York University at the time. And I think, from very early on, it was just part of who I am. I'm not, afraid to be the only one in the room doing what I'm doing.
So when you were growing up, did you know that your thinking was different from, say, the other kids in your class?
No, I wouldn't describe myself as a prodigy. I would basically say that I learn things a lot faster and I pick up things a lot faster than most people. And I think that helps me understand concepts. And thank God, New York University made you take classes in many different topics. And one of them was macro and microeconomics. And who knew? It just made perfect sense to me. And it's from there that, I really felt like this was second nature.
When I look at your brain, I can certainly see some of the things that you're describing. Do you want to tell me a little bit about the kinds of cognitive skills that you've developed over time that you think make you a good trader?
I react much more on instinct. And once I've developed a trading system, I have a trading system that I've used for over 10 years now. And it's almost second nature to me. So for me, it's just about developing the habit and repeating the habit over and over again. And it's a complicated process because for me, I'm a trader that fuses what we call fundamental analysis and technical analysis. So I dissect, all of the incoming news flow. I take a look at what the market sentiment is, whether it's a positive day, a negative day. I take a look at whether investors are bullish or bearish, and I combine that with chart analysis. But it happens very quickly for me. This whole process can happen in 10 minutes maximum. So I think, it goes back to my initial learning process. One of the ways that I was able to go to college at 13 and graduate at 18 was because I took, during summer programs, accelerated math learning classes, where I learned different ways to do mathematical equations very quickly. And I think, taking that type of thinking into the real life scenario and trading, I've been able to, recognize the
really interesting. You mentioned intuition, and a lot of people think of intuition as something that it just, you just have a gut feeling, right? Like either because you have this literal physical response or that you're not consciously aware of what it is that's coming into your decision making. It just kind of feels right. And I think a lot of people don't understand that instinct, that intuition is built up over time through learning. And it sounds like that's what you're describing, this building up over time of this knowledge base that now you can quickly query, as opposed to just going with a feeling that, may or may not be based on any actual reality.
I agree. I mean, this is true of many careers out there. I just got off the airplane. A pilot, by instinct, knows how to react in